UCB, this is a biotech business, and they seem to be guiding a little bit higher this morning, so we'll see if we get a pop in the share price there. We're also focused on energy stocks. This is to do with some ratings. So B of A Global Research cutting their recommendation on BP to underperform. So we'll watch to see if that has an impact. Guy.
Okay, here we go. Time for the Friday session. The week is almost close. It's been a long week. There's been some really interesting things happening this week. Where do we find ourselves at the end of the week? Near all-time highs, certainly over in the United States. Europe kind of drifting sideways as the market opens this morning. FTSE 100 up by 0.1%. I'm interested to see how the CAC opens this morning. Maybe there's a little bit more momentum potentially in that market this morning. What's happening with luxury stocks? But Germany, front and center as well. What's going to be happening in Germany today? The politics is going to be having an influence. This 1 p.m. Announcement potentially on this key vote that's happening in the Bundestag today could be crucial for the afternoon session here in Europe. The IBEX is up by 0.2%, the big outperformer so far this year. The CAC's actually not delivering that much on the upside. I was expecting maybe a little bit more, but we're up by 0.3% on the CAC here on. Do we get a little bit more as we kind of start to fully open here in Europe? The DAX and the SMI will wait. We'll see what happens there in just a moment. Anna, sectors, single stocks, what are we looking at?
Yeah, sectors. So I'll start at the bottom of the pack, shall I? And rightly, our team flagging the energy sector to keep an eye on because of that B of A note. And I mentioned BP. It's actually wider than that. They've actually been pretty scathing of BP and Shell. So they downgrade to some degree, both of them. They cut their recommendations on BP and Shell as lower oil and gas prices are deflating refining margins. This is the view of analysts over at B of A, and that has had an impact on the start of trade this morning. So we see the energy sector as the worst performing. BP is one of the fallers within that, so it's down by 2.7%. So we're watching to see what happens with the wider energy space there. So that's the bottom of the barrel. Barrel inadvertent there. Insurance is also not looking great this morning. That sector down. Swiss Re actually down by just over 5%. So there's clearly something in the announcement that they put out this morning. But that's where we are at the bottom. They announced a buyback, which I had mentioned ahead of the open, but that doesn't seem to be pushing the shares higher this morning.
Rolls-Royce, AstraZeneca, EssilorLuxottica, Siemens Energy, Airbus. In terms of the kind of the points, that's where the gains are coming from in Europe. So a little bit of an engineering bias maybe coming through, industrials bias. I think there's a note out on industrials today, actually. Somewhere, I'll find that in just a moment. But elsewhere, a kind of reasonably eclectic mix of stocks. Airbus coming back a little bit. Some of the pharma stocks, which got beaten up a little bit yesterday, maybe coming back a little bit as well.
It seems, and you were flagging the copper price earlier on. That does seem to be pushing the basic resource stocks a little bit higher this morning, even as iron ore prices are a little weaker. But it seems like the copper story perhaps winning out, and the basic resources sector is one of the better performing ones this morning. Let's go to what's going on in bond markets, because yesterday we saw the markets moving, the gilt market specifically moving ahead of an expectation that we'd see the DMO pulling back on issuance at the long end of the curve. We got confirmation of that story this morning, and so actually in the event it seems that the markets don't have too far to move on the news. They moved on the rumour and they moved on the expectation yesterday, and we did see the long end of the curve moving quite substantially yesterday, but that's not the case today. We're seeing a slight move higher in yields, but it's sort of across the curve. Maybe it's already reflected in what we were expecting.
Absolutely. And it's going to be a similar story maybe elsewhere in Europe as well. There's a nice story on the Bloomberg Terminal this morning talking about how the Dutch pension reform may force actually governments to migrate towards that front end, which in some ways is an opportunity, but also poses a risk, obviously, kind of as you bring the duration in. Just means you're kind of more susceptible to the change in the wind. Let's
talk about what's going on in global stock markets then as we head towards the end of 2025 into 2026. Beata Manthi joins us, Head of European Equity Strategy at Citi. Beata, very nice to speak to to you. Thank you for being with us. I'm just looking at some of your latest research, and you say that you remain constructive on European equities. So towards the end of the year, into 2026, what is the key driver that means you stay constructive on Europe?
Good morning. Yes, this comes from our 2026 outlook that has just been published this morning. And the constructive view is based on really many things coming together into the next year, positive triggers, right? So number one, we are having a more resilient global economic growth. It's been very resilient this year, despite the headwinds. We think it's going to remain this way into the next year. There is some softness out of the US labor market. That means the Fed will underpin this constructive outlook with the cuts. We think they are going to cut 3 times. And then domestically in Europe, we are going to have expansionary fiscal policy, finally, next year. This year it hasn't been expansionary yet, it's been restrictive. So we are going to see some of this expansion feeding through into the data. And let's not forget that the ECB easing cycle, that of course has come to an end a few months ago, the effects of that easing will only come through into the economy next year. And we are already seeing it in the outlook for EPS and outlook for broader set of sectors.
So on that fiscal push, we're closely following a vote that's taking place in the Bundestag today, and the German coalition trying to push through some pension reform. And a lot of people are looking at this to give a sense of the authority that the Chancellor has within his own coalition, his ability to deliver his programme, which of course includes a huge amount of fiscal spend. Is that just intact anyway, regardless of what happens with this sort of mini drama around pensions today?
So what I would say is Germany has gone through seismic changes. This type of changes don't come through very smoothly, right? We knew there was going to be some teething phase along the way. But what I would focus on is the fact that the budget has been approved, the money is being issued and deployed. So things are going in the right direction. And look at the economic data, actually. The momentum of economic data in Europe continues to improve as per our City Economic Surprise Indices and underlying data. The data out of Germany today, earlier in the morning, in terms of factory orders,
very strong.
Up, very strong, up, revised up the previous month, and the domestic orders up almost 10% month on month, right? So you can see this fiscal and cyclical revival uptick starting to come through in the data. So that's exactly what we need.
We often talk about the fact that the US stock market is very concentrated, and the Mag 7 has delivered, in terms of the performance, a huge amount. In Europe, it's the banks. The banks in Europe are up 57% this year. The next best performing sector is the utilities, up 25%. Banks, it's all about the banks. You look at the IBEX, massive outperformance this year because of the banks. Are the banks going to deliver again next year? Because that appears to be crucial.
Absolutely. So perhaps you won't have a repetition of such a concentration of and dispersion in terms of sectors' performance that one sector is up 50% and everything else at least half behind. But given this macroeconomic backdrop I've described, this is a very good backdrop for banks to continue to do well, right? And then add to that actually perhaps some sentiment from the corporates picking up, sentiment from the consumer picking up. It's a very good backdrop. So we've been overweight banks, we continue to be overweight banks into the next year. But we also couple it with the sectors that will be beneficiaries of this industrial revival, of the fiscal, and of secular themes that are going in the economy. So today we've upgraded industrials to overweight, we've upgraded basic resources to overweight.
So it broadens out?
So it broadens out, yes.
Should US investors invest in Europe next year? Because the dollar looks like it's going to be a significant factor, a big kind of swing in that story. The IBEX has done very well this year, the Spanish market, driven by the banks, up 44%. If I'm a dollar investor, I've done 62% in the IBEX this year.
Absolutely.
Does that tailwind for European equities continue?
The tailwind continues, but could take a different form, right? Because let's concentrate on this dollar. This is a very good point. Let's not forget that actually I rounded out IBEX to the entire European market that has done remarkably well, especially in the US dollars, despite a big chunk of the market doing quite badly.
Yep.
So it's been a market concentrated and driven by the domestic story. Therefore, banks doing so exceptionally well, right? Into the next year, we see it in the EPS, and the dollar, some dollar weakness into this year will help as well for the upswing in the internationally exposed sectors. So 15% appreciation of euro-dollar has been a huge headwind for EPS of that part of the market, actually dragging the entire EPS for Europe to only 2% from 8% expected at the start of the year. Next year, dollar could be a swing in the EPS broadening, so more sectors doing well from the EPS perspective and therefore performance perspective. And in terms of US investors, I think there continues to be the need for diversification, given the volatility related to the rhetoric around AI theme. Right?
Yes. Let me ask you about how that plays out for Europe next year. Where do we look in Europe, Beata? Clearly we talk about the companies that make the cables, the companies that do the electrification. There are names we can point to, but and energy businesses. Investing in grids and that sort of thing. Is that where the focus remains, on the AI story next year?
I think Europe is at a very interesting crossroads where the broadening of AI, and we think the broadening is not only going to be about the providers of AI, but of users of AI, right? So Europe, with its domestic spend concentrated on infrastructure spend, part of it is build out of data centers, electrification. Our analysts also point out to the physical AI, so robotics in the manufacturing space, right? This is where fiscal spend in Europe, which is quite unique, is going to meet the next stage of AI broadening. So yes, a reason why we've upgraded industrials, because we've been overweight and bullish certain parts of it this year, but we are broadening it out as well.
Two kind of related questions in one, I promise. FTSE 100, is it still cheap? And is it going to be the commodity play next year, as I see things like copper moving sharply higher?
So it's cheap versus other regions, but it has re-rated a lot, right?
Yep.
It's not cheap versus its own history. Nothing is in the global equities anymore, and FTSE 100.
Nothing is cheap anymore.
No, well, you can find some selective sectors, right?
Right.
So value is still cheap versus its own history.
That doesn't include banks anymore, does it?
Well, I would say banks are still cheap, despite an outperformance, because they are still trading at single-digit Ps, and they are versus their own history that we look a lot at.
But nothing is cheap. Not even the FTSE.
They are trading in the middle of the 25-year valuation. FTSE is in the 60th percentile right now. So
cheapish.
It's cheapish, yes, absolutely. So basic resources, definitely, as I've just mentioned, we have upgraded it to overweight. However, FTSE 100 is a very specific sector when it comes to the sector weightings, and it has a lot of weight in defensive sectors. Given the backdrop, you want to be more in cyclicals. So it doesn't mean that we are particularly bearish on FTSE 100. We have a decent upside over the next 12 months, 10%. However, on a relative basis, if the market wants cyclicality, continental Europe is better positioned to do that.
Yeah, defensive, but defence and banks have driven the FTSE 100.
Exactly.
This year. Anyway, Beata, nice to see you. Thank you very much indeed for coming to see us, Beata Manthe, bringing us her outlook, if I can speak this morning, on next year, joining us from Citi. Core 6, let's talk about exactly what we are watching this morning in terms of some of the individual moves that we are seeing. It looks a little bit like this. We're going to be talking to Rheinmetall very shortly. That stock is down by 1.2% this year. Elsewhere, we are seeing farmers coming back, Nestle a little softer. But let's start with the energy space. A big note out this morning, having a big impact in terms of the European space. Let's find out the details of that with Chloe Melle.
Good morning, Guy. Yeah, we are seeing some weakness across the oil sector this morning. So we had JP Morgan double downgrading Eni, and then Bank of America also downgrading BP. So both sets of analysts have said that this is a sector that will have to deal with the risk of oil oversupply coming next year, and that this is a sector that will also be facing those lower oil prices, lower gas prices, and deflating refining margins. And that will put pressure on the cash flow for those companies. And therefore, we are seeing this really drag down those shares, especially for BP, which is down 2.5%, excuse me, this morning. Moving on to the defense sector, we have got two different stories there, with Rank Group up and Hensoldt down, and that's because of a note from a Bank of America, which double upgraded Rank Group whilst downgrading Hensoldt, to saying that there was a really attractive pipeline of opportunity for Rank Group, but that the momentum was probably going to be slowing down for Hensoldt. So it's quite an interesting note that talks about two companies that are within the same country and within the same sector, but with two different stories going forward. Moving on to Greggs, which is up this morning after being rated a new overweight rating by JP Morgan, saying that it's will be a structural winner within that food retail sector. It's up quite strongly on the back of that upgrade. We're up 6.5%. This comes just a few days after news that an activist investor has been pushing Greggs to cut those costs so that it doesn't become a takeover target. But it's a good day for Greggs today. And finally, also a good day for UCB, which has upgraded its guidance for 2025. That is thanks to a really strong performance of its skin disease drug, Bimzelx, and that's really driven that rally over the last year. And we are up also this morning on the back of that guidance upgrade, and we are up almost 6% for UCB.
Chloe, thank you. Chloe Melly from our equities team, of course. Now, coming up on the programme, a Bloomberg scoop: Warner Brothers Discovery in exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. More on that just ahead. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. This is the opening trade, 18 minutes into Friday's session, which is delivering some green on the screen for European stocks, making some modest gains. US futures also pointing higher, E-minis up by around 0.25% to end the week. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Bagori, who's got all the details on this. Manuel, this is a story that's been unfolding for a while. Multiple conversations have been happening, it seems, at the same time. So how significant would this be if we see Netflix taking possession of this, one of Hollywood's crown jewels?
It is a very significant move, definitely also a surprising one by Netflix, which, as we all know, has been trying to find new sources of revenue and growth after being very successful in the paid streaming, becoming the world's largest. But now, obviously, the company needs to diversify and keep growing, and it is zeroing in on Warner Bros., the TV and film studios, plus HBO, as you well explained. A very remarkable move. It's been ongoing for a while. There's been a sale process there where different parties looking at it, but it seems as if Netflix is pulling ahead, and they just enter exclusive talks, which would lead to a potential deal fairly soon. That's what we hear from sources. So definitely a transformative deal in the entertainment industry ahead of us.
That's all, folks. How big a risk is there that this doesn't get done? That regulators stop it? I'm fascinated that all of the stories flag the breakup kind of fee that is being attached to this, and I'm assuming that's there for a reason. Are regulators going to be comfortable with this deal?
Yeah, that's a really good point, and also remarkable the $5 billion breakup fee that we are seeing. We understand that they are actually offering just in case the deal falls apart. The regulatory landscape is always a bit of an uncertain one, and it can go either way. I'm sure advisors are spending lots of time going through all the potential scenarios, but it remains to be seen how possible it will be to actually go from signing potentially the deal in the coming days to actually completing the deal. It might be a bumpy road on that front, and that's why also the fact that Netflix has offered that massive breakup fee suggests that could be a breaking point also for them to gain exclusivity.
Manuel, great stuff. Looking forward to the reporting on this. Manuel Bagori joining us on the media landscape and how that's changing. I want to talk a little bit about how the auto sector is changing, because there's quite significant shifts underway at the moment. Let's focus on Stellantis. Stellantis says buyers apparently are snapping up vehicles in its refreshed Ram and Jeep brands. The reason for this is that they've basically added a whole load of V6s, powerful engines, more options on the hybrid front are also coming through as well. The group apparently received 50,000 orders for a Ram pickup with the Hemi V8 engine in it within 6 weeks of bringing back that kind of powerful powertrain to the market. Let's talk about all of this with our transport reporter, Danny Lee. Danny, the V8 is back, the muscle car is back. Just talk about how this is going to change the outlook for Stellantis.
Yeah, this is a very important time for the relatively new CEO, Antonio Fields, just to get this restructuring, this massive restructuring, to try and revive flagging sales for Stellantis. And ultimately, it's the recipe that you stay true to in business. Give the customer what they want, whether it be bringing back engines on some of those 4x4 pickup trucks or SUVs, and even to bringing in a whole range of hybrid options. Hybrids in markets such as the US has been very contentious. There is changes in legislation and rules which could affect the outlook and the consumer habits. But when it comes to some of its most important flagging brands, the likes of the Ram and the Jeep, these are critical changes that Antonio is making in order to try and revive the brands. And by making these changes, he is feeling more upbeat about demand, and maybe he's thinking about how this feeds into the rest of of the portfolio of brands across Europe that he oversees and presides over. So clearly there is a lot of thinking going on and executing it. And as you said, the 50,000 orders, bringing back a model with an engine, that's a pretty sizable success that he's now can assess and see whether that can translate into maybe other changes to other brands.
Yeah, we saw actually the auto sector was the best performing yesterday in Europe, Danny, as a result of a real shift in expectations for what this sector can deliver from here. Much troubled, of course. So what is the outlook for the wider auto sector as we look ahead into 2026?
Well, the wider auto sector is still kind of dominated by this level of Chinese competition. We already see the Chinese automakers really upping their targets to sell internationally. They've had a lot of success in Europe when you see the likes of BYD, who's outsold Tesla. But still, those legacy automakers in Europe, they are struggling in markets like China. That kind of legacy, the luxury story is also a bit of a struggle for some of the likes of BMW and Porsche and whatnot. So there is a challenge there, and so I think we're probably going to muddle through a little bit of 2026, and as we wait to see a lot of these restructuring and these transformational changes and strategic changes pull through.
But it feels like the Trump administration is backing away from some of the Biden-era emission standards that were put in. You're now starting to see real pressure coming out of Germany for Europe to do the same. Is that going to be the story in 2026, that actually it becomes easier to build old combustion engines than maybe push forward with new EVs?
I think that's a real question, right? Whether, what you see in the likes of the US and whether some parts of Europe, whether that they've calculated that cost, that keeping those combustion engines alive for a lot longer. And of course, I think at the heart of this will be jobs. It's a critical time for Europe, thinking about how to ensure that you keep these economies ticking over. It's those white collar or those blue collar manufacturing jobs at stake. So I think there's going to be a lot of hard thinking and pressure on executives in the auto sector boardrooms to just see what the US does and how they might be able to follow and perhaps also appease Trump on things such as kind of cleaner, greener engines as such.
Danny, thank you very much. Bloomberg's Danny Lee joining us there with the latest on the auto sector. The auto sector, of course, close to the European economy, Germany, France. France, we're seeing the French President Emmanuel Macron has been making a visit to China. There doesn't seem to be a huge amount to show for the visit in terms of deals announced, but
no Airbus aircraft orders.
There we go. We're always looking for that.
Big aircraft orders.
We're always looking for those. But there are pandas. There are always pandas.
Pandas are really so the French are going to get some new pandas.
That's the biggest smile you've done all morning. I mentioned the word pandas.
He doesn't love a panda. So yeah, it's going to be really interesting. Do we get pandas here in the UK if we get a new embassy, a Chinese embassy? What's on the line here?
Hopefully not in the embassy.
Hopefully not. Well, maybe.
Yeah, I mean,
maybe London Zoo.
Bear in mind that they never belong to the people they're.
No, they're on loan.
They're always on loan. Goes back to the 1950s, apparently. Use of pandas as diplomatic ambassadors by China, in this case to France. Coming up on the programme, we're going to talk about the European banking sector. Jose Manuel Campa joins us, chair of the European Banking Authority, the EBA. A new report out today around the risks that they are monitoring for European banks. That's next. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food, I never had this ingredients never used in Japan. Kind of like a wow, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi. But Peru use fresh fish make the called ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make novel style.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. This is Friday, 30 minutes into Friday's session. Happy Friday, everybody. European equity markets are positive this morning, up by 0.3% for markets overall. Pretty similar gains across these European equity markets. US futures have also been pointing a little bit higher. Looks as if we're, at least from this early morning perspective, starting or finishing the end of the week on a high. A lot of volatility driven by central bank policy towards the beginning of the week. Expectations around the BOJ. Does that continue to be a theme as we go through December? The Fed meeting, of course, looms on the agenda for next week, Guy. We've got the Bank of England, the ECB. Plenty of central banking conversations still to be had. So we'll certainly keep those in focus as we look at these modest gains for European equity markets.
Slightly obsessed with the BOJ, and I'm wondering if kind of more hints come next week. They like to pre-warn. They like to keep us on our toes as we go into key meetings. Is that going to maybe eclipse maybe the story around the Fed next week? Plenty of people are telling me no, focus on the Fed, but keep an eye on the BOJ. Huge source of funding for the global economy. Let's talk about what we're seeing in the market this morning. Higher, lower, definitely got a bias to the upside this morning. 412 up, 178 down. Volume is fairly flattish. These are the leaders. We'll whip through these fairly quickly. Novo, UCB, and Banco Santander. Banks have been the key driver. Spanish banks in particular have been the key driver this year. Actually, I think the laggards are more interesting this morning. This Bank of America note on what's happening in the energy space actually having a fairly big impact. Shell and BP are both down on the back of that. BP really quite sort of hit hard by this note this morning. But Swiss Re is also down quite hard as well, down by nearly 6%, 5.7%. It does look as if the return of money to shareholders looks a little underwhelming. The outlook looks a little underwhelming. That seems to be the nod that we're getting through in terms of the reaction to Swiss Re this morning. So its stock is down by, as I say, 5.8%, Anna.
Let's get an update then on some of these central bank stories that we've been covering this morning. Bloomberg has learned that the Bank of Japan officials are ready to raise interest rates at a policy meeting later this month, provided there's no major shock to the economy or financial markets in the meantime. The central bank is also expected to indicate it will continue to raise rates if its economic outlook is realised, while remaining cautious on how far they will eventually push rates up. The German Chancellor, Friedrich Merz's ruling coalition, faces a key vote in Parliament later today. Parliament is to decide on a pension bill, part of the reforms pledged by Merz to reinvigorate the German economy. If the vote doesn't go through, it could precipitate the demise of his leadership only 7 months into its 4-year term. And European nations are looking to lower the length of their borrowing as an overhaul of the Dutch pension system reduces demand for longer maturity bonds. In an early sign of what could lie ahead, Austria's debt chief says this week that it has room to go lower in the average maturity of its debt after years of targeting longer tenors. We had an update from the DMO in the UK with this theme in mind as well, Guy.
Let's bring you a bit of breaking news that we've had over the last couple of minutes. It relates back to actually Friedrich Merz. We'll come to that kind of link in just a moment. But the headline looks a little like this. The US apparently is urging Europeans to oppose a plan. This is an EU plan that we see a loan being used to support Ukraine. And this is the basis of this loan is around the frozen assets, the frozen Russian assets. Now, Merz is meeting the Belgians today, which at the moment the Belgians are effectively blocking this this loan being pushed forward. And it's going to be interesting to see ultimately what comes out of this. But the US, which is, in some ways, this is one of the few levers that Europe has to pull at the moment, this loan, this critical loan for the Ukrainians. And the US are basically saying, no, don't do that. Yeah. In some ways, you can argue this is the US maybe trying to remain in control of the narrative or dominate the narrative. But it's interesting they're pushing back on this particular idea.
Yeah, absolutely. This new line that US has been weighing on some of the European governments to try and oppose this plan is interesting. And we've seen Belgium, of course, being at the forefront of that. Belgium, for their part, they've had concerns domestically that they're the ones that would bear the risk if there were in future legal action taken against Belgium or the EU for having done this. Now, lots of European voices we've heard from them saying, look, we're going to put in place legal systems that mean that Belgium wouldn't have to shoulder all of the legal vulnerability here and all the risk. But that's not been enough for Belgium. And so it will be interesting to see whether Friedrich Merz is taking that message to Belgium when he goes to meet today, or is he mindful of that US pressure?
And essentially the ECB has also kind of backed away from this too. But the European line seems to be basically that the money is here, and therefore it is our responsibility to figure out what to do with it. And Merz's line is, we're not going to leave this to the US. We control this asset.
Yes.
And the US, Washington, does not.
And the ECB hasn't necessarily spoken out against Europe doing this. They just said for their part, they won't break the treaty to enable it to happen. But they've seen ways of doing this without the ECB's involvement.
Okay. We'll continue to monitor this. This is obviously one of the key European stories they're going to be watching today. Let's talk a little bit about what we've seen so far this year. We were talking about this a little bit earlier on the programme. European equity market performance this year has been largely driven by banks. The banking story has been absolutely front and centre. It is by far and away the sector that has driven European performance. Look at markets like Spain, where there has been significant outperformance, and that has been largely driven by the Spanish banks. However, the European Banking Authority, despite all of this, which is a huge positive, is calling for continued vigilance in its latest risk assessment report, citing persistent geopolitical uncertainty, market volatility, and increasing operational risks. That's the headline coming out of it. So let's deal with the details of what we are seeing within this report. The chair of the European Banking Authority, Jose Manuel Campa, joins us around the table. Good morning. Morning. Nice to see you again. This is quite. I'm looking at the European banks and how they've done this year. Up by, 57% in terms of the overall performance that we've seen in terms of their share prices. You are, though, kind of in your report this morning talking about the risks, and you are a regulator, so you understandably kind of want to do this, but the language is quite strong. EU, EEA banks remain highly vulnerable to external shocks due to ongoing uncertainty is the line that really sort of stands out to me this morning. I'm a shareholder in a European bank. How worried should I be by what I read here?
Well, if you're a shareholder of a European bank, you're also a European citizen. If you think about the conversation which you were just having about the tensions of the Ukraine war, the fact is that we're in the middle of a war. We are a lot of tensions. There's tensions that have been rising over the last year. So we think that the geopolitical context is very difficult. And that geopolitical context somehow will permeate into the economy if risks materialize. And banks are cyclical industries. They will be exposed to that. So although the overall performance has been really good in the market, and not just in the stock market, also on profitability, on levels of capital, liquidity, low, non-performing loans, that's all looking very good, and that's great. Risks are there, and we need to be conscious.
But do you think shareholders are underestimating that risk?
Well, I'm not sure, because I think what shareholders have been doing is repricing. A market that has been very, very poorly performing for many, many years. The banks, the European banks, were systemically undervalued on their equity prices relative to other Western banks, Anglo-Saxon banks. So a lot of that has been repricing, catching up, I would call it. Well, I think it's also good, the economic outlook for Europe right now. Unemployment is good. Growth is not great, but it's not negative. We're not in a recession. Again, there's cyclical businesses. So that's good. So I think that's all good. But nevertheless, and this is a risk assessment report. The geopolitical risk is the area where I think we need to focus. And that can materialize in many different ways into the bank's balance sheets.
Jose, good morning. Is there any particular worry about the German banking sector with all of this in mind? We heard from the German business lobby talking about the economy being in free fall. They're trying to persuade the German government to do more. Germany is trying to do a lot fiscally. Is there a particular concern when it comes to the impact of the conflict in Ukraine, the geopolitical realignment we've seen as a result of that is weighing heavily on Germany?
Right. As I said, the geopolitical risk can filter into the economy in different ways. Our focus has been, we think this is more likely to focus more on those sectors that are more exposed to international trade, international activity. The German economy is very exposed to that activity. I think that's the link that is there, and it's reasonable to think that it will be affected. I don't think that's a vulnerability for the stability of the system, but they're more exposed. Also, if I may, from the previous 2 or 3 years, we've also seen increases in commercial real estate exposures that are becoming what we call early non-performance, stage 2. Yes. And that has happened a lot in Germany as well.
I wondered, last time you came in, Jose, we were talking about areas where you wanted more transparency, private markets and the relationship between private markets and the banking sector. That's clearly an area you wanted more transparency. SRTs, significant risk transfers, you wanted to see more transparency there. Are you getting the transparency you need on both of those fronts to assess the risks from those dynamics into the banking sector?
Yeah, if I may, on those 2 examples that you put, the situation is quite different. I think on SRTs, I'm positive. I think we're making a lot of progress. There's also a proposal from the Commission on enhancing the securitization market in Europe, which I think will go in the right direction, and the co-legislators hopefully will approve that soon. So that's good signs. On the other part, I think we still have a big black hole, and I think that we need to continue to focus there in getting more information, better understanding of what the different linkages are, where leverage may be, where liquidity mismatch may be within the non-bank private credit sector that continues to grow, by the way. So that's an area of focus.
Bank of England's doing stress tests or trying to kind of talk to the industry about this. Do you welcome that? Do you think that there should be more of that? Are you thinking about doing something similar?
Yeah, absolutely. I think it's a very good exercise. When you make stress tests, also, I take it that you said to the non-banks.
Yes.
Yes, absolutely. I think that we need to have more information on how that part of the financial sector that's been growing a lot. And I'm not saying that it's all solely potentially dangerous.
Yeah.
I'm saying it's just been growing and we don't know.
But do you think you should do? They're trying to launch. It's a voluntary process. It's not something that is formalised in the same way as stress testing the banking sector. But do you think you need to be doing more?
I mean, I think both at the at the global level, the Financial Stability Board is working on this.
Yeah.
At the European level, the European Systemic Risk Board, and we're working with them in trying to understand a mapping.
Yep.
How that overall sector is working, what the interlinkages are, and where potential vulnerabilities may be there. And I think that's an area for us of focus and that we will continue to work in the coming years.
Thinking about risks, I wonder what your take is on, do you think that European banks have become more interested in stable coins? And if so, what is the reason there? Because I've heard lots of suggestions, Jose, about how this actually does link into geopolitics, and it links into the way that the dollar perhaps is becoming dominant after the Genius Act in the dollar stablecoin space, therefore, and that European banks have something to fear from that and therefore are keener on a European version.
Yeah, no, I think there's big interest. I would distinguish between stable coins. I would also distinguish between technology, crypto technology being used in the financial sector, because you also have tokenized deposits, you have different ways in which the technology can be filtered. But we have seen announcements of projects by banks. Last week there was an announcement by 10 banks, 10 large banks in Europe putting forward a project to build a stable currency in Europe. We have been seeing interest. I would say that take-up is still relatively slow.
Yes.
But over the long term, I think it's important to follow that.
Is that because, though, of worries about what the Trump administration could do in terms of access to payment systems, or worries about dollar dominance in stablecoins?
Yeah, I think the area that's concerning for us is, first of all, we see that there is a difference in approach from the European to the Americans, particularly in 2 areas. Europe has a digital euro project, which they're spending a lot of time. In the US, they have made clear that they don't want to develop a CBDC, a central bank digital currency. Second part, as you said, the US is putting a lot of emphasis on the innovation aspect that the industry can bring. We tend to be more concerned about the risks that the industry may bring. So those are 2 big differences.
Okay, thank you so much for joining us. Really good to get your perspective on a host of risks, I guess, pertaining to the banking sector. Jose Manuel Campa, Chair of the European Banking Authority. Speaking of the banking sector, Bloomberg will have an interview with the Bank of America CEO, Brian Moynihan. That's at 9:15 London time. So that's certainly worth staying with us for.
You want to stay with us regardless, because we've got some great conversations coming up on this programme as well. In a moment, we're going to take you to Dusseldorf. Armin Papinga is the CEO of the German defence giant Rheinmetall. Oliver Crook will be in conversation with him very shortly. That's coming up. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back. This is the opening trade, 8:46 here in London. Over to Germany now, and Germany has ramped up defence spending to 108 billion euros, the most since the end of the Cold War. The move aims to bolster the armed forces and equip Germany to tackle a growing threat from Russia.
Peace deal or ceasefire, anyway, both things are strongly connected, but I think still it calls for action in Europe to actually ramp up, fill up stockpiles, and here I see still defense spending. I mean, the plans are there, that the demand is structurally high, which has been confirmed in a couple of meetings I had with German politicians, so we expect that the next 10 to 15 years, defense spending will continue.
That was the Hensoldt CEO, Oliver Dure, speaking to us a little bit earlier on this week. Well, our very own Oliver Crook is in Dusseldorf today with another company that expects to benefit from Germany's increased spending. Oliver.
That's right, Anna. With all that spending in the German government in focus into the sort of military, we heard there from Hensoldt. We're happy to hear now from Rheinmetall, the CEO, Armin Papperger. Thank you so much for joining us here at your headquarters in Düsseldorf. I'd like to begin with the sort of flurry of diplomatic activity that's currently happening around Ukraine. If there is, in fact, a peace deal, first, what do you think the prospects of a peace deal are? And second, what does it change for Rheinmetall if, in, say, 2 weeks, there is no longer a war?
I wish that peace is coming in Ukraine because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard to that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunitions, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. But if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
And I think that in order to achieve that, obviously, the scale of ambition has to be very large. I would say that Rheinmetall seems to have much higher ambitions than many of the other CEOs that I speak to within the industry. You're building the factories. A lot of other CEOs are a little bit more cautious in their approach. What accounts for that difference in Rheinmetall trying to take advantage of that once-in-a-generation opportunity? Why do you think you are prepared to do that in a way that your competitors are not?
We believe the demand is high for the next 10, 15 years. And I'm not responsible for other companies, so I will speak not about other companies, but we believe that the way that we are doing that is absolutely the right way. We enable the governments, that they can react very fast. We create capacities here in Europe, which are also able to produce a level of ammunitions, of tanks, of electronics, which is on a war level.
And you want to close a lot of the gaps that exist in the European system. You've gone into new territory to do that. Where else do you see gaps, do you think, that Rheinmetall could fill? We've talked about satellites, for example, very recently.
Yeah, we started as an ammunition company. We stepped into platforms. Now we are not only on land platforms, we want to go onto the naval platforms. But everything, the glue between that stuff is digitization. And for digitization, you need also satellites. That is that we go into the satellite business, but we also go in new ammunition types like drones. And we produce this year for 120 to 130 million euro drones. So we are also a huge drone, or one of the biggest drone producers in Europe. But nobody takes care about that because the figures are still too small.
And thinking about the sort of the future and the degree of growth that you were sort of preparing for, there are always growing pains when you are growing at that rate. Where are the growing pains right now? Where are the areas of concern that you need to figure out? Is it labor, getting the kind of people to specialize in all of the things you're moving into?
We get a lot of people. So we have, this year we will have about 300,000 people who want to join Rheinmetall, which is great. And we can pick out 10,000 people because we hire about 10,000 people per year. The biggest problem that we see, don't call it problem, the biggest issue is that we bring the supply chain really under control, that the supply chain can grow like we grow.
And thinking about the supply chain, because that's the lesson we've learned during the pandemic, and we keep learning every couple of quarters. One of the issues in the supply chains that we've had a lot of attention on recently, raw materials, critical raw materials, rare earth metals. How close are you to being completely secure in that domain? How much of that of your time does that occupy?
We check it weekly. Yeah. I get a risk report every week on rare earths, on different materials, and we have to check it. And at the moment, we have it under control. Is that forever? I think for the next 12 months, everything is fine. For other materials like linters, we are fine for the next 4 years. So therefore, we do a lot.
And thinking about that risk assessment, do you think about potentially relationships souring with, for example, China, where a lot of raw materials come from? How insulated are you about that? How often do you think about China and its role within your supply chain, and how are you adapting it?
The Chinese part of our defense materials that we have is less than 1%. So it's very small. And China is, at the moment, in different areas, a very reliable partner. In other areas, like rare earths, is that they made a stop. But we can find other sources, so it's possible.
And I'd like for you to sketch a vision for us of this ambition, this massive ambition that you have for Rheinmetall, what this business looks like in 5 to 10 years from now, and potentially also how important you think that that is to European sovereignty, because we've learned what dependencies in Europe look like and the consequences that can be.
The European politicians are very clear about that. We must be a partner of the United States. At the moment, we are not a partner because we invested nothing over the last 30 years. And as I always said, President Trump is absolutely right to say, okay, the Europeans has to invest more. Now they invest, and with that investments, we become a partner, and then we can create also more technologies here in Europe.
And then one final question about the SAFE program within Europe. I mean, there's a lot of discussion that happens in Brussels. Very rarely does it turn into actionable programs. SAFE is one of those programs. It was oversubscribed. How important do you think would it be to get a SAFE 2 program, for example, for the Europeans to push that through? And how much of a difference would that make in satisfying precisely the ambitions that these politicians are talking about?
The SAFE program is a perfect program. SAFE and ASAP. I believe that ASAP 2 would be also very important with the direct investments to the industry. But SAFE is very good for the governments. And the governments now, especially also in the Eastern European side, but all the other Europeans also, Germany is not using it. But it's very important for them really to have safe investments in this area. Great program that the European Union started.
Well, Armin Papegger, thank you so much for your time and welcoming us here in your headquarters in Düsseldorf. That is the CEO of Rheinmetall there, with sketching out his ambitions, not just for the business, but also European defense further out for the next 5, 10, 20 years.
Oliver, thank you very much indeed. Fascinating conversation, particularly in the light of the news we've learned this morning about the US urging Europeans to oppose this EU plan to use frozen Russian assets to continue to fund the war in Ukraine. That obviously a huge geopolitical story that is developing right now.
Yes, and we'll continue to watch German politics with that in mind, with his trip to see the Belgians today in mind, and also what happens domestically in Germany. Will the situation that we just heard described there on German industrial spending and defence spending come to pass based on the politics?
You're going to want to stay tuned. Brian Moynihan is sitting just over there. He's going to be on the pulse very, very soon. Bank of America coming up next with Francine on the pulse. The week's nearly over. Not just yet, though. Plenty still to come. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German chancellor braces for a key pension vote in parliament that could signal the end of his coalition if he loses. Plus, we have some spectacular guests for you this morning, including Brian Moynihan, chief executive of Bank of America. We also speak to the U.S. ambassador to the EU and the new lady mayor of the city of London. That's also a conversation on regulation and banks. Now, first thing is first, let's check on the markets. And again, there's quite a lot going on. This is the picture overall. Now, the S&P 500 on track to push towards a new all-time high. Investors really tilting towards risk on growing confidence in the U.S. economy and the prospect of interest rate cuts. You see the U.S. 10-year yield at 4.1079. Look, euro-dollar 116.53, and then the one we also need to watch out for is copper at 11,639 points. Now, with a rate cut next week all but priced in, there's quite a lot of thinking around what the Fed does next, again, for further policy easing into 2026. Investors now gearing up for a potential year-end rally. So let's get on to the European markets map also to have a look at what the CAC 40 and some of the others are doing. You can see, again, I think a lot of the focus will be on Fed, and so therefore that data from the U.S., the DAX gaining 0.5%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a consequential day for global politics with world leaders on the move against the backdrop of the Ukrainian war. A Bloomberg scoop this morning, the U.S. urging Europeans to oppose EU plans to use frozen Russian assets to back a massive loan to Kyiv. Now, it comes with the Russian President Vladimir Putin in New Delhi as he looks to deepen economic ties with India despite pressure from the White House. Meanwhile, the French President Emmanuel Macron is in China meeting President Xi Jinping with panda diplomacy back on display. Now, here in Europe, the German Chancellor faces a crunch vote that could lead to the demise of his ruling coalition only 7 months into a 4-year term. So joining us now, Julien Lafargue, Chief Market Strategist at Barclays Private Bank. We're also joined by Tina Fordham, founder of Fordham Global Foresight. So thank you both for joining us. I know you're looking at eco and a lot of the data. Tina, you're looking at diplomacy, and it feels like everything's happening at once in these 2 days. How would the U.S. President, actually, Donald Trump, first of all, look at Vladimir Putin and Modi in India today?
Well, he was a little bit sad, wasn't he, when they all met up, Xi, Putin, and Modi at the Shanghai Cooperation Organization meeting. He seemed to feel a bit left out. But I actually think that the Modi-Putin meeting is important, especially for Modi, who is working hard to show that he won't back down in the face of U.S. threats. But I think the real event is what's happening in Brussels today with Merz and Bart de Wever.
And so what are you expecting there?
I don't expect there to be a breakthrough, but it's impossible to underestimate how important this issue of the use of frozen Russian assets is to the outcome of European security, and then coming on the back of this bombshell new U.S. national security document that was published last night.
Julian, give me a sense of what this means for investors. I know investors have, I guess, seen points of stress, and that's translated into oil because of all the geopolitics. But actually, they're now largely, looking through a lot of the tariffs concerns. Could that come back at the forefront when you see big leaders across the world trying to sign deals?
Yeah, clearly, I don't think we're done with tariffs. Of course, we're waiting for the Supreme Court to express its opinion around the reciprocal tariff. It looks like, look, we're moving into a much more multipolar world, and so you're going to see alliances form in different corners of the world. And the result is you're going to have much more volatility and headline volatility around geopolitics. So this is something that we expect to continue in 2026, but way beyond as well.
Okay, let's also talk a little bit more about, of course, the visit of Vladimir Putin over in India. Our senior reporter, Dan Strumpf, is in New Delhi. So, Dan, just bring us up to date with the developments there.
Hi, good morning. Yeah, that's right. Vladimir Putin arrived here in New Delhi just yesterday. Today, we saw both Putin and Modi in their first bilateral meeting taking place this afternoon. We don't know exactly the outcome of that meeting just yet. We're expecting a press conference to bring some announcements there, which could happen actually just any minute now. But we do know that economic and trade talks are really at the center of this visit. Both sides have signaled that they are very eager to deepen their trade and economic partnerships, as well as partnerships around areas like migration. Is kind of a real way to sort of show that this partnership between India and Russia is alive and well in the face of pressure from the U.S., which both countries are facing quite heavily right now.
But so, Dan, I mean, is this on oil? Because India still needs quite a lot of Russian oil. And is there a danger that actually Washington reacts quite badly by imposing extra sanctions or try to break the two apart?
So Russia has been a growing supplier of oil to India this year. Now, that's been a real source of strain between the U.S. and India. India has been working to reduce its reliance on Russian oil, and that has come down in recent months. Now, what we haven't seen is the U.S. respond with an easing of its really quite debilitating 50% tariffs on India in response. And so what's happening is that India and Russia are looking to expand their partnership beyond these sort of traditional areas around energy and around defense to include a much wider range of trade in other goods. And for India, that really helps to kind of offset the impact of those tariffs from the U.S.
Dan, thank you so much. Our senior reporter there in India, Dan Strumpf. Julian, again, does this show up in inflation data at the margins if we're going to see more geopolitical allies and blocs coming together?
Well, we haven't seen it so far. If you look at what oil price has done year to date, clearly, it doesn't feel like we are in this world where geopolitical tensions are quite significant. It will obviously create some tension, especially if we're seeing more tariff being implemented. But I think at this point, it's very difficult to expect more tariff to be implemented as we're waiting for this decision by the Supreme Court.
And Tina, I mean, this also comes, I mean, there are two other things, right, going on at the same time. Emmanuel Macron is in China, so I want to get your thoughts on what that means for Europe trying to, have a better relationship with China, maybe to counter India and Russia. And the other thing is also the German chancellor is really in a sticky spot. So how much does that weaken Europe?
Europe is caught between coercive powers. We always knew that 2025 was going to be a big wake-up call. But the really astonishing turn of events, again, mentioning this new U.S. national security strategy, is how the United States, Russia, and China appear to be treating Europe as a diminishing concern, despite being the world's third largest trading and economic bloc. And the way that feeds into support for leaders in elections and everything else really matters. What Macron is doing is hedge America. And similarly, Putin and Modi meeting today are also looking to shore up alliances. More volatility, has been mentioned, but what we're talking about is the remaking of the international global power structure, which won't settle into a new pattern. This is going to be messy for an extended period of time.
The other thing, Tina, that I want to ask you about is that you're also writing extensively on this U.S. public discontent with affordability in the U.S. Does that really goes against the Trump administration? Are they being blamed for it?
So the affordability crisis is really, top of the list for U.S. public concerns as we head into this midterm year. We had the Tennessee special election take place, and although the Republican candidate won by a very comfortable margin, that district was won by President Trump by 22 points, and it dropped quite a bit. So there's a lot of panic in Republican corners about affordability. What matters is what the response is. At this point, the Republican National Committee response seems to be double down on MAGA, and you've seen President Trump say that affordability is a Democrat hoax and other kinds of dismissive terms. This reminds me of what the Biden administration was saying when Americans were upset about inflation, despite the fact that his administration achieved other goals. And it turns out inflation is really the most toxic factor in politics in developed markets.
And Julian, so what does that mean? It seems that uncertainty is probably the only uncertainty for 2026. So how do you build on that, given what Tina was saying for the markets?
I think, we've just released our Outlook 2026, and frankly, it was one of the toughest ones to write because there are so many wild cards that having a clear view as to how 26 will play out is very difficult. I think you want to do two things. You want to focus on the really strong underlying trends and build on that. And the second thing you want to do is you really want to be a bit more agile and tactical this year because the narrative is going to keep shifting, whether it's tariff, whether it's the Fed, whether it's geopolitics, and there's no way to predict how this is going to play out. So we have to approach every quarter with a different pair of eyes and see how we're going to position for the next 3 months, and then we do that again. I think that's the only way.
So, Julian, do you actually see opportunities beyond the U.S. and beyond AI?
Yeah, I think definitely you want to be able to diversify away from the U.S., away from AI. One particular part of the market that we think is extremely attractive at the moment is everything that is linked to quality. Quality as a style has underperformed massively. There is no reason why you shouldn't own quality if you're investing for the medium to long term. And we see this is where you want to put your focus on, whether it's on the fixed income side or the equity side. Quality is probably the style that we prefer at the moment.
And Tina, what's your wild card for 2026? Does geopolitics really also work through AI and this massive fight between the U.S. and China to be number one in the game?
Well, I mean, I would say this, Francine, but geopolitics does cut across all of these topics because, as you've heard me say so many times over the years, geopolitics is about power and power projection. It's not a negative externality, as economists like to talk about it. So whether it's AI, critical minerals, energy security, or these frozen Russian assets and how they are disposed of, it all comes down to this great power competition. And the other countries, middle powers like India, Saudi Arabia, Brazil, for example, really fighting to have their weight and their agency register in the global system. It's tough out there.
Yeah. It certainly is. Tina and Julian, thanks so much for joining us. Julian Lafargue, Chief Market Strategist at Barclays Private Bank, and Tina Fordham, founder of Fordham Global Foresight. Coming up next, we'll be speaking with Brian Moynihan, the Chief Executive of Bank of America. We also have two other interviews you don't want to miss. The U.S. Ambassador to the EU, and of course, a new Lady Mayor of the City of London, also a little bit later on in the program. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, we've had a data blackout after the longest U.S. government shutdown in history. Investors, of course, closely watching the release of key inflation data a little bit later ahead of a widely expected rate cut by the Fed next week. Let's discuss what it means for the U.S. economy and the banking sector on Wall Street with Brian Moynihan, Chief Executive of Bank of America, which also just laid out new financial targets at its Investor Day last month, its first in almost 15 years. So, Brian, thank you so much for joining us. Congratulations on the Investor Day.
Oh, thank you.
I'll ask you about that in just a second. But first of all, how's the U.S. economy doing, actually? How's the U.S. consumer holding up?
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money, our 70 million consumers who's pushed about $4.5 trillion plus in the economy every year, they pushed in about, for that month, about 4.5%. And so it was good, and around the Black Friday in the U.S. and Cyber Monday and all the things they talk about, the spending was solid and good, and it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort of sort the aggregate economic impact of the consumer, our 70 million consumer spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
Would a Fed cut help?
A Fed cut helps, and our team believes the Fed will cut next week. They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
And sticky.
It's sticky, although right when they started raising rates, people told me it takes 5 years to actually squeeze out inflation, and people just aren't patient, and so it takes a while. So it's been coming down, and it's it's sticky. Is that it's not making the incremental progress a little different? But I think the belief is because the labor market's softer, they'll lower rates. That's how our team got there. But we get into the hand-to-hand combat of next month and next week, and this. The question really is longer term. Our team thinks the Fed gets down to about a 3% Fed funds rate. The 10-year rate sits in 4.25%, 4.5%. And that's a more normal rate structure for the United States. And I think that's not a bad thing. If you have a little higher inflation, a little faster growth, and a normal rate structure, then I think the incentives created by very low rates and stuff are out of the system, and I think people can then act on economic incentives.
And so what does that mean? That animal spirits are back in terms of also, IPOs and M&A, or does it take a while to settle? The market was also a little bit of a tissel because of the possible new Fed chair being Kevin Hassett.
Yeah, I think you've got to, I walked the trading floor this morning, you got to sort out people who worry about 5 basis points on the 10-year versus people who worry about the next 50 years of the United States and a strategic view of the world. But if you look at companies, the activity kicked up after the new administration came in because there are a couple things. One was that you could get deals through the system, get them done, especially the United States, and that's important. So in our industry, which we are not allowed to make any acquisitions deposits by the law, it's been on books for 30 years. But in our industry, as an investment banking firm, our advice is you can get deals done, and you're seeing the time frame to approve a deal drop by half. And that's important because the idea of a deal being open for a year and a half, that's tough on the companies. And so that's good news. Then the second thing is settling out the major policies that you guys talk about every day on trade and immigration and tax. Those are settling in so people can see that. There's still work to do. But I think that means that companies can look and discount cash flows and make decisions. And then even a rate structure that's higher, as long as it's consistent, they can plan into it.
Brian, you know Kevin Hassett, and you've known him for quite some time. Yeah. What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's a lot of commentary about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with, Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say, some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think, again, they're ready to do deals?
Well, generally there's things that you look at, you say, I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much you can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clear that there's sort of 10 to 15% increase is generally across the board result. That's helped businesses understand it better. And so I think that's been worked into their plans. And that's why you're seeing the relief come off from Liberation Day, where people were very confused to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique, but I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes, but generally they're more worried about the ability to address markets and drive. And I think one of the things administration's worked on that gets lost in the percentages and count is the non-tariff barriers, and those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States but around the world, because to get access to markets without having to change product is a big deal.
What's your take on the UK? So we had a budget. It didn't 100% go well for all companies, but I think there was a sigh of relief that at least we know what there is. JP Morgan's building, massive building in London. Are you committed to London?
We have 6,000 teammates. We just announced we're adding another 1,000 teammates in Belfast that will specialize in certain areas that we know we can get the talent there and help grow that economy. And so we're in London. We believe in London. We've been here for a long time. It's just part of who we are. I think the UK, London in particular, is a great place for multinational, international operations. So Bernie Menza runs international is here, and I walked the trading floor today, and the Asian traders and the Middle Eastern traders and the EU traders, and everybody was up and working, and so I think it's a great thing. The key is for the policies to make sure that you distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. Because if you're a good place with the rule of law and the great city that London and the great country that UK is, there's plenty of upside in the world where there's not that many places where people can get young kids to go to work. We're just about young kids. Remember, we bring 2,000 kids in from school every year. They've got to want to work in the cities, and so New York and here and other places have a leg up if they just handle it right.
So what do you tell the Prime Minister?
I tell them to make sure the regulation's fair and protect it, but also materiality is the hardest thing for governments to understand. We have 6,000 teammates here. It's an incredibly important operation. It's 20% of our revenues. Our international business is growing nicely, but it's 20% of our revenue and things like that. We have hundreds of billions of dollars of capital to make sure things are all right. So if you make it hard to operate, that's when people start to make decisions, or make it uncomfortable for taxation for their workers. That's where they make decisions. Or expats coming in, that's where they make decisions. So I think our advice is be the best place for a non-UK based company to operate, and you'll get companies coming here. And it won't be that people leave, it's just where the next 500,000 people are going to go.
Brian, talk to me about your Investor Day. I mean, this was the first in 15 years. You set up some really ambitious targets. Are you happy with the way it went and the way it was received?
Yeah, it was great. It was a chance to show the hugely competitive advantage we have as a franchise, the moats we have on it, what all the technology spending done. We talked about what we do in AI that people are asking a lot about. We showed that it's actually not theoretical at Bank of America. The Erica will interface with 2 million customers today at Bank of America, which is an AI bot. So we gave that view, and we showed in each of the business how the competitive position they have. Their top businesses, number 1, number 2, number 3. They're growing organically, have been. And then the returns come back as the NII and the pricing on the fixed assets. So we talked about our net interest income growing at 5 to 7%. The industry's growing at 2 to 3%. That's really coming from the balance sheet, continue to reprice while we generate good organic growth. And it was good. And so we thought the returns would reach 16% return on tangible common equity, moving up to 18. And last quarter we had 15, and we grew EPS, I think 25, 30%. It was a good quarter, and the team does a great job for us.
You know, I need to talk soccer or football.
Yeah.
I may get my nationality pulled away if I call it soccer, but are you now a football guy? I mean, you're sponsoring FIFA. The World Cup is coming to America.
Well, I have to say, as an American, I am a football person. It's just not the same football. Look, the draws tonight, we're very excited. We are a sponsor. We are the major financial sponsor for FIFA, working with Johnny and the team for the last 3 or 4 years now on this. Our team has got a set of programs. Just today we announced that if you apply and get a credit card, you get a chance to go into lottery to buy tickets and things like that. And our clients are excited. The cities are hosting are excited. We're working in the cities. We're working with other colleagues, other companies to put fields in these cities, FIFA and Visa and others. These are all important things, because what we're trying to do is bring soccer into places and have it, when the World Cup goes away, which will be a wonderful event, to have the FIFA World Cup continue through these fields.
Brian, the most difficult question, who do you support if not USA?
well, we have
your
to support
second
the
team.
USA.
I know, but your second team, do you have a second team?
I've got too many colleagues around the world that have come after me for that.
You're going to get the calls, the hate calls. Brian, thank you so much for joining us. Brian Moynihan, Chairman and Chief Executive of Bank of America. Coming up, our exclusive conversation with Andrew Puzder, the U.S. Ambassador to the EU. We discuss the Russian invasion of Ukraine and, of course, competition and regulation concerns in Brussels. That's next, and this is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi Zahran, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German chancellor braces for a key pension vote in parliament that could signal the end of his coalition if he loses. So let's return to our top story this morning. And Bloomberg understands that the U.S. lobbied several countries in the European Union in an effort to block EU plans to use frozen Russian assets to back a massive loan to Ukraine. Now, U.S. officials argued to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. Well, joining us now for an exclusive interview is Andrew Puzder, the U.S. ambassador to the EU. Ambassador, thank you so much for joining us. So because of this Bloomberg scoop, can you just run us through the logic or exactly what the U.S. wants?
With respect to the Russian assets loan? Is that what you're asking?
Yes, yes, Ambassador.
Can you hear me?
We understand that some U.S. officials have lobbied several countries in the EU to block EU plans to use some of these Russian frozen assets. What's behind that?
The first I heard about that was when I walked into the studio this morning. I haven't been briefed on it, and I have no idea.
Okay, Ambassador, do you think, is there a concern? I mean, have you heard about some of your officials briefing, or have you had calls from EU trying to understand what the official U.S. position is? What do you think the official U.S. position is on this?
Well, I don't want to speculate on what the U.S. position is, and no, I haven't had calls from anybody in the EU or the administration on this issue. Again, the first I heard about this was when I walked into the Bloomberg studio this morning, so I have no idea if there's been lobbying, or if there hasn't been lobbying, or who would be doing it.
Ambassador, talk to me then a little bit about regulation. You've spoken on regulation about the need for the EU to pull back its regulatory burden. What specifically are you referring to?
Well, I'd say the two principal areas would be what's called the Corporate Sustainability Due Diligence Directive, the Corporate Sustainability Reporting Directive, and then the Digital Marketing Act and the Digital Services Act. I think those are really contrary to the EU's best economic interests. One of them makes it very difficult for the EU to get inexpensive energy, which it desperately needs, and the other makes it difficult for it to get the cloud services and the sophisticated AI software that they need and the investment they need here on the European continent to participate in the AI economy. So as the U.S. ambassador here, of course, I'm very interested in advancing President Trump's efforts to make America safer, stronger, and more prosperous. But that doesn't mean we have to leave Europe aside. We want to make America great again, but we'd like Europe to be right there with us, particularly in this AI war. And these regulations make it very difficult for Europe to participate in the AI economy.
Ambassador, yesterday, I mean, we heard a post that was quite aggressive on X from the Vice President J.D. Vance on the EU Commission's plans to fine X for not engaging in censorship. Again, I mean, we understand that the EU, is talking about breaching transparency requirements. What's your take on this? Is it censoring, or is there a way forward?
Well, I will say it's somewhat of a coincidence that every company that seems to get fined with respect to these digital services or Digital Marketing Act violations is an American company, and so I have not. The X fine, the news just came out last night. I haven't had a chance to look through and see what the basis of that fine is, but I know the Vice President is very concerned about limits that are unfair against American companies, enforcement of legislation that's really contrary to the spirit of the free trade agreement, where we're trying to eliminate non-tariff trade barriers when you're singling out American companies for regulatory action. That really is not within the spirit of that agreement. And he's also very concerned with aspects of free speech. The First Amendment is a very important right in the United States, the right to free speech, the right to free expression, and the Vice President is very concerned about violations of those rights.
Yeah, I mean, I think the Commission is talking about, accessing data, misleading users with potential fines. They have not decided yet. Ambassador, do you think it's targeting U.S. companies, or is it just targeting companies that happen to be American?
Well, they happen to be American because the legislation was drafted in a way that would basically cover only American companies. I think there's 8 companies that are covered by this legislation. I think 7 of them are American companies. And the only substantial, meaningful fines that have been imposed so far have been against American companies. So at some point, if you're an American company, you've got to sit back and say, look, am I being targeted here? Or is this an effort to try and advantage European competitors over U.S. companies? And if that's the case, it's something that the United States needs to respond to. And I believe the Vice President has been very active in that respect.
Ambassador, let's also look at the Corporate Sustainability Due Diligence Directive. Where do you see this going?
Well, I don't know where it goes. There's 2 problems with it. One, the big problem is that Europe needs energy. If Europe's going to run an industrial economy, it needs inexpensive energy or reasonably priced energy, and it needs abundant energy. And if it's going to participate in an AI economy, it needs even more energy because you have these terrific energy demands that come with these large data centers if you're going to be a participant in the AI economy. And both President von der Leyen and Professor Draghi have been very adamant that Europe needs to participate in the AI economy, and the U.S. would like Europe to participate. But when you pass regulations that impose net zero mandates on oil companies, and when those mandates reach not only into the supply chain, the direct supply chains, but the indirect supply chains of companies that really have no nexus to Europe, that don't do business here, don't want to do business here, but are somehow in a supply chain of a large multinational oil company or fossil fuel company. When you make those kinds of restrictions, you make it very difficult for these producers to supply Europe with the energy that it needs. So I think it's a regulation that just is not in Europe's best interest and is not in the best interest of making Europe a prosperous and vibrant economy.
Ambassador, what about steel and aluminium? I know EU exporters, for example, are being hit by 50% tariffs, with 400 items now being subject to this tariff rate. Is there any progress or any sign of breakthrough in this?
Well, the idea with the iron aluminum tariffs, both the United States and Europe now have 50% tariffs. Originally, the United States was concerned that China is dumping steel and aluminum on the market, and we wanted to make sure that these derivative products, the 407 that you mentioned, that they wouldn't contain Chinese steel or aluminum, which could get dumped in America. Now, Europe is saying that's not going to happen. That's not what they're going to do. Our Secretary of Commerce and our trade representative were here in Europe last week and made it clear if we can make some progress on these lawsuits, these regulatory actions against America's tech companies, if we can make some progress there, we can make progress on these derivative issues too. So I think both sides are talking, both sides are negotiating, and I think eventually this will get resolved. I just don't think it's been resolved yet.
Ambassador, I just wanted to go back to Ukraine, because today is a very, very crucial day for the EU's plan to tap these immobilized Russian assets to help Ukraine. What do you understand the U.S. position to be today?
Look, this is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. I don't want to comment on this area and have some impact on negotiations I'm not involved in. And so it's really difficult for me to comment on it.
I understand. We're just, if the U.S. were to call European countries to try and tell them, like, look, this is not the right way, do you think there's a danger that the U.S. is trying to force Ukrainians to capitulate to Russia? Is this how you would see it?
Well, I'm not going to comment on a hypothetical. I'm certainly not going to give my opinion on an issue where I could actually have an impact on negotiations that I'm not involved in. That's just not that's not something I would do.
Ambassador, thank you so much for your time, and thank you for joining us. Andrew Pusder, they're the U.S. ambassador to the EU. Now, turning to defense, and Bloomberg's chief Europe correspondent, Oliver Crook, sat down with the chief executive of Rheinmetall earlier this morning to discuss the challenges facing the sector.
I wish that peace is coming in Ukraine, because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard to that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that, because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunition, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. And but if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
The Rheinmetall chief executive speaking with our chief Europe correspondent, Oliver Crook. Now, coming up, we'll be joined by the new Lady Mayor of the City of London, find out how Susan Langley plans to attract investment to the capital next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Welcome back, everyone. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and the HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Baigori. Manuel, how significant would this be?
Francine, it is very significant. Indeed, it's a transformative deal in the entertainment industry, not just in the U.S., but globally, right? Netflix has become such a major powerhouse, and Warner Brothers is such an iconic brand. So it sounds like they're getting closer to the potential sale of the film and TV assets as well as HBO Max. So that would definitely create a formidable company in that space, and it will also send some shockwaves for other competitors. Comcast, Paramount, among others, were also eyeing these assets. So definitely a big transaction that seems to be just days away from a potential announcement.
Manuel, thanks so much. Manuel Baigori there with the very latest on Warner Brothers Discovery. Now, the City of London remains a global hub for talent and wealth, but has faced challenges over recent years. Well, someone tasked with improving the outlook is the new Lady Mayor of the City of London, Suzanne Langley, who joins us now. So, Lady Mayor, first of all, congratulations on the appointment. You come adorned with...
I come adorned with, yes, an awfully large badge. Yes, I do.
I mean, an awfully large badge because you have, an enormous job, actually. What do you hope to achieve over the next year in trying to promote London's financial services to the world?
Well, the role of the Lady Mayor is the ambassador for financial and professional services in the City of London and for the UK. And I like to think of the Mansion House as the embassy for FPS. So really, my role is to promote the city, 100 days overseas, travelling as global ambassador. But for the city, we have to focus on matching capital with opportunity, and that's both financial and also human talent.
Yeah, so what will you focus on? How do you attract more talent to the UK? Finally, we had the budget. It feels like it was a long time coming, or certainly there were quite a lot of leaks in the run-up. What can be improved on?
Well, you're absolutely right. There were a lot of leaks in the run-up, and as you know, uncertainty is not good for business. It stops business making decisions. So now we have certainty, we can actually move forward. One of the things for me, well, there were two things for me, really. First is promotion. I mean, I actually think in the UK we are really good at saying what we're not good at, and we are really not good at saying what we are good at, and we're brilliant at things. I think, we're the #1 in the whole of Europe for fintech unicorns. My sector, insurance, we're the global risk centre of the world. And one of the things we need to do is actually be slightly less British and actually promote the city and the ecosystem around it. And then the second thing with talents, I mean, I'm an East Ender, so this is one of my passions. And you might have heard a phrase has got coin, which is unsquare the square mile. And by that, I actually mean, I think the word square for the city kind of implies something that's closed off, fenced, old-fashioned, and it's neither of those things. It's open to all talent, look at me, and it's not old-fashioned. We build on our history, but we're innovative and forward-looking. We're a fantastic city.
What I hear a lot is the lack of risk-taking, and this could be either pension funds or just the lack of investing, for example, in private companies from, pensions, and I know that's slowly changing. But if you had a magic wand to do something differently for the City of London, to, I guess, increase the capital pool, what would that be?
I'd simplify regulation. So I think the regulators have taken some great steps with the secondary competitiveness objective. But the trouble with incremental change, especially in a fast-paced world, is it's not fast enough. And if we look at some of our competitors, they have some really simple, cutting-edge regulation in certain areas. So personally, if I had that magic wand, I wouldn't incrementally change and peel back the layers, because that's really hard to do. I'd look at certain centres, I'd copy best of breed, and I'd reimagine, not amend.
This is what, for the banks or financial services in general? I mean, is it ring fencing? Is it, something to also keep up with the US?
Yeah, it's financial services in general, okay? So in some areas we're brilliant, okay? Our regulation is great. And also we have a very stable business environment, and regulation gives us that. But if you want to encourage risk-taking, you are going to have to roll back regulation to a degree. It's that balance between risk and progress.
I mean, there's been a lot of coverage about Lloyd's of London and its previous CEO in recent weeks. Does this industry have to change?
See, my experience is no, okay? I've had a fantastic career. I've come from, I call it an accidental career, from East End to chair. I think there's always more to do in this industry. Cases like that always get profiled, but my experience is it's equal, it's fair. I've had a great career. I've had a lot of support through it. And if any women were thinking of coming into this industry, I really would encourage them. It's a great industry to be in.
Lady Mary, can I ask you about what you think of, crypto? The crypto world is cozying up to Nigel Farage. Like, what does it mean for London as a financial centre?
I think it's one of the areas where we really need to focus on, because it's one of the areas that some of our competitors have as a real strength. So it's just something, I just think it's something for the city that we need to start working on. We need to get some regulations in and decide what our policy and our strategy actually is. Clarity is always good for business.
Is there, again, a danger that actually the crypto world just is seen as cozying up to the more right-wing faction of politics?
See, I don't think business should be like that. Business should be apolitical. My role is apolitical. We work with the government of the day. We will support the government of the day. And for business, business is commercial. It just needs to do what's right for business.
Lady Mayor, thank you so much for joining us. Suzanne Langley there, Lady Mayor of the City of London. I know we'll speak to the Lady Mayor much more often because we're just a stone's throw, but there's also so much that Lady Mayor wants to do. Now, key U.S. inflation data due out a little bit later today, pushing up expectations of a Fed rate cut. Ven Ram, Bloomberg MLife strategist, joins us now. So, Ven, what's the data likely to tell us today?
Morning, Francine. Always great to be talking to you. I think that, the expectations on the street is that, that we will get a milder core PCE reading. But the fact of the matter is that it's going to be, if it comes out as forecast, we'll get a number of 2.8%. Now, if you look at the average for this year, that is exactly where it lands, 2.8%. So, and we haven't had a sub 2% print in more than 4 years now. So we've there's been a lot of progress made on disinflation. We progressively got down from punitively high levels to three handle, and then we have come down to a below 3 handle. But the transition from 3 to 2 isn't quite happening, and that is going to be the big question for the Fed, which meets next week.
So, Treasuries fell after that jobless claims, report dropped to the lowest level since 2022. What's the broader implication of that, Ven?
Well, I mean, what we've been seeing is bits and pieces of erratic data where, we got the ADP report showing a contraction, and then we got the initial jobless claims today. So it looks like the economy is muddling through, and the Fed is kind of expecting average growth, GDP to grow 1.8%. That is smack in line with the trend growth forecast for the U.S. economy in the long run. So if the U.S. economy muddles through, the question is, what is the right level for, say, the 10-year yield? We have been doing 4% plus, and I think that strikes me as the right thing because you've got core PCE, as we just discussed, around 2.8%, holding around 2.8%, and you've got nominal GDP growth of 1.8%. So that suggests that the 10-year yield should be above 4%, which is what we are doing at the moment.
Yeah. Ven, how much do you think, we also had Brian Moynihan of Bank of America. We talked a little bit about Kevin Hassett. He says, first of all, let's see who the president nominates. But what exactly is the market going to be focusing on away from data over the next couple of months?
I think that, they will be keen to find out, what kind of a consensus that Hassett will be able to drive within the FOMC. That is the big question, for the immediate question for the markets over the next couple of months, because assuming that Hassett is nominated to be the Fed chair, I think that the question is, there's going to be a radical change to the FOMC committee come February. The composition is going to change, and what kind of a Fed 90-member committee that we will get, and whether Hassett will be able to drive a consensus thereof. And I think that, if you look at the dot plot of September, fully 5 members were already inclined to take rates below 3%. So I think that his job shouldn't be as difficult as the markets envisage. But, that is the big question for the markets going into the first 2 months of the year.
Ven, as always, thank you so much for all of your analysis. Our Bloomberg MLife strategist there, Ven Ram. Up next, Bloomberg Brief. Of course, there is quite a lot going on with the markets. We had a really good conversation with Brian Moynihan talking about the strength of the U.S. economy and, of course, the strength of the U.S. consumer, despite concerns about affordability across the board. Now, this is a picture overall for the S&P 500 futures, actually pushing higher with possibly a new record in sight. We also look at a measure of volatility dropping to the lowest since October, the dollar slipping. Treasuries pretty much steady with a rate cut next week largely priced in. And then there seems to be growing confidence that the U.S. economy remains resilient in prompting rotation into stocks that I guess if you speak to investors or people on the ground, portfolio managers, that tends to benefit from domestic strength with investors gearing up for a year-end rally. Now, a couple of other things we're watching out for. Look, there's this rate cut next week, largely priced in the U.S., bets pointing to further easing into 2026. We have a couple of corporates we're watching out for example, Swiss Re here in Europe announcing its first share buyback in 5 years. Warner Brothers entering exclusive negotiations to sell its film and TV studios, HBO Max streaming service, to Netflix. Up next, it's Bloomberg Brief, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. On track for a fresh record, futures in the green with September income and spending data on deck, along with a fresh look at December's UMISH survey. Hollywood giants at the negotiating table. Warner Brothers is said to be in exclusive talks now with Netflix to sell its film and TV studios and HBO Max streaming service. And Fed Chair frontrunner Kevin Hassett says the FOMC, quote, should and is likely to cut rates by 25 basis points next week. And that could be setting the tone today as markets await what is very likely to be a 25 basis point cut next week. S&P futures pointed higher, NASDAQ 100 futures pointed even higher. We've had a couple of down days this week, but the S&P is on track to eke out a gain this week. The NASDAQ 100, in fact, on track to be up more than 0.5% this week already. And the Russell 2000, it may look like futures are pointed lower, but it closed at a record yesterday, an indication that perhaps finally this rally is broadening out, and maybe it's a more permanent broadening. We have massive expectations for earnings for that particular component of the stock market. Let's take a look at bonds, because of course we do get that data today. Personal income and spending is going to be stale. It's for September. UMISH survey can be distorted now by political leanings. At the same time, we might get just some kind of read on the consumer. The 30-year yield climbing a basis point since yesterday, the 10-year yield now back above 410, and the 2-year yield at 352. All right, let's get to some individual movers. We'll get over to London, and good morning to Valerie Teitel.
Good morning, Bonnie. Let's start with a check on Warner Brothers at Netflix. Warner Brothers is trading higher off the back of this news. They have entered into the exclusive negotiations with Netflix. We're up 2.8% on Warner Brothers. Netflix, on the other hand, is down 0.6%. Maybe some of this positivity in the Warner Brothers shares has to do with Bloomberg reporting that Netflix has promised a $5 billion breakup fee if regulators smack down the deal. So still some questions to be asked about this deal. We still don't know what kind of prices we're talking about, but it does seem that Netflix wants to promise Warner Brothers an upfront fee if the regulators do decide that the deal isn't to go through. Let's move over to earnings at HP Enterprises. This is a kind of underwhelming report from HPE. Shares are down just shy of 8%. And this is on the back of missing on sales for the previous quarter and giving a weak forecast for the quarter ahead. This is due to some delays in delivering on customer contracts around AI. They had a delay when it comes to a European data center build out and a second delay around the U.S. government shutdown. Lastly, let's end in the beauty sector. Vani, Ulta Beauty out with earnings after the bell, up 5.6% in pre-market trade. Their business line into K-beauty, Korean beauty, seems to be really paying off. Sales were up some 13% in the previous quarter. Also doing well internationally with their recent acquisition of Space NK, one of the largest beauty retailers here in London. Ulta Beauty up 5.6%. Bonnie?
All right, a massive rally this year. Thank you to Valerie Teitel. And coming up in this hour, we'll drumbeat to the slew of economic data on deck and that Fed meeting next week with Citi's Veronica Clark. But first, Bloomberg learning that Warner Brothers has entered exclusive talks now with Netflix, a deal that could shift the entire entertainment industry. Joining us now is Bloomberg Deals reporter Manuel Baigori. Manuel, serious antitrust concerns on this one. Geetha Ranganathan of BI telling us that Netflix at least will make the argument to regulators that this will bring down prices for consumers. But will that be enough to pass muster with regulators?
Vonnie, that is a very good point, because definitely a big transformative deal ahead of us in the entertainment industry, not just in the US, but globally. So regulators will definitely take a close look at how this may affect consumers at the end of the day. But definitely if Netflix ends up winning this auction over other bidders, including Comcast or Paramount, it will definitely put them in a very strong position. I mean, they're already the biggest out there in obviously streaming, but that will also give them other assets, the TV and film studios, and obviously HBO Max as well, will put them definitely apart from the rest. So, and also a very rare move by Netflix, which so far, you know, is not used to making such big M&A transactions. So remains to be seen. The next few days are key to see whether or not this deal gets signed and announced, but it all seems to indicate that that's the direction of travel here.
Yeah, David Ellison and Paramount, though, they are ready for a fight on this one. They are not happy about what's happening here. I mean, will legal ramifications have any impact on any board decision?
Yeah, that remains to be seen, Vonnie. I think one step at a time. I think for the time being, we need to get a little bit more clarity on this auction, on this sale process that has been taking a little bit of time. Advisors have been working non-stop, even over the Thanksgiving break, to try get this across the line. And this, just look at this massive potential breakup fee that Netflix is committed, reportedly $5 billion. That is quite remarkable, and it clearly speaks to the fact that Netflix is very, very committed to potentially getting this deal. Now, whether or not there might be legal ramifications, it remains to be seen. It's a little bit too early for that to see how it pans out.
Yeah, so many questions to be resolved here, but it is a fascinating one. Bloomberg's Manuel Baigori, thank you so much for joining. In Washington, with the Fed decision next week, National Economic Council Director and Fed Chair frontrunner Kevin Hassett spoke to Fox News about his expectations.
If you look at the communications from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right.
And how much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
Joining us now is Bloomberg's Skylar Montgomery-Koning. So, Skylar, that sentiment seems to be pretty reasonable, right? It's definitely what the market has priced in. We didn't get any indication of whether Hassett would want to continue on with lowering rates, you know, at every next meeting. And, of course, he's not going to be the chair, assuming he ever is the chair, for certain amounts of months.
Yeah, I mean, certainly. And I think something we need to remember is that we've come a long way from the Fed confidence issues that we had earlier in the year. So it's a much more reasonable candidate that's been being put forward now. It's also one member on a committee. And I think what we've seen even more recently with Powell in charge is that we're moving away from the chair being the kind of center stone of the consensus view. You're going to get more dispersion within the Fed, and so that's why we need to watch the dots from this meeting particularly closely. But I think it doesn't necessarily mean that you're going to get this broad dovish shift into next year. And I think particularly for this meeting, you need to highlight that we've already shifted very dovishly. So the first point is you've essentially fully priced a 25 basis point cut, and that doesn't necessarily come. It's not guaranteed by any means, even if it is that far priced. The second point is, as bets have gained that Hassett will be the candidate for chair next year, that's more dovish. Then you also have a terminal rate that's 3%, that's in line with the long-term dot. So it's much harder to get lower than that without serious economic deterioration. So that means on those three metrics, the risks are skewed that you get more hawkish rather than less. I don't think you actually get that shift maybe until you hear some of the Fed commentary, which means it's more of an event for Wednesday.
Yeah, and you make a great point, Skylar, because it isn't for sure that we get a cut next week. The market might think it is, but really, what has changed since the Fed chair said that we are in murky waters, right? There's fog out there, and in fog, you tend to slow down. Maybe you do nothing. I mean, that's what had moved the market originally. Why does the market suddenly think we have better visibility now?
Well, yeah, this is it. I think Powell has had a much more balanced view of where the economy is. But the market is very much taking data dovishly. Now, don't get me wrong, some of the data has been weaker. So if you look at something like ADP, that was definitely on the weak side. But I think we need to take the labor market data with a grain of salt, because we know labor supply is coming down because of immigration. That means you have a break-even rate of employment that's lower. And if you look at the trend, which is arguably more important, something like initial claims, that for this year is trending below your expansionary averages. So that points to relative strength within the labor market. And the market's just kind of holding on to these dovish cues over other cues, especially because you have had inflation kind of go to the back burner with not having its release.
Skylar, thank you so much. That is Skylar Montgomery-Koning there joining us, and much appreciated. And now to Germany. Chancellor Friedrich Merz's ruling coalition faces a key vote in Parliament today. Bloomberg's Europe executive editor, Chad Thomas, joins us for more. Chad, Merz is holding a vote today. He didn't necessarily need to hold this vote. He's taking a huge risk. Why is he doing this?
Hi, Vonnie. Well, he had agreed with the Social Democrats, that's the junior coalition partner that he's governing with, that they would move forward with this pension reform, and they really want to get this off of the docket before the Christmas holidays. They want to get it done with so that they can come back at the start of the year and not have to deal with it. But of course, as you say, it is a huge risk. There are members from within his own party who have indicated that they will potentially vote against it. We're hearing now that there is potentially some 11th hour wiggle room, that the chancellor has been telling people within his party that it's really important that the government can show it can pass this piece of legislation. And Vonnie, it's really not just about the pension reform as such, but it's a question of, can this governing coalition, you know, they just came to power 7 months ago, can they actually pass major legislation? The big issue is they only have a 12-seat majority in the Bundestag, so it doesn't take very many members for to be against something in order for them not to be able to get it through. And they have been struggling with other votes already in previous months, so this is just another sign of the struggles that this new government is already facing.
Yeah, and I mean, he may need some abstentions as well in order for this to pass. He doesn't want to be seen as a lame duck chancellor, and he certainly doesn't want elections of the AFP really rising in the polls. But I want to ask you about this story that the US has been urging Europeans to oppose that EU plan for loans to support Ukraine. We're just sort of hearing about some details of it now, although the US ambassador says he hasn't heard anything about it. What do we know?
Yes, so Bonnie, we've been hearing from sources here in Europe that the U.S. has been urging EU member countries to not back this proposal to use Russian assets for to back loans for Ukraine. Chancellor Merz, he actually, after today's vote, he's flying off to Belgium and he's going to have a private dinner with Ursula von der Leyen, the president of the Commission, and the Belgian Prime Minister. Belgium is really the holdout here in this proposal to use these funds to provide loans to Ukraine. Ukraine is running out of money. They need more money early next year. And one of the reasons why what we're hearing from sources that the U.S. is telling the EU not to do this is they're saying that if they give money, if the EU gives money to Ukraine, it's going to prolong the war. And so they don't want them to move forward with this. They're trying to get the two sides to reach a deal on peace.
All right, Chad, thank you so much. We'll see how things progress. That is Bloomberg's Chad Thomas there in Berlin. Now, to other top stories trending on the terminal this morning. President Trump publicly declares support for Defense Secretary Pete Hegseth, despite a string of missteps and controversies. At a cabinet meeting on Wednesday, the president said, quote, "Pete's doing a great job." The comments come after a Pentagon Inspector General found that Hegseth risked endangering U.S. troops by sending sensitive information in signal texts. NVIDIA challenger in China, Moore Threads Technology, jumped 425% in its Shanghai trading debut after raising $1.13 billion. That marks the biggest first-day pop for a major IPO since China's 2019 reforms. The company's listing comes as optimism over China's drive for tech self-sufficiency intensifies. And European nations look set to shorten the length of their borrowing as an overhaul of the Dutch pension system reduces demand for longer maturity bonds. Changes may be announced in the coming weeks as governments unveil bond issuance plans for 2026. Coming up, we're going to bring you our exclusive conversation with Bank of America CEO Brian Moynihan. That's next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta. And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Bank of America CEO Brian Moynihan is confident in the U.S. economy being driven by the consumer, but is worried about non-tariff barriers in certain regions, such as the European Union. He spoke with Bloomberg's Francine Lacroix earlier.
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money, our 70 million consumers who's pushed about $4.5 trillion plus in the economy every year, they pushed in about, for that month, about 4.5%. And so it was good, and around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good, and it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort of sort the aggregate economic impact of the consumer, our 70 million consumer spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is, with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to where they compare it to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
You know Kevin Hassett, and you've known him for quite some time.
Yeah.
What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's a lot of commentary about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think again that they're ready to do deals?
Well, generally there's things that you look at. You say I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much you can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clear that there's sort of 10 to 15% increase is generally across the board result. That's helped businesses understand it better. And so I think that's been worked into their plans. And that's why you're seeing the relief come off from Liberation Day, where people were very confused, to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique. But I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes. But generally, they're more worried about the ability to address markets and drive. And I think one of the things administration's worked on that gets lost in the percentages and count is the non-tariff barriers, and those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States but around the world, because to get access to markets without having to change product is a big deal.
Bank of America CEO Brian Moynihan speaking there with Francine Lacroix. Coming up, SoftBank CEO Masayoshi Son hammers out high-tech factory plans with the White House. That and what else is making headlines in your front page news next. This is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
This is Bloomberg Brief. I'm Bonnie Quinn in New York, and it is time now for your front page news. First up, the Washington Post leading with video footage of the U.S. military strike on alleged drug smugglers in the Caribbean. The video, shown during a day of closed-door meetings on Capitol Hill, shows two people attempting to flip their capsized vessel as they were fatally attacked again. The Post says the footage is considered a crucial piece of evidence in determining whether the strike amounted to a war crime. The attack killed 11 people in total. Next up, the Wall Street Journal reporting SoftBank's Masayoshi Son is working on a plan to build Trump-branded industrial parks around the United States. It'll be funded by money pledged by the Japanese government as part of that recent trade deal. The factories will be built largely on federal land and would produce components for AI infrastructure. And finally, the Financial Times leading with Wall Street banks predicting double-digit gains once again for U.S. stocks next year. The average forecast of 9 major banks is for the S&P 500 to rise more than 10% to 7,500 by the end of the year. All right, let's take a look at those markets, because if we look at today, well, it certainly looks like that might come true. We are certainly on deck for another record day for the S&P 500 with futures pointed higher. And that small gain yesterday, nevertheless, again, we are already at a record for the Russell 2000. Little weight to the Bloomberg US dollar index, and that 10-year yield crept back up to 4.10. The market's nervously awaiting that FOMC meeting next week. Of course, we do get some data today. We obviously have little stale personal income and spending data, and then fresh UMISH data. Let's take a look at some commodities, because we are seeing gold just up a little bit, back right above 4,200. And then I want to point to copper as well. We're talking to a city economist a moment. Copper is just on its way up, and Citi predicts a bullish season, even more bullish for copper. All right, coming up, we will talk with Citi's Veronica Clark.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief, and here is what you need to know. On track for another record. Futures in the green with September income and spending data on deck, along with a first look at December's UMISH survey. Hollywood giants at the negotiating table. Warner Brothers said to be in exclusive talks now with Netflix to sell its film and TV studios and HBO Max streaming service. And Fed Chair frontrunner Kevin Hassett weighing in on next week's FOMC meeting, saying the Fed should and is likely to cut rates by 25 basis points next week. So let's take a look at those markets. As I said, futures are in the green, so there's a little bit of optimism out there on this Friday. The S&P, of course, rose just fractionally yesterday, but it is fractionally in the green for the week off the back of that. The Nasdaq 100 down 0.1% yesterday, but it is firmly in the green, up more than 0.5% already week to date and pointed higher again. So still close to records. As for the Russell, it closed at a record yesterday. So this breadth expanding might just be a little more permanent than it has been in previous sessions. It looks like we might get a positive start to the Russell trading as well. Now, the data today, potentially a little bit misdirecting. We have bonds moving just a little bit, a couple of basis points in yesterday's trade. The 2-year yield at 3.52, close to 3.53, the 10-year yield creeping up, and the 30-year yield also creeping up. But the curve very definitely steeper than it was before this repricing for a 25 basis point cut. I want to point to copper there as well, 11,609 per ton. Citi, as I was saying, it's bullish on copper. It sees prices hitting 13,000 a ton by the second quarter. Bull case is 15,000 on average between Q2 and Q4 for that metal. All right, let's get to some stocks to watch. Valerie Titel joins us now in London. Valerie.
Good morning, Bonnie. Let's start with a check on the merger that you mentioned, that of Warner Brothers and Netflix. We are seeing Warner Brothers up 1.5% in the pre-market. Netflix, on the other hand, on the downside, down 0.8%. And this comes after some reporting that Netflix has entered into an exclusive deal talks with Warner Brothers. The streaming giant, the world's largest streaming giant, Netflix, is about to get even bigger. Sources telling us here at Bloomberg that a deal could be announced in the coming days. Let's move on to earnings. This one in the AI space. HP Enterprises out with a disappointing outlook when it comes to sales. The shares are in the red this morning, down 9%. They also missed on their sales for the current quarter as well, Vonnie. The CEO is citing some delays in customer contracts, some projects pushed out to 2026, one of those being a delay in a European data center build out, another delay off the back of the U.S. government shutdown. So Hewlett-Packard Enterprises to the downside, down 9% off the back of this disappointing outlook. Lastly, let's end in the beauty sector. Ulta Beauty raising their full year guidance up 5.6%. Their push into K-beauty, into Korean beauty is really paying off for this company. Sales rose around 13% in the previous quarter, also helped by their international business with their recent acquisition of Space NK, one of the largest beauty retailers here in London. Vonnie?
All right, Valerie, thank you so much. Valerie Titel there. So September PCE, personal income and spending out today, and December UMich survey. Well, the first look at it anyway, coming at 10 Eastern. Here to take us through this and look ahead to next week is Stuart Poll of Bloomberg Economics. So how stale, how relevant is this personal income and spending data? Is there anything we can garner from it?
Well, it is old. The thing that matters most, of course, is that the Fed cares about the core PCE price index. It's a preferred inflation gauge. And it also just closes out our swath of September data. Ultimately, what we're expecting is about a 0.3% month-on-month headline headline PCE inflation print, 0.2% in the core. We're expecting just about 0.3% aggregate labor income growth as growth in wages and salaries. So on an inflation-adjusted basis, it's basically nothing for the month of September. And I think that when the Fed thinks about the potential for a re-acceleration, it's going to look at this personal income and outlays report and see that there's basically very little indication of acceleration going into the government shutdown, which then took a toll on economic activity also.
What about the Michigan survey? Paul Donovan of UBS this morning saying it's become ludicrously politicized and we can't trust anything about it. I mean, I'm maybe, being a bit too enthusiastic about what he said, but he did put that in there.
Yeah, it is true that, especially when you look at things like inflation expectations, it's really clear that there's a political divide between Republicans who expect basically a lower inflation, Democrats who expect tariffs to take a toll on consumers and to support inflation going forward. What matters most to me in the consumer sentiment surveys is what buying plans look like. Because again, I'm looking for some indication that there could be a re-acceleration in 2026. And if we were to see some additional enthusiasm around buying plans, that could do it. But I'm expecting to see rather dull buying plans, especially for household durables and vehicles.
All right, just on this, I want to hold you for a second, Stuart, and bring in Veronica Clark, now U.S. economist at Citi, who also joins us, and bring her into the conversation. Veronica, anything that Stuart said that you object to, first off?
No. I mean, the September data that we're going to get this morning, it does feel pretty stale at this point. And yeah, PCE inflation is the most interesting, but it's never particularly surprising. We know most of PCE inflation once we get the CPI and PPI data. We really don't learn anything new there. Maybe if there's anything that I'll be looking for in this report, it's spending for September, because we did see softer retail sales in September, so maybe that's the start of a slowdown, but we're coming off of a couple of very strong months of consumption anyway, so probably not too interesting details.
Veronica, consumption was really strong in the summer. It looked like it really cooled down in September. We then had the government shut down, probably shaving about 1.5 percentage points off of fourth quarter GDP growth. When you start looking at the data that you have at Citi, at what things look like on the spending front coming into the holidays, how did it look? After September, how did it look?
Yeah, we do have some of our credit card data that we try to look at. We don't have, unfortunately, the latest data for that Black Friday, period. It did look like there was still some resilience in October. But yeah, of course, there should be some kind of drag on economic activity from the shutdown. You would expect to see that present as maybe less spending. That's a lot of people who are missing paychecks for a couple weeks there. They would probably be spending less.
Stuart, can I ask you, and Veronica, you can weigh on this as well. The market has totally baked in a price or a 25 basis point cut next week, but we're still in murky waters. There isn't the visibility that we thought we might have, and then we get a whole raft of actual fresh data the following week. So I'm curious, is there a danger that the Fed makes a misstep next week and the market sees ructions the week before the Christmas holiday?
I think that the real risky move would be to fail to deliver on market expectations for a very, very priced-in December cut. It is tricky, though, to manage communications because, as you say, we have this raft of data. We have NFP coming out the next week. We have CPI coming out the next week. So how is the Fed going to hedge against the potential for a surprise in either NFP or CPI the next week? Conventional wisdom is that they're going to try to deliver a hawkish cut, but Veronica, I'm not really sure how the Fed is going to deliver a hawkish cut when the median FOMC member is already showing just 25 basis points of cuts next year.
Right. You really can't do it with the dot, so there's really not a lot of room to believably move more hawkish with those dots as of September. It's got to be in the press conference, but I think Powell probably wants to keep optionality. Of course, we're only pricing one more cut by the middle of next year, so there's maybe not necessarily a whole lot to push back on, but it certainly will be a weird meeting. Yeah.
It's going to be strange because also Kevin Hassett came out and he's perfectly entitled to give his opinion. He's not, anything to do with the Fed at the moment, but he is sort of the contender to be the front runner, at least for the next Fed chair, undermining a little bit maybe what the Fed chair is going to do next week. Does Powell continue to have credibility until we do have a new nominee and a new Fed chair?
Yeah, I think he will. And yeah, we don't know who that nominee is going to be yet. Certainly the market is expecting that it could be Hassett, and maybe that's worth another cut, 25 basis points, a couple cuts or something. But yeah, I think for now, the division that we see among the Fed, I don't think it's necessarily political driven or concerns about administration influence. I think it is because the data have been confusing, and there are good arguments to make on both sides.
If we get somebody like Kevin Hassett coming in, do you think that he'll have the, I don't want to say credibility again, but do you think that he'll be able to build a coalition, especially what we know about the next slate of voters coming in from the regional Federal Reserve Bank?
Right.
So we're going to be more hawkish.
Yeah, they do skew a bit more hawkish. It is going to be interesting. If the data are not supporting more rate cuts, the Fed does still make decisions by majority vote, and I think it would be hard to get some of those more hawkish.
Yeah, what's the risk in that scenario? Do we get a reacceleration of inflation, and does the economy suddenly go on tilt again?
It does depend, of course, on how the Fed is acting. If we do see some stickiness to inflation data, presumption of a more dovish chair, we've already seen maybe longer end yields move a bit higher, kind of baking that in. If you're not actually getting the rate cuts, then I think it's not really an issue. We're not particularly concerned about a inflation.
Can I ask you about the yield curve? And Stuart, you can weigh in on this as well. What is the recent steepening telling us?
Yeah, part of it absolutely could be the Fed chair, if it is a particularly less independent Fed, but it's not worth, too many basis points, of course. But yeah, it is just this expectation that, debt issuance is going to be larger, but we do have a more dovish Fed.
So the old narrative's creeping back in, but this 2-year yield really stuck around 350. Stuart, the market is telling the Fed, we don't care what you do, we are not sending this terminal rate lower.
I think that's right. I think that markets are just as confused about whether the next chairman can build a coalition as anybody else. I think that even Kevin Hassett is worried about whether he'd be able to build a coalition, and I think that's why that terminal rate has stuck around 3% when we look at what's priced in.
Veronica, just in terms of general growth next year, I know that Citi is looking for a Goldilocks scenario. Not too optimistic, though. Why not? What's to keep us from being optimistic? I mean, the tariffs don't seem to be taking too much of a bite.
Yeah.
Sure, a little bit of weak economic data in the labor market, but maybe it'll all turn out okay in the week of December 16th.
It is that labor market. There do kind of seem to be two camps right now. People who maybe expect some more slowing, which is kind of where we would lie, and then group expecting maybe this reacceleration. And there very much are positive stories that you can tell around business investment, AI-related investment. But consumption is still 70% of GDP, and if the labor market is really slowing and people's take-home labor incomes are slowing because of that, that is a big headwind for consumption.
Well, that was so fun, you two. Thank you so much. Much appreciated both your time. That is Stuart Paul, of course, of Bloomberg Economics, and Veronica Clark of Citi joining us today. Now to other top stories trending on the terminal this morning. NVIDIA challenger Moore Threads Technology jumping 425% in its Shanghai trading debut after raising $1.13 billion. That marks the biggest first-day pop for a major IPO since China's 2019 reforms. The company's listing comes as optimism over China's drive for tech self-sufficiency intensifies. Cristiano Ronaldo bets on AI. He has taken a stake in Perplexity AI, making the most high-profile investment for him to date. Until recently, he's primarily invested in his homeland of Portugal, focusing on smaller businesses. A BlackRock Bitcoin ETF recording its longest streak of weekly withdrawals since debuting in January of 2024. Investors yanked more than $2.7 billion over the 5 weeks to November 28th from the iShares Bitcoin Trust, or IBIT. The ETF is now on pace for a 6th straight week of net outflows. Coming up, a potential seismic shift in Hollywood. Warner Brothers now in exclusive talks with Netflix. More on that next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersachi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. The U.S. has lobbied some EU nations to block its plan to use frozen Russian central bank assets to back a massive loan to Ukraine. This is according to European diplomats familiar with the matter. Kate Ackley of Bloomberg Government joins us now from Washington for more. So, Kate, this apparently is true. The U.S. has been lobbying some European governments. Will it have any success? Does the U.S. have leverage, or can it threaten European governments in order for them to not back this plan?
Well, I mean, the U.S. officials are saying, according to our colleagues reporting, that this is all in an effort to try to, secure these assets to help bring peace between Ukraine and Russia. This is a very sensitive time for Ukraine. Obviously, we've seen in the United States our Congress, the administration being much less willing to provide aid to Ukraine. So they're really, for lack of a better term, sort of cash-strapped amid these discussions and these negotiations.
Yeah, exactly. Well, domestically, Pete Hegseth, who keeps getting into trouble, is maintaining Trump's favor, it seems, for now. Fresh missteps with the signal messages and so on. And this is really, different to Trump's first term, where if somebody displeased him or made a misstep, they tended to be gone. Can Hegseth ride out this criticism and even potential legal action here?
Well, this is the President Donald Trump, who was famous for saying, "You're fired," right, on The Apprentice. So we saw certainly all through his first term an interest in kind of saying, "You're fired." There's a real sense of loyalty, though, now in this second, Trump 2.0 administration. And as of now, that's what we've seen, where he is standing by Hegseth despite obviously mounting criticism from Democrats. That's not really going to probably move this administration and this president. There's more sort of quiet opposition among some Republican members of Congress, especially those who are planning to retire, not running for re-election. So you see a little bit more slipping out, a little bit more division. But you're absolutely right. So far, the president has been sticking with Secretary Hegseth.
So we have the story today from the Wall Street Journal reporting that Masayoshi Son is hammering out a plan with the White House for high-tech factories. And apparently, it was a very sort of almost sci-fi type plan where he wanted factories on federal land, the size of Los Angeles in one telling of the story. What do we know about this?
Well, these would be Trump-branded, high-tech, sort of factories, but almost like you're saying, villages or campus or something, Trump branded. And so the response from the White House is not a no. It sounds like this is something that President Trump is interested in. I think the official comment from the White House was just noting that this is a president who uses his business contacts globally to bring economic things into the United States. So it was certainly a warm reception, I would say, in the official comments from the White House.
And then, Kate, I do want to ask you about the SCOTUS decision. So it looks like Texas now can use a new Republican drawn map. It puts 5 House seats into play for the Republicans. And we have Liberal Justices Kagan Sotomayor and Ketanji Brown Jackson saying it's probably an unconstitutional racial gerrymander. But the challengers didn't produce an alternative map, and that was one of the reasons why the Supreme Court decided this way. What is the outcome generally, though, given that these 5 House seats might be in play, but also we had a similar type of thing going on in California, which maybe levels out the playing field?
Right. I mean, that's what we're seeing as we head into next year and the 2026 midterm elections. A big part of these races are going to be won or lost on redistricting and how these different states can redraw the lines to give their party an advantage. And so you're right. You're seeing in California, Democrats trying to give their party the advantage. Texas, there's been a little bit of whiplash with Texas thinking, oh, they're not going to be able to use those redrawn lines. Now the Supreme Court saying that's okay. We still are seeing pressure from from President Trump and other Republicans on Indiana to also redraw their congressional lines to hopefully for them get more Republican seats out of that state. So you're seeing this across the country,
Yes.
and I think you'll see it through into next year as people start tuning into the midterms.
Kate Ackley, thank you so much. That's Kate Ackley of Bloomberg Government in Washington. Now back to our top headline. Warner Brothers said to have begun exclusive talks now with Netflix to sell its film and TV studios as well as its HBO Max streaming service. Let's bring in Bloomberg's Lonnie Prinsloo. So Lonnie, what do we know about these talks now that they seem to be exclusive talks?
Hi, yes. So basically, if these talks do not fall apart in coming days, we can have an announcement that this is actually happening. Of course, that will come with a lot of regulatory concerns, both in the US and the EU. So we'll see how that goes. Our competitors such as Paramount are already unhappy. They've been writing letters saying their proposals are better in terms of regulatory hurdles, and that the bidding process was skewed towards Netflix taking the lead on this.
Yes, and everything could change. We have to put that in as a caveat. But if it doesn't, and if there does end up being an agreement between Netflix and Warner Brothers, how might that change the sector as a whole?
It will turn it on its head, basically. It will be the biggest deal that Netflix has done by far. It will give it access to a whole lot of studios from Burberry to California, powerful content of the HBO network, The Sopranos, White Lotus, TV library that includes things like Friends and Harry Potter. So a combined sort of subscription base of more than 400 million people. So it really is going to turn the industry on its head if it does go ahead.
Yeah.
We've had a number of A-listers, actually now writing to Congress, also saying that they are concerned about the theatrical film's survival, with Netflix basically moving content from the theaters to the platform, the HBO platform, Netflix HBO platform, quicker than usual. So yes, many people have concerns about if this happens, but it will definitely be a huge deal to watch out for.
Netflix making the argument that if it happens, it'll be better for the consumer because they can bundle, but, you know, of course they would say that. Bloomberg's Lonnie Prinsloo, thank you so much for the update. Coming up, data on deck will get you set up for your Friday trading session. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Tune in to to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today for your Friday trading session. Victoria's Secret's reporting earnings before the bell. Plus, we get more economic data. We have PCE, personal income and spending, although that's for September. That's at 10 a.m. Eastern, along with University of Michigan sentiment data, the preliminary December reading at 10 a.m. Let's take a look at some movers pre-market now. Warner Brothers. Reports are that it's begun exclusive deal talks with just Netflix. That's not pleasing everybody. That stock down about 1.1%. Hewlett-Packard Enterprise, well, that outlook really severely disappointed on slower server deals. It's down almost 9% in the pre-market. Different story for Ulta Beauty, though. It has been outperforming, and it raised its full-year outlook again as cosmetics demand stays robust. A little bit cheaper, maybe, to buy something in the cosmetic store than elsewhere. This is your macro picture for Friday. Futures are at session highs now. We are eking out a gain already for the week on the S&P 500. We are at a record for the Russell 2000. Dr. Copper also up 1.3% on stockpiling in the U.S. ahead of tariffs and so on. And that two-year yield not budging, but it is well above 350. That's it for Bloomberg Brief.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
also seeing that investors are sitting on the sidelines of this market.
There has been a shift in sentiment, and you're starting to see some deterioration in some of the key themes.
The equity market has to climb, basically, the traditional wall of worry.
You have an equity market that broadens and rotates a little bit.
As we think about next year, we do like equities. We do like U.S. equities in particular.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes turning to next week's Fed rate decision as potential Fed Chair Kevin Hassett supports a 25 basis point rate cut and some inflation data coming up with today's PCE report from September and UMich sentiment data trying to fill in the gaps ahead of that key meeting next week. It should be a non-farm payrolls Friday. Instead, it is a what? University of Michigan in September PCE data kind of Friday?
But we do know that the Fed has reacted in the past to the University of Michigan, although we do know that it is incredibly partisan. Everyone usually comes out and says how they're feeling based off the economy, based off their political lines, although there could be some interest in that. Obviously, when it comes to PCE, this is the Fed's preferred inflation gauge, but it's from September. So does it even matter that we're getting this data today?
Right now, what I'm looking at is the fact that small caps are at a new record high, even though you are about 0.5% away from it when you look at the broader indices. When you take a look, since the end of April, the Russell 2000 has returned almost 30%. It is only 5 percentage points behind what the NASDAQ has performed as. So it raises this issue of how dependent is this index, this sort of small business indicator, to any Fed rate cuts versus something else, versus a real kind of momentum in the consumer in the United States?
Well, I think this chart speaks to two things. One is that you were able to get through Liberation Day and the low of this administration in terms of the market, and then, of course, the bond market really pushing back, being that barometer, and then everything was off to the races there because they realized that Trump is not going to be as aggressive when it comes to trade policy. At the same time, maybe there is a real broadening out, especially if you have a Kevin Hassett, potentially, as the president said, a potential next Fed chair, talking about, yes, 25 next week, and then that's what he would like to see continued as well into 2026.
How long do we have to do this for? I'm just curious. Like the Kevin Hassett sort of, is he or isn't he?
Well,
kind
it was
of
supposed to be the fall,
right?
And then it was supposed to be Christmas, and now it's sometime in the new year.
Sounds like a fun game. Right now we're seeing markets basically continuing to grind higher. It has been a slow grind, nonetheless, a consistent grind with the fourth potential consecutive day of increases. S&P futures up almost 0.2%. You are seeing bond yields continue to inflect just slightly higher, closer to that 4.11% level, and crude prices off by about 0.2% today. You got to wait until 10 a.m. to get that dated PCE data from September. That's when we get that core PCE as well as spending and income. Then at 10 a.m. also we get that University of Michigan sentiment survey. Coming up this hour, Chris Verone of Strategas as stocks look to round out the week with a fourth day of gains. John Lieber of Eurasia Group as Russia-Ukraine peace talks hit a snag. And Jill Carey-Hall of Bank of America with small cap stocks, as we were just mentioning, at record highs. We begin this hour with stocks rising after closing near all-time highs. Chris Verone of Strategas, a Baird company who, by the way, was just ranked second among Wall Street's macroeconomists in an annual Extel survey. Writing this, as the calendar starts to run out on 2025, we continue to see more signs of positive inflection from the real economy and the market's daily message. Chris joins us now. Chris, first of all, congratulations.
Thank you.
Very exciting. And it comes at a time where there is more optimism. We're talking about the Russell 2000. Does this come with real sense that the overall economy is doing a lot better?
Well, I think there's clearly been a soft patch in 3Q, 4Q, but maybe more importantly, I think the market's looking through it. And you see it, as we write, in the daily message, the daily prices. When you look at, say, the transports breaking out here, the regional banks, the discretionary stocks have all inflected, copper making new highs. So I think there's a lot of almost reflationary pro-cyclical tones starting to weave their way through the market's message here. And, you look out to 2026, and I think it tells us that really the tone is changing from, after years of all the excess liquidity being soaked up by the speculative economy, I think the excess liquidity is now being soaked up by the real economy moving forward. Very important theme for us into 26.
Do you think that this is getting ahead of what we can see with respect to labor market gains? Do you think that this is actually coming in tandem with that hasn't necessarily been picked up by the data? In other words, is this already underway, or is this anticipated reacceleration on the heels of Fed rate cuts cuts later this year, next week, as well as earlier next year?
I think it's a little bit of both. And kind of if you look at the trajectory of Fed policy into 26, I really don't think it matters who's the Fed chair. I mean, the two-year yield this entire time has been remarkably stable at about 350. That's probably where policy is going. I mean, think back just a couple weeks ago. Everyone was pulling their hair about, oh, is the Fed going to cut in December or not cut in December? I think the odds got down to like 25% at one point. You know what never moved? If you look at June 26 Fed funds futures, they were always about 330, 340. So I think the trajectory is pretty set. I suspect we'll get 2 more cuts here. But remember, most global central banks have been cutting for the last year. So I think a lot of this kind of market looking through some of the soft patch data is also in response to what we've seen globally over the last year.
Do you think this is going to be a hawkish cut, though?
Yeah, again, I don't really think it matters. It probably is. That's what the economists will say. I'm just not sure it matters. The two-year yield is telling us, I'm a believer, let's focus on the market rate, not the policy rate, right? The market rate's 350. That's probably where policy is getting. Whether it happens over 2 meetings or 3 meetings, I don't think the market cares too much. When you look at this pro-cyclical tone starting to rework its way through the tape, that's what I think is most important going forward.
You also spent a lot of time in Washington, D.C. I'd love to get your take on the Fed race.
Yeah.
I mean, at one point, does it even matter because we know the direction of travel? But do you really think it is going to be Kevin Hassett?
Well, I'll make a couple points. I would say, number one, I do think we're in this pretty important shift where the shadow of the Fed or the shadow of the Fed chair is probably getting shorter over financial markets than what we've been used to, certainly since the financial crisis, but maybe even going all the way back to Greenspan and Volcker, where really the Fed was the dominant player. I think that pendulum has shifted to Treasury here. It's almost a bit of a kind of a reminder of what the 1950s looked like in that regard, where Treasury shadow over financial markets and the bond markets was so large. So I think this pendulum has shifted. I think it frankly began with the Yellen Treasury going back to the last administration. So that has been underway here. You know, at the end of the day, whether it's Hassett, whether it's Warsh, whether it's Waller, I don't think the trajectory of Fed policy is dramatically different over the next 12 months here. And, you know, I would add one more point. You know, all this attention about it being Hassett, you know what didn't make new highs on this news is gold didn't, right? You know, it hasn't really moved as five-year forward. So I think the market's pretty comfortable no matter who ultimately it is.
I want to dig into this idea that the U.S. Treasury has a greater influence, especially in light of the story that came out that the U.S. Treasury market is now $30 trillion. It has doubled since 2018, and there's been a real question, how has the market absorbed all this issuance in an okay way? And the reason it really does lie with the Yellen Fed and now the Bessent, the Yellen Treasury and then the Bessent Treasury, a question of disproportionate issuance on the front end. Is that the reason why you think supply isn't going to disrupt long-term benchmark rates to the degree that some people were expecting?
Yeah, you know, actually, if you look at a long-term time series, we're still below kind of on the short end what the average issuance typically is. I think there's more room to expand issuance on the short end here. I would also just know, and we've written this all year, I mean, ironically, the U.S. bond market has been the envy of the world this year. When you look at what Japanese JGB yields have done, I mean, even German 30-year yields are back at the highs right now. U.S. 10s have been in the same range they've been in for the last 3 years. So I think until you get some resolution, either above 475 or below 375, you look at the shape of the U.S. Treasury curve and you say it's relatively stable. It has been. My suspicion is global curves do want to re-steepen here, though. We saw 3-month 10-year in the U.S. this week make about a 6-7-month high. U.S. 230s are starting to re-steepen. What is that good for? Real economy type stuff. Regional banks are following that.
Well, this is exactly where I wanted to go. Does this backdrop support the idea of the broadening out? And maybe the overall index isn't going to rise as much as some people think because you might not get the participation in the same kind of way as with big tech, but that broadening out trade is actually going to come to pass in a more material way in 2026.
Yeah, it's funny. I was heading over here this morning. I was reading the FT, and they had all the bank strategists where their S&P forecasts are for 2026, and they're all, you know, 7,500, 7,800. Targets are targets. We're in the business of direction and trend. I think the trend is up. It won't be a straight line, as we know, but I think maybe more importantly, it does look like the the complexion of the leadership is evolving here. I mean, for the first time in 3 years, energy is involved. For the first time in a number of years, healthcare is involved. Consumer discretionary. You know, we talk about the UMIS survey today. You know, ironically, you want to be buying consumer discretionary stocks when consumer sentiment is as poor as it is right now. You've seen the transport start to wake up here as well. So all of this has this real economy vibe that, frankly, has been elusive for markets for much of the last several years.
We did basically an entire conversation of 10 minutes without mentioning AI. Do you still think we're going to see new highs when it comes to artificial intelligence, NVIDIA next year?
These stocks are still in uptrends. NVIDIA still is in an uptrend despite it correcting here. Broadcom still in an uptrend. Taiwan Semi still in an uptrend. But I think they're becoming less of the main show here. What I want to watch, and this is really kind of going back into our work from 99, 2000 and remembering, you know, what started to shift. It was all the internet posers or the derivatives or the adjacent internet stocks that peaked first before they got to the main show, which was the Ciscos and all the like. So I think when you kind of compare that to today, watch all the, quote, AI derivatives today. My suspicion is they would peak first before NVIDIA peaked or before Broadcom peaked. So that's kind of how we're thinking about, you know, what's the appropriate analog or approach here?
Yeah, data centers, for example, at what point do they peak out?
Well, they trade terrible, actually. I mean, if you look at DLR or Equinix, those are the two publicly traded big data centers. They're in bear markets. So that's probably the one place where I think the market's already pushed back against the idea.
Chris Verone, wonderful to see you.
Great
Thank
to
you
hear.
so much for being with us. Chris Verone of Strategas talking about how much we are seeing the real economy come back, and AMH, just think about copper and how it's reached one record high after another. People pointing to the need for supply, the stockpiling by a lot of countries ahead of this AI build out.
And also the fact that they're trying to get a lot of copper into the United States because there is a little bit of uncertainty in this market, and that's the president did say he's going to revisit whether or not he's going to put the duties up, the tariffs up when it comes to copper. And if you're in this trade, you want to get ahead of that.
Yeah, Citi analysts forecasting a 2.5% rise in global end-use consumption by the end of next year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vani. Vani.
Lisa, thank you so much, and good morning to both of you. The US urging several countries in the European Union to block the EU's plan to use frozen Russian central bank assets to back a massive loan to Ukraine. According to European diplomats familiar with the matter, officials are arguing to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and shouldn't be used to prolong the war. National Economic Council Director Kevin Hassett said the Federal Reserve should cut interest rates at its meeting next week. Hassett expects the central bank to cut by 25 basis points, but said he wants to, quote, get to a much lower rate over the long run. His comments coming as speculation grows that President Donald Trump is preparing to nominate him to lead the central bank. Warner Brothers Discovery entering exclusive negotiations now to sell its film and TV studios and HBO Max streaming service to Netflix. Sources telling us here at Bloomberg, the streaming giant is offering a $5 billion breakup fee if regulators don't approve the deal. The two companies could announce a deal in as soon as the coming days. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani Quinn. Up next, Europe on the hook for Ukraine.
This is a European issue. This is something that Europe is trying to deal with. We want to make America great again, but we'd like Europe to be right there with us.
John Lieber of Eurasia Group joins us next with futures higher on the morning, potentially the fourth straight day of gains. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It looks like the Santa Claus rally is underway. What you are seeing is potentially the setup for a fourth straight day of gains, with stocks nearing new record highs. You already have a record high on the S&P, on the Russell 2000, the S&P, less than 0.5% away from that, now up 0.2%. NASDAQ futures up 0.4%. Big question mark is in the bond space. Michael Hartnett over at Bank of America said that the only thing that can stop a Santa Claus rally is a dovish Fed cut, causing a sell-off in the long end. Right now, you are seeing that slight yield curve steepening, with 30-year yields up just about a basis point, 4.76%. 10-year yields up about a basis point as well. A real question here, Anne-Marie, about the credibility of a dovish pivot for a Federal Reserve at a time where the economic data isn't that bad.
That could basically spook the market. Maybe they then would expect that, oh no, if the Fed is really, really nervous, then the economic slowdown might be worse than some of the data we are seeing suggest. We're going to get a lot of a clearer picture, not next week, but when we get the non-farm payrolls report the following week. And then at that point, we could see, was the Fed prudent in their decision, depending on what they say in their commentary, or not?
Also, a big question is the inflation and the cost of living inputs. If you take a look at natural gas over in Europe, it has been actually falling. In the United States, not so much. Natural gas prices have been increasing. A real question and focus on geopolitics. Under surveillance this morning, Europe on the hook for Ukraine.
This is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. We want to make America great again, but we'd like Europe to be right there with us.
Here's the latest. European sources saying the U.S. urges several EU members to block plans that would use frozen Russian assets to back loans to Ukraine. Bloomberg's Rich Bravo joins us now from Brussels. Rich, great to see you. I'm just curious, from your perspective, what you think the motivation is in saying, hold off, don't use these loans just yet to back up Ukraine, even as Europe really bears the onus for financing the ongoing war.
Yeah, that's exactly right. I mean, the burden really is on the Europeans now, since the U.S. has pulled back its support, its financial support for Ukraine. So it really is up to the Europeans to make those financial pledges to Ukraine. And the reason why the U.S. is, our reporting says that the reason why the U.S. is pushing the Europeans not to use these assets is Washington would prefer to use these assets as a means of leverage to try and broker a peace deal between Moscow and Kyiv. So it really is a tough situation for the Europeans. They know that Ukraine's funding will run out at some point in the beginning of next year, and they're struggling to really get this massive loan proposal across the line on a domestic front. Then to have the U.S. lobbying against it really puts Brussels in a tough position.
Just quickly here, Rich, what do Europeans suggest in terms of how to bring an end to the conflict, not just finance, the ongoing defense against Russia?
Well, I mean, one thing they want to make sure is just bolster Ukraine as much as they can, make sure they have money, make sure they have weapons, and they're able to continue fighting this war in a way and keep the front line where it is, so that when a ceasefire does happen, if a ceasefire does happen, the battle lines are somewhere advantageous, so that they do have more leverage to negotiate an end to the war.
Rich Bravo, thank you so much for being with us this morning. Really appreciate it. Joining us now is John Lieber of Eurasia Group. John, I would love your sense of what the United States is doing in their approach to suggesting that the European Union members do not extend these loans to Ukraine. What do you think the end game here is?
I mean, the end game in the Russia-Ukraine war probably is going to be decided either on the battlefield or with the Russian economy, because those are the two variables that are most likely to drive an outcome. But with the immediate question of financing the ongoing war, this is a real challenge. It wasn't clear that the Europeans were going to be able to coalesce around a plan to use these frozen Russian assets in the first place. We believe they probably will, and they'll probably do it this month. If they don't, or if they can't, and these objections from the U.S. and Belgium are, of course, real and present serious obstacles, but if they can't, then we also think that more common borrowing is likely to happen in order to support Ukraine. The Europeans are very committed to their defense, and we don't see a scenario right now where they don't find a way to deliver more money to Ukraine, either from Russia or from their own ability, their own purse.
John, we also have the U.S. National Security Strategy released this morning from the President of the United States, and he talks about Europe, and he says the larger issues facing Europe include activities of the EU and other transnational bodies that undermine political liberty and sovereignty, migration policies that are transforming the continent and creating strife. It's really critical of the European Union. How far apart is this administration right now between Brussels?
Yeah, I don't think the Europeans have a lot of fans inside the Trump administration. This is not an administration that prioritizes multilateralism. It's not, President Trump sees the European Union combined as a way to threaten the United States. And in a way, he's got a point. I mean, the whole point of the trading bloc is to be stronger together than any individual country is separately. And of course, that represents a threat to the world's largest, most powerful country. This is, and I think that it's interesting that they mentioned migration in the national security strategy. This was, of course, one of the focuses of J.D. Vance's speech that he gave at the Munich Security Conference this last year, that individual countries were being robbed of their sovereignty and forced to accept this immigration policy they didn't agree with. And that was fundamentally upending these societies, which, of course, is core to the sort of MAGA argument about the United States. So this is, we're in a new world now, and these alliances, this multilateral approach that the U.S. used to lead is simply not something that the Trump administration cares about. I think the Europeans should be very concerned about this approach and this new tone from the administration. And I don't see anything that's going to help it get better.
Do you think, though, we can get a deal on Ukraine without the Europeans at the table?
Yes, I do think you can get a deal on Ukraine without the Europeans at the table, but it's not going to be one that's good for Ukraine or Europe. Because, I mean, one of the big threats throughout 2025 is that the U.S. and Russia just decide to get together and force a peace plan on the Ukrainians that's unacceptable to both them and Europe. Those odds have faded, and I don't think that's likely to happen right now. But you see Trump's increasing interest in getting this deal with Russia, and you see him more desperate to get a peace deal, and that's going to continue into 2026. And that's bad news for the Ukrainians, who look like they are on their back feet right now on the battlefield and are going to have serious attrition problems and serious problems fighting this war going into next year. So they are looks like they are in an increasingly weaker position as the U.S. is more interested in aligning with Russia to end the war, and that's bad news for the Europeans, obviously.
John, just taking a step back, it seems like the U.S. is getting increasingly involved in a number of geopolitical issues, whether it's the Ukraine-Russian negotiations or whether it's with Venezuela. At the same time, increasing questions mounting around Pete Hegseth and his leadership of the Defense Department. I'm just wondering, for your perspective, how much that complicates some of the United States' geopolitical involvements, given the sort of ongoing question of his fate and the support of the president.
I mean, Hegseth isn't exactly, I think Hegseth's a bit of a figurehead role at the Department of War, as they're calling it. I think if you look at foreign policy, a lot of this is being driven clearly out of the White House. Marco Rubio is an incredibly influential advisor being both the national security advisor and the Secretary of State. And Trump's also surrounded himself with a number of people that he's known a long time, who he trusts quite deeply. And we heard this in the clip prior to this, people like Jared Kushner and Steve Witkoff. So Hegseth's credibility and his role at the Department of Defense, I think, matters for deploying military assets, which of course the U.S. has no problem in doing. But I don't think he's one of the key drivers and shapers of U.S. foreign policy right now. That is coming from Trump, his immediate advisors, and of course, Marco Rubio.
John Lieber of Eurasia Group, thank you so much for being with us. As we look to what the U.S. is requesting from Europe wanted to seize these loans, use them, Russian assets, use them for financing to Ukraine to continue gaining leverage ahead of these negotiations. A real question of any kind of critical mass, an agreement and issuing common debt to support those efforts if this doesn't come through.
Potentially they're going to have to, but how challenging is that going to be for Europe right now? Also, this needs to get through Belgium, where these funds are. And I think you have serious concerns within Belgium that potentially these funds can go out to Ukraine. But then if a deal is struck and Russia comes back and says, we want those funds, who is going to be left on the hook to pay for them?
Yeah, and what does this do in terms of the demand for gold? Remember back when the United States kicked off this discussion around potentially seizing Russian assets, that's when you first started to see gold pick up and shift away from the dollar. The dollar has been actually on a weakening trend, although real questions emerge as you do see strength in the U.S. economy. Coming up, Jill Carey Hall of Bank of America with small caps, an arbiter of just how much strength there is at a record high. Plus, you hire Anand with your morning movers. Ulta rising with consumers continuing to spend on cosmetics. Good morning. This is Bloomberg Surveillance.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Okay. Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
We are potentially seeing another record high, just inching back toward that on the S&P 500. Equities more broadly doing really well, led by the small caps. Not today. You're seeing small caps up just barely, just a touch above flat. NASDAQ futures up 0.4%, regaining the lead with S&P up 0.2%. The NASDAQ hit a record high a while back. It is up 35% since the end of April. The Russell 2000 has returned almost 30% in that same period. Why? Potentially because there could be more Fed easing that could potentially pave the way to greater reacceleration. If you look at 2s, 10s, and 30s yields, just climbing a touch on the long end in response to any kind of potential Fed rate cuts that might come without the commensurate weakness. I keep going back to this, Anne-Marie. Michael Hartnett over at Bank of America talking about what could potentially kill this Santa Claus rally, saying it would have to be a dovish cut, indicating further rate cuts coming in the year ahead. This would lead to a rise in the long end of the yield curve. Yes, you also potentially could get pessimism in the overall economy, but it also speaks to an overall dovish tilt at a time where the economic data is not screaming pain.
The economic data is not screaming pain, and the consumer is resilient, as Mohamed El-Erian said. If you look through, even if you do see individuals being choiceful, maybe trading down, the consumer is still going out and spending. I think it's going to be interesting the first 3 months of next year. Is the consumer spending today because they know they're going to get those tax refunds, and it's going to be an incredibly challenging environment next year? And what the political polls are showing is that consumers are saying it has been hard to keep up in this affordability. But Michael Hartnett is saying is interesting, because usually you think dovishness, good, we're off to the races. But he's saying this might actually say to investors, actually the Fed might be more worried than you are.
Yeah, and it's the Dollar General and Walmart gains a good thing or a signal of pain elsewhere. 3 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Ulta. Those shares are rising in the pre-market after the company raised its full-year outlook on strong results, highlighting consumers' reluctance to give up their beauty routines despite cutting back elsewhere. And the CEO says they're off to a strong start this holiday season because apparently, she says, more people are planning to gift beauty products during the holidays. Meanwhile, HPE not having the same luck. Those shares are down 9.5% in the pre-market after the company delivered a softer than expected sales outlook, a blow to hopes that high server demand, AI server demand, would drive a bigger jump in revenue. And part of that weakness was due to order delays, with the CEO saying that big government and European deals slipped into 2026. And that was an issue with a data center delay not being up and ready yet, and the government shutdown. And we end on SoFi, those shares falling 7.3% in the pre-market after the company announced the share sale of $1.5 billion, which of course is a diluting event, but it follows a massive rally with the market cap nearly doubling this year. So it is striking while the iron's hot, with plans to use that fresh capital to fund future growth. And BI says that it wouldn't be surprising to see SoFi pursue M&A given this move. Lisa?
Thank you so much, Yahira. On our radar this morning, the U.S. urging EU members to block a massive loan to Ukraine backed by frozen Russian assets. U.S. officials arguing the assets must be saved to secure a peace deal, not to prolong the war. Elsewhere, more threads. A leading Chinese AI chipmaker founded by a former NVIDIA executive jumping over 425% in its Shanghai trading debut. The move fueling optimism for China's goal of achieving tech self-sufficiency amidst trade tensions, and raises a question about national champions around the world and how much investors are trying to chase the backing that comes from corporations.
And if you think that NVIDIA is not going to play the long game or be able to because of national security concerns in the United States, in China, who is going to fill that void? And what better than someone who actually used to work at NVIDIA at the helm of this company? But I think this shows that this really is, as Jensen Huang will tell you, China neck and neck with the United States when it comes to AI. And I wonder if this story actually plays into all the lobbying efforts he is doing in Washington, trying to tell policymakers, at least in his view, we should get China and the rest of the world addicted to our tech so that we are not competing with them at this level.
Yeah, and this is one reason why you are hearing that drumbeat, an increasing shift in the view of what national security looks like. It also, though, highlights how much countries are choosing national champions. And they're saying whether it's Intel or whether it's this one, these are the ones that we want to win. Whether they will win is another story. And I think we are writing the book in real time on just how much this will be successful. Yes, the initial pop, yes, but in a historical context, these haven't always been the biggest winners in the end.
True, haven't always been the biggest winners, but you could see that, at least in China, they do pick winners and losers and will put a lot of effort behind that. We are seeing some of that state capitalism also in the United States, but it is because semiconductors are just not important for your iPhones and consumer products. These are important companies and industries for things like the military, which is why you see really this out-proportional emphasis from governments on these types of companies.
Yes, indeed, and we'll keep tracking this. Warner Brothers Discovery, meanwhile, entering exclusive talks to sell its film and TV studios, along with HBO Max, to Netflix. Sources are telling us here at Bloomberg, a $5 billion breakup fee is on the table if regulators block the deal, which could be announced in the coming days. Both those shares trading lower in pre-market activity. Just getting a headline that is crossing currently, and it kind of builds on what we've seen from other airline companies, Delta in particular, saying that the hit that they're going to experience from the government shutdown is significant. Southwest coming out and cutting their full-year forecast, saying that they see the full-year EBITDA about $500 million versus the expectation previously of $600 million to $800 million. A real question here, how much this is a shutdown capacity? How much is this demand from people who are less well-heeled? We'll bring you any information as we get it. Those shares lower by 2.3% in pre-market trading. One of the small caps we're keeping an eye on, given the fact that this has been the outperforming sector. Turning to those small caps, the Russell 2000 closing at a fresh record high ahead of the Fed's widely expected rate cut next week. Jill Carey-Hall of Bank of America writing, we see support for small caps from improving earnings, guidance trends, and Fed cuts. Jill joins us now. Jill, thank you so much for being with us. I want to start with a real question. How much are small caps doing better because of an expectation of Fed rate cuts? And how much are they doing better because their actual businesses are doing really well?
I think both are a big part of it. I mean, really over the last 2 years, you've seen this increased sensitivity of the Russell 2000 to Fed expectations and the factors driving that. And so that's been one big driver and one reason we got more constructive in August, because the Fed cuts were projected to restart. But I think, one reason we had been cautious on small caps for a lot of earlier this year was the fundamental story. And, investors were expecting this big profits recovery. Small caps usually recover out of a profits recession faster and harder than large caps do. But we hadn't seen that, and the can kept getting kicked down the road. So finally, this summer we were seeing evidence that small caps were out of the profits recession, revisions were trending up, guidance was positive. Usually corporates can be more conservative, but they're actually guiding above consensus more than below.
How much, Jill, is this coming because of higher volumes and actually more consumer activity? And how much is coming from better balance sheets, more efficiencies, better use of technology, and all around a greater degree of productivity?
Well, I think when you look at this year, it's been kind of interesting. I mean, performance year to date has been this barbell of mega caps outperforming and then micro caps outperforming. And that's made it a really tough environment for small cap active fund managers because they tend to tilt up in quality and up the cap spectrum within their small cap universe. So very few small cap managers are ahead of the benchmark year to date. And, one of the dynamics that we've seen this year was elevated retail trading. That's a dynamic we've seen post-COVID, but much higher volume in terms of what's been driven by retail, particularly in small caps. So I think, that's driven up the concentration within the Russell 2000. If you didn't own those particular stocks, that made it more challenging. The Russell will move to a twice-a-year rebalancing next year rather than once a year. So if the stock gets really big and out of the small cap range, it's stuck around longer. That will help to mitigate that. But that's been another factor. So I think the retail trading, the the dynamics that we saw with micro caps outperforming, lower quality stocks outperforming. Those were happening even at parts of the year when small caps themselves were lagging large caps.
Joe, how much of this is, we're more than 10 months into the Trump administration. There was a ton of policy uncertainty at the very start. How much of this is also driven by there has been some more clarity, especially when it comes to where the administration is going when it comes to trade policy?
Right, and I think that's another reason that helps to be more constructive on small caps next year is we saw small caps get hit hard given the uncertainty around tariffs. They do have the thinnest margins of the size segments, so higher input cost is a bigger hit for these companies. And so if we are in an environment where effective tariff rates are potentially lower, if there are some exemptions, some potentially easing of tariffs. And just greater certainty that's a help to small caps. Small caps tend to do well when there's less volatility and uncertainty. If we see deregulation, that should be a benefit. So certainly a number of factors that created greater uncertainty for small caps early in 2025, but we could see more positivity in 2026. M&A activity has also picked up. And while it doesn't tend to necessarily be a driver for the small cap index overall, it has tended recently to be a factor that's caused targets to outperform more than usual. It's an environment where certain sectors within small caps, healthcare, for instance, has been one of the best performers year to date within small caps, and M&A and the sentiment around that has helped.
Well, I wanted to ask you about that, this deregulatory push from this administration. Are you expecting that pickup in M&A to continue throughout next year?
Yeah, I think we and our analysts in a number of sectors definitely see the case for continued M&A activity. We've seen the pickup this year. It started even before this year. Healthcare has been a big driver. We've seen more banks M&A activity this year. So there's been several sectors where we've seen a pickup. And we still haven't necessarily seen a lot of bigger deals, mega cap or even really mid cap deals. But we have started to see deals get done quicker. And, in sectors like healthcare, where there was a lack of M&A for quite some time, this has helped sentiment. So, macro conditions need to remain supportive. M&A is cyclical, but the fact that small caps are still relatively cheap versus large caps and the macro environment has remained supportive has certainly been a positive factor.
So just from an economic perspective, how difficult is it to get a full read on things, given the fact that we're not getting non-farm payrolls, we're not getting a whole slew of other economic data, and we have mixed reports from different corporations? On one hand, Walmart and Dollar General, yay. On the other hand, not so much, because these tend to outperform in times of economic distress.
Right. Yeah, I mean, I think we've been in an environment where there's been a lack of data, and at Bank of America we have a number of reads from the B of A Institute and on our internal data. But I think overall we do expect the Fed to cut next week, and we expect 2 more cuts next year. So that is still an environment that should be supportive for small caps, given the refinancing risk that these companies face. They're more levered than large caps. They have more short-term and floating rate debt, more debt coming due over the next several years. But I think some of the macro factors that are going to be most important for small caps, beyond just the overall condition of the economy and the consumer, is the manufacturing backdrop. We've struggled to see the ISM climb back into expansionary territory, and that's an indicator that's highly correlated with small caps. And then the credit backdrop, where obviously we saw some signs of concern over the last several months. We're watching that. So far, not necessarily signs of broad-based credit deterioration, but small caps are highly sensitive to the credit backdrops. So those would be 2 key factors we're watching as well.
Jill Carey-Hall of Bank of America, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The European Commission is fining Elon Musk's X nearly $140 million for violating the EU's content moderation law. It claims the social network misled users with its paid-for blue tick symbol and stonewalled researchers' access to data. It marks the first fine under the EU Digital Services Act. X has 90 days to implement the changes, or it could face additional penalties. The U.S. Senate is seeking to ban NVIDIA from shipping advanced AI chips to China. They've now introduced bipartisan legislation to prevent the Trump administration from easing export controls. It comes amid reports that the Trump administration is considering relaxing restrictions on exports to China. The bill urges maintaining rather than loosening those export controls. Democratic Senators Elizabeth Warren and Jack Reed are reportedly demanding tighter credit rulings for banks engaged in private credit. According to the Wall Street Journal, the lawmakers are citing the BlackRock debt write-off as proof investors can suffer in opaque markets. The senators are pressing regulators for immediate action and a mandatory private credit stress test. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. I know that everyone is shocked about that potential proclamation for more regulation.
Oh, right. Elizabeth Warren, Senator from Massachusetts, asking for more regulation in the banking sector. I don't think anyone's surprised about this morning. The day ends in Y. There's going to be a letter.
Which is a reason why I think a lot of people are looking past that to what's going on the monetary and fiscal side. Up next, pushing for lower rates.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
Kelsey Barrow of JP Morgan Asset Management joining us next. Good morning. This is Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2, then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3, then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Trying to end with a new record high, the Santa Claus rally gaining steam. The S&P 500 up throughout the morning after 3 straight sessions of gains. The Russell 2000 has been leading the charge, less so today, up 0.2% on S&P futures. You also are seeing a lift to bond yields, a question of what the influence of the Fed will be over the longer end. 10-year yields now almost at 411. And check out shares in pre-market trading of Southwest. Southwest cutting its operating profit for the full year to $500 million. Previously, they had said $600 to $700 million. The expectation here that some of their profitability crimped by the government shutdown. They are seeing bookings return to normal. Those shares lower by 2.2% in pre-market trade. I'm just curious if this is a broader trend too, whether this really does speak to any kind of consumer pushback or if it is government shutdown related.
Well, the government shutdown was the longest in history, more than 40 days. And at the same time, you cannot make up that demand. That's it. It is over. So they're citing this as being potentially this one-off hit. On top of that, also higher fuel prices. Maybe jet fuel has been higher for some of these airlines. They say that bookings are back to normal, so potentially for the airlines, smooth sailing for 2026. But you can't make up the fact that people were just stuck not traveling because a number of individuals were not getting paid.
You heard the same kind of thing from Delta. This just adds to the sort of muddied waters behind the backdrop of the Federal Reserve under surveillance this morning, pushing for lower rates.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
And if you were Fed chair, would you want to keep doing that how many times in the beginning of the year?
You know, as Fed chair, what your job is to look at the data, see how it's going, and make sure that you're, keeping unemployment low and inflation low. And depending on how the data move, that you move interest rates in response to it.
Here's the latest. NEC Director Kevin Hassett reiterating his call for lower rates as Wall Street voices concern over his potential nomination as the next Fed chair. Kelsey Barrow of JP Morgan Asset Management writing, the market has been incorrectly pricing rate cuts in December and January as interchangeable rather than cumulative. Kelsey joins us now. Kelsey, you're right. We've actually seen a decline in the probability of a January Fed rate cut as people have increased the probability of one next week. Why do you think this is wrong?
Yeah, so what we've been seeing is the pricing for a December rate cut and a January rate cut over the last month have been negatively correlated. So when December came down before the last payrolls report, you saw January go up. So people were generally thinking these are interchangeable. Now, the reason that I am skeptical about that, there's a few. One is the continued deterioration in the labor market data, which to us signals that the Fed is likely to deliver not just the December rate cut, but also one in January. But more importantly, just from a market probability perspective, I think that ahead of the jobs report on December 16th, which coincidentally comes after the Fed's decision, that you should be pricing in a probability for January that's really closer to 50-50. So if we're coming out of the December FOMC meeting and we get this hawkish cut that most of the consensus at least expects, and January probabilities are still as low as they are today, below 30%, I think that's actually a decent risk reward heading into the October-November combined payrolls print, where I think you're probably more likely than not going to see more softness in the data.
So why do you say that? Yesterday we got initial jobless claims. We haven't mentioned it once this morning. People seem to have just rejected it. Came in at the lowest level that we've seen going back to 2022. I believe only once before in history it's been this low since the middle of the century, last century. So how do you square that with ongoing weakness that you think will justify further rate cuts?
I don't deny that it is a peculiar situation, and the data is not clear completely. And I don't know if it will ever be clear completely. But here's what I would say. In terms of initial jobless claims, we broke below 200,000. It was during the Thanksgiving week. There are sometimes quirks around that. But at the same time, we did get the challenger job cuts. And if you look at the cumulative amount of job cut announcements this year, relative to prior years, we've actually seen the most layoff announcements in that challenger survey since 2009. So it's unusual actually over time to see that big of a disconnect between initial jobless claims and the challenger layoff series. Now, there could be reasons for it. It's announcements, right? Challenger is announcements, not things that actually happen. So there could be some of a timing mismatch. But I think more broadly, when you look at the mosaic of data, it's still telling you that the risk of a reacceleration in the labor market, a risk of a wage price spiral, which is the most important thing for the Fed in terms of being able to maintain an easing bias, those are all still fairly low.
When it comes to the December 16th non-farm payrolls report, what is the bar of how low it needs to be for the Fed to cut in January in your mind?
Well, I look at things like the ADP and Revelio data, which we have through October and November already, and they're flagging the risk of something closer to zero. So if I think about it, we have the September NFP, job growth on average for the last 6 months in that survey is around 60,000. Then you compare that to where the 3 and 6 month moving averages for job growth are through November for Revelio and ADP, and those are closer to zero. You know, you look at the last 6 ADP prints, 4 out of the 6 of them have been negative. So I'm not necessarily calling for a negative print. I am calling for something that is softer, something that biases the unemployment rate slightly higher. You know, we were nearly there in the last report at 4.44 on the unemployment rate. That could round up. And again, this is still, at least from the market's perspective, a low hire, low fire, sub-trend growth environment, not a recessionary environment, but one where the labor market is squishy enough, you know, that the Fed has ample justification to maintain the easing bias and gradually cut a few more times.
We just have about 30 seconds left. Michael Hartnett saying that if the Fed is overly dovish, that will lead to a rise in long end yields. It sounds like you disagree. Is that correct?
It depends, obviously, on the mix of data. I think the market would be surprised by an overly dovish message ahead of key data points. And so there is a bit of a sequencing thing here. I think the way that the Fed should approach it is to have more of a neutral bias. I think that makes sense given that you know that just 6 days later or 5 days later, you're gonna have a lot more information than you did before.
Kelsey Barrow, thank you so much for being with us. Kelsey Barrow of JP Morgan Asset Management, and AMH is shaking her head.
It doesn't need to be this way.
I know.
Just move the meeting.
She's gonna keep her lobbying. Just move the meeting.
It's circumstances that you couldn't predict, have all the data going into the next Fed meeting.
Yeah, and the second we get the data, people are gonna say, how clean is it? And can we actually read that much into it? So we will have these debates on an ongoing level. Coming up next, we will continue that. Kate Moore of Citi Wealth will be joining us, plus David Steinberg of Zeta Global, Abby Yoder of JP Morgan Private Bank, as we look ahead to a really big week. The Fed has to decide amid a dearth of economic data. We should be getting non-farm payrolls. Instead, we're getting University of Michigan sentiment. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
So I know from owning a sports team that owning one team takes a lot of energy and time.
Tell me about it, yeah.
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the 2 teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only 2 teams that was independent.
So now you have 2 soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Feminine is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
Technology
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Everybody's talking about this K-shaped economy, and I think it's real.
It's been the tale of two consumers.
This is a structural problem.
The recovery isn't really in sight. There are a number of upside risks as we look out to the end of the year and turn the calendar page into 2026.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes now turning to next week's Fed rate decision. And potential Fed Chair Kevin Hassett says he does support a 25 basis point rate cut. Some dated inflation data coming up later today. We are getting a mixed read on the U.S. consumer. On one hand, we've got the likes of Walmart and Dollar General that are doing really well, Anne-Marie. On the other hand, you've got Southwest coming out and actually downgrading their earnings forecast for the year.
So Southwest, though, could potentially be linked to what happened with the U.S. government shutdown. Longest in history, they're saying that part of this is because of that. Maybe they're leaning heavily on that, but you can't make up that lost demand. That's it. People didn't fly. A lot of Southwest individuals linked to potentially federal workers flying around the country, also individuals that have jobs because of the federal government. They're contractors too, so potentially that's part of it. And then when it comes to Dollar General, Dollar Tree, Walmart, is it a sign that the economy is actually not doing well because maybe those higher income spenders are actually looking for deals on the lower end?
Right now, what we're seeing is people pricing in their optimism, in particular with the Russell 2000, hitting another all-time high yesterday. Notable to see the gain so far since the end of April in the Russell 2000, up 30%. So the real issue is this because the Fed is expected to cut rates? Is this because of actual strength? Or is this because a lot of these companies are getting better at becoming efficient, cutting jobs, using technology, and actually doesn't speak to an overall economic boom?
Well, this year they've had to learn to do that. They were given a tremendous amount of uncertainty with the global trading landscape as well with the Trump administration. What they've been able to do is really weather that storm in terms of passing on some of those costs, but not all of them, and being able to be as efficient as possible.
We are getting some breaking news currently. Netflix is going to buy Warner Brothers. This is just crossing. This had been something that we were talking about throughout the morning. Netflix is planning to buy Warner Brothers for an enterprise value of $82.7 billion. The cash and stock transaction valued at $27.75 per Warner Brothers shares. You are seeing shares slightly lower in pre-market trading of Netflix, down about, fluctuating here, but down about 0.5%. One way or another, this comes after a lot of rumored speculation, including a breakup fee that Netflix would pay to Warner Brothers of $5 billion, but it comes after so much drama around these names.
So much drama, because remember, this was a bidding war. Netflix was really the dark horse. Everyone thought it was going to be Paramount, especially given David Ellison's link to the Trump administration. He was in Washington, D.C. this week trying to lobby them. There is concern about the regulatory approval when it comes to Netflix and the antitrust concerns. And you have a number of congressmen in California also speaking about this. You have a letter to Variety from some film directors that they say, prominent film directors are part of this letter, talking about the potential antitrust issues. So that $5 billion breakup fee seems to be what put this over the edge. I am surprised, though, how quickly. Just last night, we broke that they entered these exclusive negotiations, and today they got the deal done.
We'll be developing the story as we learn more throughout the morning. Right now, futures higher as we look to potentially clinch a fourth straight day of gains on the S&P 500. Meanwhile, you are seeing the outperformance from NASDAQ, 0.2% gain on the S&P, yields marginally higher to 411, and you are seeing just that range-bound dollar weakening trend that has kind of hit a stall speed in the past couple of sessions. Coming up this hour, Kate Moore of Citi Wealth. As investors eye that fourth straight day of gains, David Steinberg of Zeta Global with a new view of the consumer this holiday season, and Abby Yoder of JP Morgan Private Bank on whether big AI bets are cashing in. We begin this hour with stocks inching higher ahead of a long-delayed inflation information report. Kate Moore of Citi Wealth writing, we remain fully invested in equities on this nominal growth backdrop and prefer gold over long end duration as a hedge to risk given the upward pressure on rates. Kate, I am so pleased to say, joins us now for more. Kate, good morning. Thank you for being with us.
Good morning.
So this has been a market that you've been cautious about for a lot of this year. You still see reasons that maybe the everything rally can't continue forever, but the tone has shifted. Why?
Okay, so it's not that I've been cautious. It's that we didn't aggressively add to risk because we prefer to take our exposure in large caps. And I continue to, even after seeing some of the small cap rally. I think most of that, and you kind of led into this a moment ago, has been around rate cut expectations. And relative to some others, we don't think the Fed should be cutting rates at every meeting from now until next June. I know some people are hoping for that and some pricing that in. And we think small companies desperately need that in order to really sustain a rally and to have better earnings and fundamentals. So we prefer to take our risk in the large caps space. We've done quite well there, but it's not that we've been out of the equity market or been underweight in any way, shape, or form. We just want to be where the earnings are and where the free cash is and where we have visibility. And that served us really well this year.
So what you're saying is it sounds like you don't buy that there is this truly durable rotation into small caps and to expand out of just where the leadership has been. Is that correct?
Yeah, I want to. And I know so many people have written their year ahead report saying, once again, same thing they did at this time last year. Next year is going to be a year of broadening. It's going to be a year of broadening in sectors. It's going to be a year of broadening in terms of regions. And I'm not a buyer of that today, this first week in December. And let me explain why. Because we are kind of later in the cycle. We are at a point where you can pick and choose whatever economic data you want to fit the narrative you want to tell about the overall macro and what policy might do to respond to that macro. And I think you have to be very anchored to fundamentals. And where we have visibility into fundamentals, where we can see earnings, where we know that companies have the ability to weather any kind of storm in the economy, whether that's a bit of inflation spike or a slightly weaker labor market or policy headwind, that's where we want to be anchored. And I think many investors will as well. You don't just rotate for the sake of rotation. You just don't buy the laggards for the sake of it. In fact, we have done a bunch of quantitative studies to show that when you employ that strategy, particularly after a full year of performance of kind of tech and comms, et cetera, you don't perform as well. Some of these things that are doing well deserve it, and we don't rotate for the sake of rotating.
But isn't the table set this time around better than it was last year in the sense that the Fed looks likely to remain accommodative?
Yeah.
You have deregulation push from this administration, and the trade policy uncertainty is now behind us.
Well, so let me say this. We are really constructive on the deregulatory side, and it's a reason we've been talking about the opportunity in banks. I realize I do work at a bank, but I also can be objective, and my job is to make my clients money in all parts of the cycle and in all sectors. So, yeah, I see the deregulatory side as a good tailwind for parts of the market and for the economy. On the trade side, much of the uncertainty is behind us, but not all. And I like to say we were past peak tariff shock, But we're still kind of working through what's going to happen with the IEEPA tariffs, which tariffs are going to be enduring, what will trade look like. Look, I'll be honest, I'm encouraged when the administration is pulling back or rolling back some of the tariffs they employed. I think that's, I'd like to see a more moderate inflation environment, but we know that higher prices are still filtering into the costs and to the end prices that companies are charging consumers. So I don't think we're past the concern. I think people are tired of talking about it and want it to go away. But inflation, I think, is spicier than many are pricing in the market. That's a core view of mine.
Lisa and I have been talking about all week what the signal should be from the dollar stores and Walmart. Is it a good signal in the economy and the consumer, or is it actually a negative one?
I think it is a cautious signal. I think we are getting consumers who are continuing to spend. We like this, but they're continuing to spend in a way that is conscious of, brand, it's conscious of value, and it's conscious of where the best deals are. We all know how this went kind of over Black Friday and the following weekend. Consumers are, if they're in the big box stores, they're using their phones to price check at the same time. And we saw more people shopping online than in the stores than we have historically, continued to see that trend. And that's largely because people are comparison pricing on prices. And I think that's a smart thing to do, but they are not stopping spending. But we do need to recognize that we are at this later part of the cycle, that consumers are a bit fatigued. This has been a tough year. They don't feel many things are affordable, from the regular basket of goods to housing, et cetera. And we need to listen to that, and the administration needs to listen to that as well.
So you talk about how you are somewhat looking at the large caps to continue to outperform. You're not screamingly optimistic about the U.S. economy. At the same time, not seeing long duration as a hedge. I wonder how much this has to do with the glut of supply, not only coming from the Treasury market, but also from the corporate bond space, as it helps to finance a lot of the AI tech boom that we're seeing.
Yeah, so we've seen an uptick in some of the financing, obviously, for AI projects and AI adjacent projects and infrastructure, but it's not setting off any alarm bells for us. Frankly, on the duration side, the thing that we're most concerned about is that we are exhibiting very little fiscal discipline in the U.S. government. That is not a political statement. That's true across both Republican and Democratic administrations, and that the rest of the world is kind of waking up to this, and that this is not a great picture over the medium term. Frankly, if we think inflation is going to be a little spicier, and we think that we're likely to get no fiscal discipline in 2026, the likelihood that bond yields stay where they are or move a little bit higher, that we're not going to get a lot of juice, I think is quite high. We prefer to hedge our long equity position with more gold at this point.
Well, I wonder where credit fits in with this. And I'm saying this after Warner Brothers and Netflix, their tie-up has been confirmed this morning. That deal is expected to close in 12 to 18 months. Netflix has been talking about using a lot of cash as well as buying shares. That is code for debt markets that are going to be financing this, since they don't have that cash on their balance sheets. At what point do you think that the credit market is going to experience some fatigue with the massive issuance it's seen, not only from AI, but from some of the other M&A activity that's come down the pipe?
Yeah, I mean, this is an excellent question, and actually something we've been spending a lot of time on our research side on this week, because we're asking ourselves, how much juice is there left in the credit market? We know spreads on the IG and the high yield side are close to the 15-year tights. It's great if you're a company that's issuing. It's not so great if you're looking for a great total return from that asset class. And as asset allocators, that's what we're really examining. So while I'm not calling for any significant spike in defaults, we have to ask ourselves, relative to equities, can we get the returns that we need on a risk-adjusted basis from credit at this point? And we're less convinced. And we've been a little bit underweight relative to our index.
So if you're underweight credit,
but overweight equity.
But overweight equities, and you're underweight long duration.
And balancing out with gold.
Balancing out with gold.
Mm-hmm.
This is a new portfolio allocation. This looks like a different kind of model than pre-pandemic, the 60-40 type of allocation.
It absolutely is. And a big project we're also undergoing is really kind of rethinking how we construct portfolios in general for all of our clients. They need to be outcomes-based and not just static based on a 60-40 benchmark. What part of the portfolio needs to be generating growth, income, and uncorrelated returns? And then where do the traditional asset classes and factor exposures fit into that? So this is a huge project for us, and we are really, really excited about where we'll take it.
Kate Moore, you're going to be sticking with us. Kate Moore of City Wealth here in New York, as we do see this deal. Netflix planning to buy Warner Brothers for $27.75 per share in cash and stock. We'll build on that in the upcoming minutes and hours. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Yeah, well, just some more details on that. He didn't get to the $30 mark, Lisa, as you've said. Netflix acquiring Warner Brothers, including its film and TV studios. The deal will be a cash and stock transaction valued at $27.75 per share of Warner Brothers Discovery. Now, the total enterprise value, approximately $82.7 billion. And that transaction expected to close after the separation of Discovery Global into a new publicly traded company. The Supreme Court clearing Texas to use a new Republican-drawn congressional map for next year's election. The decision reversing a lower court ruling, bolstering GOP hopes of picking up as many as 5 new House seats in the state. 3 liberal justices dissented, saying the majority should have respected the lower court's ruling. FIFA is conducting the Men's World Cup draw at the Kennedy Center in Washington today. The draw determines which opponents all 48 teams will eventually face in the initial group stage. The ceremonies kick off at noon. President Trump is hosting the festivities with performances from Andrea Bocelli and the Village People. The World Cup starts next June with matches in Canada, Mexico and the United States. And that's your Bloomberg Brief. Lisa.
What is it? Thank you so much, Vonnie. What is it? I said the Village People. When Vonnie said the Village People, just laughter around the table.
Well, because it's a little bit unconventional, right? You have the Village
Andrea
People,
Bocelli.
YMCA coming out. It was the contrast for me, you know. Aaron Judge will also be there.
Will he also be singing?
I don't think so.
Up next, we're not talking about that. All about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news.
Bloomberg's Lauren Dezensky joins us up next from New York. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
Not a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Trying to build on 3 consecutive days of gains, equity futures higher in pre-market trading, led by actually the NASDAQ, which had been lagging behind for the previous few sessions, up at about 0.2% on the S&P. Range-bound on the euro-dollar cross. We had seen some dollar weakening that had reversed yesterday. Yields marginally higher. Watch this name. You can see Netflix shares lower in pre-market trading after announcing that they were going to buy Warner Brothers for $83 billion. It is a stock and cash transaction, raising questions about how much debt they're going to have to issue. We'll get into that in just a bit, but this deal seeming to culminate. Warner Brothers shares still halted after that news dropped. Under surveillance this morning, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. There's this fake narrative that the Democrats talk about, affordability. They just say the word. It doesn't mean anything to anybody. Just about everything is down. You know, this whole thing is, they use the word affordability. It's a Democrat hoax.
Here's the latest. President Trump traveling to Pennsylvania on Tuesday to promote his economic agenda as more polls show affordability is the dominant concern for Americans. Bloomberg's Lauren Dezensky joins us now for more. Lauren, can you sort of square the circle for us? On one hand, the rhetoric coming from the White House is this is a hoax. On the other hand, the actions really speaking to the concerns making their way through polls about affordability.
Certainly. President Trump is going to Pennsylvania to pitch this affordability argument. I think that the president certainly, I think it stands to be seen what argument specifically he does make. If he tells those voters in Pennsylvania that this is all a hoax and prices are down, I don't think that that's going to resonate all that well. At the end of the day, data is showing that Americans are concerned with how expensive the cost of living has gotten in this country. And the idea that this is simply Joe Biden's problem or this is a hoax, this is Democrats coming after it, while it is a familiar refrain for this president, it's not necessarily something that is going to change the reality for Americans in that it's just more expensive to buy groceries.
Lauren Dezensky of Bloomberg, thank you so much, which is the reason why I think a lot of people in markets right now, Emery, have been looking to some sort of stimulus early next year, that maybe the rhetoric is one thing, but the actions are going to be quite different.
Well, there's really going to be a fiscal impulse when it comes to one big, beautiful bill, some tax rebates, but then you have the administration teasing this idea of $2,000 checks. Now, the president continues to talk about it, even though we've seen the Treasury Secretary sort of back off and say potentially something we need to look at, this needs congressional approval. The president can't just come out and decide to write these checks. Also, we need to know what goes on with IEEPA before you start writing out dividend checks from the tariff revenue that these tariffs have brought in. Are they even legal?
Yeah, and we have to wait until bond vigilantes possibly wake up. Kate Moore of Citi Wealth is still with us. And Kate, I'd love your take on how you price in or game out any kind of fiscal support as you do see this affordability issue continuing to gain ground, not just with Republicans, but also the Democratic wing of the party.
Yeah, look, I think this is a major, major issue for most consumers. And one thing we've been anchored to, and of course we know we haven't gotten more recent inflation data from the government, but in the last print for CPI, more than a third of the components are running at a 5% annualized rate. And so there may be some things that are depressing overall headline CPI, and it could be rents, and it could be like one-time purchases like used cars, et cetera. But we know that the average consumer is going to the store and feeling like it's costing more to get the same basket of goods than it did a year ago. And that, to the point we were talking about the retailers, they're being more choiceful, they're being pickier about what they're buying, and they are really searching for value across online retailers and stuff as well. That's not behavior that's consistent with, hey, everything feels affordable to me right now. And I do think it's going to influence a lot of the discussion around the midterms next year, as well as some of the policy decisions from this administration going into that voting. So, President Trump may have said it's not a concern for him. I would suggest, given some rollback on some specific tariffs, he and his team are aware that it is an issue for many voters.
Especially the fact that he's going to Pennsylvania next week. He understands this is an issue. There's this meme circulating about the $2,000 checks. You have electrical power strip and you just plug it in itself. How circular is this when you basically have tariff revenue and then giving that revenue back? Isn't it just giving basically a tax credit back to the American people?
And the question I always have, because the administration has suggested if they were to do something like this, there would be a tiering system that certain consumers wouldn't qualify and others would. But if you have a higher propensity to consume with, say, the lowest quintile of household income and the highest, are spending quite a lot and they're feeling that tariff pain, who gets what and when and how would that be funded? It feels very challenging.
If it does only go to the lower income cohort, though, does that mean it could potentially put a lid on stoking inflation the way we saw some inflation induced under the Biden administration with the checks?
I mean, it's a good question. I think I haven't worked out the math there of what the real impact would be. But I do think that even if we roll back IEEPA, which I know we talked about, and even if people feel temporary relief from some of the things that they purchase on a daily basis. The tariffs are a tool this administration feels are very important for trade partners and for, allies and adversaries alike. So I don't think we should expect tariffs to come off of the policy playbook for this administration and that they will continue to pursue more specific sectoral tariffs that will be more enduring. And frankly, as we've seen in the past, have endured through multiple different administrations and different political leadership. So those things are stickier and will lead to prices. I can't tell you exactly what they're going to be at this point because we've heard many different stories, but I think tariffs are an important tool that are not going away.
This policy backdrop is the reason why a lot of people are really bullish on equities.
Yeah.
And I hear that again and again because ultimately, potentially it could be inflationary, regardless of what happens if you're giving more cash to consumers. Also, there are these Trump savings accounts that are gaining steam. The idea of having every child in the United States that is eligible to have some sort of money set aside to go into equity markets or broad markets. How are you sort of pricing that in terms of the outperformance of the equity asset class as a whole, which tends to do better in more inflationary times?
Yeah, I mean, those are definitely supports for the equity market into 2026. But I would also note we have a very important driver, which is what's happening in terms of capital expenditure, not just in the AI space, but frankly in a lot of adjacent spaces, and the overall kind of spending that businesses are doing to be competitive in this new and changing landscape. All of that data that we've received more recently, both from companies as well as things that are aggregated, are suggesting that spending goes full steam ahead into 2026. So combined with some of these policy, moves to get people invested in the market, the corporate side, I think, is really going to drive what will be a solid economy in 26.
Yeah, and I believe that your bank, Citigroup, just came out with an increase in their forecast for copper. I imagine copper very much gaining steam with all of the metals in general on the heels of that.
We've been looking very closely at resources, not just on the research side, but also in the Citi Wealth side as well, as beneficiaries, frankly, of this increased capital expenditure, and especially materials that do very well in an environment where we're building these data centers. So we see a lot of opportunity to actually add to resources, not just the tech companies, as a way to play this theme.
Kate Moore, wonderful to see you. Thank you so much for spending this morning with us. Kate Moore of Citi Wealth here in New York. Coming up the next hour, David Steinberg of Zeta Global with a fresh read on the U.S. consumer. Plus, Yahira Anand with your morning movers. Shares of Southwest Airlines lower after cutting its outlook. Anne-Marie, I'm watching Netflix shares right now and Warner Brothers. Warner Brothers actually restarted trade and is almost flat in pre-market activity. Seems like a big deal that a lot of people have been waiting for.
A lot of big deal. A lot of people have been waiting for this. It's been a bidding war. And for Netflix, this deal is the biggest ever they've taken on in scope. Shares are down. The next big hurdle is going to be the regulatory scrutiny this deal is going to come under.
Yeah, especially given the fact that there's a real focus on media and the potential groundwork for other big consolidation. Those shares lower by 2.7%. Netflix futures down as they do pledge to buy Warner Brothers for $83 billion. From New York, this is Bloomberg Surveillance.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Futures inflecting higher as we look to close out the last day of the first week of December. I'll get it out. It is a long week, even though it is just the first one of the last month of the year. We're looking at a 0.2% gain on the S&P. The NASDAQ futures leading the charge, up 0.3%, and the Russell 2000, which hit an all-time high yesterday, is up 30% since April 30th. Now, those shares, futures lower by about 0.1%. When you take a look at 2s, 10s, and 30s, 30-year bond yields rising to the highest level going back to September 25th, 4.78% rounded up. You're seeing 2 basis point increase there. Similar move on the 10-year, squarely through 4.11, with the real question around duration, given the fact that the Fed will probably cut rates, and given the fact that some of the economic and corporate data has been better. 2 hours away from the cash open, let's take a look at some of those corporate stories. Yahaira Anand has them for us. Yahaira.
Hi, Lisa. It is a big shift in the media landscape. Netflix acquiring Warner Brothers Discovery studio and streaming businesses in an $83 billion deal, ending a saga that has been months in the making. The deal pushes Netflix deep into traditional Hollywood, overseeing a century-old studio and a theatrical business that Netflix has never really embraced. What also could be weighing on Netflix stock this morning, which is down 1%, is that $5 billion breakup fee if regulators reject the deal. Meanwhile, we are seeing Southwest Airlines shares falling nearly 1% in the pre-market, pairing earlier losses after the airline cut its profit outlook for the year. The carrier now expects operating profit of $500 million, down from as much as $800 million, blaming the hit on higher fuel costs and that recent government shutdown. It says that upended travel, and that is why Southwest is taking a bigger hit, since it is a mostly domestic airline. And we end on SoFi shares. They are falling nearly 7.5% in the pre-market after announcing a $1.5 billion share sale, which of course is a diluting event, but it follows a massive rally with SoFi's market cap nearly doubling this year. So it is striking while the iron is hot, planning to use those fresh funds to fund future growth. And analysts here at BI say that this could mean that it wouldn't be surprised to see SoFi pursue some M&A because of this move. Lisa?
Thank you so much, Yahaira. On our radar this morning, NAC Director Kevin Hassett saying the Federal Reserve should cut interest rates at its meeting next week.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
President Trump is planning to announce his pick to lead the Fed early in the new year, and Hassett is considered a front-runner for the nomination. But still, Emery, a lot of questions given the fact that it's dragged on for so long.
It's dragged on, and the president said this week a potential Fed chair is in the room. Didn't really go out and enthusiastically talk about how he has made his decision on Kevin Hassett. Specifically, I know he's winning in the betting markets, but the timeline just keeps getting pushed back. So, and he's known potentially to change his mind. So it's not a done deal.
just yet.
And it really is this question of markets. How much of a concern is this? On one hand, you've gotten rumors and stories about pushback from members of the Treasury buying market. On the other hand, one thing Steve Englander of Standard Chartered points out this morning, you're not seeing those inflation worries perking up in break-even rates or other kind of market-based expectations.
Right, which Kevin Hassett then went on news and said, look, the market reacted fairly to the idea that the president has maybe not so much picked me. He wasn't trying to boost his own ego, but the idea that he's coming down to a decision. I do think it is interesting that the Treasury is trying to solicit input from bond investors. And if bond investors are telling them, yeah, that Financial Times article, one comment was, we don't want a Liz Truss moment. We don't want to get trust. That might give them pause. And obviously, the Treasury Secretary is going to have to be honest with the president in terms of what market participants are saying about the individual who's right now the front runner.
Yeah, Scott Bessen's been very clear that the market ultimately does hold the vote. Right now, we're also watching U.S. Trade Representative Jamieson Greer saying the U.S. trade relationship with China needs to be stable, more balanced, and potentially smaller. Greer adding a 25% reduction in trade with Beijing would be a move in the, quote, right direction. Also talking about how negotiations and discussions are ongoing on a daily basis. So this isn't exactly something that is going quietly.
We had a détente between Xi Jinping and President Trump when they met in South Korea, but the trade negotiations continue and that dialogue continues. And there's been reports in the Financial Times that this administration is so focused to making sure that trade maintains on a good track with China because the United States need those rare earths, that they're actually starting to potentially look at ways maybe they could wait it out when it comes to other issues they have with China, like sanctions, when it comes to national security space.
Yeah, focus on natural resources, very much front and center. Copper extending a record-breaking run after a bullish price outlook from Citi. Analysts expecting copper to rally to $13,000 by the second quarter. The AI build-out is fueling demand for the metal and stoking fears of a shortage. Let's turn back to that breaking news from earlier this hour. Netflix planning to acquire Warner Brothers Discovery in a massive cash and stock deal valued at nearly $83 billion, representing $27.75 per share. Joining us now for more is Geetha Ranganathan of Bloomberg Intelligence. Geetha, how surprised are you that this deal was announced so suddenly after so much drama over the past few months?
Yeah, we're actually very, very surprised, Lisa. We never saw Netflix really as a front runner. I mean, when we first heard the news about Netflix kind of kicking the tires, we just thought it was more of like an exercise, them just kind of looking at all of the assets. So this really comes as a surprise to us because I don't think anybody on the street or in the market actually thought that this was an existential deal for Netflix. It very much is the case for Paramount, Skydance, and Comcast. I mean, now those are two subscale streaming platforms. I think the street was very much looking at that as a must-have, Warner Brothers. For Netflix, not so much. So definitely a huge surprise.
So why did Warner Brothers in the end go with Netflix?
So I think there are a couple of different things here. I think one is just the price is something that they were looking for. I don't think Paramount was willing to pay more than about $26 for the entire company. Remember, Warner Brothers here is selling two different parts of the company. So there is the global networks business, which is, TV networks, CNN and all of that. And then you have the streaming and the studio business, which is, of course, the far more valuable part of the business. And Netflix, of course, really kind of paying up almost $28 a share. So we know that David Zaslav, the CEO of Warner, was looking for something close to about $30 per share for the entire company. Remember, this is a stock that was trading at $12 just a few months ago. So there's been a huge, huge run up. And I think that this probably was the best deal for shareholders. And that's what Zaslav said he was going to do.
Geetha, do you think that this is going to be the best deal for regulators? Do you think they're going to sign off?
Yeah, this is really a huge regulatory gamble, Lisa. I mean, you kind of look at Netflix, they already are the dominant streaming platform, 320 million subscribers globally. That's the #1 streaming service. HBO Max also pretty massive with close to about 130 million. So you combine the #1, #3 streaming services across the world, huge regulatory red flags. So it's going to be tough. There is a $5 billion breakup fee that kind of reflects that uncertainty. we'll have to see what are the concessions that Netflix is willing to give up.
Geetha Ranganathan, thank you so much for being with us. Hopefully we'll catch up with you again soon as we parse through the details. Turning to the broader economy, dated inflation data coming up as we get a mixed read on the consumer. A new report by Zeta Global, an AI-powered marketing cloud, finds, quote, holiday-related activity continues to support consumer sentiment, though growth appeared to be driven more by higher prices than rising volumes. David Steinberg, CEO and chair of Zeta Global, joins us now. David, this is the ultimate question. How much of what we're seeing that looks like strong sales really is strong inflation driving pretty tepid sales?
I think it's a combination of both. I mean, we're really seeing prices continue to go up. In certain categories, they are going down in some, like gas. But what we're seeing is really the economy is being driven by non-discretionary and holiday purchasing right now.
Which is the reason why I think people are looking at some of these mergers and some of these other activities in the market. The dominance of, say, the Walmarts, the dominance of the streaming services that can jack up prices in some of your streaming service. I mean, how much is that the gameplay right now? That there isn't that much growth, per se, organically, but some of the returns that we're seeing from corporations in the retail space have benefited from consolidating market share and actually doing better efficiencies.
I mean, there's no question efficiencies are getting done. I mean, we just had the holiday weekend. We saw our platform utilization go up 153% over 5 days, and AI was able to drop our clients' costs by 87%. That's not just us. We're seeing that across the board through mergers. And when you look at Netflix buying that type of a platform, I think they're looking for additional scale in a world where scale really is driving winning.
When you say dropping their cost by 87%, what type of costs are we talking about, David?
We're talking about the internal cost of managing their marketing and business intelligence. So getting rid of data scientists, getting rid of people who are focused on doing the activation of marketing, and quite frankly, lowering the marketing costs by hyper-targeting the marketing. In a world like today where it's really a tale of two cities, where you've got the top 10% of people in the United States driving the vast majority of economic growth, you've got to be able to target them on a hyper basis. And once again, I think that's why you see the Walmarts, you see Netflix and other organizations are winning in the marketplace.
David, what you're saying is basically layoffs then?
Well, there's no question that we're going to continue to see layoffs across the economy, in my opinion. You know, AI is being talked about as a game changer. It really is. You're going to see disruption, too, for, I think, amongst the first time in areas of organizations that have just never been affected by this type of technology.
David, how does the consumer experience change? You talked about advertising being more targeted, how online purchases have increased dramatically. I just wonder how quickly consumers are adapting to a world that's rapidly shifting to a technology that not everybody has wrapped their heads around yet.
To put it in perspective, we saw almost a 300% increment in individuals utilizing artificial intelligence platforms to do their shopping at the beginning of this holiday season. So I think long term, you're going to have an AI agent that's going to represent you, and the organization that you're shopping with is going to have an AI agent that's going to represent them, and your agents are going to negotiate your price and help you figure out where you want to go and what you're going to do.
So do humans even matter, right? At a certain point, a robot's going to be buying dresses for one another. David, I'm just curious, you know, going forward, at what point are we talking about a consumer that is strong or weak, or a consumer that's irrelevant because you've got bots speaking with each other?
Well, the consumer is going to be the ultimate purchaser. I think the AI is going to make recommendations to the consumer, and they're going to have to decide if they want to buy it or not. It's their money, so to speak. So I think you're going to see disruption, but the consumer, which in the United States makes up the vast majority of our GDP, is going to continue to be a very important component of purchasing for many, many years to come.
David, when it comes to the consumer, how much is the spending right now predicated off the fact that they know that they're going to get tax rebates next year?
Yeah, I mean, we're seeing tax rebates. We saw a meaningful reset, interestingly enough, from the reopening of the government. We saw the Zeta Economic Index tick down just a little bit after being up meaningfully the month before. And we think a lot of that came from the reset of everybody going back to work in government. And then you saw it going into the end of November, the holiday shopping season, we saw sales up as much as 4% across the economy. We think it's going to be a very strong holiday season, and we think people are excited that the government reopened. We think a lot of people are excited about tax rebates, and we think a lot of people are excited about where their dollars are coming from right now.
I'm so excited. I'll have your bot talk to my bot. Maybe they can figure something out. David Steinberg of Zeta Global, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. A Virginia man has been charged with transporting explosive devices and attempting, quote, malicious destruction. Prosecutors claim Brian Cole Jr. placed pipe bombs outside Republican and Democratic National Committee headquarters in Washington on the eve of the January 6th, 2021 riot. U.S. Attorney General Pam Bondi says there could be more charges to come. Warner Brothers Discovery entering exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. Sources are telling us here at Bloomberg the streaming giant is offering a $5 billion breakup fee if regulators don't approve the deal. The two companies could announce in the coming days. More Threads, a leading Chinese AI chip maker, jumped over 425% in its Shanghai trading debut. The move fueling optimism for China's goal of achieving tech self-sufficiency amidst trade tensions. More Threads was founded by a former NVIDIA executive. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, investing in AI power.
We're at the beginning of this technology build-out. AI is getting more compute intensive, but the bottom line is we need energy.
Abby Yoder of JP Morgan Private Bank joins us next as people look to natural gas, people look to copper and other resources in this build-out boom. This is Bloomberg Surveillance.
What's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed. This gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Futures high are looking to get a fifth day of gains. We're looking at a 0.2% gain on the S&P. Yields marginally higher as we do see potential expectations for a Fed rate cut leading to stronger growth next year, 4.11 on the 10-year. Take a look at the energy space. Crude prices are lower by 0.2% over this year. They have dramatically plunged. And this is sort of the conundrum. If you believe that this is an energy really intensive world, why is it that oil prices are down so much, down 17% year to date? Well, natural gas prices up significantly in the United States at record highs. They are up 42% year to date. It is all about which power source. Under surveillance this morning, investing in AI power.
Our energy efficiency improves by 5 times or 10 times each year. But the problem is this. We're at the beginning of this technology build-out. AI is getting more compute intensive. The adoption's going way up. I've got all these exponentials. And so we're going to keep chasing this. But the bottom line is we need energy.
Here's the latest. Investors piling into utilities as surging AI data center demand drives up power needs. Abby Yoder of JP Morgan Private Bank writing, we are still constructive on the market despite a strong year-to-date rally. Our favorite themes are AI power and defense. Abby joins us now. Abby, great to see you.
Great to see you.
So I'd love to talk about power and energy and what that means, given the fact that it's been a hugely diverging fate depending on which source of energy you're looking at.
Yeah, I know you just brought up oil prices, and I think, we were talking about this, like, it really is a supply issue, right? Like, you have too much supply on the market, they're incentivized, and now when you think about U.S. producers, they can break even at a lower price, right? So they can still continue to do this and be profitable. And when you think about oil, traditionally also, you have to think about what's going on in emerging markets, and in particular in China, right? You have a slowing economy there, particularly on the consumption side. I mean, really on the investment side as well. So I think that's really weighing on it too. It's out, but then you look at things like nat gas, look at things like copper, and they're all doing really well because they will be part of this, power infrastructure build in the United States. And the way that we think about accessing that is really through utilities, right? Who are, and particularly the independent power producers who are signing these one-on-one contracts with the hyperscalers to secure that energy and that power demand off the grid, right? And so you're trying to avoid, which is becoming a political thing, trying to avoid the consumer price increase as well.
Okay, there's a lot to unpack here.
Yeah.
The idea that a lot of big tech providers are looking for energy sources outside of the grid so that they're not subjected to the political power so they can get the other extra energy. And it raises questions about whether we are seeing any of the overbuild in some of these areas, right? How do you discern whether you're pricing in true growth or whether you're pricing in something that's going to be a stranded asset in 2 years?
Well, I think that, when you think about the individual companies that are like, there's a particular nat gas company that is not willing to actually commit to a lot of these deals over a 5-year period because they want to avoid exactly that. So there is like a lot of prudent decision making, at least in our view, on the independent power producers who are saying, look, we're not going to do this if we think this is going to be a stranded asset. And that's part of why there's such a backlog, right? There's a decision making process that does feel very thorough in terms of thinking about, okay, we're going to add here, but we want to think about whether or not this will actually be a stranded asset in the longer term. And I would say also, when you think about the grid and how aged it is, particularly when you think about transmission lines being on average like 25 years plus, if we have this build out and we have this upgrade to the grid, overall, that's a positive, right? Even if these become quote unquote stranded assets, if it's a data center, for example, if we get the upgrade to the grid that we've needed, but has been politically stagnant, that's a net positive, right, over the longer term. So I think.
You mentioned this becoming a political problem, and it is. We saw that actually in the midterm elections in Virginia and also in New Jersey. If that's the case, do you expect government intervention in a space that you think is very bullish?
Well, I mean, you've heard inklings of it, right? And I think that the goal is obviously to avoid that. And I think next year will be very important when we think about, how these companies actually really construct these deals to make sure that that doesn't happen. And it's very, power and power generation is very local, right? So it's very difficult to think that at the federal level they can have a meaningful impact in terms of that decision-making process. But I mean, it started coming up in conversations where I was like, this feels like it's going to be the next healthcare, right? Where it just becomes a very it's a lot of talk at the political level, but like how they address it will be very, I think, niche in terms of the locality.
If we don't see the build out and we don't see electricity there, can AI spending continue at this level?
No, I think that's the biggest risk. I truly think that when we think about going into 2026, and obviously that's a very bullish outcome for these utilities and the power providers, is that is the bottleneck, right? Especially in the United States. China's a different story. They actually do have that power capacity to be able to build. We just really don't. And that's the biggest thing. It's like, okay, they're signing all of these deals, but like, do they have the ability to actually deliver on it? Like that's really, and I mean that on the power side. I don't mean that on the tech advancement and all of that. I think it's just, we don't have the grid to be able to support this, so we really need this build out to be across the entire grid, not just the data centers.
If your favorite trades are defensives, essentially, which is utilities and then defense stocks, right? I mean, that's a different kind of defensive. I'm just wondering what your view is then on how much the economy can meet expectations, right? Is this sort of an indictment of the idea that you're going to get some sort of massive reacceleration in the U.S. consumer?
Well, I think no. So we're not saying that we being bullish on utilities, defense, and actually healthcare as well is actually not this defensive posture and negative outlook on the United States economy or markets. It's actually just structural growth drivers, right? Like you think about where policy money is going and where all of the spend is going. It's to power, it's going to defense, it's going to, tech, obviously, AI. And so that's kind of the part of the process that we're thinking. I know it kind of maybe screens at the high level as defensive in nature, but it's really more where are their structural growth stories, where are dollars flowing, and that really leads us to these industries and sectors.
Do you think that in general, the way it'll manifest is in this broadening out that we're seeing right now, or do you think that that's an oversimplification? It's just that the AI trade is broadening out, not that overall economic engine is really broadening out?
No, I do think that we'll see the overall economic engine broaden out, and I do think, look, inherently, we went from being overweight 3 sectors this year to being overweight 5, so that is suggestive of a broadening out, just generally speaking. And we do think that there'll be like a soft patch in the first half of the year, but this has been a very, very resilient economic backdrop and just corporate backdrop, right? We are at basically peak margins in 3Q earnings. And so they've navigated through what has been a very difficult tariff situation and political situation. And we really are of the view that we see another year of above average earnings growth next year for the S&P 500. And that's across a lot of different sectors.
Abby Yoder, great to see you. Thank you so much for being here. Abby Yoder of JP Morgan Private Bank, with that optimism continuing to build on the week. What we are seeing right now are deals, and this idea of how much more do we see in the M&A space after the Netflix announcement to buy Warner Brothers.
Netflix announcement is going to be so interesting because there's been a lot of regulatory scrutiny already, and Variety had this exclusive reporting about prominent filmmakers writing to Congress saying you cannot let this deal go through. That's why maybe that $5 billion sweetener, if the deal doesn't get regulatory approval, was key to this.
Yeah, and we also see a $59 billion bridge loan that banks are agreeing to provide to Netflix for this deal. Netflix shares lower by 2.3% in pre-market trading. Coming up, Nadia Lovell of UBS, U.S. Interior Secretary Doug Burgum on that energy issue, Constance Hunter of the Economist Intelligence, and Michael Collins of PGIM Fixed Income.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
We are still seeing that investors are sitting on the sidelines of this market.
There has been a shift in sentiment, and you're starting to see some deterioration in some of the key themes.
The equity market has to climb, basically, the traditional wall of worry.
You have an equity market that broadens and rotates a little bit.
As we think about next year, we do like equities. We do like U.S. equities in particular.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes turning to next week's Fed rate decision as potential Fed Chair Kevin Hassett supports that 25 basis point rate cut and some dated inflation as well as consumer sentiment data coming up. Right now, though, the focus is squarely on the M&A space, with Netflix agreeing to buy Warner Brothers for almost $83 billion.
So this is going to be historic. This is the dominant streaming service going up against, or with now, one of the revered studios out of Hollywood, which is why there's going to be a lot of concern about the regulatory steps forward and the scrutiny this is going to come under. But also, it is pretty incredible that Netflix was this dark horse candidate. No one was taking it seriously. And then in the end, they were the ones that were able to get the deal done. And how quickly, we know they were going into exclusive talks just last night, but how quickly they were able to get to the finish line.
Yeah, and the financing behind it. I think a lot of people are looking for some of the details there, given the fact that the $83 billion almost will be paid for in stock and cash-free debt. And what we are getting is news this morning that Netflix has lined up a $59 billion bridge loan from banks across Wall Street, Wells Fargo, BNP, HSBC, et cetera, which would be one of the largest bridge loans in history at a time where there's huge regulatory risk for this deal.
Absolutely, which is probably why they had to put up that $5 billion that will be paid to Warner Brothers if this falls through. When you look at the bridge loan, Lisa, it is one of the biggest. Anheuser-Busch InBev obtained $75 billion of loans back in its acquisition of SAB Miller in 2015. So this is huge when you look at historical perspective.
Yeah, and going forward, this is really the backdrop for why it's such a complicated market heading into 2026. On one hand, you've got a Federal Reserve that is poised to cut rates. You have a consumer giving some mixed signals in terms of just how strong you are. And then you have capital markets that are revving up for another year of M&A, another year of relatively loose financing conditions. It is a difficult backdrop for the Fed when they meet next week, Wednesday.
Absolutely difficult backdrop. They're going to have a lot more data, but then the week after, they're going to get the most prime data they've been waiting for, which is the non-farm payrolls, which potentially means that could really give us insight into how the Fed is going to act in January. What Kelsey Barrow was saying, if we get that weak labor report on December 16th, does that mean we're going to get another Fed cut? Difficult moment for the Federal Reserve, especially uncertainty when it comes to things like IEEPA, tariffs. It is a midterm election year. So this administration is going to want to make sure they continue the consumer impulse in the United States. Will we get those $2,000 checks? What does this mean for inflation? It's going to be a little bit confusing.
Well, people keep buying. At least they keep buying stocks. Right now, equities across the board up, actually led by the NASDAQ. Right now, S&P futures up about 0.2%. Yields higher. And really watch this space as duration loses ground across the world this morning, 4.11% on that 10-year. And you are seeing just quiet in the currency space. Coming up this hour, as we do prepare to get that data, is PCE data. Nadia Lovell of UBS with stocks trading near all-time highs. U.S. Secretary of the Interior Doug Burgum discussing the future of AI energy production. And Michael Collins of PGIM Fixed Income looking ahead to next week's Fed decision. We begin this hour with stocks steady as traders bet that rate cuts will help drive a global rally into the year end. Nadia Lovell of UBS Global Wealth Management writing, we think the outlook for stocks is positive as we move toward 2026. With broadening market performance, we expect the S&P 500 to hit 7,700 by the end of next year. Nadia joins us now. Nadia, good morning.
Good morning.
Great to see you. Thank you for being here. So how much is what you're expecting for next year predicated on the story that we've been hearing all morning, which is that earnings are doing pretty well and that companies have actually been maneuvering through a pretty difficult time with a stellar kind of performance?
That is core to our thesis. I mean, when we look at this past year, the fact that we had above-trend economic growth, despite the fact that there was concerns around tariffs, next year we think that you're going to see very healthy growth as well on the macro level, probably something close to trend line 2%, and that could actually prove to be conservative. As you've been highlighting some of the things around the consumer into 2026, we also have stimulus coming from the One Big Beautiful Bill Act. That should also help. We also could see productivity gains, at least on the margin, as AI monetization starts to pick up. And then the M&A activity that we're seeing, all of this together should be able to drive some earnings growth of at least 10% next year. And we're going to see a broadening out of that. You know, historically, as you see in the last couple of years, a lot of it has been driven by the Mag 7. But we think that that gap is going to narrow next year. And so that's what we think that will push the S&P 500 up to 7,700.
We've seen the Russell 2000 in particular outperform as people bet on this broadening out, hitting a record yesterday. I just wonder how predicated that is on Fed rate cuts, right? Do you need to see substantial monetary policy easing in order to get the broadening out that so many people are betting on?
The broadening out that we're talking about is definitely within the large cap space across more sectors just beyond tech that has been driving this market. Can you see small cap get a bit of a big? Absolutely. But at the end of the day, small cap is more of a macro trade. So the economy is holding up and the Fed is cutting. That's usually a good environment for small cap. And also you're starting to see some recovery potentially in the manufacturing side of the economy that has been in a doldrums for the last few years. We know that small cap Russell 2000 is mostly exposed to financials, right? So if you're seeing pickup in M&A, if you're seeing better credit environment, the steepness of the curve as well, the long end, the short end coming down, that should be a positive from a financing financing costs for small cap companies. And so while we're neutral on small cap, you could see them get a bit more support in 2026.
Nadia, the way you're talking about 2026, it doesn't sound like the Fed even needs to cut interest rates, but you think they're going to continue?
We think that they will continue. We think that you get at least one more cut in the first quarter of next year. Right now, the market is really priced in the December cut. We've long been there, and the market has been swinging back and forth, rightfully so. We're not expecting any major changes in the S&P and the dot plot at this point. I mean, Powell probably still feel like he's in a data fog, so we don't expect any major changes in that. But maybe the S&P and the dot plots don't matter all that much for this meeting, because reality is, we don't have all the government data. We know that there's going to be changes at the Fed, but we think that you get one cut next year because of the in the first quarter of next year because of the softness in the labor market, and then the Fed will wait on hold and see how it goes. I mean, I think that the overall view is like the risk is probably skewed to more the dovish side for obvious reasons.
When it comes, well, to Michael Hartnett's point, though, if the Fed comes out and say the rhetoric is dovish alongside with the cut, will that signal that the Fed is more nervous about the economy than most other people are?
I don't think that Powell is going to be dovish in his rhetoric. We think that this is probably going to be a hawkish cut, right? Again, the dispersion that you're seeing on the committee, Powell has to manage that when he messaged, in the press conference, just like he did in the last press conference. And so we think that the rhetoric from Powell will be very similar to what we heard in the October press conference, and a hawkish cut. Not looking for any sort of dovish commentary. Next year, we'll see. It all depends on who the chair is, but at the end of the day, the chair is one vote. It is a committee, but if the rhetoric around the chair is more dovish, that could also have implications for market. But we don't think that that's a negative, right? We think that this administration is going to do all that it needs to do ahead of midterms election. That word affordability keeps coming up.
Well, this is the reason why I think a lot of people are looking to possibly outside of the U.S. for an outperformance, right? And I wonder where you fall on that, because yes, a lot of people seem to agree that the S&P is going to do well in 2026, but on a risk-adjusted basis, a currency-adjusted basis, maybe not the outperformer.
I'm so glad you asked that question, Lisa, given my global title. But we like Japan. We like Europe as well, right? When you think about, I talked earlier about the potential for that cyclical recovery. We're already seeing elements of that in Europe, and so that should be positive. We know that Europe tends to be more cyclically focused. And also Europe does have those structural growth. Not as much as the U.S., of course, but data centers are being built out there. Electrification is happening. Longevity and healthcare is also happening in Europe, and so we think that that will help Europe. Defense spending, all of that should help Germany. And then Japan, we know that we're getting incremental information around stimulus for that economy that should help in 2026. And the companies there are also going through corporate reforms, and we should see a pickup in ROEs. And then we were seeing upward revisions to earnings in Japan. So we think that that's also, look at Japan has done really well the last several months, and we think that that continues in 26.
I wonder how complicated the backdrop is for you, given the fact that an increasing number of countries are choosing national champions. And we're seeing that over in the United States. We're seeing that over in China with some of the new AI startups that are gaining preeminence. How do you decide to play that? I mean, are you looking for who the national champs are going to be and getting behind them? Do you just try to steer clear of that kind of political interference?
No, we think that, look, this all goes back to the long saying of diversification, and that's becoming even more important as we go forward, as all of these governments support their economies more. China, I failed to mention, China is actually, and China Tech is one of our highest conviction ideas for next year, because the government is leading more and supporting its tech industry, and that localization of chip is happening. And we think that monetization potentially around AI happens faster in China than it is going to happen in the U.S., because China is really going after the consumer and applying a more lower cost model. And so I think that you have to sort of, have a diversified portfolio across all of these markets, because it's no longer that U.S. just lead and everyone else gets left behind. We think that the more boats are going to be rising.
Well, Nadia Lovell of UBS, thank you so much for being with us this morning. Nadia Lovell of UBS Global Wealth Management. And this is the reason why people were so interested, Anne-Marie, in more Threads technology. The IPO over in China that surged 425% in its debut. It was chosen as a national champion. China is looking to support some of its AI incubators, and this is a prime target.
Well, remember a few months ago, the administration said, fine, NVIDIA, you can sell your H20s to China, and China said, no. sent out letters to a bunch of companies and firms, said, shrug these chips. We are going all in on our own, which is why there's been this huge debate within the administration. Do we have higher export controls, or do we get China and others addicted to our tech? That is a massive conversation and a massive debate, and they haven't truly decided just yet.
Yeah, we'll continue that conversation. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. National Economic Council Director Kevin Hassett said the Federal Reserve should cut interest rate at the meeting next week. Hassett expects the central bank to cut by 25 basis points and says he wants to, quote, get to a much lower rate over the long run. His comments coming as speculation grows that President Donald Trump is preparing to nominate him to lead the central bank. The European Commission fining Elon Musk's X nearly $140 million for violating the EU's content moderation law. It claims the social network misled users with its paid-for blue tick symbol and stonewalled researchers' access to data. It marks the first fine under the EU's Digital Services Act. X has 90 days to implement the changes, or it could face additional penalties. And it's official. Netflix is acquiring Warner Brothers Discovery in a deal valued at $82.7 billion. Netflix now becomes the owner of the HBO network, Warner Brothers Studios, film and TV archive. It's so far beaten out rival suitors Paramount, Skydance, and Comcast. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls. We're going to be taking a look also at that tie-up between Netflix and Warner Brothers and some of the debt financing behind it, a $59 billion bridge loan from Wall Street banks as Netflix tries to get through a lot of regulatory hurdles. That's next. This is Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
There's a lot of almost reflationary pro-cyclical tones starting to weave their way through the market's message here. And, you know, you look out to 2026, and I think it tells us that really the tone is changing from, after years of all the excess liquidity being soaked up by the speculative economy, I think the excess liquidity is now being soaked up by the real economy moving forward. Very important theme for us into 26.
And into 26, that was Chris Verone of Strategas, a Baird company, talking as an increasing number of strategists get bullish on the prospect for U.S. equities right now, feeling that bullishness with futures up about 0.2%. You can see yields continuing to climb up about 2 basis points to 4.11%, and Brent is basically flat. When you take a look at natural gas prices, they have surged to the highest going back to 2022. They are higher by almost 4% this morning, with a real focus on just how much further they could go. It is snowing in Washington, D.C., so people are using their heat. Time now for the morning calls. First up, Truist raising its price target on Alphabet to $350, highlighting AI-driven efficiency gains and e-commerce momentum. Next up, Morgan Stanley upgrading MP Materials to overweight, believing it is positioned to benefit from U.S. rare earth policies. And finally, Needham initiating coverage of Oklo with a buy rating, citing its, quote, advantaged regulatory position in nuclear energy. Those shares lower by almost 4%. We do want to stick with energy. 28 Democratic California lawmakers writing a letter to the Trump administration condemning plans to boost oil drilling along the state's coastline. U.S. Interior Secretary Doug Burgum joins us now. Secretary Burgum, thank you so much for being with us. I want to start with just how important it is right now for the United States to increase energy supplies across the board, not just with drilling, but across the board in the face of the demand coming from AI.
Well, good morning, Lisa. Yes, it's absolutely essential, and this is part of the just announced national security plan that the White House has released. That security plan mentions energy 23 times. There's an entire section about energy dominance, and folks should think about energy dominance as the ability for the U.S. to sell energy to our friends and allies so they don't have to buy it from adversaries, particularly those adversaries that are either funding terrorism or are funding wars, actively funding war machines. And so it's core to the strategy right now, but it's also, as you've talked about on the show, is about with AI, because it never before in history have we been able to convert a kilowatt of electricity into intelligence. The demand for that, regardless of stock prices or stock movements, the demand for AI, for intelligence applied to every job, every company, every industry is going to continue to increase the demand for electricity around the world. The U.S. is an energy dominant country, now the largest oil producer in the world, largest LNG exporter in the world, and growing quickly. With that strategy, it bodes well for the future of the U.S., both in terms of peace and in terms of prosperity.
Secretary, I'm sure you're aware WTI is under $60 a barrel. What's the impetus for the oil and gas companies in the United States to continue drilling wells at this price level, which potentially could be a loss for them?
Well, I think one thing that we know that in the Trump administration, we're cutting red tape so rapidly. We think that one of the early targets we had was cut 10% of the cost away from those producers just by cutting red tape. So if you think about $60 today might be what $67 was a year ago because of our ability to take cost out for those producers. And there's example after example, whether it's from the EPA, the Department of Energy, Department of Interior, where we've been able to help reduce costs. And of course, this industry has been better than almost any in terms of gaining, productivity. The shale producers now drilling 3-mile laterals instead of 2-mile laterals, up to 4-mile laterals in many places. Offshore, we've seen examples overseas of people building 10-mile laterals when they're getting after the shale rock, all with the same small well pad on the surface. So, great for land management and great for energy production, and kudos to this industry. The entire shale revolution has occurred through innovation, and that innovation is going to continue. And with AI applied to that, it's going to get even better. So I see the leading companies are getting their costs down, even as demand is going up.
But Baker Hughes is talking about drilling rig activity has fallen 16% since Trump took office this year. The president loves to talk about drill, baby, drill. Do you expect that to change, those numbers to change next year?
Well, I think, again, I'd have to take a look at the numbers. When we talk about drilling activity in my home state of North Dakota, we had number of the well count was going down, but the miles of lateral productive rock could be going up. And so, analysts have got to make sure that they're actually keeping up with how fast this industry is changing, because we've got, again, record production occurring right now, and we expect to see records through 2026.
One area where you have seen price increases has been natural gas. Natural gas prices rising to the highest levels in the U.S. going back to 2022. And a real question on how much the U.S. can continue to export to places like Europe in the face of significantly higher prices here in the United States. How do you plan to sort of set policies so that the U.S. can be a big exporter to places like Europe while not allowing prices to go up so significantly in the future?
Well, again, the key is it's supply and it's infrastructure. We have places in the U.S. right now where, again, there's not one price for gas in America, as you know. I mean, even though we've got the markets and we've got, Henry Hub, but we've got widely ranging prices. I mean, even in the difference of price in Pennsylvania versus in New England, because of the lack of natural gas pipelines that have been blocked into places like New England. And when we think about markets, you're talking about AI and the capital spend going against AI, where we're an AI factory where we're actually creating and manufacturing intelligence. Those plants are going to go to the places where states have low electricity prices, and policies are setting price, not just markets. And we've got policies in blue states around our country. California, you mentioned California, 63% of California's oil is being imported from foreign countries because of blocking of pipelines coming into that state. They have a record number of internal combustion cars in California. They have more internal combustion cars than any other state has cars. And yet 2 refineries have announced that they're shutting down in California because of policies, not because of lack of demand, not because of lack of consumers. And so what's going to happen? You're going to have oil tankers and refined products coming into San Francisco Bay and coming into Long Beach in record numbers in California because of policies. They will have higher gas prices than virtually any other state. So again, we have a strategy in America to help every state. The Trump administration wants to have low, affordable energy prices for everybody, whether it's heating your home or driving your car or producing electricity for AI. But we're going to need the collaboration from states to make sure. And if states don't want to collaborate on that, then you're going to see this $1 trillion in AI, a historic amount of spend, all going towards states that have pro-energy policies that drive down prices.
Secretary, we've seen a significant increase in energy costs, especially for individuals who live near data centers. How is the U.S. going to do both at once, both support these AI initiatives, but also make sure consumers' energy prices remain affordable?
Well, if you said on the show, I mean, the prices are in electricity are local, not national. And so there are the examples that you think we're driving that analysis right now, and we're going to be publishing that from the White House to the National Energy Dominance Council, the Department of Energy doing great work on that. But a lot of the higher prices that you're seeing are not related to the AI data centers. A lot of the data centers are going to be off the grid, behind the meter, and then adding more energy, and then putting some of that energy onto the grid. So we could be actually increasing the supply. In some of those areas where we've got increased pricing, it's because of the policies they pursued the last 5 years of having unreliable, intermittent, and highly subsidized projects, including things like offshore wind, where people were spending $11 billion to create 1 gigawatt of intermittent, versus spending $1 or $2 billion to create 1 gigawatt of assured 7 by 24-hour power. So the policy choices of the last 5 years, driven by sometimes climate extremists, were the ones that are driving up the prices that you're seeing. I mean, electricity costs 3 times as much in New England as it does in North Dakota. That is not because of data centers. That's because of policies.
U.S. Interior Secretary Doug Burgum, thank you so much, and definitely something that we would love to keep talking about, given the fact that a lot of people have talked about how certain places, I'm thinking of Arlington in particular, in Virginia, right near Washington, D.C., have seen higher prices for electricity bills due to artificial intelligence. Commentary somewhat different there.
Bloomberg ran an analysis that found that electricity now costs as much as, get this number, 267% more for a single month than it did 5 years ago in areas located near significant data data center activity. I hear him. A lot of this is local, but also there's a tremendous amount of competition right now between the everyday user and the massive tech companies looking to build data centers.
We're going to continue this conversation. Coming up, Constance Hunter of Economist Intelligence on what a Kevin Hassett-led Fed could mean for markets. Plus, Yahira Anand with your morning movers. Another check on Netflix and Warner Brothers. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Bersetchi in Vienna, and this is Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Seeing a lift to end the week after a really interesting week, given the fact that we started on a pretty soggy note, and then it's been about 4 consecutive days of gains. Up now, fading a little bit from earlier, down up just about 0.1% on S&P futures. Seeing a little bit of euro strength, a little bit of dollar weakness, 116.49. Really, the question heading into next year is how much does this dollar weakness continue to mount that we have seen over the past week or two? And watching yields, they've come off some of the earlier highs, 4.11% rounded up. Take a look at these commodities. This, to me, is where the action is this morning. On one hand, you've got natural gas futures up 3.7% as people take a look at A, how cold it is, and B, how much that you need to use energy in the face of all sorts of technological gains in copper. Those prices up 1.6% in pre-market trading. 1 hour away from the cash open, here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It's a blockbuster deal that could reshape Hollywood. Netflix is taking over Warner Bros. Discovery's studio and streaming businesses in an $83 billion deal, wrapping up a dramatic saga that was months in the making. The deal pushes Netflix deep into traditional Hollywood, managing a 100-year-old studio and getting into the theatrical business, an area that has not fully embraced, and what also could be weighing on the stock, now extending its losses down 4.3%, is that sweetener, that $5 billion breakup fee if regulators don't approve the deal. Meanwhile, we are seeing Victoria's Secret shares surging 14% in the pre-market after the retailer raised its full-year outlook in a sign that the turnaround strategy is working at the company. But now that we've nearly wrapped up all the retail earnings, it's important to note the strength we've seen with Ulta, Macy's, American Eagle, Walmart. The list goes on, all posting upbeat numbers. And we end on HP not seeing the same luck, down nearly 10% in the pre-market after it delivered a softer than expected sales outlook, a blow to hopes that AI server demand would drive a bigger jump in revenue. And part of that weakness was due to order delays, with the CEO saying that big U.S. government and European deals slipped into 2026. That was due to a data center not being up and running and the U.S. government shutdown, which is getting a lot of blame this morning. Lisa?
Thank you so much, Yahaira, and wonderful work all week. And honestly, blame because maybe they deserve it. I mean, come on, some of this data coming out of Southwest, let's be honest.
And it's not Southwest's fault. What are some of these airlines supposed to do? The demand's not there because the government is shut down, longest in history, more than 40 days. And you can't make that up.
Which is the reason why we're seeing some revisions to full-year profit forecasts from the likes of Southwest. And we also heard a similar note from Delta. Let's turn to how the Fed's going to respond. NEC Director Kevin Hassett, seen as President Donald Trump's likely pick to be the next Fed chair. Constance Hunter of Economist Intelligence saying a Hassett-led Fed could go in multiple directions, writing, if the Hassett who wrote about the deleterious effects of inflation shows up at the Fed, the markets should feel relieved. If his loyalty to the president shows up, markets may show concerns. Constance joins us now. Constance, great to see you. Thank you so much for being here. Yeah. I want to start with why we haven't seen more concern in markets yet, because ultimately, if you're looking to the market as a barometer of fear, you're not seeing any huge red flags.
No, you're seeing zero fear. And part of that could be that markets are looking sort of short term, right? They know that there's going to be another, or think that there's going to be another Fed rate cut in December. Also, it's the makeup of the Fed, right? The Fed was designed as an institution to be immune from political pressure. So whether you're talking about the terms of the governors, whether you're talking about the way the regional presidents are set up, so all of this is a very intricate timing game. I think the markets are betting on the fact that the Supreme Court will punt the decision to after February. And so therefore, Lisa Cook will remain in place, right? That's really critical, because if you have a threshold of 5 or 4 governors, they can overrule the president's terms. So there's a lot going on in terms of timing, and I think the market is betting on a few things that will keep that independence in place regardless of who is Fed chair. But also, if you look at Kevin Hassett's work from before he joined the first Trump administration, it really centers on the importance of keeping inflation low, because the tax code is geared towards benefiting firms during periods of low inflation. Right? So it depends on which Kevin Hassett shows up.
Yeah, it depends on which economy shows up too, right? Because ultimately, you're at the behest of the market and of the economy. Right now, we're kind of flying in the dark because we aren't getting a lot of real-time data. We should have just gotten the non-farm payrolls report. Sorry. Newsflash, we're not getting it until December 16th. But right now, we are looking to September PCE report coming up in about 90 minutes time. I mean, what do they do with this? How do we understand whether inflation is the bigger problem or whether it's the labor market?
Well, we pretty much know what the PCE report is going to say with regard to inflation, because a lot of that is derived from the CPI and the PPI. So we think it's about 2.9% for headline, 0.22% for core. Those are both month-over-month numbers, right? The more interesting thing is going to be looking for any signals in the wage and income data. And so we are looking for a little bit of softness in the wage data, but that's going to give an indication of the strength of the labor market.
When you say which Kevin Hassett shows up, isn't he being chosen Because the one that is going to be Donald Trump's chief marketer when it comes to the economy, isn't it going to be him that is going to listen to him when it comes to lower rates? Because that's the only reason why he's being chosen.
I don't think it's the only reason why he's being chosen. I mean, he is an economist who has a long track record of being in DC, being a policymaker. He basically crafted the TCJA, and he was very influential in the CARES Act. So I think he's being chosen for those reasons. But remember, he's going to have to convince his fellow board members and the presidents who are going to be voting next year that that his policy direction is the direction that the Fed needs to go in. And that is a big question mark. I mean, he's going to have to use a framework, and he's going to have to think about policy within that framework. And keep in mind, we have the benefits of the One Big Beautiful Bill Act coming, the delayed tax refunds. We're looking for over 3% GDP growth in the first quarter, about 3% in the second, and about 3% in the third. How do you cut rates into that environment?
Do you think that potentially the rebates we're going to get, the One Big Beautiful Bill, and the fact that this administration is talking about $2,000 checks is going to make the inflation picture that much harder for the Fed next year?
Well, the $2,000 checks, I think we need to put aside, because who knows if they're going.
But they keep talking about it.
They do keep talking about it,
and it's a midterm election year.
Yes, fair enough. Yes, that would put more money in people's pockets, and it would be make them able to withstand price increases. Because I think what you've seen with the tariffs is a lot of concern about people's ability to handle price increases. Firms have absorbed some of that tariff increase. They've reduced hiring in order to sort of compensate for that. And so the question is, how much are they going to be able to pass on? It would stand to reason if people have more money in their pockets, companies are going to be able to pass on bigger price increases.
We're talking about a Federal Reserve that's set to ease policy, and we're talking about pain among the consumer base at the same time that Wall Street is talking about enthusiasm for mergers and acquisitions. We've been talking all morning about this deal of Netflix agreeing to buy Warner Brothers. We're talking about returns that are likely to be above 10% on the S&P next year. Is this a potential headwind or a tailwind for central bankers that are both looking for some sort of boost from consumption that will come with more of the wealth effect, but also could potentially be fueling froth in markets that seem pretty accommodative?
So it all comes down to productivity, right? If we really are getting the productivity gains, and not just from, when we say AI, right, it's not just generative AI and ChatGPT, but the productivity gains from just regular AI, right, are still being diffused throughout the economy. And that is an important driver of productivity growth. So it really comes down to, are we in a period of enhanced productivity growth, in which case the markets are not excessively frothy, in which case the Fed has a lot more room to maneuver, because ultimately that will help inflation. But there's going to be a lot of noise in the first and second quarter in the data, and it's going to be very difficult to interpret the underlying factors that are happening in the economy,
as opposed to the easy market that it's been to really decipher. Constance Hunter, thank you so much for being with us today. Constance Hunter of Economist Intelligence here in studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. The U.S. urging several countries in the European Union to block the EU's plan to use frozen Russian central bank assets to back a massive loan to Ukraine. According to European diplomats familiar with the matter, officials are arguing to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. The U.S. Senate is seeking to ban NVIDIA from shipping advanced AI chips to China. They've introduced bipartisan legislation now to prevent the Trump administration from easing export controls. This all comes amid reports that the Trump administration had been considering relaxing restrictions on exports to China. The bill urges maintaining rather than loosening those export controls. FIFA conducting the Men's World Cup draw at the Kentucky Center in Washington today. The draw determines which opponents all 48 teams will eventually face in the initial group stage. The ceremonies kick off at noon. President Trump is hosting the festivities with performances from Andrea Bocelli and the Village People. The World Cup starts next June with matches in Canada, Mexico, and the United States. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. I would like to see Andrea Bocelli sing YMCA. I think that they should sort of bring it.
That is definitely not going to happen, but that would be funny. I have to say, though, I love Andrea Bocelli. I saw him recently at the Met, did some amazing Italian opera. He's performing also next week in New York.
The Village People should perform Italian opera, and I think that Andrea Bocelli should do YMCA.
YMCA, maybe we'll do the dance.
It would be a viral moment. Up next, setting you up for the day ahead. Plus, Michael Collins of PGIM Fixed Income looking ahead to next week's Fed decision and the glut of corporate debt issuance on the heels of all of the M&A activity. From New York, this is Bloomberg Surveillance.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The Fed is likely to deliver not just the December rate cut, but also one in January. But more importantly, just from a market probability perspective, I think that ahead of the jobs report on December 16th, which coincidentally comes after the Fed's decision, that you should be pricing in a probability for January that's really closer to 50-50.
That was Kelsey Barrow of JP Morgan Asset Management as people game out not just the Fed rate decision next week, but also heading into the new year, potentially with new leadership. Right now, you do have new leadership in the market. You have the NASDAQ outperforming once again. S&P futures are lower on the heels of some deals news, which we'll get into in just 1 second. Yields higher, almost to 412 on the 10-year yield, rounded up. Otherwise, fluctuating fluctuating around, trying to find some ground, and definitely some interesting action in the commodity space. The real move and the focus this morning has been on this Netflix deal, this agreement to buy Warner Brothers Discovery. Right now, you're seeing Netflix shares futures falling 4.2%. Warner Brothers Discovery shares surging almost 4%. A real question here about, A, the valuation. It would be a $72 billion equity value deal. It would be an $83 billion enterprise value of this deal, but also the financing of it. We will get into that in a second. Counting down to the opening bell, here is the trading diary for today into next week. 10 a.m. Eastern, September core PCE data, as well as University of Michigan sentiment. This is the data that we're getting because we're not getting non-farm payrolls, not that I'm bitter. 3 p.m. Eastern, Trump signing executive orders. On Monday, Toll Brothers reporting earnings after the bell. Tuesday, we get that JOLTS job openings data. On Wednesday, an FOMC rate decision followed by Fed Chair Jerome Powell's press conference. Let's stick with the Fed ahead of next week's meeting. Michael Collins of PGIM Fixed Income joining us now for more. And Mike, I'd love to get your take on the Fed, and we'll get into, of course, the corporate debt issuance that we're seeing in the market. But starting on the Federal Reserve, I guess I'm trying to understand the market's reaction function to any of the data coming in real time. We're getting dated data. We're not going to be getting non-farm payrolls until after next week's Fed meeting. How do you sort of get a game plan to understand what the Fed's response mechanism is to a very uncertain backdrop?
Yeah, the good news is, Lisa, we're going to get a lot of data, right? I'm just looking at, today at 10 o'clock, we're getting hit with, a couple dozen data points, and we'll have a lot of that coming through over the next few weeks. It will be a lot for the market to digest. And I really do believe the reaction we've seen so far in the Treasury market, in Fed funds futures, have been driven by the data, right? I mean, all this talk about the politicization of the Fed and what that means for the shape of the curve. I really don't think there's been any notable market reaction to that at all yet. It's all driven by the data. And of course, some of the Fed speakers like Williams came out in the last few weeks really cementing the rate cut next week. But I mean, this is fun, right? This is what you do as a bond investor, as a market participant. You parse the data, you look at it, you overanalyze it, and you try to figure out the path of the economy, the path of inflation, the path of growth, the path of the labor market. I mean, the Fed is in the same boat as us, right? They're going to be seeing all this stale-ish data for the first time, and I think that there's a big question about what they're going to do next year. I mean, I think there's almost as good of a chance that they don't cut as they cut, 50, which is priced in.
Mike, this is exactly the point that a lot of people keep coming back to. Are we talking about a bond market that is embracing weakness that we're just not seeing? And are we seeing risk assets embrace the strength that the bond market isn't recognizing? How much are you looking to financial conditions? And I'm talking about some of the M&A activity. I'm talking about the glut of AI-related corporate debt issuance, and sort of give that as a read on just how accommodative or restrictive monetary policy actually is.
I mean, if you just think about it, Lisa, right? And if you're the Fed and you're looking at the inflation data, which arguably has been a little more benign, so maybe it's going to go from 3 to 2.5 over the next year. The growth data, the real data in the economy, seems to be really solid. And as you've heard, more people are kind of increasing their GDP forecast for next year, kind of from the 1s to the 2s, and even, you hear some 3 handles. The labor market, is weakening, but it's resilient. Financial conditions are easy. I mean, the stock market is hitting new highs almost every day. And if you look at those projections you showed earlier in your show, the street is calling for somewhere between an 11 and 17% increase in the S&P 500 next year, right? It's like, wow, if you're the Fed, would you ever even think about cutting in that world, right? So you're really basing your assumption, if you're looking for cuts, and if you're the Fed planning to cut, that the labor market side really gets quite a bit weaker. I mean, we look at the economy, right, and it's kind of running on a two-legged stool, Lisa, right? You have this wealth effect, which is so powerful, it is sustainable, and it does have a drop-down effect, a trickle-down effect. And then you have the AI CapEx and all this technology investment, whether it's through borrowing or equity, market appreciation. Those two things are driving GDP. You take those two things away, Lisa, U.S. real GDP is close to zero, right? And you could argue the two legs of that stool are kind of two sides of the same coin, right? If the stock market tanks, the wealth effect gets hit. And so there is you know, the U.S. economy is on some, you know, weak footing. So you could be in a situation at any point in the next 6 to 12 months where you do get a leg lower in the job market and in the economy. And in that case, you know, the Fed's not going to cut twice, right? They'll probably cut 4 times. So that's kind of the market dilemma. The markets are pricing in 2, and, you know, you could have this, you know, downside scenario which results in a lot more than that. Of course, as you mentioned, the upside risk is something we're spending a lot more time in our shop talking about, right? Where maybe the Fed cuts too much, i.e. you have a policy mistake, the curve does continue to steepen, which it has a lot, and, you know, financial conditions continue to ease and the stock market continues to boom, and that doesn't end well either, right? So these 2 big tail risks are generally bad over the intermediate term for risk assets, including our favorite, you know, credit product.
Mike, just to get specific here, we are seeing a lot of debt, and you talked about the AI-related debt. We're seeing this morning this deal, Netflix agreeing to buy Warner Brothers Discovery for an equity valuation of $72 billion, a $59 billion bridge loan being offered up by a number of banks. Does this concern you? Does this feel a bit like the 2006, 2007 LBO booms that were really taking hold then, or is this actually something that the credit markets can absorb?
You know, M&A risk and deregulation are 2 big risks to the credit markets, right? Those behaviors tend to be late cycle-ish behaviors. They tend to lead to more speculative activity among corporate, you know, CEOs and CFOs, more debt issuance, more leveraging up of corporate America. And I think we're kind of, you know, in the middle innings of that part of the cycle. So yeah, it does worry. If you look at credit spreads this year, Lisa, they're basically exactly where they were a year ago or at the beginning of the year. They haven't really changed, meaning you've earned your carry or extra yield over treasuries, which is a good thing because we haven't had a lot of defaults. Credit quality is generally pretty good, but the supply wave in and of itself will put pressure on credit spreads. I mean, our base case is that spreads kind of leak a little wider, and you maybe earn a little bit less than just your carry or extra spread next year. And a lot of that is supply driven, but some of it I think is just the increasing speculative behavior and speculative nature of a lot of this supply and corporate behavior.
So maybe more 2006 than 2007. Mike Collins of PGIM Fixed Income, thank you so much for being with us this morning. Let's 7%. Geeta Ranganathan of Bloomberg Intelligence joins us now. Geeta, you've had some time to look over how this deal is going to get financed, how this deal is going to get through. What's your sense of anything that stands out to you in terms of whether this has been something longstanding, whether this came together in a rush for Netflix to get this over the finish line?
Yeah, I mean, this is definitely a huge surprise, Lisa. I mean, we did not really expect Netflix to make this big, bold move. They've always historically stayed away from acquisitions of this type. And, you know, they themselves have said many times that, you know, M&A in the media space has kind of a choppy track record. So definitely something that we think they saw as a once-in-a-generational opportunity. I mean, this is an iconic studio with very, very beloved franchises. And it's, you know, it's, of course, it's a very expensive transaction, as you pointed out, you know, $83 billion enterprise value. But again, it's for them, I think it's not just the cost of the deal, it's the cost of not doing the deal. And they're playing the long game here, just kind of a very defensive strategy for Netflix.
How difficult is the DOJ probe going to be and the antitrust concerns in Washington when it comes to this deal?
Yeah, it's definitely going to raise a lot of red flags. There's already been a lot of chatter about how this basically combines the #1 streaming service in the world with over, you know, 320 million subscribers, you know, along with HBO Max, which has about 130 million, which is the #3 service. So obviously, there are going to be some concerns. Netflix is, however, kind of, I would say, flipping the script a little bit, saying that this is actually good for consumers. They're going to be able to offer both the services actually at a discount. So overall, it's actually going to be a good thing. But of course, we have to wait and watch, see how that plays out.
Geeta, just about a minute left. How much is this the path of travel? Everyone's going to try to consolidate as much share as possible and then say, look, you're getting a discount from buying both subscription services. You only get one for the increased price of just 10% more.
So historically, we've seen that bundles actually work really well, and they're not completely wrong when they say that, you know, it does provide good value to consumers. I mean, we've seen bundles from Netflix, from not from Netflix, but more from Disney, from other companies. You know, bundles are about 40 to 45% cheaper than if you were to buy the standalone products. So it does have some merit, But then again, we do see the costs of all of these services kind of constantly rising, and there is going to be a breaking point.
Geetha Ranganathan, thank you so much. I'm sure we'll be catching up with you as we get more details. A really interesting deal. AMH, I just wonder what other competitive impulse there's going to be in the media space to compete on this level, to really kind of do something similar.
Well, you know, the appetite is there because Comcast and Paramount really wanted this deal, and there was a bidding war for it. Netflix sort of came out dark horse from behind. Not a lot of people were expecting this, as Geetha's been talking about, and I think given this deregulatory environment, the consolidation, we've already seen the media landscape, there's going to be a lot more. But it is not a done deal yet. Ton of regulatory scrutiny on this deal.
Yeah, Warner Brothers saying this in a filing just crossing. This decision reflects the realities of an industry undergoing generational change. So watch this space. Coming up on Monday, Christian Nolting of Deutsche Bank, Henry DeTrey's of Veda Partners, Kevin Foley of JP Morgan, and Savita Subramanian of Bank of America. From New York, this was Bloomberg Surveillance. Have a wonderful weekend.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for VBA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2, then turn. Now these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3, then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Good Friday morning, 30 minutes until the start of trading here in New York City. I'm Matt Miller. Danny Berger is on assignment. Bloomberg Open Interest starts right now. Coming up into Hollywood, earthquake as Netflix snaps up Warner Brothers for $72 billion in a cash and stock deal. Also, the Fed is poised to cut rates again next week as worries mount over a weakening job market. BlackRock's Rick Reeder shares his outlook with us today. And the pressure is on in Washington. Democrats force a vote on extending health care subsidies after the shutdown deal. We'll ask House Minority Leader Hakeem Jeffries what's at stake in just a few minutes' time. First off, let's take a look at the big deal that broke about 2 hours ago. Netflix right now trading down about 3 1/3% after it said it is buying Warner Brothers Discovery in a deal that combines the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. Warner Brothers will complete the planned spin-off of its networks division, Discovery, which includes CNN, TBS, and TNT. So Netflix may not get Animal Planet, but it will get that beautiful studio in Hollywood, California. For more on the deal, we're joined by Bloomberg Intelligence media analyst Geetha Ranganathan. And Geetha, is that really what this big, multi-billion-dollar deal is all about, getting that lot?
Oh, absolutely. It is. It's a huge lot, 100-acre lot. And really, this is about, owning one of the best and biggest studios in Hollywood. And Netflix really playing the long game here, a very defensive move by Netflix, looking out over the years, kind of really beefing up their content library and adding all of that prestige content to their service.
So tell us about the mechanics of this deal. I know yesterday we were talking about Paramount offering a $5 billion breakup fee. Now I'm hearing that Netflix has offered a $5 billion breakup fee, and that's not insignificant considering the fact that we've already heard concerns out of Washington about these two, big streaming players getting together and maybe amassing a little too much power in that market.
Yeah, I mean, antitrust is going to be a huge concern, Matt, no doubt about it. It's a $5.8 billion breakup fee, one of the highest in all of, media transactions that we've seen. But Netflix saying all the right things. They're saying that they're going to do things that are right for the consumer, provide more consumer choice, sell both the services, HBO Max and Netflix, at a discount for consumers, keep movies in theaters. Now, again, that goes against what Netflix has always said, releasing movies first to streaming. But now they're saying they're going to keep, movies in theaters. And then also saying that as far as the studio is concerned, majority of Warner's revenue, or at least 40% of it, comes from licensing to other platforms. They said that they will continue to do that. So far they're saying all the right things that should placate regulators, but we have to wait and see how this all actually plays out.
All right, so let's talk about the other big bid. Paramount Skydance, according to CNBC, had offered $30 a share. That's more than the $27.75 that Netflix had offered. But I know, because I've been listening to you, Geetha, all morning long, talk about this deal, that would have been for the entire asset, right? And in this case, in the Netflix case, Warner Brothers is first going to spin off its cable assets. That's valuable to shareholders before it sells the streaming assets and the studio to Netflix.
You're absolutely right, Matt. So the $30 was for the entire company. This $27.75, or close to about $28, is just for the studio and streaming business. So obviously the board and David Zaslav, as they were evaluating all options, thought that the global networks business, or the TV networks business, is worth more than $2 or $2.25 a share, and obviously in the best interest of shareholders that the studio and the streaming business goes to Netflix.
By the way, we've long talked about the closeness of the Ellison family to Donald Trump and this administration. That was thought to be an advantage. Is anyone in Hollywood, is anyone in Washington saying it still could prove out that somehow this administration sees to it that antitrust concerns scuttle the Netflix deal? They get Warner Brothers gets the $5 billion breakup fee, and then Paramount swoops in for the assets.
Oh, anything is possible, and this hasn't been anything short of a soap opera here, so I wouldn't rule that out, Matt.
All right, Geetha, thanks very much. We'll continue talking to you about this deal throughout the day. It is an absolute monster. Geetha Ranganathan there of Bloomberg Intelligence. I have to say, it probably touches everyone, too. Everyone who consumes entertainment, which is most people, watches either Netflix or HBO or both, and soon they could become one. Let's turn to tech now, away from media. Hewlett-Packard shares dropping pre-market after sales of its AI server business fell short of high expectations. The company did say, however, it continues to see, quote, substantial interest in the business. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, what does that mean, substantial interest in the business?
It means they actually had to push back some revenue into the next fiscal quarter because the government was in shutdown, and maybe that impacted a few of the sales. But it did protect the margin a little bit. Remember, AI servers, they're not the most lucrative, profitable business because memory chips are getting so expensive. The things you put in servers are getting so expensive. We've seen that with Dell, that HPE, reiterating that. That's why they bought Juniper. That's why they're looking at the networking side of the equation, and why actually BI has been liking the fact that they're getting a more diversified model, more diversified business, and they're looking to grow there more broadly. But yeah, look, we had very high expectations for HPE. It's been caught up in the whole AI frenzy and optimism that many more companies can benefit from the AI infrastructure build out. But we just have to wait for a little bit for the next quarter, it feels like. For here and now, though, we did see some support more broadly for its margin, and we are seeing that actually 14% growth in revenue ain't too bad.
All right, so that's the Hewlett-Packard story. There's a lot.
Not Hewlett-Packard. HPE.
Sorry, HPE story.
Rebrand.
I got it. No, and I get stuck in my ways as an older man. But you're right, HPE. That's the HPE story. We're going to continue to stay on top of that. You'll be covering that with Ed Ludlow in your program, Bloomberg Tech at 11. But there's a lot going on in tech this morning. I woke up to a Chinese IPO, which normally I don't pay much attention to, and I hadn't really heard, I will say, of more Threads. But this is apparently a challenger to NVIDIA that the market is taking seriously.
Was it the 450% pop on the IPO that caught your attention?
Yes.
I mean, it's a record. We've never seen an IPO enter that market with such a fanfare. It only raised $1 billion, but the fact that it crescendoed ever higher and it's now worth about $39 billion, I mean, nothing in comparison to NVIDIA's overall market cap, but still, this focus that China doesn't want NVIDIA chips, wants to grow domestically, so the government wants at least. So you've got CameraCon that's been doing incredibly well in the public markets. We've seen, of course, now Huawei do well. We know that other Baidu, for example, is thinking of spinning off its chip-making part of the business and indeed listing it. Others are waiting in the wings. Meta X Integrated Circuits, other companies over there are thinking, this Star 50 index has got a lot more lucrative for non-profitable companies that are looking to innovate where the government wants to innovate. So if you're thinking about quantum, if you're thinking about AI infrastructure, you're going to be able to potentially raise some funds. So absolutely stellar performance. And we'll just have to see how that benefits, because I think it was 2,000 times oversubscribed for the retail part of the overall offering.
All right, so one of the other big stories, now there's a lot that you guys are trying to squeeze into your hour today, but obviously media and tech go hand in hand. You guys had such incredible coverage of the Screen Time event with Lucas Shaw. We're hearing today that Meta is going to be expanding Meta AI with real-time news sources. They've made partnerships with CNN, Fox, Le Mans, People, The Daily Caller, The Washington Examiner, USA Today, and others. So this is your worlds coming together. This is tech and media really colliding, isn't it?
And again, because remember, we used to have pretty lucrative deals for publishing industry with Meta, but they folded that and the news tabs back in 2022 or so about, well, at least the payments folded in 2022 and they shut down the news tabs a couple of years ago. But now we're seeing them having to pay out and make these commercial relationships once more. They actually did one with Reuters back in 2024 because you and I need real-time answers to our chatbots. It's no good having something that was trained on the internet a year ago. They need live and contemporary, I'm not even going to say that word at this time in the morning, but real-time answers to not just your business news, but your fashion, your entertainment more broadly. You want international news, why they go with Le Monde. And it's interesting that they're going across the gamut in terms of political perspective here, right? Because they were criticized back in 2016 of not having enough conservative voices. They did have Breitbart and others linked into their news offering previously, but the fact that they've gone with Fox, the fact that we've gone across the gamut, these are going to be costly for Meta in the same way that Perplexity is having to pay off and some of the others are, but I think it's going to be much more beneficial for you and I, the consumer.
All right, I just want to finally talk about the New York Times suing perplexity over use of its copyrighted work, because this is the same story essentially, except they didn't make a deal, right?
And New York Times has been relatively litigious against large language models. Equally, Perplexity has come in the line of fire with cease and desists from across the board. Poor Perplexity is getting being targeted by Amazon as well, because it's been trying to allow its chatbot to be able to make purchases on other particular websites. So this is the beginning of companies trying to work out who's got whose real estate, who's ensuring that they're training and giving fair royalties back when necessary. And once again, Perplexity has been trying to make these commercial deals itself, but clearly not quite quickly enough.
So funny, I was talking to Matthias Dupfner about this like 10 years ago, and I figured it would be resolved by now, but this is an issue.
It's not evolution, Matt. It's an evolution.
All right, looking forward to your program. Caroline Hyde hosts Bloomberg Tech. That kicks off at 11. They've got a lot to squeeze in on that show today, so definitely tune in. I want to check in right now on futures. We are about 20 minutes away from the market open right now. Not seeing decent gains right now, little change on the S&P 500, but we're so close to a record. If we do manage to rally into the close, which has been known to happen on a number of occasions, although it is a Friday, we could get a 0.5% gain. That would push us to another new record for stocks. I'm not saying it's going to happen. I'm just saying we're close. Let's get a check at some of the other movers on our radar. Ulta issued a beat and raise as demand remains robust, but the cosmetics company's CEO cautioned that consumers are getting choosy. So Ulta Beauty this morning up 7.3%. Speaking of beauty, Victoria's Secret also beat earnings and raised its outlook as its turnaround strategy seems to be luring more shoppers across all income levels. This is a huge story of a once giant in the lingerie world that has come crashing down with competition from startups like Skims. Today up almost 16%. And cybersecurity firm Rubrik is jumping after posting a surprise profit in the third quarter. Rubrik up right now more than 20%, increasing its market cap by a fifth. Coming up, a Bloomberg exclusive, House Democratic leader Hakeem Jeffries joins us right here on Bloomberg Television to discuss the battle over health care subsidies and whether New Yorkers could see higher taxes again next year. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, let's head now over to Capitol Hill in Washington, D.C., where Bloomberg's Balance of Power co-host Joe Matthew has an exclusive interview with the House Minority Leader Hakeem Jeffries, and they'll be talking about health care.
Indeed, thanks for joining us live from Capitol Hill on Bloomberg TV and radio. I'm Joe Matthew with an exclusive conversation with the Democratic leader in the House of Representatives, Hakeem Jeffries of New York. Leader Jeffries, thanks for being back with us on Bloomberg. It's good to see you.
Morning, Joe. Good to see you.
Pretty important ruling in the Supreme Court when it comes to redistricting in the state of Texas that I'd like to start with here. It's open season, apparently, on redistricting. Does that mean every Democratic-led state in the country needs to redraw their maps?
Well, first of all, it's unfortunate that the Supreme Court has rubber-stamped a racially gerrymandered extreme map that Donald Trump ordered Texas Republicans to engineer as part of his effort to try to rig the midterm elections in 2026. But notwithstanding this adverse ruling, we're going to continue to move forward and ensure that there is a fair map across the country. California voters enacted Prop 50, and as a result, we'll have a fair map in California with some additional opportunities to be competitive, and I expect that you'll see other states across the country continue to respond.
Will yours be one of them? Are you on the phone with Governor Hochul today saying it's time to redraw the New York map?
Well, the New York map has some particularities relative to the Constitution that won't necessarily allow it to be revisited in this particular cycle, but some voters have filed a lawsuit in New York, and we're monitoring that litigation closely to see what the outcome may be.
Okay. There's a question about whether you really need it. Leader Jeffries, after the special election in Tennessee on Tuesday, we saw a plus 22 Trump district go down to a plus 9 Trump district, and you've got a lot of armchair mathematicians out there suggesting that could mean as many as 30 or 35 seats for Democrats in the midterms. How do you see it?
Well, Republicans know that if the elections were held today, they would lose. That's the reason why Donald Trump has decided to engage in this extreme effort to gerrymander congressional maps all across the country, and it's very unfortunate. Our view is that we're not going to unilaterally disarm, and we have to ensure that there's a fair map nationally across the board so that it's the voters who get to decide who is in the majority after the November 2026 election. Part of the challenge with Republicans is that they've broken all of their promises. They indicated that they were going to lower costs. In fact, lower costs on day one. Costs haven't gone down in America. Costs have gone up. Housing costs are through the roof. Grocery prices through the roof. Electricity bills through the roof. And now, because my Republican colleagues refuse to extend the Affordable Care Act tax credits, we know tens of millions of people are about to experience dramatically increased health care costs. Democrats are actually the party focused on driving down the high cost of living.
And so let's talk about a couple of those points of leverage that you just pointed out. Affordability and health care. Many would argue that it's kind of the same story here. President Trump has been saying that affordability is a Democrat hoax, a Democrat con job. Does that mean you do not have Republicans on board with you in reforming health care or extending Obamacare subsidies?
It appears that way. It's unfortunate that the president's position, which is the Republican Party's position, is that the affordability crisis in the United States of America is a con job and it's a hoax. No, what was a con job and hoax was the fact that Republicans spent all of last year claiming that they were going to lower the high cost of living in the United States of America, that they were a party committed to addressing the inflationary pressure that the American people were under. That's all they talked about last year. But they lied to the voters. That's the con job.
They lied.
They absolutely lied to the voters because there's no evidence throughout this year that they've had any intention to actually address the affordability crisis that exists. In fact, they now say it's all a hoax. But everyday Americans, when they go to the grocery store, the supermarket, when they see their health care premiums dramatically increasing, when they see the electricity bills that they have, which are through the roof in part because Republicans in their one big ugly bill attacked the clean energy economy at a time in America where we have growing power needs, in terms of what we see with the expansion of artificial intelligence. It's all extraordinary. So Republican leadership has made it clear they have no intention to extend the Affordable Care Act tax credits, and that's very unfortunate.
You know, the White House would say, hold on, Leader Jeffries, this president's been working overtime to cut deals to lower the cost of prescription drugs. Does he deserve credit for that effort?
We haven't seen any evidence that prescription drug prices have gone down in any meaningful way. What we have seen are that the Trump tariffs are out of control. They've increased costs by thousands of dollars per year on everyday Americans, and they've created an uncertain environment for businesses and corporations throughout the country. And we know that uncertainty is one of the biggest problems that American corporations and companies may face. It's difficult to actually make investments when you have this chaotic environment that has been visited upon the economy.
So let's talk about what you can get done before the expiration of these subsidies at the end of the month. A bill was introduced yesterday, a framework that was bipartisan. A Democrat and a Republican, Gottheimer and Kiggins. It would extend these subsidies for a year and put new collars on eligibility. Is this a path to renewal in your eyes?
Well, we'll have to take a look at the particulars in the four corners of that bill.
Yep.
214 Democrats have signed a discharge petition that will extend the Affordable Care Act tax credits for 3 years and give the American people the certainty that they need in order to move forward during these otherwise uncertain times. All we need are 4 Republicans. There are 219 of them. All we need are 4 House Republicans to join us, and we can extend the Affordable Care Act tax credits. We also want to take a look at what happens in the Senate. I'm thankful for Leader Schumer and Senate Democrats who will put a bill forward next week and force an up or down vote on an extension of the Affordable Care Act tax credits. You know, we're in this fight until we win this fight on behalf of the American people, because in the wealthiest country in the history of the world, it cannot be the case that working class Americans and middle class Americans are unable to afford to go see a doctor when they need one.
Are you in touch with the Speaker of the House on this? Is Mike Johnson talking to you about a potential vote after John Thune promised a vote on health care in the Senate for next Thursday?
You know, the big challenge with House Republicans has been that they've adopted a my way or the highway approach. They have zero interest in actually sitting down and finding a bipartisan path forward. We've said from the very beginning of this year and throughout the Trump Republican shutdown that we will sit down with anyone, anytime, any place here in the Capitol, or go back to the White House, sit with the president to try to figure out how we can fix our broken healthcare system and address the Republican-created healthcare crisis that's devastating people all across America. They've refused repeatedly to sit down and even try to find common ground, apparently because they really are uninterested in dealing with an extension of the Affordable Care Act tax credits. Joe, as you know, this is the same group of people who have actually tried to repeal the Affordable Care Act more than 70 times over the last 15 years.
So could we be in a world in which there's a health care bill that passes the Senate and dies in the House?
Well, if there's a bill that passes the Senate, there will be tremendous pressure on Mike Johnson, Steve Scalise, and House Republicans to bring that bill to the floor for an up or down vote. And the votes will exist in the House of Representatives. I call upon some of my Republican colleagues, more traditional conservative colleagues, or the so-called swing seat Republicans, to actually press their leadership to give the people of this country an up or down vote on something meaningful that will extend the Affordable Care Act tax credits.
Just lastly, President Trump today will be receiving, we understand, the inaugural FIFA Peace Prize. Does Donald Trump deserve credit, as he says, for ending 8 wars?
Yeah, it's unclear what 8 wars he's talking about. What the American people clearly want to see from this president is action related to the challenges that we face in this country, lowering the high cost of living, fixing our broken healthcare system, making life better for everyday Americans. That's the Democratic commitment, that we actually should deliver on the promises that Republicans made to lower the high cost of living, but refused to address. In a country that's the wealthiest in the history of the world, but there are far too many people who are struggling to live paycheck to paycheck, can't thrive, can barely survive. And that should not be the case in this great country. We should allow for a situation where every single person who works hard and plays by the rules can afford to live a comfortable life, live the good life, good paying job, good housing, good health care, good education for your children, and ultimately, at the end of the day, a good retirement. That's the American dream. We need to bring it to life for every single American.
Democratic leader in the House, Hakeem Jeffries. Leader, thank you for being with us today once again on Bloomberg.
Thank you.
We'll send it back to you in the studio.
Joe, thanks very much. Joe, I just wonder, while you were talking to Hakeem Jeffries on Fox Business, House Speaker Mike Johnson was saying that the Republicans will roll out a health care plan probably mid-next week. I know because I listen to your program every day that we don't have that many legislative days left.
That's correct.
On the calendar. What is it, like 10 days left and the Republicans are going to come out with a plan mid-next week? Is there enough time to get anything done?
That's a great question, and we could be in a situation, and we'll talk to leadership about this, where there is a short-term fix because, Matt, as you point out, time is tight, and these Obamacare subsidies will expire at the end of the month. If there is, in fact, a Republican plan, we'd love to know what the details are. There was a bipartisan bill, as we just discussed, dropped yesterday, but there's no path to freedom at the moment on this, Matt, and if it waits until next week, we're going to have single digits in terms of legislative days left to make this work.
All right, Joe, thanks very much for that. Joe Matthew there, anchor of Balance of Power. His show kicks off on Bloomberg Radio at noon, then again on Bloomberg Television at 1 p.m. Let's take a look at what's going on in these markets. Just about 4 minutes left until the opening bell. And there's a very special guest ringing the bell down at the New York Stock Exchange, so stay tuned for that. We're looking at S&P futures right now that are a little changed, but the arrow is green here, 0.1% the gain. We need to see that move up to about 0.5% before we hit a new record on stocks. NASDAQ up a little bit more, about 0.2%. You can see the small caps this morning down 0.2, even though it looks even more like we're a lock for a cut from the Fed next week. We get a ton of data coming out at the top of the hour. And when we come back, we're going to talk to BlackRock's Rick Reeder as well. This is Bloomberg Open Interest.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? And because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
From the world of politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at markets that are hovering between gains and losses. Right now, green arrows on futures, 0.1% on the S&P, 0.2 on the NASDAQ. If we do get up by 0.5% by the time we close, we'll have hit another all-time record high on the S&P 500. So stocks, although November was a tough month, we've wavered. We're back up there at new records. I teased a special guest at the New York Stock Exchange ringing the opening bell. And it is special to see Brad Jacobs here. He's got a new book out, How to Make a Few More $1 Billion, and he runs QXO, and it's a company that we talk about all the time. But I had accidentally looked ahead on the NYSE website, and I thought that Hank Azaria was going to be ringing from, Mo Sizlak of The Simpsons. But that's actually tonight. So he's ringing the closing bell. Stick around for the close with Romaine and Katie, and you'll see the voice of Apu ringing the opening bell. It's a SPAC at the NASDAQ market site, so that's pretty much all you need to know. In terms of the big news today, we had what could prove to be an historic deal. Netflix is buying Warner Brothers in a $72 billion deal that combines the world's dominant paid streaming service, that is Netflix, with one of Hollywood's oldest, most revered, and most iconic studios, Warner Brothers. It is a fascinating deal, and right now you've got Netflix down about 4%. Warner Brothers Discovery up 324 to 25.34. So the price actually is $27.75. That was the agreement. We're not quite there yet, but we're getting ever closer on WBD. And apparently Paramount had made a $30 bid, but that was for the whole company, and Warner Brothers is going to split up for the Netflix deal. This is a story we're going to continue to cover with you. But I want to get to the broader markets, and we have a Fed meeting next week, and there's a lot going on in rates as well. So let's bring in Rick Reeder. We have a ton of economic data coming out at the top of the hour, Rick, and normally we would have also jobs day today. That's going to be pushed forward a couple of weeks, or back a couple of weeks, I should say. And this leads me to my main question. Why would the Fed meet next week if they're not going to get the big jobs number out until after their meeting? Why not delay your Fed meeting, break up your precious schedule, get a little closer to Christmas? I get it. Everyone wants to be home for the holidays. But isn't the U.S. economy important enough for them to do that?
It's a great question, Matt. I mean, listen, I would say one thing. I think there's not a lot of ambiguity about the velocity of hiring in the United States today. I mean, you see, obviously, we got the ADP data, the claims data we got yesterday, but that's pretty ambiguous because of the timing around the holiday. But boy, you see it in terms of where companies are going. I mean, literally every day. And you see, by the way, on the backside of M&A, to me, it's pretty clear that we don't have any hiring velocity today, and that the Fed, I think it's a pretty clear, you got to get that funds rate closer to 3%, if not at 3%. And so I think you've got enough data to do that, and you don't have enough data that suggests that inflation, certainly over the intermediate term, is accelerating. So I don't have any issue with the meeting. I mean, I think they can move closer to 3% sooner. So, and I think you got enough data to allow you to do that.
All right, so you think it's a lock, and it doesn't really matter. They might as well cut now if they're going to cut.
By the way,
yeah.
By the way, I don't think it's a lock. I actually think, when you look at, we're going to probably have some dissents. You probably have a disagreement. I think it should be a lock. Listen, I think the fact that we haven't heard anything otherwise, that they're probably going to go. But I definitely don't think it's 100% that they're going to go.
All right, that's interesting. So you think we're going to see more dissents? Does that continue, Rick, or do you think, once Jay Powell is done and the president puts in whomever his pick is for Fed next year, that we're going to see less dissent, or is this a new feature of the Federal Reserve?
So I don't, personally, I don't think it's a crisis that you have some disagreement. You have some independent voters, you have some independent people on that Fed that are interpreting the data differently than others. So I'm not sure that it's a structural problem. Listen, I think that, to me, the data is very clear that inflation is a bit elevated today, but productivity and innovation will deal with that. And that is so clear to me. And then the flip side of that, productivity and innovation are creating an incredible lack of hiring for ordinary jobs, lower skilled jobs, et cetera. And so, how people interpret the data in the near term, I don't think it's a structural issue that you have those dissents. I just think going forward that, we're going through what I think is the most extraordinary industrial revolution we've seen maybe in a generation. And I think the offtake of that is pretty clear in terms of what it means for jobs and inflation.
Let's talk about the next Fed chair. I mean, reports suggest that Kevin Hassett has won this contest, and I wonder, as someone who runs one of the most important rates businesses in the world, what do you think about Kevin Hassett as a pair of hands to run this Federal Reserve?
I will say that I'm not going to comment on any individual. The thing I will say is I think this Fed will, continues to be one that will analyze the data. I think the data is clear today in terms of where it's going. I think the thing that we've got to do as market participants is think about not just what are they going to do with the front end of the yield curve, but what do you do out further on the yield curve? There's a bunch, including with the name you mentioned, how people think about how does the 10-year react, how does the back end react to that. I think one of the great expressions of the market today is I actually don't think that rates are going to be that volatile out the curve going forward. And so, one of the great expressions of the market today is selling volatility in the rates market, which has been pretty good trade. And I think will continue to be. Mortgages, agency mortgages also being an evolution of that.
Mortgage rates and consumer borrowing costs are still high by recent standards. That's part of the reason, I guess, you want to get the terminal rate at 3%. But companies are telling us every day that tariffs and policy uncertainty are more important than the Fed funds rate to their business. And we talk to economists like Diane Swank who say that especially consumers at the lower end are not going to be helped by a rate cut. Anybody in the subprime borrowing area, which is massive, by the way, is like the bottom 2 quintiles of the country. Are we in a world where rate cuts just don't pack the same punch as they once did?
That is a long and complex question. So I will say the answer is yes. The short term, the overnight funding rate is not nearly as effective a tool at moving monetary prices, at moving the economy as it used to be for so many reasons we've chronicled before. Service-oriented economy, people borrow out the yield curve. CapEx is not driven by the interest rate today. It's driven by hyperscaler spend or by CapEx spend on AI, et cetera. However, long-end interest rates do matter. And how you fund out in the 5 to 10-year part of the curve particularly do matter quite a bit. It's part of why I believe that stability out the curve is so profoundly important. To say, though, the comment about getting the rate down doesn't help low-income people is not true. The truth is there is a transmission mechanism that even if you move the front end of the curve down, as long as the curve doesn't steepen that much, and there are ways to manage that, what you do is you create velocity of mortgages. You get the mortgage rate down, you create velocity of housing. It allows people to unlock value of their house. It allows labor mobility because people can move. There's so many, and by the way, whether it's credit card financing, whether it's auto loan financing, to say that it doesn't help to get that rate down, I think is, for particularly the place that it does help, housing, low income, small business, and that's what needs the help today.
Mortgage rates have come down. I mean, the 10-year is at 4.1%. This administration has been steadily moving it lower. Where do you think we see the 10-year, say, at the end of 2026, since the market believes that the Fed will cut rates to 3% or even a little bit more?
So, man, I think the key is, so the answer is I think it's going 3.5 to 4. And I think the key will be maintaining stability in and around 3.5 to 4, because if you get to 3.5 to 4, you get the mortgage rate into the mid to high 5s. If you get the mortgage rate down to the mid to high 5s, you see it today. Why is existing home sales picking up? Why are you seeing, and we see it in prepayment speeds in the mortgage market. You see high coupon mortgages that are widening relative to low coupon as a result of the fact you are starting to see some velocity around housing, existing home sales particularly. So if you get the 10-year, which I think can happen in 3.5 to 4, you get the mortgage rate in the mid to high 5s. And by the way, I don't think it has to go much lower than that. That's where you get, what I think is a much more effective operating ecosystem in the economy.
How do you control, or how does the Fed, as you said, focus on rates out the curve? We have a viewer writing in who wants to know, what's the mechanism to do that?
Many. So, if you are the Federal Reserve today, you have, when people say they have one tool, the Fed funds rate, I find that incredibly superficial. The handbook at the Fed has much more complexity to it. You can use the balance sheet, you can use their parts, if you use your voice, a la what Mario Draghi has done in the past, where you think about things like, gosh, if the amplitude of the curve is at a certain level, if the yield was at a certain level, you think about the size of the balance sheet relative to the duration, and you think about how you can be effective about using the long end of the curve. There's actually not that much, to get too technical, duration DV01 out the yield curve that you can be pretty effective at managing that relative to the front end. To your question, your point earlier, front end, the overnight funds rate is interesting, but it doesn't, moving at 25 basis points every 6 weeks, doesn't do a hill of beans for really, until you move it to where it needs to get to. Unless you're moving it quickly, it doesn't really do that much. But managing further out the curve where corporate finance takes place, mortgage finance takes place, structured finance takes place, that has real efficacy to it.
I got to ask about Bink. You've outperformed the market universally, 1.6 times the return, 1.8 times the return of the ag. So I'm just looking at the ETF that you run here. How have you got Bink set up for the Fed cuts, the path that you expect, and I wonder how the massive investment in AI, the huge borrowing that these hyperscalers are doing to build out this global network, how does that touch Bink?
So yeah, it's a great question. Thanks for asking. So I'd say a couple of things. My job literally is, I'll say there's something I was looking at it the other day. Do you know in fixed income there's 1.4 million unique securities? So you think about all the tranching of the debt, publics, privates, et cetera. My whole job and what I'm trying to do with, oftentimes what I find with lack of wisdom, is all I'm trying to do is figure out what is the best value across the markets globally. Where do you take interest rate risk? Where do you take yield risk? Where do you take convexity risk? So all we're doing and trying to do for people, because fixed income is pretty complex, is use our teams around the world. So today, do you reduce a little bit of your investment grade credit? Because to your point, there's going to be a lot of AI financing that will come. We've seen it in the last few weeks. Do we need to own as much investment grade credit at tight spreads? Not really. It's not that exciting. Agency mortgages are more interesting. European high yield, European investment grade, we're not seeing as much of that AI, and the growth is moderate, and you get a cross-currency benefit. That's exciting. Having some interest rate exposure in places like Asia or in parts of the emerging markets. So I know the idea being just try and move around dynamically to where the best relative value is around the world. Today, credit is okay. We still own, we still like high yield. We've reduced some U.S. Just because spreads have come in a bunch. But we're just trying to create, if we can create 6.25 yield for people, stability. The thing I'm most proud about is we keep our volatility down. That's in fixed income. If you can get 6.25, and then take the risk in equities, to your point about AI and spend, pretty spectacular returns if you get it right around where the equity opportunities are.
Well, it has been. I'll tell you what, Rick. I put the Bloomberg data on your ETF on Bink into ChatGPT, and it came back with this. It says Bink has outperformed broad benchmarks by a wide margin while taking notably less risk. It's delivered equity-like returns versus the ag with roughly half the volatility, and it's captured most of high yield's upside with much smaller drawdowns. So high praise.
Thanks for saying it.
High praise from ChatGPT 5.1. BlackRock's Rick Reeder, that's just one of the many reasons we have him on this program. Really appreciate your time this morning. Let's get a check on what's going on in the stock market right now. You've got some gains here. We're up about 0.25% right now, and I'm just watching for the records. I like the superlatives. Right now, we're trading at 68.71, and we have to go another 0.25% in gains until we get an all-new record. But it just, to me, is amazing that we're looking now at two weekly gains in a row after such a tough November, so much volatility that we're back at an all-time high. Broadcom putting up a 1.5% gain, that adds 3 points. Google putting up a 1% gain, that adds 4 points. Amazon putting up a 0.5% gain, that adds 1.5 points to the S&P 500. NVIDIA on the downside is not enough to drag us down, so it's off 1.3%, and that does take 6.5 points off the S&P, but because we see 277 gainers and only 224 losers, it's not enough to drag us off. Apple, Netflix, and Microsoft also a drag on this index. Coming up later on in the program, the University of Michigan's Director of Consumer Surveys, Joanne Shu, joins us because, as I said, we have the release of a ton of data, including the latest consumer sentiment read. We'll get it all to you, plus more on the Netflix deal to buy Warner Brothers Discovery. This is Bloomberg Open Interest.
Rodriguez, and I'm Jason Kelly, and we're back with another season of The Deal with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2, and it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Time now for our top call. Some of the analyst action in focus this morning. First up, CFRA is raising its recommendation on Five Below to a buy after the discount retailer reported blowout third quarter numbers. Blowout is their term, not mine. A number of Wall Street firms are also raising their price targets on the company. So you can see Five Below up 2.5% in today's trade. Next up, Jefferies is upgrading Humana to a buy, saying the insurer's risk reward is more attractive. The analyst sees Medicare Advantage membership growth of over 20% next year, and you can see Humana in a decent market is up a lot more, 3.5%. The target 313, so we're still a ways away from that. And finally, Synchrony is getting cut at Baird. The firm says the bank's solid fundamentals are now overshadowed by its heavy exposure to lower income consumers, which makes the stock harder to pursue after its recent run. You can see that they have a hold. Stock's down 1%, and the target's at $82. So still a little bit away from here, but not the kind of thing that analysts like to slap a buy on. Coming up, BlackRock's Bitcoin ETF recorded its longest streak of weekly withdrawals since the debut in 2024. More on the crypto route's impact on the ETF space next. This is Bloomberg Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. We are continuing to see gains in the few minutes of cash trading thus far. The S&P 500 up to 68.77. The NASDAQ gaining 0.5% to 25,720. So these gains have been driven largely by tech, but as we saw just moments ago, NVIDIA is not participating. NVIDIA off right now just about 1%, a little bit less than it was before. Facebook, big gain on news today that it's going to, or as we get news today that it's going to make some partnerships with a number of media outlets. Netflix is down on its offer for Warner Brothers Discovery. It's a $72 billion cash and stock offer. It's not down too much now, only 0.8%. Warner Brothers up 3%, but not to the offer price. $27.75 is the offer price, and right now we're at $25.30. You can see Bitcoin here. That's the Bloomberg terminal code for it, XBT, XBT currency. I think it's interesting, although we chose that in the early days of the asset. Right now down 2%, just over $90,000. And iShares Bitcoin Trust down 2.4%, obviously moving pretty closely to the underlying asset. Investors have pulled more than $2.7 billion from BlackRock's Bitcoin ETF in the 5 weeks leading up to this month, a record run of outflows as Bitcoin tumbled. Bloomberg Intelligence analyst Athanasios Sarafagis joins us now for our weekly ETF roundup. Athanasios, how closely does the ETF track the underlying asset? I mean, is it really a one-for-one move?
Oh, hey, good morning, Matt. Oh, yeah, and this is why this Bitcoin ETF has taken off so quickly. It's because it tracks Bitcoin so well, right? And it's one of the easiest ways to get exposure to it. But to your point about the outflows, yeah, it's suffering a couple weeks of outflows here. Some of it could be sentiment driven, just obviously based how much Bitcoin is off of its all-time highs. But the other thing is this ETF was adopted really, really quickly. It's one of the most heavily traded ETFs, period, not just within crypto. So when you have that, you have a lot of different investor types that pass through that product. You have buy and holders, you have shorters, you have hedgers, you have institutions. So that tends to make the flows much more volatile just because you have a much more wider investor base. So I think some of it, to your point, is sentiment driven. The other point of it could just be some people making year-end tactical changes, maybe some tax loss harvesting here, just kind of taking some money from its drop from the top. So yeah, this is, there's obviously a lot going through that ETF.
What is the competition like for IBIT? I mean, there are clearly other ETFs. What are the cost bases like? Why is this the number one choice?
Yeah, it's, if you remember when these all launched, a lot of them came out on the same exact day. I think, one, you can't ignore just the brand name. It's BlackRock. I think a lot of people trust that name. That said, several Bitcoin ETFs did take in quite a bit of money alongside BlackRock, but what their main advantages over the other ones is just that tradability and that liquidity, and that tends to attract the much bigger fish, which is why most people just tend to now default to IBIT. But that said, Fidelity's got some decent assets in their product Bitwise, so there's been some pretty decent adoption, but it's almost like comparing SPY to some of the other ETFs. There's one that just tends to be bigger and more liquid, and that's just what was happening with IBIT as well.
All right. Thanks so much. We have a break coming. I'm running up against a break. Otherwise, I'd have a million other questions for you about ETFs and the SEC that have come up this week, but we'll talk about those throughout the day and next week. Athanasios Sarafagis of Bloomberg Intelligence, one of the triumvirate of our ETF specialists, together with James and Eric. Tune in to ETF IQ on Mondays. You'll see that whole crew usually. It's at 12 p.m. Mondays, New York time. Let's take a look at what's going on in markets right now. We're up on the S&P 500 by 1/3 of 1%. The NASDAQ gaining by 2/3 of 1%. Small caps still down a little bit, but we're going to get a ton of economic data in about 4 minutes' time that could well move the market, including consumer confidence. And for that reason, we're going to talk to the University of Michigan's Joanne Shu. I'm sorry about last week, but Ohio State really deserved the W. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies. which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. It would be a marriage made in Hollywood heaven.
You're a wizard, Harry. The King of the North! Bazinga!
The world's largest streaming network, Netflix, says it sealed a deal to buy Warner Brothers Discovery for almost $83 billion in cash and stock. The streamer's co-CEO, Ted Sarandos.
This is a rare opportunity, and it's going to help us achieve our mission to entertain the world and to bring people together through great stories.
The deal still needs approval from shareholders and federal regulators. Syracuse University pop culture expert Robert Thompson.
A lot of people are very concerned about this. It certainly does change the shape of this ever more consolidated world of content and entertainment and all the rest.
CBS News parent company Paramount, Skydance, and Comcast were also vying for Warner Brothers. The Pentagon's reported a new strike on an alleged drug boat off South America as lawmakers in Washington mull over what they heard from the Navy admiral who ordered a second strike on a separate boat that killed survivors of the first. CBS's Charlie Daggett.
Democrats who saw the video of the missile strikes in the alleged drug boat are calling for Admiral Bradley to testify in an open hearing. There's no word from the Pentagon on whether that will happen.
A judge has dismissed an anti-Semitism lawsuit filed by a former student against Harvard.
Yoav Segev claimed he was harassed for being Jewish during a campus protest in 2023, 2 weeks after the October 7th Hamas attack on Israel. In a viral video that caught Washington's attention, Segev tried to walk through a group of pro-Palestinian protesters on campus. The protesters surrounded and jostled him while yelling shame. Segev accused Harvard of failing to take any action against the protesters, but the judge ruled Segev failed to show he experienced severe and pervasive racial harassment. Michael Wallace, CBS News.
Find the nutrition labels difficult to find on food packages? The American College of Cardiology is calling for changes. Dr. Kim Williams.
We would want it to be on the front where people can see it up front, and we would want them to know what the big four are: saturated fat, cholesterol, added sugar, and sodium.
The leaders of the first World Cup being hosted by 3 countries at once meet today. President Trump, Canadian Prime Minister Mark Carney, and Mexico's Claudia Sheinbaum will come together at the Kennedy Center in Washington for the big draw. CBS News LA's Elizabeth Campbell.
There's only so much excitement that you can get out of non-soccer fans for pulling soccer balls with countries' names on it. So FIFA is trying to make this a overall entertainment event to try to gin up more support, more excitement, and more anticipation for the World Cup next year.
This is CBS News. A retired basketball star has a court appearance scheduled in the South today.
Basketball legend Michael Jordan is to testify today in federal court in Charlotte, North Carolina, in an antitrust case against NASCAR. The NBA Hall of Famer co-owns one of two racing teams suing NASCAR, claiming it operates as a monopoly. The two teams have refused to sign agreements that guarantee a spot in races and a payout from NASCAR. Jim Crisula, CBS News.
Taylor Swift might just understand. Former Brazilian ballerina has just unseated the pop star and AI entrepreneur Lucy Guo to become the world's youngest self-made female billionaire. 29-year-old Luana Lopez Lara co-founded the prediction market firm Kalshi 8 years ago. Forbes says the platform hit an $11 billion evaluation, putting her net worth at $1.3 billion. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you can find us. Norma Linder, she's sitting in for Scarlett Fu. Scarlett is still on assignment today. People are telling me that she'll be back in on Monday. So Norma Lind and Paul Sweeney are live here, bringing the Bloomberg Intelligence program to you. It is a big media merger day. Netflix buying Warner Brothers Discovery. So we'll have some more on that. Joanne Shu is going to join us coming up. University of Michigan, the UMich data came out today. A little bit better than expected. We'll break it down. Bryant Van Cronkite, Senior Portfolio Manager at Allspring Global Investments, give us his thoughts on the market. Then we're going to go to Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. Get her thoughts on this huge deal. Again, Netflix buying Warner Brothers Discovery. Monster transaction there. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst. He's going to recap some of the tech names. HPE, Hewlett-Packard Enterprises reporting some earnings as well. Then we're going to play back a chunk of an interview from earlier today. Brian Moynihan, Bank of America CEO, spoke with, or is speaking with Bloomberg Television's anchor Francine Lacroix. So we'll break that down for you and bring that for you. Right now, let's kick off the Bloomberg Intelligence program with Lisa Mateo and the Bloomberg Business Flash. Lisa.
You got it. This Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. All right, we've got a lot of eco data to get to. A little bit dated, but it's here nonetheless. Let's get right to it. So we have the core PCE price index. Let's go year over year. This is for September. The expectation was for 2.8%. Right on target at 2.8%. We go to core PCE for year over year. 2.8% came in right on target at 2.8%. That's for core. Now we go to personal income, personal spending for September. The expectation was for 0.3%. Came in a tick higher, 0.4% personal spending. The expectation was for 0.3%. Came in right on target with 0.3%. Now we go to UMich sentiment. That's out too. And like you said, it's a tick higher. The expectation was for 52. Came in at 53. So things are pretty steady. We have Michigan sentiment a little bit higher. All that said, we go to the markets. So we have stocks higher, yields advancing. We have the NASDAQ up about 0.5%, 128 points. We have the S&P 500 up 0.4%, 32 points, and the Dow rising 0.4%, 228 points. The 2-year yield 3.54%. That's up 1 basis point. The yield on the 10-year 4.11%, and that's up about 1 basis point. The Bloomberg Dollar Spot Index weakening by about 0.1%. Over to company news, and yes, Paul talked about it. Netflix agreeing to buy Warner Brothers Discovery, that $72 billion cash and stock deal. Netflix becoming the owner of HBO Network, Warner Brothers assets, including studios, film, and TV archive. So let's look at the shares right now. Netflix shares down about 0.1%. We have Warner Brothers Discovery up 3%. And in other news, Elon Musk's X hit with a lower than expected $140 million fine for violating the EU's content moderation law. The European Commission claims that X taxes paid for a blue tick symbol? Well, it misled users. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Norm Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Market Drivers today is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow in your own terms with a partner dedicated to your success. Go to commonwealth.com to learn more. Let's get a sense of what's moving in the stock market today. We can do that with Bloomberg's Christina Aquino. She joins us here in studio. Christine, what are you looking at?
We got to talk about Netflix, Paul. Biggest deal of the day, certainly, possibly of the week, right? So Netflix shares, though, not taking it very well. So ticker NFLX. Those shares are down about 0.3% at the moment, but earlier they were down more than 5%. So investors initially taking this deal as a negative. And again, let's recap, right? So Netflix agreeing to buy Warner Brothers Discovery in a deal worth $72 billion in equity value. Enterprise value is $82.7 billion. Warner Brothers shareholders receiving $27.75 a share, both in cash and Netflix stock. And before this deal gets done, which is expected to be done in the third quarter of 2026, Warner Brothers will complete the planned spinoff of its networks division. So they're going to spin off their cable channels like CNN, TBS, and TNT. And then on the Netflix side, apparently they have secured $59 billion, or up to $59 billion in bridge loans from banks including Wells Fargo, BNP, and HSBC. So perhaps investors may be just pausing a little bit, given that they're going to be taking a little bit of debt and then maybe parsing through the deal. That's why we're seeing a little bit of caution today.
Yeah, really big deal. We're continuing to see the headlines on this deal here. What else do you have your eyes on, though, in the market?
Looking at Ulta today as well, Nora. So Ulta ticker ULTA, that share up majorly this morning, up 11%. And that's because they raised their full year outlook after reporting better than expected results in the third quarter. So the company is now expecting comparable sales to be up as much as 4.7% in the current fiscal year. And, you know, Ulta really kind of capitalizing on the trend among shoppers. Yes, they are pulling back on some purchases, but not on their beauty products, not on their skincare. So that's still something that they're spending money on, and Ulta's capitalizing in that by building out their loyalty program. And as we know, you know, the strategy has really differed greatly from Sephora, for instance, which is their main competitor. Like Sephora's focusing on urban centers, Ulta very much focusing on the suburbs, and that's winning big for them.
Hewlett-Packard Enterprises.
Hewlett-Packard Enterprise, yeah. So that stock also not doing well this morning. So ticker HPE down just about 1.6%. And, you know, we heard from the company, they're saying that their current quarter sales falling short of estimates, revenue now at, or estimated to be at $9 billion to $9.4 billion. Previously, or rather the estimates among analysts was for $9.88 billion. We also have the CEO, Antonio Neri, saying that their sales in the fiscal fourth quarter missing estimates, and they're pointing to basically delays in their AI workload deals. You know, some of those were pushed in 2026. Yep. One of them is because of a delay in a Europe data center that's not built yet, which is, you know, part of the issue of banking on data centers. The build out takes time. And then there was another issue with the U.S. government. Essentially, their agreements with the U.S. government just have been delayed by the shutdown. So sounds like a bit of a bureaucratic delay there.
All right, very good. We're going to talk to Bloomberg Intelligence analyst Woo Jin Ho later this hour on. We'll follow up on HPE. Christina Aquino, thank you so much for joining us. Christina Aquino, she covers all of the stocks for Bloomberg. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcast, Spotify, or anywhere you listen. As Christine was mentioning, UMich data coming out, 53.3, and consensus was 52, so a little bit better there. The last period was 51, so some improvement there. Let's break it down with Joanne Shu, Surveys of Consumers Director for the University of Michigan. Joanne, what do the numbers tell you today from the consumers?
Consumers feel no worse than about the economy that they did last month, and that's certainly good news. Probably the strongest part of today's release was inflation expectations. Those ticked down both in the short run and the long run, and we're at the lowest levels that we've seen since February of this year. So it is definitely welcome news to see that consumers believe that inflation is not going to be as bad as they were fearing back in April and May, but at the same time, they're still expecting inflation to remain high for the foreseeable future.
How are you factoring this into what we've been seeing? We're just coming off of Black Friday. We've been seeing a bit of resilience for the consumer here, but then you are still seeing people trading down. How are you taking all this into account?
What we're seeing out there is very much consistent with what people are telling us on our surveys. Consumers are not feeling strong about the economy. They are quite worried about labor markets. That is pretty much the one major development this year that's very different than what we were seeing in 2022 at the height of the post-pandemic inflation period. Even though consumers, we haven't seen that many mass layoffs at this time, consumers are not feeling confident about their incomes going forward. Income expectations are pretty anemic right now. We have more than 2/3 of consumers expecting unemployment to go up. So overall, they're not feeling very confident. And I think that's one of the major reasons we're seeing consumers being choosy with their dollars and looking for value. At this time, again, labor markets have not, people more or less have been able to keep their jobs. But if that starts to change, I would expect a pretty rapid pullback in behavior.
I know you guys, in terms of sentiment, you break it down current conditions, which came in at 50.7, which was weaker than consensus. But the expectations going forward came in at 55, higher than consensus and higher than last period. Is that a typical type of trend there?
We're going to need to see if that sticks at the end of the month because this is based on the preliminary data for December. But by and large, what we're seeing on the expectations index is consistent with the softening of people's outlook for inflation. And we know that high prices as well as incomes are the two top thing on consumers' minds right now. They're not necessarily feeling that much better about labor market prospects. They still believe labor markets are going to weaken in the year ahead. And they still expect inflation to persist, but just not as extreme as they were expecting a few months ago. And that is certainly welcome news, both for consumers themselves as well as policymakers.
All right, Joanne, thank you so much. We appreciate it. As always, Joanne Shu, Surveys of Consumers Director at the University of Michigan in beautiful Ann Arbor, Michigan. We got some green on the screen here today, Nora, with the S&P up about 0.5%. The NASDAQ up about 0.6%.
Yeah, I mean, we're seeing communication services and information technology really buoying the S&P 500 higher. I'm taking a look at the VIX as well. It's around the 16 handle, we'll call it.
Yeah, just below 16. I mean, to me, that's kind of a more normalized kind of level for this marketplace. You get down to like 12 or 13, and that's quite low. But anything above 20 kind of suggests a little bit of angst in the market. So yeah, right around 15, 16 seems pretty reasonable here. So again, stocks higher here, yields pretty steady here. The 10-year Treasury 4.11%, and it's been a big deal day, certainly in the world of media. This is the first time Netflix has ever made an acquisition, and then to step up into a $75 billion deal is extraordinary.
So is this game over for everybody else, all the competitors?
I don't know. It's we were talking to Jason Bassinet of Citi, who covers the media industry, and he was saying, boy, if you're Paramount Skydance in particular, what do you do? Because you are, to be polite, subscale, and even more so today. What do you do there? Comcast less so, but still their streaming business is subscale, according to Jason Bassinet. And those were the most likely ones to make this acquisition, but they didn't get it. So what did they do? I don't know. It suggests maybe even more consolidation going forward. So I'll have to see how that plays out here. But so this is a huge deal in terms of dollars. It's transformative for the industry. You put together the biggest streamer with one of the big 3 studios out there, and there you go.
What do you do from there?
I don't know. Integration risk, I guess. Regulatory risk, I guess, pretty solid there, but we'll see how that plays out. But they had their call this morning, and we'll see how it plays out. S&P up 38 points, 0.5%. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, Netflix shares starting to see a turn right now, up about 0.2%. We have Warner Brothers Discovery, their shares up about 0.3%. That's after announcing an agreement to buy Warner Brothers Discovery. Netflix agreeing to buy Warner Brothers Discovery. A few other stocks on the move. We'll start with shares of Hewlett-Packard Enterprise, HPE. Their shares down about 0.5%. The company gave an outlook for sales, fell short of those high expectations for the AI server business. And consumers still spending on cosmetics and hair supplies. Ulta Beauty, it raised its full-year outlook after reporting better than expected results in the third quarter. Ulta shares up about 13%. Victoria's Secret shares up 18% after reporting better than expected sales. Also lifted its outlook for the year. Stocks extending their gains as after a reading of the Federal Reserve's preferred inflation gauge, we had core PCE. It rose 0.2% in September. That was in line with expectations. We go to the yield space, the 2-year, 3.54%. That's up 1 basis point. The yield on the 10-year, 4.11%, and that is little change. The Bloomberg Dollar Spot Index weakening by about 0.2%. That for on-demand news 24 hours a day, you can subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Nora and Paul.
All right, thank you, Lisa, for this breakdown here. Let's take a check at the markets. I'm looking at the S&P 500 up about 0.5%. Dow Jones Industrial Average just about the same, but the NASDAQ up about 0.7% as we speak. We're really seeing stocks continuing to gain here as we're really seeing green all across the screen. I'm Norma Linda here for Scarlett Fu, who's on assignment. I'm here with Paul Sweeney today, and we're really just digging into what's happening here with the market and how we're still continuing to see this green across the screen. We're joined by Bryant Van Concrete. He is a senior portfolio manager at Allspring Global Investments, and hopefully he can give us a bit more understanding about what's going on right now. Of course, we've seen some really strong returns this year, double-digit gains, Bryant. People are really nervous coming into this year, though, but we are seeing some resilience here in the market. What's your view for 2026?
Yeah. Hi, Nora, Paul. Good to see you. Good to be with you. Well, look, inflation's coming down to a level that's now reasonable. It gives the Fed the chance to cut rates. And that's why I think we're seeing optimism in the markets right now. There's a lot of built-up energy going into 2026, whether it's from Fed cuts that have already happened, that are going to continue to happen, whether it's the tax benefits, both corporate and consumer, that's coming from the one big, beautiful bill, whether it's the AI CapEx spend. There's a lot of energy that's coming into 2026, which makes me think that it could be a really good year for the U.S. economy and for markets, at least in the first half. But that doesn't mean we can be complacent. I think we need to start thinking about how to rotate into what is next when it comes to the AI theme. What's next for markets in terms of what sectors are attractive? So opportunities are out there right now, and consumers, I think, are feeling the pinch of old inflation. But I think the market's got a lot of opportunity for investors to be pretty offensive here.
Offensive, I guess in 2025 really meant kind of being long that AI trade and big tech in general here. What's offensive mean in 2026, do you think, Brian?
Well, staying in tech, I think it means rotating a bit. I think that we're going to see the next 3 phases of AI begin to play out. So phase number 1 from here is the expansion phase. The first phase is all about just a couple companies, right? But we're going to see that expand now to companies like Teradyne, for example, who are going to help test and package more broader semiconductor chips that are going to be beyond just the NVIDIA GPUs. Then we're going to see the next phase, which is implementation. How do we take this build out and start to implement it within the broader landscape? We'll need names like Keysight, who are doing R&D and simulations on edge devices that'll help bring this to companies. And then finally, how do we realize the value from this? How do companies and consumers actually take what we've now built in society and make it into real savings? And that's going to be a company like CDW, who's going to help implement it across small and mid-sized businesses. So there's more phases that we need to start thinking about with AI, but that's the offensive mindset I think people could have going into 2026.
What sectors are you a bit more apprehensive about as we're heading into next year?
Well, I think the consumer is giving people a lot of angst, but I'm actually pretty positive on discretionary and a little bit more negative on staples. The consumer angst is so great right now around affordability, but it has the attention of the Fed. It has the attention of the administration. And as a result, I think the consumer discretionary stocks, especially around housing and durable spending, could actually be quite attractive in 2026. So I like names like a D.R. Horton or a Somni Group, which is the old Tempur-Pedic mattress company, where I think turnover and housing-related spending can pick up. But on the staple side, I'm more worried. I don't see a lot of room for those companies in the food category, for example, to drive their own destiny. there's not a lot of upside leverage to volume. The pricing power is probably coming down. And so I'm favoring discretionary over staples coming into 2026.
Brian, we've had really good earnings over the last several quarters here. Is the earnings environment strong enough to support this market broadly defined?
I think it is, actually. So the earnings expectations for the large cap universe continue to do pretty well, and they're going to broaden out. The Mag 7 in this year had a really strong earnings growth rate. The other 493 did okay, but I think we're going to see the 493 inflect as the AI theme and the economic theme begins to expand. But small caps also look interesting. We're starting to see that inflection, at least in the first half of 2026, the inflection in small cap earnings expectations, which could give a little bit of juice to the small cap trade. I'm not saying we should go all in on small cap over large cap just yet, but not being in small cap and importantly not being in what I call higher quality small caps could be a big miss for 2026. So maybe fade the lower quality trade in small cap that's done really, really well in 2025 and begin to shift more towards the quality small caps where we're going to see some earnings growth and real earnings growth inflection in the first half of next year.
All right, Brian, thanks so much. Appreciate it. As always, Brian Van Cronkite, he is Senior Portfolio Manager at Allspring Global Investments from Milwaukee, Wisconsin. It is Merger Friday here. Netflix agrees to buy Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. To get the bottom of this, get some real analysis with this, we turn to Geetha Ranganathan. She covers all the media companies for Bloomberg Intelligence here. You know, it's interesting, Geetha, you could argue that Paramount, Skydance, and Comcast arguably needed this Warner Brothers Discovery company more than Netflix, yet Netflix comes out on top here. What do you think the strategy for Netflix is?
Yeah, thank you so much, Paul. So definitely Netflix here kind of really looking at the future. I mean, we are, I think, at, you know, this cusp of the media landscape kind of completely changing with the advent of Gen AI. And I think the barriers to entry for anybody is going to come down substantially because the costs to produce content are going to come down substantially. And I think Netflix kind of sees the writing on the wall and says that they really need to play the long game here and deepen their library with a lot of the beloved and, you know, global franchises that Warner Brothers Discovery has to offer. So absolutely not seen as existential for Netflix at all, but I think they see it as existential from a long-range perspective. But of course, the big losers here definitely Paramount and Comcast, at least in the short run.
And talking about Paramount and Comcast here, how are we thinking about the added pressures that they may be potentially facing if we think about the fact that they are lower or subscale, I should say, in terms of their streaming in comparison to Netflix?
Yeah, this is pretty much game over. You know, we already knew that Netflix had won the streaming wars. Now, without a shred of doubt, they are going to cement their dominance. I mean, you just look at the numbers, 450 million global streamers. Yes, Paramount Plus was already a subscale streamer with only about 70 million subscribers. Peacock is even in worse shape with, you know, only close to about 40 to 45 million. So this really kind of puts, you know, tremendous pressure on them, and they really have to come up with some kind of strategy to you know, fortify their businesses. Maybe they have to look at a potential combination. I don't know what it's going to look like.
Geetha, we spoke earlier this morning to Jen Rhee. She covers all the antitrust stuff for Bloomberg Intelligence, and she suggested that this will face a very difficult regulatory review. What, if that is in fact the case, what do you think Netflix would be willing to do to maybe get this deal done? Would they think about selling some assets here?
They definitely could. So far, Paul, they're saying all the right things. They're saying everything, you know, that should assuage any regulatory fears. That said, I mean, you are combining the #1 streaming service in the world with the #3 streaming service. So obviously, a lot of red flags there potentially. They are, however, saying that this is going to be good for consumers. This, you know, is going to provide more consumer choice. It's actually going to lower costs for consumers because, you know, they're going to be able to sell a bundle of HBO Max with Netflix, potentially lowering costs by, I don't know, 30, 40%. So that's one thing they're saying. The second thing where there was obviously a lot of concern, and not just from regulators, but also from Hollywood content and Hollywood moguls, would be that, you know, Netflix has typically been very anti-theatrical. So they talk always about day and date release releases, how, movies should be released directly to streaming. And so obviously there's been a lot of backlash from the exhibitors, from the theater, from the, creative community. But Netflix, again, kind of placating everybody, saying that they are going to continue the Warner theatrical strategy by continuing to release those 15, 20 movies year after year in the theaters. And the last thing that, everybody has been worried about is we have to remember that Warner is actually a huge content supplier. So they supply all of these big shows. Or you think of Ted Lasso on Apple TV, that's a Warner show.
Yeah.
So, again, are they going to pull, the big question is Netflix going to pull back on all that content? And just this morning, Ted Sarandos said on the call that no, we're not. Warner Studio is going to continue to do whatever it has been doing. But again, not really sure how that's going to work for Netflix if they, just continue to do that. But so far, they're saying all the right things from, a regulatory standpoint.
So from a consumer experience standpoint here, if it's Netflix and they've got Warner Brothers Discovery here, we're thinking about HBO Max and things of that sort. Essentially, are you going to maybe see some sort of merger of experience when you go onto Netflix? You're also accessing HBO, or will it be more of a bundle mindset here?
Yeah, so that is what has been really difficult to parse out, Nora. So they were asked this question again repeatedly in this morning's call. Is HBO Max kind of going to be like one of the tiles that you would see on a Disney Plus, right? You go and you see Pixar and Marvel, and is HBO going to be something similar to that? Or are they just going to continue to run the two services completely independently? If you kind of run the math, it just doesn't make sense for them to have two separate streaming platforms, because you have all of the overhead expenses and the corporates and all of that to accompany that. So that doesn't really make sense. So I think at some point they basically fold in HBO Max, all of that content onto Netflix, although they haven't necessarily clarified that. But I think that basically helps them from a cost perspective, helps them from a content perspective, and then really helps them with engagement, which is really what they're looking for. Deepen engagement on the Netflix platform. How do you do that? By increasing the amount of content. So I think eventually that is the game plan. But again, no specifics from the Netflix management team just yet.
All right, Geetha, thank you so much. We know you're busy today, but thanks for a couple minutes of your time. Geetha Ranganathan, she covers all the media companies for Bloomberg Intelligence. Has been doing that for like 15, 16 years. She knows what she's talking about. She knows all the parties involved. So good to get some breakdown there. If you want to read her research, you can go to BI Go and read her research. She's been covering this a deal for a long time here. Looking at the MA Go function on the Bloomberg terminal and seeing which advisors are getting paid on this deal. For the acquirer for Netflix, Moelis & Company, Kenny Moelis, the great investment bank, standalone investment banks, a lot of media chops in that place. And then Wells Fargo, which is really interesting to me. Wells Fargo, representing the buyer here in a monster deal. Skadden is the legal counsel there. For the seller, for Warner Brothers Discovery, it's Allen & Company. Again, another deal, I think, coming out of the Allen & Company conference in the summer. They meet in the summer, they talk deals. Seems like 6-9 months later, you see something crossing the tape. Maybe that happened here. I don't know. So Allen & Company, Evercore, another good boutique investment bank that's really focused on the media space. And then, of course, J.P. Morgan and Wachtell on the legal side. So a lot of fees there for the investment banks, a lot of fees for the bankers for a deal here that's got an $82 billion enterprise value. There's going to be $59 billion of bridge loans. So again, Wachovia is going to be leading that with HSBC and BNP Paribas. So again, some big fees coming Wall Street's way from this mega merger in the media space. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we have stocks advancing on this big day of big news in the world of Hollywood. Netflix agreeing to tie-up with Warner Brothers Discovery. Well, look at their shares now. Warner Brothers Discovery up about 3%. We have Netflix up about 0.5%. Sentiment toward technology stocks getting a little bit of a boost after NVIDIA partner Hanhai Precision, also known as Foxconn, reported strong sales. And More Threads Technology, it's a leading Chinese AI chip maker. It jumped 425% in its Shanghai trading debut. That said, let's go to the NASDAQ, up 0.6%. 149 points. The S&P 500 up 0.4%, 32 points. The level 6,889. The Dow up 0.3%, 175 points. Over to the yield space, the 2-year 3.54%. That's up 2 basis points. The yield on the 10-year 4.12%, and that's up about 1 basis point. The Bloomberg Dollar Spot Index weakening by about 0.2%, and Bitcoin down more than 1% at just above 91,000. In company news, we have Southwest Airlines. They lowered their operating profit target for the year. That was due to a fallout from the government shutdown, also higher fuel prices. And Cloudflare said it has fixed that issue that led to the websites for several banks, Shopify, Zoom, LinkedIn, to all go down earlier today. Its shares are recovering this morning. They were recovering. Now they're down about 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Nora and Paul.
All right, Lisa, thank you so much for that. I've got my eyes on this market, and we're seeing a lot of green on the screen. And of course, this is being led by communication services and energy if we're looking at the S&P 500 sector. What we've really had our eye on so much of this year has been the tech space. And of course, we did get some earnings out of Hewlett-Packard Enterprise, that's ticker HPE. We did see that this essentially disappointed what investors were looking for here. We did see the company gave an outlook for sales in the current quarter that fell short of the high expectations, particularly for its AI server business. And we've got the best person to help us break this down. We're looking at, we're going to be chatting with Bloomberg Intelligence Senior Tech Analyst Woo Jin Ho. He's coming to us out of Princeton, New Jersey. Tell us a little bit about what you took away from this earnings report.
Yeah, thanks for having me. So I actually liked it. I know there was a high focus on the revenue numbers for the upcoming quarter, but EPS, they actually raised the EPS guidance from 220 on the low end to 225 and 240 on the high end to 245. So essentially the strategy that Antonio laid out with the Juniper acquisition is working out as planned. It is cushioning some of these higher commodity costs and the higher AI mix. So, despite the disappointing 1Q sales outlook, the overall year should be fine.
So the company's talking about, substantial interest in its AI servers, and they call out governments, and that's kind of new for me, at least. I guess I'm kind of used to talking about the hyperscalers, whether it's Microsoft or Amazon. Talk just about maybe other categories of people that may be making some AI investments in servers.
Yeah, hey, Paul. So let's think about the sovereigns. Let's think about the Saudis, the U.S. federal government. They are going to start ramping up their own AI initiatives as well, right? The Department of Energy, Department of Defense, they're customers of HPE's supercompute, and they're going to convert from supercomputing to AI servers as some of these configurations start rolling out. They already, HPE already has some agreements with the Saudis, but and that's one of the issues with HPE's outlook. It's more on the timing of when these deals start flowing through. It's being pushed out more towards the second half of the year versus the first half. But they are going to play a much more meaningful role in the future, not only for HPE, for Dell and Supermicro as well.
So how are they doing in terms of comparison to competitors in this market?
Well, I mean, HPE has made the strategic intent on not going after these lower margin AI server deals. If we look at some of the competitors, the way I have Dell modeled out, they're going to do roughly about $40 billion in AI server revenue. Supermicro around the similar level. HPE for next year is probably going to do roughly about $5 billion. in AI server revenues in fiscal 26. Now, look, that $5 billion is nothing to sneeze at, but relatively speaking, it's going to be much smaller in scope and scale.
Why are they smaller? Why are they lagging? And is there a plan for them to kind of narrow that gap?
Yeah, I found that to be disappointing in terms of lagging. I do think they had the assets to do so. But at the end of the day, the management team at HPE is very focused on shareholder and shareholder value. These AI server deals are very low in margin and highly competitive. So they're not chasing after these lower margin deals. And one of the strategic reasons on why they're going after, HPE is going after these sovereign deals is because they think it's going to be higher in margin. And hopefully that does pan out for them, which is one of the reasons why that, we're talking about 1/5 the size of the deal flow for them.
So outside of HPE, what else are you really keeping an eye on right now in this tech space?
The AI play is going to be pretty important. But I will tell you, the DRAM story is actually going to start materializing as a potential headwind for all of the hardware space. One thing that we didn't discuss on HPE is the 300% rise in DRAM prices is going to affect their server sales. They think they're going to pass that through to customers. I'm a little bit skeptical, but I think the rise in commodity costs and DRAM is going to be the new tariff story in 2026. That's going to affect a lot of these hardware vendors.
Why are DRAMs up so much?
AI. These hyperscale cloud guys are sucking up so much of this memory, and the DRAM vendors aren't raising the capacity. So when demand is tilting over one way, and some of the standard DRAMs, they're not producing as many DRAMs, and the capacity is not growing, there's nowhere else to go for the price to go higher.
I mean, when we think about AI, and we're talking about HPE right now in particular, are expectations just too high? Are people putting so much pressure on these companies, and we're seeing these estimates, and we're not really seeing them delivering? Or what's your read on that?
Well, so let's talk about HPE in particular, right? The way I wrote my earnings outlook commentary was it depends on the lens that you look at, right? From a sales lens, the AI sales did disappoint, right? But if we think about it from an earnings and a cash flow lens, the networking business actually did as well as it should have. And it's doing the work that it's supposed to be doing in terms of cushioning some of the lower margin business. And quite frankly, I still think that there's potential for earnings upside if networking execution strengthens going into the rest of the year.
All right, here's my dumb. I just want to ask my dumb tech question of the day before we let you go here. If DRAM prices are up 300%, who makes DRAM?
Micron, SK Hynix, Samsung.
How come
right?
Well, why wasn't I buying these 2 years ago?
Well, should have had me on 2 years ago.
Exactly. There we go. All right, Wooj, thanks so much for joining us. Woo Jin Ho, he's sporting the Bloomberg Intelligence swag, as am I. It's kind of the look here today, folks. Yeah. All the cool kids have it. Woo Jin Ho, he's a senior technology analyst for Bloomberg Intelligence. He's based down in Princeton, New Jersey, so we'll take a look at that. Again, HPE reporting some numbers here, but the AI story, it is a big story. They tell us it's going to get even bigger.
Absolutely.
The dollar amounts are staggering, the amount of CapEx that's being spent. And now the question I think is being asked more and more and more is, okay, let me see some return on all of this investment, either in productivity or in revenue or other parts of the income statement. All right, earlier, Bank of America CEO Brian Moynihan, he spoke with Bloomberg's Francine Lacroix after the First Bank's Investor Day in almost 15 years. He was first asked about the U.S. consumer and said he is confident in the U.S. economy being driven by the U.S. consumer, but is worried about non-tariff barriers in certain regions, such as the EU. Let's take a listen.
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money, our 70 million consumers, who's pushed about $4.5 trillion plus in the economy every year. They pushed in about, for that month, about 4.5%. And so it was good. And around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good. And it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort of sort the aggregate economic impact of the consumer, our 70 million consumer spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is, with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to where they compare it to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
You know Kevin Hassett, and you've known him for quite some time. Yeah. What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all of his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with, Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say, some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think, again, they're ready to do deals?
Well, generally there's things that you look at, you say, I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much you can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clear that there's sort of 10 to 15% increase is generally across the board result. That's helped businesses understand it better. And so I think that's been worked into their plans. And that's why you're seeing the relief come off from Liberation Day, where people were very confused, to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique. But I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes. But generally, they're more worried about the ability to address markets and drive. And I think one of the things administration's worked on that gets lost in the percentages and count is the non-tariff barriers. And those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States, but around the world, because to get access to markets without having to change product is a big deal.
All right, that was Bank of America CEO Brian Moynihan speaking with Bloomberg's Francine Lacroix after the Bank of America's first investor day in almost 15 years. That seems crazy. Most companies do it every couple of years, and particularly if you're like a monster institution like the Bank of America. But there you go. Pretty confident on the U.S. consumer here. All right, I'll be honest with you. The World Cup's coming to the United States. It is not yet on my radar screen. I will be. I will get fired up for it, but it's just not there yet. But it is going to be monster.
You just need some time?
Yeah, I need to just kind of focus in on it and get in on it. We got a lot going on here. It's hoopsies. I'm focused squarely in on my dookies. Randall Williams, U.S. sports business reporter for Bloomberg News. He joins us here in our Bloomberg Interactive Broker studio. Put into context how big this World Cup's going to be here.
All right. With no understatement, I think it could be the biggest sporting event of all time.
Wow.
Okay.
There you go. That's what
and
I'm
the reason
talking
for that is because every single one of these matches is going to have the Super Bowl feel. It's make or break. Outside of the group stage, you lose, you go home. And I think ultimately that's just going to build and build and build until the final here in Jersey. Well, I'm not here in Jersey, but across the water.
Right across the way.
Across the river to the
Paul's
Jersey
always
side.
doubling there and back here. But so Fanatics, they won a deal to sell merchandise at the 2026 World Cup. How big of a deal is this if you're saying this is about to be the biggest sports event of all time?
I think it's their biggest deal to date. And the reason I say that is because they've done numerous Super Bowls, they've done World Series, they've done all sorts of different events, but when you think about all of the things that they just won, which is the online stuff, with the in-person things as well, and all of the setup that's going to be there, there's going to be these in-person parties before these matches, and Fanatics is going to be controlling all the operations for the merchandise, so that's both in-game and outside of games. Everywhere you go, you're going to be buying something. It's likely going to be from Fanatics.
When's the World Cup?
It's next year. Next year, I believe it starts in June, around that. So you have some time to get excited.
To get fired up. I'm going to do
You have a bit of time.
I'm going to do my work.
It says June 11th to July 19th.
You can't, and the tickets, they're not giving these things away, are they? I mean, Ira Jersey was telling me, like, Ira Jersey, who's our interest rate strategist for Bloomberg Intelligence, he is a part owner of Real Central New Jersey. Did you know that?
I did not.
Minor league soccer. He's all into it. He was saying that these things are crazy expensive.
They are crazy expensive. I do expect them to go down a little bit once we figure out the draw, which is today at noon. Once the draw happens and we figure out what teams are going where, I think the prices will probably fluctuate a little bit.
Oh, this is happening in Washington, D.C. today, right?
Yes.
I think the president's involved. He's going to be involved.
There's several draw parties. I was invited to one in Atlanta. I chose you all over them.
Wow, look at them.
We feel very appreciated.
And this is expanded. Aren't there more teams this year?
Biggest World Cup ever.
Wow.
More teams, more players.
It's all like
more
Haiti's
cities.
got a team in there, you know.
Yeah, potentially.
Everybody. So, I mean, how big of a deal is this for Jersey? I mean, right across the water here.
It was a tremendous upset when New York and New Jersey beat out Dallas to get this World Cup final. And granted, there's a lot of different, they're all going to have matches, of course. But when you think about how grand this event is going to be, in all likelihood, the three finalists were SoFi Stadium, which is gorgeous. It's a $5 billion facility. You have Jerry World down in Texas. Then you have MetLife. And MetLife is sort of a classic stadium, but it doesn't necessarily pop with the eyes. Like, if you walk into MetLife, it just feels like a regular stadium.
You're there.
But with all the transportation, all of the accessibility that New York and New Jersey have, I think that's what likely put them over the edge.
Yeah, they showed they could do a Super Bowl, so this is it.
I haven't been back since, though.
No, exactly. And New Jersey Transit, that's how I do it. I do it with New Jersey Transit. All right, F1. Tom Keen's all into F1. John Farrell's educated Tom Keen on F1. He's all in now. Is Cadillac getting into F1? Are they in F1?
They are in F1. Their inaugural season, or their rookie season, will start in March. But before then, they'll have a commercial in the Super Bowl that I think will get a lot of fans excited.
Wow. Cadillac in F1. Yeah. That's got to be a huge investment for them.
It was a $450 million fee, which, if you think about it from team transactions, that's relatively small. It's big for F1, but this is Mark Walter's team at TWG Sports, and I think that he has spared no expense to get the Dodgers across the finish line. The Dodgers had the highest payroll in the MLB.
Same guy, that's right.
Same guy. He recently bought the Lakers earlier this year. And so with that in mind, I sort of think this is like pocket change for him. Now, it won't be over time because you're going to have to continue to invest and build your car and make sure that you can pay these drivers and the rest of your team. But they're doing a really good job of getting people excited.
So this is a joint venture between TWG and General Motors?
Correct.
Okay.
Correct.
Interesting.
And, and buying an ad on the Super Bowl, was it $7 million this year?
It's record high. I believe Adweek said it was $8 million last year, $7. But with the game and growing and driving more viewers, then who knows? It could be 9.
I remember when CBS had it, when I was covering CBS stock and they got $1 million. We thought, oh my God, that's just crazy. But it just goes up
30
every
seconds.
single year.
30 seconds for $8 million. Nuts.
Yep. It's Bad Bunny performing, right?
At halftime.
Okay.
Halftime.
Is that still on?
Is that
because I know
the NFL
the back and forth?
The NFL was never going to remove Bad Bunny unless something completely out of the ordinary happened with him.
Like the president.
I don't think so. Okay. I think there's a lot of backlash no matter who's going to be performing. There's a different community that's upset every single year.
This is true.
Bad Bunny, him not speaking English is one thing, but he has so many listeners all around the world. The NFL's trying to grow their business internationally. What better way to do that than have an international music star perform at their biggest game?
Absolutely. My daughter's going to be tuning in just for Bad Bunny. Randall Williams, U.S. sports business reporter, Bloomberg News. Our household, when my kids were young, probably the only household in North America that did not watch the Super Bowl. If it weren't for me, none of my kids cared. But my daughter would watch it for the commercials. So there you go. Randall Williams, thanks so much for joining us there.
Appreciate you for having me.
For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, we got Norma Linda sitting in for Scarlett Fu today. Scarlett will be back on Monday is what her people are telling me. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Coming up in this hour, we're going to check in with Tamlin Basson, Bloomberg Intelligence Tech Policy Analyst. Apparently, Elon Musk X has been fined 120 euros by the EU in a first content law penalty. What's going on there? We'll get the latest there. We're going to check in with Jennifer Rhee. She is the Bloomberg Intelligence Senior Litigation Analyst. We want to talk to her about this Netflix Warner Brothers Discovery deal. Will the regulators approve this deal? That could be a little dicey. It's Friday, so that means we talk municipal bonds. Nora is fired up for this. It is Nisha Patel, SMA Fixed Income Portfolio Manager. Get her thoughts on these markets. And Max Chapkin is going to show us self in the studio here. He's a Bloomberg Business Week senior reporter. He's got the big take story. Microsoft Excel powers AI restraint and multi-trillion-dollar empires. We got a lot coming up there in the tech space. But right now, let's go to Charlie Pellet for a Bloomberg Business Flash.
Thank you very much indeed. Lots going on, lots of moving parts of this market. Got to begin, though, with the big deal of the day. Netflix buying Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. It is a $72 billion cash and stock deal. Netflix down 0.8% right now. Warner Brothers Discovery up by 3.6%. Some of the other parties, Paramount, Skydance shares, they're down 6.1%. Comcast down 1.9%. And of course, major media transaction. We got a lot more coming up right here on Bloomberg Intelligence, both in terms of the deal itself and also in terms of the regulatory environment. Equities are pushing higher. Stocks extending the bull run after a dated reading of the Fed's preferred inflation gauge. Treasuries, by the way, on track for their worst week since June. So here's where we stand in terms of the equity market. S&P up 22 now. 68.79 where we stand, up by about 0.3%. We are trading close to our record. The Dow just above 48,000 right now, up 154, up 0.3%. 48,004 on the Dow Industrials. Nasdaq up 79, gain there of 0.3%. 10-year 4.12% with the 2-year 3.55%. Gold up 0.8%. 42.40 the ounce. West Texas Intermediate crude back above 60. 60.34 barrel, up 1.1%, and Bitcoin just above 90,000, 90,200 right now. Bitcoin down by 2.1%. Some of the other stories that we are following for you today, among the economic data points, consumer sentiment as measured by the University of Michigan rose for the first time in 5 months. Joanne Shu is Director of Surveys of Consumers, and she was a guest right here on Bloomberg Intelligence.
Consumers feel no worse than about the economy than they did last month, and that's certainly good news. Probably the strongest part of today's release was inflation expectations. Those ticked down both in the short run and the long run, and we're at the lowest levels that we've seen since February of this year.
Joanne Shu of the University of Michigan, interviewed right here on Bloomberg Intelligence. Again, recapping here, stocks higher, but the big deal of the day, Netflix buying Warner Brothers Discovery in a historic combination. Netflix down 0.6%. WBD, Warner Brothers Discovery, up 3.8%. Our coverage will continue. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Alrighty, thanks, Charlie. Happy Friday. Lots of green on the screen today. I'm looking at energy and communication services, really pushing this S&P 500 higher. Take a look at the VIX. We're seeing it hanging around the 15 handle right now. And we're seeing treasuries on track for their worst week since June. But I really want to take a look at what's going on under the hood here in the equity market. Let's take a look at some stocks on the move today. I'm Norma Linda with Paul Sweeney, and we're joined today by Bloomberg's Christine Aquino. Christine, what's on your mind today?
All right, well, let's talk about Warner Brothers Discovery, which is on the other side of the biggest deal today, possibly this week, really. So those shares very much in the green, in keeping with the rest of the market, Nora. So ticker WBD, shares are up 3.8% at the moment. So definitely investors seeing the positives, at least from Warner Brothers' perspective, when it comes to this deal, $72 billion worth of equity with Netflix. And so Bloomberg Intelligence analysts weighing in, right? So when they're looking at it from the EBITDA multiple, 25.2x, that is at the higher range of the recent M&A in this space. And so they're seeing that as a positive. And, you know, the move will allow Warner Brothers to spin off its TV network businesses by the third quarter of next year. And that could potentially bring forward more industry consolidation. But as we know, the hurdle with all of these deals, of course, is regulation, right? And TD Cowen already warning that regulatory pushback might be the problem here. And of course, we heard from CNBC earlier reporting that the White House is apparently viewing the deal with, quote, heavy skepticism.
All right. What else you got for us?
Let's take a look at Oracle today, Paul.
Okay.
So that's another stock
ORCL.
that is up. Exactly. ORCL shares up 1.7% at the moment. We will get their earnings on the 10th of December. So a lot to look forward to in that. And, you know, we have Bloomberg Intelligence weighing in, saying that they are confident that Oracle will be able to top their $65 billion of total sales in fiscal 2026 because the constraints on their AI infrastructure remains tight. That means that business is booming and they're all engaged. Cloud databases, another area that they're looking for some gains there. That expanded 32% in the first quarter, so a lot of promise there. The focus, though, and the question really is all about debt, right? Because Oracle, in some ways, has been sort of the flagship of questions around how much these companies are borrowing to finance their AI deals. Oracle does not have as good of a credit rating as some of the cloud computing giants, and as a matter of fact, a measure of its credit risk actually closed at the highest level since the financial crisis this week because it has effectively sold tens of billions of dollars of bonds in recent months to finance some of their AI deals. So big questions around their debt for sure.
Yeah, shares of Oracle, ticker ORCL, up about 31% so far this year. I want to talk about the airline space. We did hear from Delta more recently, and they were talking about the drags that happened because of the government shutdown. But you're looking at Southwest, and they're kind of saying something similar.
Yeah, exactly, Nora. So Southwest, ticker LUV, those shares are not doing too badly, actually. They're very much in the green, up 5.8%. But we did hear from Southwest saying that they are lowering their operating profit target for the full year, again, because of fallout from both the government shutdown, but also higher fuel prices as another reason that they're citing there. So now they're looking at their EBIT forecast, approximately $500 million versus the prior expectation of $600 million to $800 million. So quite the cut there. But the silver lining, and I think this is what investors are seizing on, is that they did say that their bookings have recovered to previous forecasts after a temporary slowdown, presumably because of the flight halts during the shutdown. So I think that's what investors are seizing on. Big travel season also, so I'm sure there's a lot of demand for Southwest tickets.
All right. So Southwest Airlines, the ticker is LUV. Love.
LUV,
Do you know why?
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 Don't know why?
Tell us.
Okay. Southwest Airlines is based at Love Field.
Oh, you're right.
Dallas-Fort Worth area. So
they just really leaned into that.
Absolutely.
Right?
They leaned into that heritage
Yeah,
of Fort
they
Worth
did.
area. So that's good stuff. All right, Christine, thank you so much. Appreciate that. Christine Aquino giving us some of the stock movers here. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Looks like Elon Musk, his social network X, is being fined, I guess, 120 million euros for violating the European Union's content moderation law. I'm not sure I want to know what's going on here, but our next guest does. Tamlin Basin, he's a technology analyst for Bloomberg Intelligence. He's based in London. Tamlin, what did Mr. Musk do here to incur the wrath of some of the European regulators?
Yeah, sure, Paul. So this is the content moderation law is the Digital Service Act, and this is one of the sort of regulatory packages that European put in place to regulate the technology sector. This one became live in August 2023, and this probe was launched close to 2 years ago in December 2023. And really, what the European Commission was looking at was sort of in the build-up to some European parliamentary elections, whether there was disinformation that was being spread across Twitter, now X. What this fine actually assessed, 120 million euros, the penalty actually relates to not necessarily the disinformation. That part of the probe is still pending, but the regulators made three findings. One was sort of the design of X, basically that any user can pay for a blue check mark now, and calling that verified. They said that's deceptive because it's not really verification when anybody can pay for it. The other two findings related to, one, there was no ads repository on X. That's mandatory to allow researchers to really see what kind of ads are going across the network. And the third finding related to just not giving adequate access to third-party researchers on X. So this is a fairly significant penalty against X based on sort of the revenue that the platform makes. But the findings really didn't quite go to the heart of that sort of potential disinformation campaign, and that is potentially still waiting in the wings.
Yeah, I mean, we know the European Union, when we think about European regulators, they're widely perceived as really stringent, fierce, when we think about their crackdown on data protection and the like. What do you see as the merit to this? You know, what's your takeaway here in this situation in particular?
So I think, and that's definitely true. I think the European Union has been very aggressive against the technology sector, and most of those companies are American companies. I think what we have seen is a slowdown in the cadence of enforcement once President Trump won the election in 2024, and certainly once he took office. Again, this was a probe that was launched before he was elected president. So I think what we can look at is this was a high fine, but there was rumors that they may actually try to assess a penalty based on the holdings Elon Musk had elsewhere. So his Tesla holdings, his SpaceX holdings. Ultimately, they did only sort of cabin themselves to looking at X's revenue. So I think in that way, we can see that maybe, you know, they are looking to sort of flex the laws and show that they have the capability to prosecute where they think there are breaches. But I do think we have seen a sort of dampening, at least in terms of the rhetoric coming out of the European Union with respect to regulating technology companies.
Tamlin, thanks so much for joining us. Appreciate it. As always, Tamlin Basin, he's a technology analyst for Bloomberg Intelligence. Technology investors since the mid-'80s have figured out the playbook, which is, and this was starting with Microsoft and Windows way back in the day, write a check to the Europeans and move on. And that's kind of how you go. That's been the playbook for 50 years. Quite frankly. And you think about why there's only really two big technology companies in Europe, SAP and ASML. Now you kind of know that's one of the reasons. That's my opinion, folks. Just putting it out there. Big deal of the day, Netflix acquiring Warner Brothers Discovery. What's the regulatory framework? Are the regulators going to take a look at this deal? This is a monster deal in terms of dollars, you know, $80 billion of enterprise value. Let's check in with Jennifer Reed, Bloomberg Intelligence, senior litigation analyst. So, Jen, this is a big deal. How are the regulators going to view this?
Yeah, it really is, Paul. And I think, and we've seen a lot of opposition to it coming out already, I think it's going to get really significant scrutiny, not just in the United States by the Department of Justice, but likely also in Europe and by the UK and possibly some other jurisdictions as well. But, you know, they're going to look at these overlaps, which in this case are both horizontal, that's in streaming. They both both companies provide streaming services, but they're also vertical. You have a big streaming service buying a big movie and TV producer and a big a library of content. And that creates vertical issues. And when a company is really strong in both levels of a supply chain, when they vertically integrate this way, that can raise concerns too. So the Department of Justice is going to have to dig into both of those issues. And last, Paul, I'll say this because we haven't seen very much about it, but there's also what we call a monopsony concern here. Monopsony is when there are a merger results in too few buyers of a service or product. So in this case, you've got two huge creators of scripted content that are coming together, and that could have a negative impact on the artists, the production people, the writers that go into making all the TV and movie content that the companies make.
Jennifer, walk us through what exactly happens to the deal if the DOJ or regulators more broadly decide to push back on this.
Sure. So there are a couple different things that can happen. I'll start by saying this in-depth investigation usually starts by issuing what are called second requests for information. Those are like really big subpoenas where they're going to get a lot of business documents, a lot of data and information from the companies. Now, once the DOJ has looked at all that material, They have to decide either they clear it outright, they clear it with a negotiated settlement with the companies, or they sue to try to block it in trial. A negotiated settlement could mean agreeing to divest a product such as HBO Max, or agreeing to behavioral remedies such as making promises about the way the post-merger firm will behave in the marketplace. But if something like that can't be agreed upon, then the only thing the DOJ has left to do is go to trial and seek a permanent injunction from a judge that blocks the companies from closing the deal. They did that when AT&T tried to buy Time Warner many years ago. But I'll contrast that to when Comcast bought NBCU. They also had some concerns there, but they entered a settlement agreement with respect to that deal.
Jen, politics. I think politics is going to come into this deal, maybe more so than some others here. Generally, I guess on the one hand, we have an administration that presumably is more open to consolidation across industries, taking a lighter touch. But then there's also a president who makes it personal oftentimes. Do we have any idea how that might shake out?
You know, Paul, you're exactly right. And it makes it so hard nowadays to actually really do a true antitrust analysis of a deal, because we have seen the Department of Justice and the Federal Trade Commission, I could say, aligning with the Trump administration in antitrust outcomes for deals and pushing the policy priorities of the administration and listening to what the president has to say. So where the president and the administration is against a deal, there's a higher risk, I would say, of that deal having to defend itself in court and the Department of Justice seeking a block. But on the other hand, Paul, we don't really know what's going on behind the scenes. You know, we've seen some of these companies to mergers hire some Trump-aligned lobbyists, powerful people in Washington that have helped them to push through the deal. That was the allegation with respect to the settlement the DOJ entered when Hewlett-Packard bought Juniper. We don't know what other kinds of concessions or agreements are being made. You know, this is all sort of the backroom channels. And without knowing that, it's hard to understand where the administration may come out months from now in the end on the deal. But at least for right now, we know that the administration doesn't look happy about this buyer. They would have preferred Paramount.
All right, Jen, thanks so much. Appreciate that. This one, we're going to be talking to Jen. I got to say, Nora, we're going to be talking to Jen at least 12 months for this.
I believe
at least 12 months for this deal. Jen Rhee, she covers all the antitrust stuff for Bloomberg Intelligence. Worth her weight in gold when you get these big deals announced, what becomes the biggest risk. And when you talk to the arbitrators, they don't want to talk to me, who covers the media industry. They could care less what I think. They want to talk to Jen Rhee, because if you're an arbitrator and you got to try to calculate what are the odds of this deal getting approved and under what time frame, that's probably the biggest variable out there.
Absolutely.
Once deal terms have been announced, and it's experts like Jen that have the real educated analysis there. So we appreciate getting a few minutes of her time here. So that's good stuff. A little bit of green on the screen here today. The S&P up 16 points, the Dow up 130 points, and the NASDAQ up 40 points. 10-year Treasury yields about 3 basis points higher. We're drifting higher here. 4.13% on your 10-year. This is Bloomberg Good Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. Stocks holding on to gains, market extending its bull run. The equity market higher now with the S&P up 18 at 68.75. Gain there of 0.3%. We've got the Dow up 141, now up 0.3. NASDAQ higher by 0.2%. The NASDAQ 100 index up 0.4, but a retreat for the Russell 2000 index down now by 0.1%. 10-year at 4.13%. Gold up $1 the ounce, 42.09. Little change there. West Texas Intermediate crude up 0.6%, 60.06 a barrel, and a retreat for Bitcoin now down 3.1%, back below 90,000, 89,335 on Bitcoin. It is the day's major deal. Netflix buying Warner Brothers Discovery in a historic combination. But what about the antitrust outlook? Jen Rhee is senior litigation analyst at Bloomberg Intelligence, and she was a guest moments ago right here on Bloomberg Intelligence.
I think it's going to get really significant scrutiny, not just in the United States by the Department of Justice, but likely also in Europe and by the UK and possibly some other jurisdictions as well.
Jen Rhee of Bloomberg Intelligence. Now, Netflix shares, they are lower by 1.7%. Warner Brothers Discovery up 3.8%. Paramount Skydance down 6.3%. Elsewhere in the media world, Comcast right now higher by 1.1%. Again, recapping, equities higher. S&P up 19. That is a gain of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's take a look at what's been going on in the muni market. Today, we're joined by Nisha Patel, SMA Fixed Income Portfolio Manager at Parametric, and we're going to be chatting here about what's going on in this bond market. We've been seeing some significant momentum in the latter half of this year, particularly if we dig into Q4. But what's your outlook for 2026?
Yes. So I think it's been refreshing for municipal bond investors heading into Q4 to see a little bit of a pop in performance. Just looking back really quickly earlier this year, the market has seen significant supply pressure and demand had been relatively muted with all the rate volatility the market overall had seen earlier this year, meaning treasury rate volatility. So as we look into next year, I think there's a few key things here. I would point out three things. The good news is, and the silver lining, is that munis haven't kind of caught up to performance of what other high grade markets have done. Take, for example, treasuries, IG corporates, investment grade munis have still lagged from a performance standpoint. So the silver lining there is that you're looking at very attractive yields, especially out in the long end of the curve, to where for high tax bracket individuals, there's a really good opportunity to lock in yields. And you could see a little bit of that catch up in performance opportunity into next year. And the second thing quickly I'll mention is we talked about high supply, lower demand this year. I think you could see the demand side of things catch up possibly next year in 2026. Now, the supply outlook, street estimates are still forecasting fairly elevated supply, similar to this year. But the big difference will be we could see a significant catch up in demand, right? That's a function of the Fed cutting on a steady path, reinvestment risk rising, but clients sitting in cash. And while I'm certainly not making any sort of an equity call here, I think you could see some clients looking to rebalance portfolios, right, where they may have been underweight fixed income going into this rate cutting cycle in 2026.
Yeah, as someone who lives in a very high tax state, I am all over my New Jersey munis, baby. Triple tax free. Nisha, talk to us about just the supply here. Why is there so much supply out there? I mean, I understand 24 was a record year for issuance. 25 is going to be a record year for issuance. And as you mentioned, the street's calling for another busy year next year. What's going on out there?
Yes. So I would say, the main themes that we saw this year, which will carry over into next year, and I'll mention kind of one new dynamic next year. In 2025, I think it's been a function of few things. We take a look at inflation, right? We're still seeing inflation roughly at about 3%. Just think about those costs permeating down all the way to these types of financing projects. So just costs of projects have gone up. The second thing is that you've had stimulus money post-COVID, federal stimulus money running off, and that's not necessarily a bad thing, so this shouldn't be alarming. But as you have states, cities, local entities feeling like, look, we've had some of that stimulus run off. We do financially feel comfortable taking out, right, a little bit more debt to finance necessary projects. You're seeing more of that inclination to do so this year. And again, that trend should continue next year. And then if you think about what happened very early on this year, there was that threat of tax exemption to munis. So while you usually see supply maybe a little bit second half back end oriented in terms of just calendar year issuance, we have seen a little bit of that or a significant amount of that pull forward in 2025. So those have been really the main themes. And I'll lastly mention, I think issuers may have been waiting for maybe more attractive yield environment in the name of Fed rate cuts. And I think there's a realization, while yields have come down a little bit, there might be a realization that, look, if this is a slow and steady path to rate cuts over a longer period of time, and there's still financing needs, let's look to get this out as soon as we can. So I think you'll see a lot of those same trends in 2026. And as you have, lastly, all of this CapEx expenditure happening on the AI front, data centers, think about all of the support that you need from an infrastructure perspective, water, right, utilities. Where is that financed? That's in the municipal bond market. And I think that could be a trend you start seeing in 2026 and beyond.
Nisha, thank you so much. Always appreciate talking with you. Nisha Patel, SMA Fixed Income Portfolio Manager at Parametric, talking about the muni market. All right, Nora, there was a time many moons ago when I was an investment banking associate when managing directors would really work hard to get me staffed on their deal because I was a spreadsheet guru. I knew all the macros. My spreadsheets worked, like my balance sheets balanced, my cash flows flowed. They are generally pretty accurate. Now, I don't even know how to open up Excel. So that's a diminishing skill there. Great big take story here, and they're all good, but this one I loved because this one hit home. This is titled, Why We Can't Quit Excel. And the subtitle, I'm not sure if that's the right phrase, Microsoft spreadsheet software is expensive, derivative, and depressing. It might also be the most killer app of all time. That is awesome. Max Chafkin joins us here. He's a Bloomberg Business Week dude. He and Dina Bassett, which is one of my favorite reporters way before she got here to Bloomberg. She's covered the media space. Max, talk to us about Excel and Microsoft, and it's still a thing, right?
Yeah, it very, very, very much a thing. 40 years, the anniversary of Excel. It's been around.
I was there, dude.
Late September 1985. That's kind of what prompted us to do this story. And just thinking about the fact that, we talk about these developments in the software industry happening over a matter of months, right? You have like OpenAI talking about its latest model. It's so much better than the last one. These advances that feel so urgent. And then you look at something like Excel, which has basically it's the core of this nearly $4 trillion company, Microsoft, and it really hasn't changed all that much since it was first released. And I think when you look at, sort of the most important software applications of all time, like this would definitely be a candidate. It really changed business just because it brought numbers into a much more accessible way, and not only did that, but kind of vaulted personal computers, put personal computers on the desk of every office worker, and it still is the thing that's running many businesses.
See, I know a lot of people still continue to use Microsoft Excel, but then you also have Google Sheets. So has that been a bit of competition there?
Absolutely. But what has happened, and you see this even today, we got news yesterday that Microsoft was going to raise the prices of its productivity office software, basically 33%. Companies, this is partly because Excel is so important. It's partly because Excel has market share, and partly because of the way that Microsoft sells these products. But even companies that are using Google for some things are often still paying Microsoft because the way they've set things up, like you can't just take Excel out without taking PowerPoint and Outlook and Word and so on. And we think of Microsoft obviously big in AI and big in cloud and all that stuff, but at the center of this still, 40 years later, is this Office suite.
Who's this dude, Michael Jarman? This is a little disturbing.
He's one of the great athletes of our time,
yes.
Paul. He was the 2024 Excel World Champion.
So there's competitive modeling?
There is very much competitive. It is an esport. The championship was this week in Las Vegas. Jarman, who we spoke to for the story, unfortunately lost his championship belt to a newcomer, Dermond Early, who won in a dominant performance, kind of a wire-to-wire final. Now, I have to admit, I found competitive Excel to be a little bit difficult, a tough watch. Although talking to people in the spreadsheet industry, I forget who it was. I asked someone about, what do you think about competitive Excel? He was like, I just can't understand why it's not more popular. Because if you know, you know.
Yeah.
Honestly, you learn something new every day. Because I did
Here's
not even know
my
this
Excel
existed.
story. I was an investment banker at Merrill Lynch. One of our dudes was going to leave to go back to business school. It turns out he's the only one that knew the model for this big corporate convertible bond that was a proprietary product of Merrill Lynch. And we're like, dude, you can't leave. You're the only one that understands the model. So Merrill Lynch paid him what was almost a year's salary to stay 1 month to train like 20 junior analysts, of which I was one of them. Just because Izzy was the only dude who understood the Excel model.
Yeah, this happens all the time. I think this is part of the reason. I think those stories are more common than you'd imagine. These kind of because companies are entirely dependent on, like you said, some Excel model that somebody made a long time ago, and that they've basically been maintaining ever since. That explains all of these kind of huge payouts and so on, but also why Excel is still the dominant platform, because it's just not worth trying to tear out this piece of software that you're essentially running your business on, and that's true of small businesses, but it's also true of some very, very, very large businesses.
Can I just say I'm obsessed with these graphics?
I know, they're the best.
Big take story
Big take
for those
stories,
who haven't taken a look.
They kill it. It's just great as always. Max, thanks so much for joining us. Max Shafkin, Bloomberg Business Week senior reporter and co-host of the Elon Inc. podcast. The big take story here: Microsoft Excel powers AI restraint, multi-trillion-dollar empire here. So you can read that story and all the big take stories on the Bloomberg terminal and on Bloomberg.com/big take. Again, my first job as an investment banking dude at Payne Weber in 1986, June of 86, was taking our transportation earnings models for a lot of the railroads, converting them from whatever the software was then to Excel or something. I don't know. I was like, I spent like a month doing that over and over again. So there you go. I still have the floppy disk. Still have them. So if anybody wants a model of Consolidated Railroad or CSX, I'm your guy.
You have
S&P 500 up 9 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks pushing higher, but we are well off session highs. Right now, the S&P 500 index higher by 6 at 68.63. That is a gain right now of just about 0.1%. Dow Industrials up 39 on the Dow. Also a gain of 0.1%. NASDAQ higher by 0.1%. Small cap shares, though, selling off. The Russell 2000 index down by about 0.3%. 10-year at 4.13% with the 2-year 3.55%. We've got spot gold up $5 the ounce, up 0.1%. 42.12 the ounce. West Texas Intermediate crude oil trading below $60 a barrel. WTI 59.95, up now by 0.5%. The slump for Bitcoin is continuing today, with the sell-off intensifying. Bitcoin now down by 4%. Bitcoin at $88,500 on a Bitcoin. The day's major deal, Netflix buying Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. Our coverage will continue. It's a $72 billion cash and stock deal. Netflix shares, they're down 2.8%. Warner Brothers Discovery up 3.8%. Some of the other players involved, we've got Paramount Skydance down 6.6%, and Comcast shares higher now by 1.1%. So again, recapping, we're looking at an up Friday here with the Dow, the S&P, NASDAQ, they're all in the green. S&P right now up by about 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Alrighty, thank you, Charlie. Norma Linda in for Scarlet Food today. I'm here with Paul Sweeney in the studio. This is Bloomberg Intelligence Radio. And we're just weeks away from what is the end of the year. We've seen double-digit growth across the board. Take a look at any of the indexes, and we're seeing some really strong strength. But this was not the expectation for many coming into this year. And now we get to look ahead to 2026 and see what could be potentially propelling this market forward, if at all. We're joined by Joe Gilbert. He, of course, is the portfolio manager at Integrity Asset Management. He's joining us now from Moreland Hills, Ohio on Zoom here. Hey, Joe, what are your expectations heading into 2026?
Well, hi, Nora. Thanks for having me. Long-time listener, first-time caller, I guess. So, no, next year, we think it's going to be a little tricky. I think that's kind of how we are playing it out. We're coming off of pretty strong equity returns over the last 3 years, effectively, double-digit returns. This year, we may reach 20%, but I doubt it. And so that setup leads us to believe that either the market takes a break here, or we get to more of a standpoint where the market broadens out a little bit more and we get more participation from just the Mag 7.
So is Moreland Hills, that's like Cleveland, right?
Yeah, it is.
So, dude, you get that lake effect snow big time, right?
Oh, yeah.
That is correct, Paul. Yes, and then actually, but I can actually say that our temperature has doubled this morning. Now we're up to 23 degrees. We started at
that's awesome. I love that. I love the snow stories you see in the month of December from that part of the world are unbelievable. They just get dumped on. My son lives up there. He's got some crazy video. Joe, we're going to hear from the Fed next week. I guess Wednesday it is. How important is that for kind of setting us up for 26?
Yeah, we think that the Fed is going to cut. I think that's the base case right now. Looks like the futures are pricing in over a 90% chance of a cut next week. But we really think that that's going to be more of a hawkish cut. Right now, they're going to be cutting into a data desert. They really don't have as much timely data. It's more they're going by feel. And you also have a very divided committee. So we think that the Fed's going to cut. We don't think that the Fed's going to cut as much as the market is projecting for next year. But we still think that it's going to be constructive enough of a background for stocks to work.
You know, Joe, a lot has happened this year, and I feel like this is a time period where I start to reflect on everything that occurred. But one thing that happened a lot was the meme stock rally. Just back in the summer here, we've seen retail investors really hopping in as it relates to meme stocks more broadly. And Bitcoin, I mean, are you expecting the same level of momentum here from retail investors as we look ahead to the new year?
No, that's a great question, Nora. I think what's really going to happen is we think that the level of enthusiasm is going to taper off from the retail investor, but they're still going to have participation there. But I think that the huge swings that we've seen this year, we think that that's just kind of will not have enough energy for that trade to continue as we go into 2026. With that said, we think that we're going to be, the market outcomes will be more based upon fundamentals. Meme stocks, Bitcoin seem to be all of one and the same trade. And when those stocks and the currency, the momentum breaks, they break very violently. And that's why we think that's going to probably shake out a little bit of the retail community.
Fixed income space here, Joe. I mean, if I look at the I and Go function on the Bloomberg terminal, it gives me all the returns for fixed income. And 2025 been a really good year, high single-digit returns. How do you think about fixed income next year, treasuries versus maybe take some credit risk?
Yeah, overall with fixed income, once again, a very strong year, similar to the equity markets. I think treasuries are having their best year since 2020. And those are the type of things that from a contrarian standpoint, they can't continue is how we feel. What we obviously see is the Fed's going to cut rates, but we also think that what's going to happen is that's going to affect the short end of the curve. The long end of the curve, we actually can see it rising. So we're going to get kind of a bull steepener there. And when the longer rates rise, unless credit spreads remain narrow, which they're almost at record tights right now, we're kind of a little bit skeptical of the forward returns that you're going to get out of the fixed income space.
Yeah, I mean, we've been seeing a lot of concentration, at least in the equity market, when we think about tech and AI. Do you expect at all market performance to broaden out next year, or do you still expect this high level of concentration in those names?
No, that's kind of our overall thesis. And once again, in full disclosure, that was our thesis coming into this year, that the market would broaden out. What we see is overall that we have there's a K-shaped economy, there's a K-shaped market as well, where you have the AI trade and that whole ecosystem is where investors have gravitated towards this year. And we just think that going forward, the law of large numbers will start working against those stocks as we get into next year. And it will make the broader market look a lot more attractive. And that's where investors go. Investors follow earnings growth. And we think you're going to get a higher earnings growth from the broader market next year versus the concentrated AI trade.
Joe, 2026 is going to be an election year with the midterm elections here. Typically, markets don't like the volatility associated with elections here. How concerned are you about that?
No, we're very concerned. And I think, once again, the starting point matters. And we'll be entering a midterm year with pretty robust gains over the previous years. And I think that overall, that's going to give investors some pause. You're going to have a lot of volatility as you get into, typically we see drawdown somewhere in the mid-teens during a midterm year. And that's going to really spook investors. That's where we think we're going to lose a lot of the retail participation. But I also think that is how you get a broader market, because some of the names that have not been where people have been crowding into is where a lot of the capital will flow.
What sectors in particular do you expect in terms of seeing some capital flow?
Yeah, we like the consumer discretionary part of the market, which is somewhat contrarian, but we've seen that work here over the last month and a half or so. We think that's going to continue. There are catalysts along the way. We're going to get more of the One Big Beautiful Bill that will infiltrate through the actual economy as we get into the first part of the year. We think that's going to be helpful for consumers. We like financials still. Financials are one of the cheaper momentum sectors within the market. We think there's going to be a lot more M&A. We've seen it, obviously, with the big deal announced earlier today. We think that's good. Those are the type of things that we still continue to see happening as we go out through the year. Also like healthcare. Healthcare has a little bit of defensive and offensive characteristics, which work well, especially when you get a choppy market.
Hey, Joe, thanks so much for joining us. Really appreciate getting some of your time. Joe Gilbert, he's the Senior Portfolio Manager at Integrity Asset Management here. Coming up, we're going to talk to George Ferguson. He covers all the airlines for Bloomberg Intelligence. Southwest cutting some of their profit forecast, I guess, here, citing the shutdown. So we'll break that down with George here. S&P up 10, the Dow up 67, and the NASDAQ up 40 points, about 0.1% across the board there. This is Bloomberg Morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Norma Linda here for Scarlett Fu today, here with Paul Sweeney in the studio. We're looking at markets that are pairing from the record highs that they were earlier flirting with, but we are still seeing indexes in the green. We have the S&P 500 up about 0.2%, NASDAQ 100 up about 0.3%, and the Dow Jones Industrial Average up about 0.2% here. We're seeing communication services and energy really pushing the S&P 500 higher. But let's switch gears and dig a bit into the industrial space. I mean, just last month, we had fears of a government shutdown continuing, and we saw it was the longest government shutdown in U.S. history. But this did drag on a lot of the major airlines. And we have a wonderful person to discuss this here with us today, George Ferguson. Of course, he's Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst. And we want to chat a bit about what's going on in terms of Southwest earnings and how government shutdown actually weighed potentially on this company here. George, what is your takeaway here from what we're hearing from Southwest?
Yeah, I mean, it was a little bit more than we expected. I think the impact was about $200 million on the quarter. It was in line with what Delta Airlines had reported. We thought, perhaps Southwest a little bit less impacted as they're not as heavily into the sort of the high volume airports. And actually I think I was a bit surprised as well that they talked about the booking curve. We think most people typically book well before the holiday season. So we wouldn't have expected their booking curve to be as impacted. But I mean, again, I think it's, largely in line with what we expected. A couple $100 million hit. I don't think it's not going to be terrible.
Stock is up 4.6% today, 52-week high for Southwest Airlines. So, George, what's the, I know you either have published or are working on your 2026 outlook here. What's kind of the call for the airlines in the next 6 to 12 months?
Yes, I mean, as we look at 2026, we get like visibility about 6 months worth of schedule, and we've already started to look at schedules for the new year. So in the first half of the year, the domestic business appears to be growing. The domestic capacity for U.S. airlines is growing, around GDP-ish, 2.5%, and we see less of that growth in the low-cost airline space. Now, Southwest is in the middle of migrating between, I don't know if I'd call them low-cost, I call them budget. They're in the middle of migrating from budget to an airline that's going to offer premium seating and some premium services in the new year. So, look, it looks like there is not a restructuring, but an adjustment underway. Again, in that budget low-cost world, there's going to be less growth than you're seeing in the full service, the trend we've seen here in 2025. So we're thinking that premium seating, full service seating could be a bit excess and could see continued push on the on fares. We're thinking budget ought to get a bit better. We were projecting kind of a 3% increase in Southwest yields originally before the government shutdown. Now we're kind of thinking 2.5%. I mean, that's really not bad for 4Q. So again, we think that sort of carries into the new year. Another big issue in the new year is going to be a lot of the U.S. airlines got a bit of a kicker, got a tailwind from lower fuel prices. We don't see fuel prices going much lower from here, so that tailwind sort of peels away in the new year, and that's something they're going to have to manage as well, even as they try to get sort of yields sorted out. We don't see yields improving dramatically right now, but we see yields probably firming a bit and maybe not falling as falling.
George, you have a broad view between aerospace, defense, airlines, and as we're kind of wrapping up earnings season, if you want to call it that, did you hear about tariffs at all during this earnings season? Are you expecting to hear about this in 2026?
The truth is, tariffs really, there was a little bit of commentary around tariffs. We heard, I think, most of it from the engine makers, a couple $100 million, $500 million here and there, which really doesn't matter a lot on their business. So largely tariffs look to have been, sort of, I don't know if they were sidestepped, but avoided by the aerospace supply chain. One of the things about the aerospace supply chain is that it definitely bridges the U.S. and Europe, and it's definitely sort of a NAFTA. NAFTA is the old word, whatever that North American free trade zone is. There's a lot of componentry that moves around those two regions. And so it's going to be, I think, in everyone's best interest to keep tariffs off of aerospace. So, I think some of that had to play, obviously, with the European agreements. In North America, we've seen some give and take, right, as Trump got mad at Canada here and there and decided he was going to put some tariffs on them. But again, largely it's been sidestepped. The biggest problem was, I think, Brazil, and recently we've seen the Canadian issue. But I think it's going to go away. I don't think it's going to be a big issue.
All right. Hopefully you are correct on that one. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst. He covers it all. If it flies, George covers it. He does that for Bloomberg Intelligence. Been covering the airlines and aerospace industry for decades. So we appreciate getting some of his time there. And again, another big story in Georgia's space is Boeing.
Right.
And as they continue to ramp up production of their 737, hopefully that'll maybe improve their cash flow situation and the performance. So that's kind of the call for Boeing there. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories in global business headlines are coming up in just a moment. Nora, thank you so much for sitting in for Scarlett for much of this week. We appreciate that.
Absolutely.
And you go back to your TV duties, which you do when you're not here on radio, which is good stuff there. I believe Scarlett is back next week. She's been on assignment, I believe, for Wall Street Week, doing some cool stuff. So we'll be seeing that soon. Your top stories in global business headlines are coming up right now.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. New action today from an advisory panel stands to shift vaccine policy for the very youngest. Sabrina Cupid of WSB Atlanta.
8 votes yes and 3 votes no. The motion passes.
A federal vaccine advisory committee has voted to end a long-standing recommendation that all U.S. babies get the hepatitis B vaccine on the day they're born. Dr. Cody Meisner voted no.
And I will just say, we've heard do no harm is a moral imperative. We are doing harm.
For decades, the government has advised that all babies be vaccinated against the liver infection right after birth. The shots are widely considered to be a public health success for preventing thousands of illnesses. Today's recommendation, which has to be accepted by the director of the CDC, would overturn a 30-year-old policy.
Well, President Trump's come out with a new national security strategy that portrays European allies as weak and aims to reassert U.S. dominance in the Western Hemisphere. It's expected trade will come up when Trump meets with leaders of Canada and Mexico at the World Cup soccer draw, which is going on now. CBS's Willie James Inman.
There's no shortage of topics that the president has to discuss with both the leaders of Mexico and Canada, in large part trade. But today the focus is on how all three of these nations will host multiple games throughout different parts of each country.
Netflix has struck a deal with Warner Brothers Discovery to buy the Hollywood giant's studio and streaming business for $72 billion. Paul LaMonica of Barron's.
What is going to happen is that Netflix wants the streaming studio assets. Think of HBO, HBO Max. They don't want CNN, TNT. So the plan is for Discovery to still be spun off as a separate company. Netflix would buy the Warner Brothers asset.
Home prices have made ownership out of reach for plenty of people, but as we hear from CBS's Michael Wallace, there's no relief for renters.
A new Lending Tree study says in the 50 largest cities in the U.S., the rent for a one-bedroom apartment has soared 41% in the last 5 years, up $457 to almost $1,600 a month. New York saw the biggest rent increases, followed by San Diego, Miami, Riverside, California, and Tampa.
CBS's Stacey Lynn tells us Rolling Stone is out with its Song of the Year.
Lady Gaga's Abracadabra takes the top spot. The magazine calls it the most inescapable earworm anthem of 2025. Her album Mayhem was also named their second best album of the year. Bad Bunny took the top spot there.
Wall Street, the Dow is up 87 points. This is CBS News. From the world of music, new life for the Dead.
The Grateful Dead holds a new Guinness World Record. Though the group quit performing in 2015, 20 years after the death of Jerry Garcia, Bob Weir, Mickey Hart, Bill Kreutzmann, and newcomer John Mayer picked up the torch, giving the Dead a record-setting 66th Top 40 album. Dave's Picks Volume 56, recorded at the Rainbow Theatre in London in 1981, hit number 25 on the Billboard 200 last month, breaking out of a tie with Frank Sinatra and Elvis. The 4-set CD features nearly 5 hours of music. Deborah Rodriguez, CBS News.
A preliminary cauldron has been lit by the Olympic flame at Italy's presidential palace as the countdown to the Milan Cortina Winter Games nears the 2-month mark. The flame arrived from Greece earlier in the week. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
It's open season for redistricting. Welcome to the Friday edition as the Supreme Court rules Texas can redraw its congressional map. A move that, of course, has prompted a red-blue exclusive conversation we're going to bring you in a moment with Democratic House Leader Hakeem Jeffries, only here on Bloomberg Radio. We'll talk with the constitutional law attorney Robert McWhirter about that Supreme Court ruling and the legality of U.S. strikes against Venezuelan alleged drug boats. And we'll have analysis from our political panel as President Trump takes part in the FIFA World Cup draw. It's a busy day in Washington, and we start, as always, with Charlie Pellet, his view of the market live from World Headquarters in New York. Charlie, happy Friday.
All right, happy Friday. What a week. Well, we say that every week, Joe Matthew. We've got the Dow, the S&P, NASDAQ. They're all pushing higher right now. On to the weekend with the S&P right now up 14, 68.71. Where we stand, we're looking at a gain now of about 0.2%. Dow Industrials up 82, up by about 0.2%. NASDAQ Composite Index higher by 59, up by about 0.3%. Stocks, however, pairing gains after flirting with records. The 10-year 4.12% with a 2-year currently yielding 3.55%. Spot gold is now trading higher. Little change. The key takeaway there, up by about 0.1%. Precious metal at 42.17 the ounce. West Texas Intermediate crude 60 even a barrel, up 0.5%. And Bitcoin down 3.5% right now, below 88,896 on Bitcoin. So the Dow, the S&P, NASDAQ all higher. S&P 500 index right now trading at 68.70. The old record 68.90, up by 0.2% right now. As for the market backdrop, Urian Timmer is director of global macro at Fidelity Management. He was interviewed this morning on Bloomberg Surveillance.
You don't want this to be a runaway train that ends up, in tears. Rather have the tree shaken occasionally of weak-handed longs in order to sustain that bull market.
Urian Timmer of Fidelity interviewed this morning on Surveillance. You can hear more of that conversation on the Surveillance podcast. Netflix is buying Warner Brothers Discovery in a history-making combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. It's a $72 billion cash and stock deal. Right now, Netflix down 2.9%. Warner Brothers Discovery up by 2.6%. Some of the other players, Paramount, Skydance down 7.8%. Comcast higher now by 1.3%. Again, recapping, S&P up 11, up 0.2%. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, does that mean that we only pay once for Netflix and HBO Max? I'm trying to figure this out.
And I think the consensus here is that you'll only pay once, but you're going to pay higher, a lot higher. Maybe not a lot higher,
more.
But certainly somebody's got to pay for all of this.
Isn't that what they did to Hulu and Disney? There's too many bills, Charlie. I can't keep track of them all. We'll get more on the market.
Remember back in the old days where you had one cable coming into the house, so you flip through the channels, and as the song goes, 57 channels and nothing on it.
Nothing on. That's
Except
right,
for Bloomberg
Charlie.
TV.
See, I love that. Well, and then we cut that cable and made our lives more expensive. I'm still trying to get my head around that, but God bless Charlie Pellet. He'll have more from World Headquarters. Just about 15 minutes. We'll get back to New York for the look at the Friday trade. It's not every day in Washington, or anywhere for that matter, you get Donald Trump, Tom Brady, and the Village People in the same room. But that's what we have for you today at the Kennedy Center. It's snowing out in Washington. It's a beautiful day, actually. Kids went to school late. There's pretty much nobody on the roads around here. And the FIFA World Cup draw is underway. A little bit later on in the program, we might see Donald Trump on stage up there because, you know, there's this rumor around town that he's going to win the inaugural FIFA Peace Prize. If that happens, we will let you know. In the meantime, we've got a lot of things to figure out today in Washington after a ruling that drops from the Supreme Court after the late edition of Balance of Power yesterday. 6-3, Texas can move ahead with its plans to redraw congressional maps. Indeed, the new Republican-drawn map, the redistricting for next year's election, will be in place. And you know what that means. Look to California. Look to Indiana, Florida, even New York and other states that have considered redrawing their maps because of what Texas was doing. We have this story and, of course, a looming vote next week. And we're not sure exactly what they're going to vote on when it comes to extending or reforming health care. That's why we left the building today to go up to Capitol Hill and spend some time with the Democratic leader in the House. Hakeem Jeffries with us here exclusively on Bloomberg Radio. Listen.
It's unfortunate that the Supreme Court has rubber-stamped a racially gerrymandered extreme map that Donald Trump ordered Texas Republicans to engineer as part of his effort to try to rig the midterm elections in 2026. But notwithstanding this adverse ruling, we're going to continue to move forward and ensure that there is a fair map across the country. California voters enacted Prop 50, and as a result, we'll have a fair map in California with some additional opportunities to be competitive, and I expect that you'll see other states across the country continue to respond.
Will yours be one of them? Are you on the phone with Governor Hochul today saying it's time to redraw the New York map?
Well, the New York map has some particularities relative to the Constitution that won't necessarily allow it to be revisited in this particular cycle. But some voters have filed a lawsuit in New York, and we're monitoring that litigation closely to see what the outcome may be.
Okay. There's a question about whether you really need it. Leader Jeffries, after the special election in Tennessee on Tuesday, we saw a plus 22 Trump district go down to a plus 9 Trump district, and you've got a lot of armchair mathematicians out there suggesting that could mean as many as 30 or 35 seats for Democrats in the midterms. How do you see it?
Well, Republicans know that if the elections were held today, they would lose. That's the reason why Donald Trump has decided to engage in this extreme effort to gerrymander congressional maps all across the country, and it's very unfortunate. Our view is that we're not going to unilaterally disarm, and we have to ensure that there's a fair map nationally across the board so that it's the voters who get to decide who is in the majority after the November 2026 election. Part of the challenge with Republicans is that they've broken all of their promises. They indicated that they were going to lower costs. In fact, lower costs on day one. Costs haven't gone down in America. Costs have gone up. Housing costs are through the roof. Grocery prices through the roof. Electricity bills through the roof. And now, because my Republican colleagues refuse to extend the Affordable Care Act tax credits, we know tens of millions of people are about to experience dramatically increased health care costs. Democrats are actually the party focused on driving down the high cost of living.
And so let's talk about a couple of those points of leverage that you just pointed out. Affordability and health care. Many would argue that it's kind of the same story here. President Trump has been saying that affordability is a Democrat hoax, a Democrat con job. Does that mean you do not have Republicans on board with you in reforming health care or extending Obamacare subsidies?
It appears that way. It's unfortunate that the president's position, which is the Republican Party's position, is that the affordability crisis in the United States of America is a con job and it's a hoax. No, what was a con job and hoax was the fact that Republicans spent all of last year claiming that they were going to lower the high cost of living in the United States of America, that they were a party committed to addressing the inflationary pressure that the American people were under. That's all they talked about last year. But they lied to the voters. That's the con job.
They lied.
They absolutely lied to the voters because there's no evidence throughout this year that they've had any intention to actually address the affordability crisis that exists. In fact, they now say it's all a hoax. But everyday Americans, when they go to the grocery store, the supermarket, when they see their health care premiums dramatically increasing, when they see the electricity bills that they have, which are through the roof in part because Republicans in their one big ugly bill attacked the clean energy economy at a time in America where we have growing power needs in terms of what we see with the expansion of artificial intelligence. It's all extraordinary. So Republican leadership has made it clear they have no intention to extend the Affordable Care Act tax credits, and that's very unfortunate.
You know, the White House would say, hold on, Leader Jeffries, this president's been working overtime to cut deals to lower the cost of prescription drugs. Does he deserve credit for that effort?
We haven't seen any evidence that prescription drug prices have gone down in any meaningful way. What we have seen are that the Trump tariffs are out of control. They've increased costs by thousands of dollars per year on everyday Americans, and they've created an uncertain environment for businesses and corporations throughout the country. And we know that uncertainty is one of the biggest problems that American corporations and companies may face. It's difficult to actually make investments when you have this chaotic environment that has been visited upon the economy.
So let's talk about what you can get done before the expiration of these subsidies at the end of the month. A bill was introduced yesterday, a framework that was bipartisan. A Democrat and a Republican, Gottheimer and Kiggins. It would extend these subsidies for a year and put new collars on eligibility. Is this a path to renewal in your eyes?
Well, we'll have to take a look at the particulars in the four corners of that bill.
Yep.
214 Democrats have signed a discharge petition that will extend the Affordable Care Act tax credits for 3 years and give the American people the certainty that they need in order to move forward during these otherwise uncertain times. All we need are 4 Republicans. There are 219 of them. All we need are 4 House Republicans to join us, and we can extend the Affordable Care Act tax credits. We also want to take a look at what happens in the Senate. I'm thankful for Leader Schumer and Senate Democrats who will put a bill forward next week and force an up or down vote on an extension of the Affordable Care Act tax credits. You know, we're in this fight until we win this fight on behalf of the American people, because in the wealthiest country in the history of the world, it cannot be the case that working class Americans and middle class Americans are unable to afford to go see a doctor when they need one.
Are you in touch with the Speaker of the House on this? Is Mike Johnson talking to you about a potential vote after John Thune promised a vote on health care in the Senate for next Thursday?
You know, the big challenge with House Republicans has been that they've adopted a my way or the highway approach. They have zero interest in actually sitting down and finding a bipartisan path forward. We've said from the very beginning of this year and throughout the Trump Republican shutdown that we will sit down with anyone, anytime, any place here in the Capitol, or go back to the White House, sit with the president to try to figure out how we can fix our broken healthcare system and address the Republican-created healthcare crisis that's devastating people all across America. They've refused repeatedly to sit down and even try to find common ground.
My conversation from a short time ago with Hakeem Jeffries, of course, the Democratic leader in the House of Representatives. If you want to see the full interview, go to the terminal or look online at Bloomberg.com. Find it on YouTube. Moments after we spoke, this is important, the Speaker of the House may not be in touch with Hakeem Jeffries, but is with Bloomberg. And as we just learned this morning, Speaker Johnson is pushing to unveil a Republican health care bill in the coming days for a vote, his office says, by the end of the month, when, of course, Obamacare subsidies would expire. We'll have much more on this for you as we learn more. Live from Washington, I'm Joe Matthew. Thanks for being with us on the Friday edition of Balance of Power, only available on Bloomberg Radio.
12:21 on Wall Street. We do check markets all day long here at Bloomberg. We are well off session highs, but still looking at gains for the Dow, the S&P, and NASDAQ. S&P up 8 right now. It's 68.65. Keep in mind, the record for the S&P is 68.90. Right now, we're looking at a gain on the S&P of 0.1%. The Dow up 74. That's an advance of 0.2%. The NASDAQ Composite Index up 34. NASDAQ up now by 0.1%. Our Mag 7 Index up by 0.1%. The 10-year currently yielding 4.12%. The 2-year 3.55%. Bottom line, though, stocks pairing gains after flirting with records. We've got spot gold up $7 the ounce, up by about 0.2%. 42.15 where we stand on the precious metal. West Texas Intermediate crude oil up 1%, above 60 now at 60.25 a barrel. And Bitcoin, 88,978 Bitcoin today, down by 3.5%. Earnings news: Victoria's Secret reporting better than expected sales, also lifting its outlook for the year. Shares of VSCO, Victoria's Secret, up by 10.9%. Also after earnings, Hewlett-Packard Enterprise down now by 0.7%, and Ulta Beauty surging after earnings by 13.6%. Netflix is buying Warner Brothers Discovery in a historic combination. Netflix down 3.1%, Warner Brothers Discovery up by 2.3%. Again, recapping, S&P higher, up 0.1%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. I'm Charlie Pellet. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, great to have you along for the Friday edition, and we'll have more with Charlie Pellet. In just about 20 minutes, we'll update the Friday trade for you, which we do every day here on Balance of Power. Thanks for joining us on the early side. I'm Joe Matthew in Washington, where the FIFA World Cup tournament draw is underway officially at the Kennedy Center. And yes, President Trump is in the box. We also, in fact, saw the leaders of Canada and Mexico there. They're all up on the screen at the same time, smiling. Maybe this is the salve we need for trade in the hemisphere. But a short time from now, we understand that the inaugural FIFA Peace Prize will be awarded. He was asked on the way in, because you've seen the stories, right? This is supposed to go to Donald Trump. He was asked on the red carpet if he was hoping to win the prize, or if he had been told. He said there's no hope. He would just be honored. In fact, went on to say, I don't need prizes, just to save lives. The pool is in the room there. When he gets on stage, we'll show it to you as we keep tabs on the latest here. Big questions about redistricting this morning. After a late call by the Supreme Court last evening, this dropped after the late edition of Balance of Power. Right when you thought Texas had to put the map down, the U.S. Supreme Court has cleared the state to use its new Republican-drawn congressional map, the one urged by President Trump for next year's midterm elections, lifting a lower court ruling that had blocked the map. Now, this is, of course, the effort that took place in Texas that prompted California to pursue Prop 50, that prompted many other states to start doing the same, red states and blue states trying to push back with their own redrawn maps. And we still don't have a real sense of exactly what the country is going to look like when it comes time to vote, never mind launch a political campaign. This is a 6-3 ruling here. It's one that we've been waiting for, and it's only where we begin our conversation, because we have a lot to talk about with constitutional attorney Robert McWhirter, practicing criminal defense civil rights lawyer in Maricopa County, Arizona, back with us here live on Bloomberg. Mr. McWhirter, it's great to see you. Welcome back. It's open season then for redistricting, right?
Oh, it looks like it. It's very interesting what the court does, and some of the liberal justices seem to go along with this. It looks like there's going to be a reworking of the law related to racial gerrymandering. Remember, the Supreme Court said regardless of how many voters you disenfranchise, you can politically gerrymander all over the place. I think that's terrible for democracy, and I'd like a court someday to really look at that issue or relook at it. But always racial gerrymandering has been violative of the 15th Amendment and the Voting Rights Act of 1966. So they seem to be signaling that they're going to relook at that law related to that. In the meantime, Texas, the new map seems to be back in place.
Does this allow every other state to do what it wants? California, for instance, is being challenged, even though it put the vote
this idea to a vote before voters, but there are at least a half dozen other states that are thinking about doing this. Do they just plow ahead now?
I think they just plow ahead. I mean, you can't argue that what California did, which is also bad for voters, really. And I think California recognizes it because they want to dial that back after this whole election cycle is over. After I think it says 3 years in that resolution, it is bad for voters. But you can't now say that what California is doing as political gerrymandering is somehow bad after you've just given the stamp of approval to Texas political gerrymandering.
Elena Kagan writes, today's order disserves the millions of Texans whom the district court found were assigned to their new districts based on their race. This is not so cut and dry. When you add the racial component, Robert, and I'm glad that you brought this up, it's still back to the drawing board here, right?
Oh, I think very much so. And again, we're going to have to see how this plays out in the court. But what you have is a majority on the court that is not open to the issues that courts used to be sensitive to about racial discrimination in voting. Remember that the great cases that came out about racial equality had mostly to do with voting from the Warren Court from the 1960s. And this seems to be a court that's trying to dial that back. And they also seem to have this fiction that we don't have racial problems in this country anymore and that people are discriminated in voting on the basis of race. So on the basis of that fiction, they seem to be going forward and saying, okay, we don't need this fix that the 15th Amendment clearly says is constitutional. And so they're just kind of reread all of that. And I find that very, very sad and disturbing. But at least with this court, there's not much you can do about it.
Well, let's talk about what's happening meantime in the Caribbean, because there are a lot of questions about legality surrounding what we're now all calling the double tap strike against this alleged drug boat coming out of Venezuela. It depends on who you talk to on this, Robert. If you talk to a Republican in the briefing yesterday, they're probably going to tell you that the U.S. acted legally. That's certainly what Tom Cotton said. He called the strikes righteous, I believe was the term that he used. Democrats, meantime, are outraged, and there are big questions about whether, in fact, we can put the idea of a war crime aside for now, but in fact are conducting an illegal operation off the coast of Venezuela. How do you see this?
Well, you know, Senator Cotton can call things righteous, but I'll note he didn't say it was legal. He may think it's righteous, and that's a political statement, but whether it's legal is a whole different thing. If I was Pete Hegseth, I'd be getting pretty nervous under the collar right now, because it looks like what is clearly shown is that there were survivors clinging to this boat, and they went back and did another strike to just kill people. And by the way, they presented no evidence that this boat had drugs in the first place. I mean, look, the normal course is the Coast Guard is always operative in the Caribbean. They often grab boats that are drug traffickers, and if those boats existed, they are more than happy to display the evidence as justification for the arrest and seizure of the boats. This is just wanting to blow things up with no evidence. That's the first problem. But then going back, there's a whole series of rules on this. And by the way, this goes back to World War II, when Grand Admiral Dornitz of the German Kriegsmarine ordered basically, or sent out an ambiguous order that was clear to his submarine captains to not help any survivors of the boats that were being torpedoed. Well, at Nuremberg after the war, that was considered a war crimes. And under the War Crimes Act of 1996, which Congress passed, a violation of international law, in this case the Geneva Convention, is now prosecutable under American law in federal court. Now, the Justice Department has to do it, and obviously Pam Bondi's probably not going to do anything, but there's something that Pete should really worry about, and that is there is no statute of limitation on this. It's a murder on the high seas, and he can be prosecuted under another administration 20, 30 years from now if it takes that long. So if I'm Pete, I'm getting pretty nervous, as should the admiral who ordered the strike.
Okay. So, but that would also suggest the buck stops with the defense secretary. I'm going to hold you right there for a minute, Robert, because we've got breaking news down the street at the Kennedy Center. I didn't see this one coming. The inaugural FIFA Peace Prize goes to Donald J. Trump. This is a live shot. You might be listening to us on the radio. He's walking out on stage right now. And there is the trophy. This is quite remarkable. They were just playing a sizzle reel, the FIFA Peace Prize. All right, is there a red hat on that? Robert, I'm sorry, we just need to keep the news flow as it's going here. Okay, so if you're the admiral and there were pre-existing conditions set by the defense secretary that were outlined in the New York Times, he just put the medal on himself? These conditions dictated how to handle a scenario like this. And if in fact the individuals were shipwrecked, incapacitated, no longer considered in the fight, they would be rescued. And Robert, that's what we have done since that first strike, isn't it?
Oh, yes. But this is different. Look, the admiral, I think, is potentially looking at prosecution under the Uniform Code of Military Justice. You did mention Donald Trump. I'm not sure Donald Trump gets a pass on this either.
Wow.
You know, the Supreme Court granted Trump broad immunity for any official acts. But we do have the War Powers Resolution from 1973, which drastically limits the power of the president to fight an undeclared war. And this is an undeclared war. In fact, it doesn't even fit the definition of a war, regardless of what people like to say with the rhetoric. So it's not beyond the realm of possibility that Donald Trump can be prosecuted for this as well, depending on where the order emanated. And as this plays out, I think you're going to see a lot of people throwing each other under the bus on this issue, from the admiral to the secretary of defense to the president, all saying, oh, it wasn't me. And they're already starting to lay the groundwork for that.
Amazing. The president has said so in the Oval Office, that he supports the public release of that video. So we'll see. Maybe we'll be talking about this together at some point soon, Robert. I'm down to our final minute here. I don't know if you're buying the dip on Netflix right now, but we've got a massive merger we're talking about here. Netflix buying Warner Brothers. Is this going to pass muster with regulators?
Well, it should not. I mean, this is huge, and it affects the consumer greatly. Look, there's a couple things to keep in mind. Number one, it has to go through the federal antitrust process. The unfortunate part about that is, basically, if there's people sucking up to Donald Trump, he's going to exert pressure to get this proved federally. But there's another thing to look at, and that is states all have antitrust laws. And if you may recall, in the year 2019, it was the states that prevented the merger between Sprint and T-Mobile. So even if Donald Trump exercises his undue influence, or somebody gets to Trump and wants to approve this, typically he'll file a lawsuit, and then they'll settle the lawsuit in his favor, and then he lets the merger go through, and then he claims he won a lawsuit against the news outlet. Yeah, but they have to worry about all the different states' attorneys generals as well, because this affects every consumer in every state. And I can't sit there on my couch at night and get a nice, inexpensive movie anymore because of antitrust violence.
Right. Wow. So a lot of lawyers are going to make a lot of money, it sounds like. Robert McWhirter, it's great to have you back. Let us know when you're coming to Washington, for crying out loud. Constitutional law attorney, practicing criminal defense and civil rights lawyer, covering the waterfront with us here on the Friday edition. We'll have much more news straight ahead here, and we'll assemble our political panel coming up next on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ all advancing. We're off session highs. Little change right now on the S&P 500 index, up by just about 0.1%. Dow Industrials up 51, also an advance of 0.1%. NASDAQ up 30, up by 0.1%. But we are seeing a decline in the Russell 2000 index of small cap shares, down now by 0.5%. The Bloomberg Mag 7 index up by 0.1%. The 10-year is currently yielding 4.13%, with the 2-year right now at 3.56%. Gold little changed, up $2 the ounce, 42.09. West Texas Intermediate crude up 1%, back above 60 now, 60.25 a barrel. And Bitcoin down 3.5%. Bitcoin 88,890 on Bitcoin. Bank of America CEO Brian Moynihan says November consumer spending was solid and good. He made the comment in an interview this morning with Bloomberg's Francine Lacroix. He also said markets are getting a lift from Washington.
You can get deals done, and you're seeing the time frame to approve a deal drop by half. And that's important because the idea of a deal being open for a year and a half, that's tough on the companies, and so that's good news. Then the second thing is settling out the major policies that you guys talk about every day on trade and immigration and tax. Those are settling in, so we can see that. There's still work to do, but I think that means that companies can look and discount cash flows and make decisions, and then even a rate structure that's higher, as long as it's consistent, they can plan into it.
Brian Moynihan, CEO of Bank of America, he alluded to deal making. Speaking of which, Netflix buying Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. This is a $72 billion cash and stock deal. Netflix shares, they're down now by 3.4%. Warner Brothers Discovery up by 1.9%. Recapping, stocks higher, S&P up 0.1%, Bitcoin down by 3.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. And back we go to Washington. Balance of Power continues. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you so much, and thank you for being with us here on the Friday edition on the early side. Balance of Power. Indeed, I'm Joe Matthew in Washington, where it's a snow day today. Kids went to school late. Snow's still coming down, as a matter of fact, as we are reminded that winter is upon us. And quite the festivity underway down the street at the Kennedy Center, the building that the president envisions someday being called the Trump Kennedy Center. He is the chairman of the board now, right? It's the FIFA World Cup draw that's underway now. And if you were with us a short time ago, you heard the breaking news. The headline on the New York Times here, as Trump covets Nobel Peace Prize, FIFA cozies up to him with its own award. Well, now, how did they know that? This came out at what time this morning? This came out just after midnight. It's almost as if everyone knew what was going to take place. Yes, Donald Trump won the inaugural FIFA Peace Prize a short time ago when he was asked about it on the red carpet when he was walking in. Listen.
I can tell you I did settle 8 wars, and we have a 9th coming, which nobody's ever done before. But I want to really save lives. I don't need prizes. I need to save lives, and we're saving a lot of lives. I've saved millions and millions of lives, and that's really what I want to do.
Need prizes. I just want to save lives. This is where we start with our political panel today. Bloomberg Politics contributor and Republican strategist Rick Davis is with us, partner at Stone Court Capital. We're also joined by Yemisi Egbiwale, former chief of staff advisor to the Biden White House, our Democratic strategist, founder of Podium Strategies. It's great to have both of you with us, and welcome. Rick, you didn't see this coming, did you?
Yeah, Hard News Friday. I can tell this was really a big shock and surprise to everybody. At that event, President shows up for basically the FIFA draw, and it's got to be the first time an American president's ever attended a FIFA draw. And
that must be true.
And just happened to be there when the award was announced. I mean, imagine the coincidence of him being there to accept this award in person. Congratulations. Look, the one talking point that I completely embrace of Donald Trump's, and he says it a lot, so it makes me happy, is that he wants to stop wars and he wants to save lives. There is no downside to that. And I applaud his efforts. And if it's gone recognized by the FIFA group, great. We look forward to having them all here, spending lots of money in 2026.
That's right.
Watching their version of football.
The headline on the screen, if you're with us on YouTube, Trump wins FIFA Peace Prize. And so here we are. Does the President of the United States deserve a little credit? As he says, he's stopped 8 wars. Is that how you see this?
I do see FIFA as a soft power moment for the president. I think his congenial relationship with FIFA has been beneficial to him on a global scale. I mean, at the same time that he's enacted tariffs on our allies that have put us at odds with some of our longest serving countries that we've been partnered with. This is really the time where he gets to globally piece people back together. But remember, he's doing it at a time where the backdrop is domestically in this country, immigration is a huge issue. And at the same time, when you overlay it with the fact that he is threatened to remove games from cities that he deems unsafe for Americans and our fellow visitors, it's all a bit of a swirl happening for him.
Well, a swirl or a weave. What do you think, though, about what you first said there, with the President of the United States in this room with Carney and Scheinbaum? Could this event, which is, made for TV and made for the President, actually bring world leaders together?
Yeah, I think this event could help folks feel a bit more confident in his leadership. I mean,
he pull the hemisphere together. We've been at odds with our neighbors, Canada and Mexico.
Maybe the Canadians will come down, have a little bit of fun with us. I mean, he is right that his focus has been foreign policy, but that is to the chagrin of a lot of people who first elected him based on the fact that he was going to focus on domestic issues happening here and put, in a sense, America first. So I think the challenge for him and his team is, how does he promote the fact that he is this global leader while at the same time reminding his core base that he still believes in the values of America first?
The President was asked about this, knowing that the leaders of Canada and Mexico were going to be in the room, of course, and taking part here in the draw, although producer James tells me there has yet to be a single team drawn yet. It's been going on for almost an hour. Here's what the President said about that.
How do you see the World Cup playing out with the tensions you have with Canada and Mexico?
Oh, I think it's going to make it more exciting. Tension's a good thing.
Even for the World Cup?
Yeah, I think so. I think it makes it much more exciting.
That was back in March. Rick, is he right? Tension makes this all more exciting.
Yeah, a little tension never hurt anybody, draws attention to the event itself and the events. And it will be interesting to see how the tripartite games, events being held in Mexico and Canada and the United States, get along. Does the president use his somewhat controlling capability on where events are going to occur and to put leverage on, these two to come up with a new MCA agreement? Who knows? It'll be all very interesting and get lots of press coverage, and certainly going to give us plenty to talk about between now and when the games kick off.
Well, they are going on stage together right now. Maybe they'll actually do the drawing here, but they're sharing a stage. This has got to be a positive moment for international relations and trade with our neighbors. Of course, Carney, if you're with us on YouTube, you see Carney on the right there, Scheinbaum in the center, President Trump on stage with, of course, Mr. Infantino, who's having a big day here in Washington, D.C. Emma, you mentioned the president's threat to start moving games out of cities that were plagued with crime, as he puts it. He was asked about that on the red carpet this morning, tried to back away from those comments. You don't think that's something he has planned, do you?
No, I mean, the folks that have been working on this from the American side for FIFA have worked on the logistics for the arenas, for staffing. I mean, at a time when we are talking about immigration, right? Like our immigration policies are going to impact temporary workers, workers that are needed for surging staffing for all of these arenas across the United States. I mean, to move these games anywhere would just show an instability. And showing instability right now is not something he wants to do, right? Like, working with FEMA is his reach towards a form of normalcy here. So he's got to just continue to show some stability. No quick draws here.
Yeah, some of the preparations that we understand have been complicated by the president's migrant crackdown, stricter visa rules. Rick, how do we rationalize all of these priorities at once from this administration?
It's hard to reconcile a lot of them. They seem to run in conflict with one another from time to time. A lot of Hispanic sports enthusiasts in this country. Are they going to show up at a stadium if ICE is standing in the parking lot? That certainly wouldn't be unusual. ICE has shown up in baseball parking lots and football parking lots.
That's right.
Before, so it should make it stressful.
Is this good for America? You referred to soft power. What are we getting for this other than maybe some economic stimulus?
I mean, this is really putting America on the world stage. Okay. Regretfully, Nigeria, where my family's from, has once again not qualified for the World Cup. But it's exciting. I mean, it's pulling together all of the continents. Look, the president has had a contentious relationship with some countries on the continent of Africa, but I know that those fans are still going to come out. Football is one of the most uniting things globally, and we're going to just have to call it football in this conversation. Sorry to our American
There is
audience.
a soccer caucus. I learned this morning in the Capitol. I did not realize that. They do call it soccer, just for what it's worth, and I did hear the president refer to soccer as well. In terms, Rick, of just projecting power, that's one thing. But when it comes to actually getting into Americans' living rooms, you know a lot about political optics. You've got, in this case, you're advising Donald Trump. You've got your guy on stage here at the Kennedy Center with two world leaders. He just won a Peace Prize. Tom Brady's in the room. Wayne Gretzky's going to be there. You got the Village People playing. What does this mean culturally for this president and this White House?
You know, look, I think when the president hits a skid on politics, he's very deft at, changing it up by doing something that puts him into, as you say, millions of living rooms in a different context. And he's used sports quite a bit to sort of bolster that image of, being every man in the White House. And whether it's showing up at football games or other award ceremonies or whatnot, he's not shy about being on a platform. One of the biggest events he did, in the campaign that really helped him was showing up at a UFC fight. Very few politicians would have thought that was going to be something that would help them, and he had a keen sense of the marketing aspects of that. So, and by the way, one of the highest growing sports in the world and in the United States, as far as people watching it, is soccer, and so you can only imagine the massive amounts of money and effort to build up its popularity before the games kick off.
This is publicity you can't buy, right? I mean, to have an elected official surrounded by all of the celebrities here, of course, other world leaders, it's kind of less the point, to be honest. But this is interrupting daytime TV, right? This is happening instead of soap operas right now. People are watching this.
All press is good press.
Well, and this is actually pretty positive, though, right? Americans just watched him receive. You can joke about the FIFA Peace Prize and however everyone knew he was going to get this, but a lot of Americans aren't reading the tip sheets in the morning. They just saw the president get a Peace Prize on TV. What does that mean for his image across the country?
Look, I could personally believe that the FIFA Peace Prize is akin to that of a Happy Meal toy, but globally, it does send a very strong message.
He said it was one of the great honors of his life. A Happy Meal toy.
We'll see who gets the second one. I'm not sure. Oh, we got the
What's
first
he holding up, James? We're showing the president on stage. It's something that says USA.
Okay, well,
oh, he drew USA. Okay, gotcha. Okay. I'm sorry. This is the actual drawing now. We're getting to it here, just to the end of the first hour. There we go, all three of them. Rick, how many Americans knew he was going to win the Peace Prize today? Are we being a little too cute about this?
Yeah, we're in the bubble. Outside the bubble, nobody was thinking about this. Nobody was thinking about the FIFA draw, with all due respect to FIFA. And yet, your point is well taken earlier, is that people are all going to see this as great. Nobody knows what the Nobel Peace Prize is. We talk about that every week. So, why wouldn't FIFA be bigger than that? Because it's got a bigger brand. So at the end of the day, it's a good Friday for Donald Trump. He's had some really rough ones lately, and today I think they're gonna celebrate. Maybe they'll open up the deck with some heaters and play a little rock music at the White House, just to celebrate what a good day it's been for him.
They got the Village people in town. I think they're all going to be at the Rose Garden Club later, right? This is a great panel. Rick and Yevesey will be back with us in our second hour as we welcome our global television audience to the conversation. Major hat tip to producer James. Managed to put together, I never thought we'd have a segment with the panel on the FIFA World Cup draw. But this is politics in 2025. We'll have a lot more in our second hour, so stay with us here. Balance of Power only on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Affordability remains the buzzword in Washington. Welcome to the Friday edition as the latest inflation reading shows prices rising in line with expectations, but we also learned today that consumer spending stalled out in September. We're going to get the latest on the data, what it means for the markets when we sit down with Ed Harrison, author of Bloomberg's Everything Risk newsletter. Speaker Mike Johnson today says Republicans in the House will deliver a health care proposal by the end of next week. We'll talk it out coming up with Republican Congresswoman Lisa McClain, chair of the House Republican Conference, and with our political panel. all after a look at Wall Street. Let's start right there with the Friday trade and Charlie Pellet in New York. Charlie, how we doing?
Right now we are higher across the board. In fact, we are on track for another week of gains on the S&P 500 index. If that does happen, it'll be 2 in a row right now. On the week, the S&P is up by just about 0.4%. What's happening today, you ask? The Dow, the S&P, NASDAQ, all advancing. Lots of moving parts, economic deals, and of course that mega merger. Right now, the S&P up by 18 points. That is a gain there of 0.3%. The Dow up 152. Dow Industrials up 0.3%. NASDAQ Composite Index also up 0.3%, as is the S&P. The Mag 7 Index up 0.3%. Red on the screen, though, from the Russell 2000 Index of small cap shares, down now by 0.2%. Your 10-year at 4.14% this Friday. 2-year 3.56%. Gold up $9 the ounce, 42.16, up 0.2%. And West Texas Intermediate crude oil up 1%, 60.24 a barrel. While we're talking commodities, do not want to ignore silver. It is surging now by 2.7%, 58.65 right now on silver. We've got Bitcoin tumbling 3.1%, 89,334 on Bitcoin. Deal-making news, what a big one. Netflix buying Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. It is a $72 billion cash and stock deal. We got more coverage coming up on Bloomberg throughout the day. Again, Netflix shares, they're tumbling by 3.6%. Warner Brothers Discovery up by 1.9%. Some of the other names associated with this transaction, we've got Comcast shares up 1.5%, and Paramount Skydance down now by 8.1%. So we're watching a lot of moving parts to this Netflix Warner Brothers Discovery deal. Recapping here, S&P up 18, up now by 0.3%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues right now. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. Charlie Pellet, live from New York, the voice of Wall Street and the New York subway. He'll have more on stocks, bonds, and the rest of what is moving coming up about 20 minutes from now, about 1:20 p.m. Eastern Time. Here on Balance of Power, welcome to the Friday edition on Bloomberg TV and radio. Find us as well streaming live on YouTube with breaking news ahead of our conversation with Republican Congresswoman Lisa McClain, and it's something I want you to hear. This is a member of the leadership chairing the Republican conference in the House and also from the critical swing state of Michigan. We're going to talk prices and health care in just a couple of moments. First, we want to look at the data today. We'll set the baseline with Edward Harrison. As consumer spending shows up, little changed in September. We got new BLS data today. Core personal consumption expenditures. Yes, the PCE said to be the Fed's preferred measure of inflation. Up 0.2 from August, up 2.8% from the prior year, and by that I mean more than 2%. So let's get into it with Edward Harrison, Bloomberg senior strategist and author of the newsletter you should be subscribed to right now. It's good to see you, Edward. We're hungry for data, so we're pouring over anything that we can get. And in this case, it's a pretty important one with PCE. Does this allow the Fed to cut next week?
You know, Joe, the interesting bit is you kept on saying versus the August number. And here we are in December.
Yeah,
so we're talking about numbers
weird.
that are...
So do they not matter?
It doesn't really matter, basically.
It doesn't matter.
Because, you know, we've moved on from that.
It's just, it's too stale.
It's too stale, and a lot of things have happened in the interim. People are much more concerned about, was the holiday shopping good?
Right.
And is the consumer, after that month-long pause in the U.S. government, still able to continue to power the U.S. economy?
So when you sit down with your everything risk hat on, are you more concerned about prices today or the health of the job market?
You know, I'm probably more concerned about prices. Yeah. I think that the job market concern, it's deep in the sense that I think very large pockets of the U.S. economy are in recession because the job market is so weak. But I think that we still have a price problem, And with the Affordable Care Act subsidies, some of those going away in January, it's going to be even more difficult for a lot of U.S. consumers.
Well, what pockets, by the way, of the economy do you see in recession? That's quite a statement.
Yeah, I would say that, we've had the housing market at points in time in recession.
In contraction, yeah.
Office space has been in recession. And then also, if you take the whole cohort of people who are, say the bottom quintile, bottom two quintiles, they've had a very hard time given the price pressures that we've had, and also the very low growth in job formation.
Sure. We see consumer sentiment rising for the first time in 5 months. Do you take heart in that number?
I take some heart in the number, but if you looked at the present situation number, I really look at it as a reflection of, okay, now we know that the government's not going to be shut down anymore. But if you looked at the present conditions number, it actually went down relative. It was lower than expectations. So people are saying that it's actually not all well and good, but enough people from the upper quintiles of the income distribution are spending. And then we have AI bubble as well. That's helping to keep things going. But there are pockets of distress there for sure.
Interesting when you look at the state of the market here. We've had some shaky days. November was not a blast. But the fact of the matter is it's still been a pretty darn good year. And the indexes are not that far from their highs. We haven't had a full-blown 10% correction in a long time. Does that suggest that the stock market is part of everything risk right now because we haven't accommodated for the trends you're talking about?
Yeah, I think that the stock market isn't at risk per se unless the labor market weakness starts to broaden out. I would say that the buy the dip mentality is still in effect, and that what you see from the Bank of America customer survey is that we had 6 weeks of tech outflows. And then last week we had tech inflows. So we're at a point now where people feel like they've taken enough risk off the table because of AI, and then they're back in the game. The whole buy the dip mentality is still there. I would say that there are probably two things that are keeping things a little bit tighter. One is that crypto is constantly creating externalities into the other risk assets.
How about that?
And then the second thing is that actually global interest rates are rising. The U.S. is a laggard in terms of the rising of interest rates and also in terms of cutting. The next move could be higher for many different central banks, and Japan is already there.
Fascinating. This has been an interesting couple of days. Edward Harrison, author of the Everything Risk newsletter. It's great to have you, as always. With us here in Washington on Bloomberg, I'm Joe Matthew. As we consider affordability and, of course, the breaking news coming from Capitol Hill today, the Speaker of the House suggesting that a health care proposal will be on the table, a Republican health care proposal, by the end of next week. This is something that I, in fact, talked about earlier today on Capitol Hill with the Democratic leader in the House. Hakeem Jeffries talked to us about the looming deadline for the expiration of Obamacare subsidies that Edward just mentioned. And he doesn't see a lot of opportunity for cooperation, at least not yet. Here's what Hakeem Jeffries told us today.
The big challenge with House Republicans has been that they've adopted a my way or the highway approach. They have zero interest in actually sitting down and finding a bipartisan path forward. We've said from the very beginning of this year and throughout the Trump Republican shutdown that we will sit down with anyone, anytime, any place here in the Capitol or go back to the White House, sit with the president, to try to figure out how we can fix our broken healthcare system and address the Republican-created healthcare crisis that's devastating people all across America.
Now, our next guest is going to disagree with everything that Hakeem Jeffries just said, and that's what we do here on Balance of Power. We hear from both sides of the aisle. The important headline, though, is that Republicans apparently will have their own plan next week, and that's where we start our conversation with Congresswoman Lisa McClain, who's chair of the House Republican Conference from Michigan's 9th District. It's great to see you, Congresswoman. Welcome back to Bloomberg TV and radio. Do you have a sense of what this plan will look like?
Yeah, I'm actually rather excited. The biggest difference between the Democrats' plan and the Republicans' plan is the Democrats want just to subsidize the ACA credits. And the problem with that is if we do that, no one's premium comes down. All it does is line the pockets of big insurance companies. And what I might remind everybody is this is Obamacare. The healthcare crisis was started by the Democrats. So I am excited to hear that both sides agree that the Affordable Care Act is anything but affordable and that it needs revamping. And that's what we're doing. We will focus more on driving down actual premiums. One, and two, giving people choice. So if they get a subsidy, can they only use that subsidy for the unaffordable health care, or can they use it somewhere else? So the main differences are we are really truly focused on driving premium costs down, not subsidizing large insurance companies.
Understood what you're saying in principle, but I'm curious what happens in the immediate term here. There was a bipartisan bill introduced yesterday that I'm sure you know plenty about. We talked about it with Hakeem Jeffries this morning. The Gottheimer-Kiggins bill would actually extend Obamacare subsidies for 1 year while also reforming the plan to add some collars around eligibility. Will we need to see a plan something like that so there's not this so-called Obamacare cliff or healthcare cliff that's looming at the end of the month?
Yeah, listen, we want to make sure that everybody who wants to keep their Obamacare plan can keep their Obamacare plan and that it's affordable, right? We both agree and both sides agree on affordability. But I think you're going to see, we have a menu of options. And what we're going to have to see is how do we thread that needle to make sure that premiums are down, that things are affordable, and that we eliminate the waste, the fraud, and abuse. Because I do believe that both sides also agree that somebody making $600,000 a year doesn't really qualify for the subsidies or the tax credits. So that's what we're focused on working on. I am an optimist by nature, and I've been in those meetings with the speaker and with the heads of our committees, and you will see a plan that will be put on the floor. There's going to be a lot more work to be done, but it will be a good start.
Fascinating. President, while we're talking about affordability, says he's got an issue with that word. He calls it a Democrat con job. What does he mean?
Yeah. Well, I think if everyone were to take a look at what got us here, let's take a look at the past 4 years. Under Biden, inflation was sky high, upwards of 9%. It's down now less than 3%. He shut off all of the oil and gas in the United States, made that more difficult. So if we talk about the affordability crisis, the root of that, not to mention the trillions of dollars that his Inflation Reduction Act put in place and insurged into the economy, it made things very unaffordable. And we are in a recovery period now, and I think you see progress on that, right? Gas prices are down, heating prices are down, mortgage rates are down. So inflation is down. So we're beginning to recover, not to mention what's going to happen in 26. If you listen to Scott Bessent, which I happen to agree with, the economy will be jump-started with higher wages, no taxes on tips, no taxes on overtime, less taxes on Social Security. Those are all positive things that puts more money in the people's pockets and drive wages up. That's all a positive, while avoiding the largest tax increase in history with the working families tax cuts.
I want to hit you in your backyard here, Congresswoman, and talk cars while you're with us. The Trump administration has begun the process of easing fuel economy requirements, CAFE standards, as they're called, for new vehicles. I believe you were standing right next to him in the Oval Office when this was announced just the other day. And that's not the only thing that he announced, Congresswoman. Let's go to the White House and listen to the president from earlier this week.
My administration has taken historic action to lower costs for American consumers, protect American auto jobs, and make buying a car much more affordable for countless American families and also safer. Just about everything is down. This whole thing they use the word affordability. It's a Democrat hoax. They're the ones that drove the prices up. I think affordability is the greatest kind of, when they use the word affordability, they never say anything else.
You were standing right next to him at that event. What are you hearing from automakers in your state? What does Mary Barra say? What does Jim Farley say about the CAFE standards? They were all in town as part of this. Will this, in fact, lower the cost of a car?
Yeah, listen to what the automakers say, the people that actually are building the cars. They are extremely excited about it because it's less regulation and it makes the car more affordable for the average American. There is, I think, roughly about $16,000 to $17,000 per employee that these automakers are spending because of regulation. And the more regulation you put on manufacturers, on people, that's passed right down to the consumer. So they're excited on twofold. One, that they can produce the automobiles more affordable, and two, that they produce an actual automobile or a product that people want to buy. So they're extremely excited about it. Don't take my word for it, take theirs.
Well, so I want to pick up on something you just said, because I always hear that Americans want to buy big cars. We love our SUVs. We love our F-150s. I can't even park in the garage half the time because there's so many big trucks down there, Congresswoman. The president on Truth Social, though, and he talked about it in the Oval with you the other day. I have just approved tiny cars to be built in America, he says. Manufacturers have long wanted to do this, just like they are so successfully built in other countries. He says they can be gas, electric, or hybrid. Very near future, inexpensive, safe, fuel efficient, and he says, quite simply, amazing. Start building them now. What are these tiny cars that are coming?
Yeah, I haven't seen the tiny cars, but I think what the president's trying to do is actually give the consumer choice, the American people choice. If you want a big F-150, you can have one. If you want to drive a small, tiny car, you have that opportunity and you have that choice as well. No different than if you want to buy an electric car or a hybrid car, you can. Yeah. But if you want a gas-powered engine, you can too. So we are all about, and the president is all about, we don't want to tell you what to do, when to do it, how to do it. We actually believe in people, and people can make the right decision. We don't need big government telling us what to do and what to buy and how to buy it.
I've got you pegged for, I'm just blue sky in here, Escalade driver? What do you have in the garage, Congresswoman, in the state of Michigan?
I have an old GMC Yukon. That's what I drive. And it's great.
Driving a Yukon?
Yep, yep. I have four kids, and they all have spouses, so when we all get together, it's a good vehicle to put the whole family in.
You can't drive that thing around New York. I mean, you can, but good luck while you're up there. It's great to have you back with us. Live from World Headquarters in New York, that's Congresswoman Lisa McClain, who's chair of the House Republican Conference. We've heard from Hakeem Jeffries, the Democratic leader in the House, now the woman who runs the Republican Conference, to give you a sense of exactly what the conversation is like. Next week's going to be a doozy. We could have a vote in the Senate on a Democratic health care proposal. We'll get a look at what Republicans have up their sleeves as well. That's why we do this every day, live from Washington. I'm Joe Matthew. This is Bloomberg TV and Radio.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the U.S. stock market pushing higher, off session highs, but still looking at gains for the Dow, the S&P, and NASDAQ. 68.69 where we stand on the S&P right now, up 12 points, up by just under 0.2%. Dow Industrials advancing 123 points, up by roughly 0.3%. And NASDAQ pushing higher by 50 points, up by about 0.2%. The Bloomberg Mag 7 index up 0.1%. A down day for small caps with the Russell 2000 index lower by 0.3%. The 10-year 4.13%. The 2-year 3.56%. Spot gold up 0.1%, 42.12 the ounce. And West Texas Intermediate crude up 0.8%, 60.15 a barrel on WTI. Bitcoin meanwhile down 3.1%, 89,337. Paramount said to be mulling taking its offer straight to Warner Brothers Discovery shareholders. That headline right now from CNBC. We've got Netflix shares after announcing its takeover attempt. Netflix up by down by 3.5%. Warner Brothers Discovery up 4.5%. Paramount Skydance shares, they're losing 7% right now. Comcast shares up by 1.3%. Briefly, earnings news. Lots of companies reporting this morning. We heard from Victoria's Secret. Stock surging 13.2% last night. Hewlett-Packard Enterprise reported earnings up now by 0.9%, and Ulta Beauty after earnings surging by 13.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie Pellet, thank you so much. And thanks for being with us here on the Friday edition of Balance of Power on Bloomberg TV and radio. We meet once again at the threshold of the weekend with big questions today about congressional maps around the country. The districts that you may or may not take for granted in your state could soon be redrawn after an important ruling from the Supreme Court, clearing Texas to use its new Republican-drawn congressional map for next year's midterm elections, lifting a lower court ruling that had blocked the map. Not everybody saw this coming, although we have been waiting for this ruling, and it's something that I talked about earlier, the effort to redistrict, which, by the way, some Democrats have taken up in their states. Look no further than California and Prop 50. We talked about it with Hakeem Jeffries, the Democratic leader in the House. Listen.
Republicans know that if the elections were held today, they would lose. That's the reason why Donald Trump has decided to engage in this extreme effort to gerrymander congressional maps all across the country, and it's very unfortunate. Our view is that we're not going to unilaterally disarm, and we have to ensure that there's a fair map nationally across the board so that it's the voters who get to decide who is in the majority after the November 2026 election. Part of the challenge with Republicans is that they've broken all of their promises.
So it's open season on redistricting, and that's where we start today with our political panel. Bloomberg Politics contributor and Republican strategist Rick Davis is with us, partner at Stone Court Capital, joined by Yemisi Egbewale, former chief of staff advisor of the Biden White House, Democratic strategist, and the founder of Podium Strategies. Yemisi, what do you think about this? Gavin Newsom wasn't waiting for the Supreme Court to rule. Should other blue states do the same?
Look, Gavin Newsom knew what we all knew, was that a conservative Supreme Court would eventually rule in the president's favor on this. And I think that other states are going to follow. Now, I think it's going to be tricky. Some Democrats have already raised a little bit of an alarm, saying this might be a race to the bottom. But there are other folks in the Democratic Party that are saying, we're already at the bottom. So I think this is going to give some division to the Democratic Party, but it's looking like Texas is definitely getting more red.
Well, that's right. Will states around the country other than California get more blue?
I think some states like Illinois.
Yeah,
I mean,
Illinois,
and we have to
New
think
York
about
has come
New
up,
York as
Maryland
well.
has come up.
And who runs those, right? Maryland, you've got Governor Wes Moore,
Yes.
right? We've got Pritzker over there. Well, we might see if Shapiro does something. I mean, these are also people that are looking at 2028. This is beyond just a redistricting for some of these folks. Gavin Newsom pushed Prop 50 because he saw what happened in Texas, but also because he has political ambitions of his own. And so we have to factor that into how some states will play it.
Absolutely right. What are you thinking about this, Rick? Will Democratic governors like Wes Moore, who have been a little gun-shy to start redrawing congressional maps in the middle of a cycle, be suddenly convinced by this ruling?
Well, I'm not sure there's anything in the ruling that'll actually convince them, other than it's fair play now to change your redistricting
right.
and midstream. I mean, basically, this ruling ruled against the district court because it said they were trying to actually change the changed redistricting in midstream, and that it was too late to do that. They didn't rule on race, and they didn't even rule on the politics of redistricting. So I don't think that's going to change anything. I think it's open season. It's advantage Republican. There are more states that Republicans can just have the legislature do it and not have to take it to a referendum like they did in California. But realistically, I mean, if the election were today, I don't think a change of 4 or 5 seats are going to make a bit of difference. Right now, it's sort of at par. Texas got 5, California got 5, starting all over again in other states. But the reality is it is a distraction from our party's need to make a case on affordability and cost of living and the future of our economy. And if we don't do that and we play all these drawing of lines games, the only thing that's going to result is we'll only lose by a few less votes, not but a loss is a loss. And so I just wish the Republican Party was spending more time talking about the issues that people care about and not playing these games around the table, drawing up maps.
Understood. What do you see in terms of trends outside of redistricting, MSC, coming off of Tennessee the other night? Trump plus 22 district, you saw what happened. The Republican won by single digits. And so you've got strategists running around town saying that's 35 seats for Democrats in the midterms if that trend continues. Why would you need redistricting anyway?
Well, I think some folks still want to bolster up their bets a little bit. I mean, look, we can look at Tennessee and say that is concerning for Republicans that she was able to get that close. But also Democrats have to own a little bit of candidate quality here. Okay. She was able to get close, but I do think a moderate would have been able to get a little bit closer, especially in those suburban areas. We can have deep blue cities like in Nashville and New York City, but they're different shades of blue. Nashville is not the same blue as a New York City, and somebody running as a Zoran or an AOC does not work below the Mason-Dixon line. And I think that was a test to prove it. Candidate quality is going to matter so much for the midterms, and if folks don't start getting more to the middle, we're going to see some issues.
Well, that's why they were labeling her the AOC of Tennessee, right?
Right.
Donald Trump says she despises country music. Look at that. She lost. But the result was, according to many Democrats, not only a moral victory, but an indication that the electorate is bending your way.
Is the electorate bending our way, or are Republicans just not as engaged? I think we do a better job at firing up the base and getting people out to vote.
That's an honest reply.
Yeah, and I think Trump also helps in our favor. All you really have to do is play some of his sound bites, and it can get some people out. Sometimes in the Democratic Party, it helps to have a common enemy, and Republicans don't have that as much. But I wouldn't say that this is just a positive and our foot is on the gas pedal and we're raging ahead. I think it's just a cautionary tale.
Interesting. Rick, you've talked before in these conversations involving redistricting. You've talked about or gerrymandering, I should say. You've talked about dummy mandering, and I wonder how many states are going to find themselves in the process of redrawing maps and maybe regretting the final product.
Yeah, I think this is something that you can take away from the Tennessee 7 and also the elections in November in Virginia, New Jersey, and elsewhere. And that is when Donald Trump's name's not on the ballot, you have a substantial decrease in a pool of voters who are willing to turn out on Election Day. Democrats have a different demographic. Their demographic is more urban and suburban and more college educated, and they just turn out more frequently. It's just a fact of, demographics. And so if I'm a Republican candidate living in a rural district and I'm looking at those numbers, I'm trying to figure out, what in the world can I do to get these guys who historically never show up in a midterm election to turn out? And now I've got even a more diluted district because my digital list was bright red when we started redistricting in Texas, and now I've got a few less Republican voters because we created 5 more districts in my neighborhood. And the dumbing redistricting is a real thing, and they got to worry about that.
Well, it's good logic that Rick brings us here, and maybe the answer, by the way, for that candidate would be we saved your health care, because Democrats and Republicans will be called to task when it comes to the expiration of Obamacare subsidies. That's set for the end of this month. MSC, we've talked today with Hakeem Jeffries and with Lisa McClain, who confirmed that Republicans are going to drop by the end of next week a health care proposal in the House. Are we going to meet this deadline?
Okay, I'll believe that when I see it. Members of
You don't
Congress
even
are
buy
like
it.
students who always push back the deadline and tell
Yeah.
their teacher they're turning in the
Got
homework.
a big deadline here, though.
It's a huge deadline, and I don't think Congress has really shown itself this year as being a unit that meets the moment for the American people. So I hope they don't back themselves into a corner here. I'm glad that it introduces the conversation more about healthcare. And going into next year, we're going to see more people start to talk about Obamacare and why it is that you do need subsidies for it. I think we have to take a larger look at what is a landmark legislation for the Democratic Party, because we've run on healthcare, we've won on healthcare, but now we need to re-examine our healthcare.
Well, you heard Lisa McClain, Rick. She tells us that Democrats have finally admitted that the Affordable Care Act is not affordable and we need more subsidies. And we've heard that from a lot of Republicans. What will the Republican plan look like? And might it resemble that bipartisan bill that dropped yesterday, a one-year extension with new limits on eligibility?
Yeah, I think the extension is sort of like the one common ground. Everybody is going to want to get this off their back. The last thing any Republican or Democrat wants is a lot of people getting thrown off the rolls without some kind of soft landing. That being said, I think everyone also agrees that there needs to be substantial reforms. A lot of these subsidies were put on during the COVID era to soften up the impact of COVID. COVID's over. The economy doesn't need that. And now what are we going to do about these folks who've been able to buy less expensive insurance because of it? We don't want them to have to spend more money on insurance. What we want is, insurance reform and reform on, who is actually going to be eligible for these things so that the costs can be brought down. And I don't think there'll be that much pushback by Democrats. I think this is one thing, especially after the Minnesota scandals, that people have seen that they got to be responsible. It's just not health care for all anymore. Those people who are talking about that are tone deaf when it comes to the electorate.
If we see next Thursday, John Thune promised a vote, right? That's how we got the government reopened. Promised Democrats a vote on whatever the health care proposal would be. That's less than a week away. If that passes convincingly, will Speaker Johnson have any option but to bring it to the House?
I mean, yeah, he'll have all of the pressure to have to bring it to the House. I view the majority leader, John Thune, as the real driver here. I think he's able to navigate outside of that kind of Trump aura and bubble. I don't think Johnson is that strategic as people make him out to be. I think he just follows orders really well. And so if Thune moves first, Johnson's just going to have to be in a position to move next.
That would also suggest, I'll just extend this a little bit, Rick, in our final moment, that Donald Trump needs to weigh in at some point. Is Speaker Johnson waiting for the president?
I think Speaker Johnson's waiting for the president, but I think Thune is too, in the sense that Thune is not going to do anything that isn't going to have the full, presidential backing. And by the way, that then ensures that he gets what he needs out of the House, because Johnson's not proven that he's willing to buck the president on anything. So as the president said the other day, he has two jobs, both Speaker and as President of the United States. And I think Thune understands that completely. His deal will be with Trump, and then Trump will take care of the House.
Great panel. Rick Davis, many thanks. Bloomberg Politics contributor. Rick, we'll see you on the late edition of Balance of Power. Yemisi Egbewale. Podium Strategies, our Democratic strategist. Great to have both of you as part of our conversation. Patrick McHenry will be with us next as we spend some time with the former Speaker Pro Tem on what comes next. This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, and NASDAQ all advancing after flirting with records. We are seeing stocks off session highs, but still looking at a 21-point gain this Friday. On track for a winning week, by the way, with the S&P right now at 68.78. We're up 0.3%. The Dow Industrial is up 173, higher now by 0.4%. The NASDAQ Composite Index up 82 on NASDAQ. That is a gain of just about 0.4%. On an update from much of the market, Russell 2000 index of small cap shares slumping by 0.1%. Your 10-year at 4.13% with the 2-year 3.56%. Gold right now trading higher by $6 the ounce, up 0.1%. Silver up 2.6%, 58.62 an ounce. West Texas Intermediate crude up 0.7. WTI 60.12 a barrel, and Bitcoin now down 3.2%. 89,190 on a Bitcoin. We are looking at Southwest Airlines shares higher. They're up by 6% right now. Southwest, though, did lower its operating profit target for the full year, citing the fallout from the recent U.S. government shutdown as well as higher fuel prices. Other airline stocks are advancing. United up 0.2%. American up 1.6%. The exception, though, Delta, it is retreating by 0.5%. Netflix buying Warner Brothers Discovery in a historic $72 billion cash and stock deal. Netflix right now down 3.5%. Warner Brothers Discovery surging 5.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Balance of Power continues. Once again, your host, here he is, Joe Matthew.
Charlie, thank you so much. Charlie Pellet will have more on the markets coming up at the top of the hour, 2 p.m. Eastern Time, as Bloomberg Business Week Daily gets underway. Thanks for spending part of your Friday with us here on Bloomberg TV and radio as we seek voices and new ideas from both sides of the aisle. That's been our exercise this hour. We've heard from Hakeem Jeffries and Lisa McClain, the Democratic leader in the House and the chair of the Republican conference in the House, with news today that Republicans in the House of Representatives will likely unveil, Speaker Johnson says, will unveil a health care proposal by the end of next week. That would coincide almost to the day with the promised Senate vote on a Democratic health care proposal. So we may be seeing the gears turn a little bit here. We're joined at the moment by a problem solver with a lot of experience in the House of Representatives. That, of course, would be Bloomberg Politics contributor Patrick McHenry, former Republican congressman, former Speaker pro tem. It's great to see you here at the desk, and I hope you had a great Thanksgiving. You can see across the valley here to some sort of compromise, right? Because if you can't, I'm thinking not many people can right now.
On healthcare, no.
On healthcare with a deadline at the end of the month, you do not.
No, I don't see this. I don't see this coming
together. Premiums are going up.
Yes, yes, and what you have are Democratic politics at stake. The subject matter of the shutdown became health care. They eventually figured out an issue that was salient to the voters. The Democratic Party had strength in. They doubled down on that strength, and that was to their ends the shutdown. The shutdown was about something to them.
Yes.
It's not regarded that way by the populace, and it didn't net them anything in terms of policy, but it solidified their base and their position on health care. They want to double down on that strategy for the election year. They don't actually want a solution. They want to keep the problem. Keeping the problem is their political power, and rising premiums is to their political benefit. This is the reason why House Republicans and some Senate Republicans are working so fervently to address the premium question for a narrow group of the American people because of the political impact on it. The difficult problem here is that Republicans don't have a cohesive message or policy set on health care. This has long been the problem. Right. It's not that Republicans lack a plan. It's the problem is they have plans. They have lots of them, and there's no cohesion around any one that is the Republican response. So they find themselves in this pretty hopeless situation of trying to get together enough of the party around a plan. They're not going to get everyone, and I have a very difficult time seeing them originate a bill out of the House to send it over to the Senate that is a Republican-only vote. They need Democratic support. The Democrats just want to extend existing failed policy, but that's what they want to do. That's their political power is around.
But you're suggesting they don't, in fact. You believe Democrats are that Machiavellian that they'd like to see premiums rise
so they can win the House back in November.
So they have a vote on health care, and they chose a 3-year extension as their request. It is a greedy request. A 1-year extension should suffice. That should be their offering, and victory should be their goal.
But through compromise, could it not end up being a 1-year extension? You start with what you want, and you
Well,
end up
they've
getting what you
pared this
can.
down from about a $700 or $800 billion request to keep the government open for 6 weeks, down to a 3-year extension of policy that no Republican voted for, extending Obamacare, and so it's still a massive request that they have, but it shows that they want to hold on to this as a political cudgel rather than do a 1-year extension, which is really which should be the end case for these negotiations.
Yeah, well, I mean, it does seem, I don't know what you think Republicans are going to put forth next week in the House, but there was a bill that dropped yesterday, the Gottheimer-Kagan's bill would extend Obamacare subsidies by a year, and it would put new limitations on eligibility. This doesn't have to be that hard, right? I mean, could that not be the bill?
That should be the bill.
That should be the bill.
And that should be the final compromise.
Would it not pass both chambers?
Yes, but you have to have a coalition willing to do that,
right.
And you don't have enough Democrats willing to come
Will the
with
Republican bill resemble that?
No.
Okay, so what do you think the Speaker has up his sleeve?
Well, no, they have to put together something that unifies Republicans. That's their attempt. That is always the goal out of the House.
Be more along the lines of Bill Cassidy, health savings accounts.
Yes.
Something that does not resemble Obamacare.
Correct.
Okay.
And also doesn't fix the problem.
So then we have a collision next week. We go off the cliff at the end of December.
And
do
then,
I keep going and then we shut down at the end of January?
Oh, no, because the dynamics around the shutdown on an election year are different than what the Democrats just experienced. So this is now about getting the government funded, and they'll move on with that. They will keep the health care issue, though. That's how I think this thing
It's going to be a brutal year for people. The premiums are really up. Quadruple in some places. They just drop off the rolls in that world.
Yeah, but this is 10 to 15 million people. It's a serious number. These are disproportionately red states, and there is opportunity for the state legislatures to fill these gaps. It is not fully up to the federal government to respond here. So this isn't a necessary disaster for the people that would experience these healthcare premium increases, nor is it premium increases the end of their access to healthcare.
Yes, sure.
But it is being described that way. And so Republicans have a political issue. Democrats have a political issue. And this is the collide, and the reason why the compromise is unlikely to happen because the political importance of that issue at the election box benefits the Democratic Party.
Yeah, all under the banner of affordability, right? This is all one issue. The president calls affordability a Democrat con job, which they're turning into commercials right now. What does he mean by that?
What he means is the feel of the economy is largely driven by discourse. Republicans think the economy is going pretty well, and Democrats think the economy is going pretty poorly. That has a political overlay more than an economic overlay, and everything is becoming highly political in our society over the last 20 years of discourse. And so affordability is the message the Democratic Party is seeking to drive through Election Day because that is their path to victory. In 2010, a slow economic recovery meant that John Boehner spent 2 years saying, "Where are the jobs?" A message of where are the jobs got Republicans the majority in 2010. And I think that is the case that they're saying is like, the cost of things are not down since President Trump got reelected. There's a lot of economic impact that is to come for this administration. The tax bill, landing the tariff deal with China, and in the world, all those things will have an economic benefit that has to be accrued over time, and that is really the imperatives on the administration to perform, provide the right regulatory relief, the tax incentives, and clarity on tariffs. And that way the economic engine can churn and the American people can see the benefits of Republican economic policies.
I can hear John Boehner right now. Mr. President, where are the jobs? And that's the question that the Fed is asking and will be asking next week. And so I have to get into this with you with your financial services hat on here. Kevin Hassett is apparently the next Fed chair. At least that's what everyone seems to think in Washington. Bloomberg reporting that he's at the top of the list, and he was on Fox News, asked about whether it's time to cut rates. Here's what he said.
guidance from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right
And how much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
Is that 25 basis point cut in the bag?
It's not in the bag, but I think that's where they end up. I think there's still haggling to be at the governors, Board of Governors. Look, the Open Markets Committee is disproportionately appointed by President Biden. That impact is still driving the Fed decision-making. The president needs to get his appointees on the Federal Reserve Board. The next available one is the chair of the Fed.
That's right. Is his nomination in the bag?
Nothing's in the bag. Okay. Look, I mean, there's still drama to be had. And so I do think the president has enormous high regard for Kevin Hassett in the first term and bringing him back in the second term in an elevated way. And I think Kevin Hassett has proven himself as a very good voice for President Trump's economic policies. I think he has the qualifications, obvious qualifications to be the chair of the Federal Reserve, very important decision. And he has the qualities necessary to drive consensus on the Open Markets Committee, which is actually how it's done. And the difficult part of being Fed chair is you don't get to make the decision independently. Yes. You have to take all these inputs from your committee members. And so he is certainly on the short list, I think it's affirming and should be affirming to the markets that somebody of his caliber is on that short list.
Because you think he's a good pick. Do you share the president's, I won't say disdain, disappointment in Jay Powell?
Look, I got a different perspective on Chairman Powell. I think he's been given a very tough set of circumstances and has danced very well in the midst of the threat of the music being turned off. Right. And I think he will be proven as a successful Fed chair who maintained Fed independence in a very complicated time.
Well, we just had quite a headline cross the terminal. You got to be careful when you walk in here, Congressman. The Supreme Court to review President Trump's birthright citizenship rollback. Did you see that coming?
Yes, this is something that's not settled law. The president's perspective here is...
Not settled law.
Not settled in that the president having broad authorities to make this determination.
Understood.
There's been generations of litigation on the definition of citizenship in our country. This thing is carved out as a set of rights that the American people have, based off of from birth to natural death. And there are consequences for these decisions. So you shouldn't have one branch of government make that determination. The courts are always going to have to step in and make a determination or clarify the capacity the president has.
Change needs to be made?
No, look, I think birthright citizenship has been the case in the United States from the very beginning. And we don't judge people based off of their parents, good qualities or bad qualities, or where they're from. And that has made us a special and distinct nation from any of the European powers or any of the Asian powers, based off of how we treat how we treat citizenship here in the United States. The importance of it, the regard for it, how we honor this as not just something given to you, but the story of America and who we are. So you can't just make a quick administrative change of a body of law that is, in many cases, 200 years old.
Runs to our founding. That was a good answer. I'll be curious to see what happens here. We've only got a minute left. Let's just throw this one at you lastly as we look ahead here with the president, by the way, receiving the Peace Prize today. Should the House of Representatives, should Congress have a say in the president's military action in the Caribbean?
They inevitably will have votes on this under the War Powers Act. I think what the president is doing is born out of sound law and taking action. Yes, when you have these incursions from the South and movement of drugs in a concerted way, and in some respects supported by nation-state actors, for them to take military action, I think, is a justified thing. It is a clear signal to stop the flow of drugs from the south, just like we're having the clear signal to China to stop the flow of fentanyl.
Fascinating. It's always great to spend time with you. Patrick McHenry, let's do it again soon. Bloomberg Politics contributor, former Republican congressman, former Speaker Pro Tem, only here on Bloomberg TV and radio. I'm Joe Matthew in Washington. I'll meet you back here on the late edition of Balance of Power. It starts at 5 p.m. Eastern. Enjoy your Friday between now and then. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenevec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Good Friday afternoon, everyone. Live on Bloomberg Television and Radio, streaming on YouTube and Bloomberg Originals. I'm Scarlett Fu here with Alexis Christophorus, and we're in for Carol Masser and Tim Stenovic. A lot going on this Friday, the first full week of December. No shortage of news at all this morning,
and
this
a
afternoon.
Blockbuster, might I say, deal of the year in the media industry.
Absolutely. $72 billion media merger. Bloomberg News media and entertainment editor Felix Gillette joins us to discuss Netflix's planned acquisition of HBO and Warner Brothers' film and TV library and studios. Later on, Bloomberg Intelligence senior analyst for antitrust litigation Jennifer Rhee will help break down the industry reaction to the deal, potential legal pitfalls, and how regulators might want to step up and maybe, put some guardrails up here. And of course, we did get some eco data, some of it stale, some of it current. U.S. consumer sentiment most recently improving in December for the first time in 5 months. LinkedIn chief economist Karen Kimbrough will join us before the last Fed decision of 2025. So quickly. It comes so quickly.
And every month I said, can you believe it's November? Can you believe it's December? And now it's going to be 2026.
All right. First, though, let's get a check on the day's trade and top business news. And for that, here's Charlie Pellet.
Hi, thank you very much. Do want to begin with the developing story headline right off the Bloomberg Professional Service. U.S. Supreme Court says it will review President Trump's planned rollback of automatic birthright citizenship, setting up a high-stakes showdown over what long has been understood to be a constitutional right. Equities pushing higher. The Dow, the S&P, NASDAQ all advancing right to the numbers here. Fast-moving markets to the upside with the S&P up 15, now up 0.2%. Dow Industrials at 48,006 today on this Friday. We are on track for a winning week with the Dow right now up 150, up 0.3. NASDAQ Composite Index up 55, up by about 0.2%. Interestingly, though, a retreat for the Russell 2000 Index of small-cap shares. It remains lower by 0.2%. Your 10-year at 4.13%, the 2-year 3.56%. Spot gold currently trading lower, flat on the day, down 50 cents, 42.06 the ounce. The silver is moving higher, silver surging 2.2%, 58.40 the ounce. West Texas Intermediate crude up 0.6%, 60.02 a barrel, and Bitcoin down 3.5%, 88,950 right now on Bitcoin. It is the business story everybody's talking about, and we got you covered here at Bloomberg. Netflix is buying Warner Brothers Discovery in a historic combination. Shares of Netflix down 3.6%, though. Warner Brothers Discovery up 5.3%. Cannot ignore Paramount Skydance. It is down 7.8%. Comcast up by 1.1%. We'll have a whole lot more as our coverage continues on this story. Again, recapping here, S&P up 14, up 0.2%. Bitcoin down 3.4%, 89,000 right now on Bitcoin. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie. We're going to stick with that big story of the day, and as I said a moment ago, possibly the year. Netflix buying out Warner Brothers Discovery, or at least wants to buy out. They still have some hurdles they're going to have to clear. This is an $82 billion deal if you include debt. We want to break it down now with Felix Gillette here in our studios. Felix is a media and entertainment editor for Bloomberg News and also the author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. The perfect person to talk to about all of this. Felix, thanks so much for being here.
My pleasure.
I guess, first of all, this is sort of your sweet spot. This is your beat. Were you surprised to see Netflix come out the winner here?
Yeah, I think it was a little surprising. I mean, I think at the start of all this, Paramount kicked off the sale by making an unsolicited bid for Warner Brothers Discovery and for the whole company, right? And they rejected 3 bids, opened it up for sale. Along came Netflix and Comcast saying we'd like part of the business, not the whole thing. But I think, in spite of Netflix's strength in Hollywood, I think people were thinking, well, they only want part of it. David Ellison, just finished his deal to combine Skydance with Paramount. His father, Larry Ellison, the co-founder of Oracle, has an enormous amount of money to back the deal. So I think a lot of people thought that the Ellisons were going to be able to pull this off, and we're surprised that Netflix was able to do it.
Well, the Ellisons might still be able to pull this off because there are reports that Paramount Skydance is considering taking its offer straight to Warner Brothers Discovery shareholders. So it's not quite over yet.
Yeah, we're all waiting the next move from the Ellisons. And they signaled some displeasure yesterday in a letter to Warner Brothers saying that they felt the process had not been fair and that, sort of laying the framework for potentially
And they bid a
going
higher
hostile.
price than Netflix did too, right?
It depends. It was kind of apples to oranges, right? Because they weren't bidding for the same thing. Netflix was bidding for part of the company, and Paramount Skydance was bidding for the whole thing.
But part of the company, they were still going to offer even more for part of the company than Paramount was going to give for the whole company. Is that right?
It depends how you value the part of the company that Netflix is not acquiring, which is all of those legacy cable networks.
Well, let's talk about it since you wrote the book on HBO.
Yeah.
What would let's just say, for instance, this deal goes through Netflix, Warner Brothers, Discovery. What happens to CNN, TNT? TBS, HBO.
They'll all be spun off into a standalone company, and that's going to be, it's a declining asset, but it still throws off a lot of cash. And will it be eventually potentially combined with some of the other cable networks that are now out there? It's conceivable that someone will come along and roll up what's left of all of the traditional legacy cable networks.
And I misspoke. HBO is not part of that. That would be CNN, the cable.
Right.
The cable entities.
Cartoon Network, TBS, right. TNT, CNN. Yeah.
Felix, Netflix is the original disruptor. I mean, it kind of accelerated the cord cutting that we're seeing everywhere. Are we setting up for a major culture clash here by having a tech company buy a classic Hollywood studio?
Well, these deals always look great on paper, and then you start combining the assets, and often you do get culture clashes. And particularly with this company, with Warner Brothers Discovery, which was previously Warner Media, we're now 25 years into mega mergers for this company, starting with AOL Time Warner, which was one of the most disastrous, combinations in entertainment history. And then, then also the deal with AT&T buying the company later. And there was a huge culture clash there. Discovery coming along and combining assets with what remained of Warner Media also has been a turbulent ride. So, yeah, part of the question is, why would this be different? And people asked that, analysts brought that up today on the phone call with Netflix executives. And what they said is, look, we're in the entertainment business. And they didn't bring up the other companies' names, but AOL was not in the entertainment business. They were a tech company, dial-up, access to the internet in the early days. And AT&T also had, basically no entertainment industry
I thought Netflix
history.
was a tech company. That's what they tell investors.
Yeah, I mean, and they, there's the famous quote of that Ted Sarandos said, early in the streaming wars, where they said, he said, we have to become HBO faster than HBO becomes us. And, I think if you look back at what's happened in the, dozen years since then, Netflix was able to master the skills of an entertainment company and how to develop original programming, how to build franchises quicker than HBO was able to master the streaming technology and distributing in this post-cable era.
I think about the culture clash, and I think about how Amazon bought MGM for $8.5 billion. And you don't hear about MGM anymore. It's kind of like it's lost its identity.
I can't imagine that would happen with Warner Brothers, but I mean, could it? Does Netflix just become so big it overshadows these legacy brands?
Yeah, I think there's some serious questions about how these are going to fit together. And people asked today, like, what is, what's the plan? Like, is HBO going to be a standalone streaming service? Is it going to be integrated? Is it going to be like a tab on Netflix? And they said, well, hold up. We have basically a year to 18 months to figure out these questions. We're still ourselves kind of figuring out how they're going to fit together. But they see them as complementary services, complementary brands. And I think it's interesting when you think back about the past year, because in a sense, this was something that executives at Warner Brothers Discovery also came to this conclusion in the past year. They'd spent the past couple of years saying, oh, we're going to build this giant streaming service with the assets from Discovery plus the assets from Warner Brothers to build a Netflix competitor. and they weren't able to catch up to Netflix in a meaningful way in terms of subscribers and in terms of the amount of time people spend on the service. And eventually, in the past 6 months, they started saying, you know what, we kind of see Netflix as a utility. Everyone has Netflix, and there's a bunch of other complementary streaming services, of which HBO Max is one. And so we're not going to try and offer everything. So in some ways, there is, other people kind of saw this come in. Maybe there's some world in which if you already have Netflix, do you, buy the HBO add-on in the future from Netflix to see, the next season of
another bundle choice is what we may have.
More bundling.
But this is more bundling. Oh, yay! Something to look forward to.
Yeah.
Real quick, Warner Brothers Discovery has a market cap of about 64. Is it 64 million? Is that right? Billion. Yeah. Why do we have million here? No, 64 billion. That's right.
Yep, 64 billion.
So are they overpaying for this? Is Netflix overpaying? Because they're not getting the whole company and they're taking on the debt.
Yeah, I mean, I think what the share price is down a little bit today, so I think there is some skepticism and, questions about Netflix's overall strategy. Did you run out of other things to do? There have been talk in the past of, where is Netflix's growth going to come from? Well, they did this password crackdown, efforts that, people were like, what could that really do? But it was actually pretty successful. And, then they said, okay, we're going to start doing advertising, have an ad-supported version of Netflix, which previously they'd said we're never going to do advertising.
Yeah. Oh, and sports too, right?
And sports, live sports was just part of attracting advertising. Then what's next? So what's next is this deal. And it's not that, out of the, realm of what they're already doing. So I think there's some question is like, paying for all that additional library, how much does that help you? Especially when you look back at, say, Disney's acquisition of Fox and their whole library, which again, huge library of really rich content, movies, TV series. And when you look back at that deal, people now think Disney maybe overpaid.
Well, certainly we know that Rupert Murdoch sold out at the right time, if nothing else. All right, Felix, appreciate your joining us this afternoon. Felix Gillette wrote the book on HBO. He is Bloomberg's media and entertainment editor and, of course, author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. And I think you nailed it when you said, oh, bundling, yay, because the history of media is about bundling and unbundling, and now we're back to bundling once again.
Yeah, and also never say never. I think those are the two big takeaways, right, from this merger.
All right, well, we also have data that we want to get through today, some economic data. What I found really interesting was a recovery. I don't even want to call it a rebound. It's just a bit of a recovery in consumer sentiment, rising for the first time in 5 months, although it's coming off some very depressed levels, the second lowest ever, according to the latest University of Michigan survey. Let's talk about the health of the labor market and economy now with Karen Kimbrough, chief economist at LinkedIn. Karen, you are looking at the labor economy through your lens over at LinkedIn. What do you see when it comes to job postings on LinkedIn and the take-up of those job postings?
What we're seeing right now is a labor market in the U.S. that is continuing to soften. It's not collapsing. We still see some pockets of momentum, but largely this is the labor market where employers are cautious and workers are feeling a little insecure. So, for example, when we look at our data, what we see at LinkedIn is a workforce that is adding that little badge on their profile that says, I'm open to being hired someplace. And we saw a 20% increase. Yes, a 20% increase in members on our platform adding that badge in the U.S. alone in the past year.
Wow, that's
significant. Kind of a sign of insecurity. So despite this confidence measure you just mentioned among the consumer, what we're seeing amongst the worker is a little bit of insecurity. It shows up also in our own confidence measures where we say, how do you feel about getting a job, finding a job? And it's at this lowest level we've ever seen since we began this over 5 years ago.
Yeah, and we know that
yes.
Well, I was just going to say it's taking longer, right, for folks to find a job, which is an ongoing problem. So I'm curious to know where you're seeing the most hiring, the least hiring from your lens there at LinkedIn.
Yeah, so just taking it industry by industry quickly, some of the standout industries where we're seeing hiring pick up, it's actually positive, it's looking healthy. Tech, for one, believe it or not, is back in the black. It's positive. We're seeing hiring rates running around 6%. So tech is hiring, media is hiring. We also see it in healthcare, which has been a long-standing story of healthcare just outperforming in terms of hiring, and for obvious reasons. We see it in education. When you think about primary and secondary education, a lot of hiring going on there, not so much at the university level, though. So there are pockets where we're seeing the hiring happen. Finance is holding in as well. Where we don't see it happening, where there isn't much momentum, is construction. Think about retail, accommodation, not seeing a lot of hiring happening there. Manufacturing is looking very depressed. So these are pockets of no momentum. And I think when you put it all together, what it tells me is that we've got a labor market that is still moving forward very slowly, without much momentum, but it's got a fragility to it. If we were to get a shock, it probably would be pretty rocked by it.
Wow. Okay. So that's a great way of characterizing what we're seeing right now. I think there's also frustration for a lot of job seekers, Karen, by so-called ghost jobs. There's an abundance of listings, but when people apply to jobs, there's very little follow-through on actual hiring. And it's not clear if there's a qualifications mismatch or whether maybe companies are just building up an inventory of candidates for potential positions down the road. I'm curious what you're seeing at LinkedIn.
You know what, I wouldn't put it so much as ghost jobs. What I would put it as people are finding it's taking longer to find a job. So we do see applications per applicant having been, elevated over the past year. Again, like I said, people are putting that open to work badge. They're feeling a little frustrated by a labor market where, frankly, it's a lot tougher and it's taking longer to find a job. But I don't think it's a question of just ghost jobs. I think it's a question of many more applications per job. The other thing I would say is, there is a bright spot. There are places where people are having more success, and one of them is in the small business area. So small businesses are hiring. Their hiring rate is positive relative to large businesses. So those big companies, 10,000 plus employees, they're expressing more caution. They're holding back. They want to wait and see what's going to happen with the economy, with rates, with industrial policy, with AI. But the smaller businesses are taking up the mantle. They are absolutely hiring right now.
In about 30 seconds, Karen, what's the outlook in 2026? What are you seeing there at LinkedIn? Might we start to see a bit of a loosening up and more companies willing to, expand the payrolls?
Look, what I'm seeing right now is I think that the optimism that we're seeing about the economy, the outlook from small businesses who say, look, I'm finding it actually pretty easy right now to kind of continue doing my hiring. I hope that continues. I hope that small business optimism continues because that really is a backbone for the economy. I think the bigger companies are a lot more cautious. I think that's more of a wait and see. They have a big AI play for a lot of them. So I think they're going to be more cautious.
Karen Krimbro, really appreciate your joining us, Chief Economist at LinkedIn in Sunnyvale, California. And, Karen talked about small companies being big drivers of job growth. I think for job seekers, the concern is benefits. You might not get health insurance coverage at the same rate or in the same quality that you would at a bigger company, or other benefits for that matter.
No, it's true. But I think for a lot of folks who are just looking for the work, and to your point, the ghosting, the not being able to get an interview, going on one interview and never hearing again. Yeah. For some folks, doesn't matter if it's small or large, they just want a shot at that job.
Right. And we know companies sometimes list jobs for people they already have in mind. They just need to do it to make sure that it's out there.
A lot of that.
All right, well, a lot more to come here on Bloomberg Business Week. Right now, we are looking at an S&P 500 that is in the green, up for a fourth straight day, up by 0.2%. The Russell 2000 negative by 0.3%. This is Bloomberg Business Week.
So good for them. So
It's 2:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we begin with a developing story. SpaceX said to be in talks to sell insider shares in a deal that would value Elon Musk's rocket and satellite maker at $800 billion. Now, this according to the Wall Street Journal, citing sources. The other top story at this hour, the U.S. Supreme Court will review President Trump's planned rollback of automatic birthright citizenship, setting up a high-stakes showdown over what long has been understood to be a constitutional right. Stocks right now trading higher. S&P, Dow, NASDAQ all advancing. S&P up 15, 68.72. That is a gain of just about 0.2%. We do have the Dow Jones Industrial Average up 153, a gain of 0.3%. The NASDAQ Composite Index up 0.3%, higher by 59 now. A down day for the Russell 2000 Index of right now, looking at a loss of 0.2% on the Russell 2000. 10-year at 4.13%, with the 2-year 3.56%. Gold 42.08 the ounce, flat on the day. West Texas Intermediate crude 60.03 a barrel, up 0.6%, and Bitcoin now down by 3.1%, 89,358 on Bitcoin. Deal news, Netflix trading lower, down 2.7% right now. Warner Brothers Discovery up by 5%. Stay with Bloomberg for the latest on the deal news. Also, the other story that we're following for you at this hour, Southwest Airlines lowering its operating profit target for the full year, citing fallout from recent U.S. government shutdown as well as higher fuel prices. Southwest up by 5.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
all right, thanks so much, Charlie. Alexis Christophorus here with Scarlet Fu. Carol and Tim have the day off. From the White House to Hollywood, just about everybody seems to be weighing in on this Netflix mega buyout of Warner Brothers Discovery. So let's break it down a little further with Chris Palmieri. He is Bloomberg Senior Editor and Entertainment Team Leader, joining us from Los Angeles. And here in New York City, we want to talk about the legal and antitrust concerns with Jennifer Rhee, Bloomberg Intelligence's Senior Analyst for Antitrust Litigation. Thanks, guys, for joining us here on a Friday afternoon. Chris, I want to start with you. There was a group of anonymous film producers yesterday who sent a letter to Congress, and they said they had, quote, grave concerns about a Netflix deal. They argued that Netflix views any time spent watching a movie in a theater as time not spent on their platform. What are you hearing in terms of industry reaction to this deal?
Well, I'll put it this way. The Writers Guild that represents screenwriters came out with a statement that said this merger must be blocked. So they always have a way with words, I guess. Yeah, no, Hollywood not happy. Everyone from James Cameron to Jane Fonda publicly saying that losing Warner Brothers would be, in some Cameron's words, a disaster. They're not happy. The industry's already gone through wrenching change. Movie theater attendance is way down, cutbacks, runaway production, everything being shot overseas. Already seen, big mergers of MGM and Fox, and so nobody's really happy about seeing another giant deal like this.
You mentioned how the WGA, the Writers Guild Association, wants this deal blocked. Jen Rhee, is this something where regulators would step in and say, hold on, we need to go through a lot of things before we give this our blessings?
Oh, I absolutely think so, Scarlett. I mean, it's got a long haul before it. I'm sure it'll go into an in-depth investigation by the Department of Justice. Some state attorneys general may join in on that, and likely in the UK and in Europe as well, where Netflix is quite popular. You know, these concerns that Chris was just talking about in the antitrust world are called monopsony concerns. And this has kind of come into focus before the DOJ in the last like 5 to 10 years. And it's about too few buyers of products or services, right? And so this would be about Netflix. It's kind of two-pronged because it would be about Netflix now owning all of this content, the video creation assets of Warner. They already hire artists, writers, and talent for writing their own original scripted content. And now they'd be even a larger buyer of these services. And that could push down wages, quality of work, et cetera. For this big pool of talent. And that's one issue. And then the movie theaters are concerned too, because Netflix is a streaming entity, hasn't historically released movies in theaters, and would down the road be able to do what it wants to with new theatrical releases.
Chris, what is Netflix saying, if anything, about how they may treat movies in the theaters if this deal were to go through?
They've said they honor commitments that Warner Brothers has with films being released. A big part of this is the talent, the people that have the clout when they get these films made, want their pictures in the theaters. So that will continue. What's not been addressed is what happens after the sort of the deals that Warner Brothers made with James Cameron or whoever. What happens after that? Netflix's strategy has been very limited releases in theaters, usually just to qualify for Oscars nominations and things. It's always said its primary audience is the subscriber at home.
You know, I think about what this would mean to me as a consumer because, of course, I pay for both Netflix and HBO, and I wonder whether combining them will result in a lower price, the same price, or whether Netflix might make me pay for an extra access to HBO. Jen, how do you think about what regulators are likely to say regarding subscription prices?
I mean, that's certainly an argument that Netflix is going to make as to why this deal is pro-competitive. But I'll tell you that a company with market power promising to keep prices low doesn't really hold much sway with the antitrust regulators, because antitrust is about maintaining a market structure that lends toward competitive prices, that results in competitive prices, not the promise of a big company that, hey, we're going to keep releasing movies in theaters or we're going to keep the prices down. You know, a short-term gain to consumers in early on lower prices could result in long-term harm to consumers as other smaller streaming entities go out of business, let's say because they can't access popular content of Warner Brothers, they can't license it because Netflix, you know, doesn't allow for that. And then it sort of leaves a combined Netflix, HBO Max able to do whatever it wants to with prices down the road. And I think that would be the concern of regulators, even though there would be an argument that early on there could be a lower bundled price.
So Jen, what about divesting what I don't know, but would the government ask Netflix to divest something? Would they have to make some changes in the way that Skydance had to when the FCC greenlit their deal with Paramount? I think they had to scrap some DEI initiatives and do a few other things. So what might that look like here?
Well, I know it sounds strange because HBO Max is a big asset here that they're buying, but I think they could be asked to divest HBO Max. And it may be that Netflix would be willing to do that in order to get those studio assets. I think that would really solve their problems in the UK and Europe. It would go a long way to getting those things resolved, and it would solve some issues in the US as well. I would believe they would still likely have to enter some sort of a behavioral remedy with respect to being willing to freely license popular Warner content, IP, what's in the library, to some of its streaming rivals. But maybe that would be a path to getting this deal done.
Chris, jump in here. Would Netflix be willing to divest HBO Max at this price tag?
We haven't asked them and gotten an answer on that directly. Right now, their plans are to operate it HBO Max separately and kind of bundle Netflix subscription and HBO together, sort of like what Disney does with Hulu.
Right, but I mean, this is part of why it wants to buy this asset, right?
It would be very difficult to separate HBO because so much of the content is associated with Game of Thrones, The Sopranos, and that with the brand. So if they were to sell that, I mean, HBO Max is also very dependent on the movies that Warner Brothers makes, Batman, on, Harry Potter. So it's not impossible to separate, but it would certainly be tricky.
You know, look, let's face it, a lot of these things happen because people have relationships, right? And we were talking earlier about how Paramount really seemed to be the one that made the most sense out of the three suitors here. Does a lot of this, Chris, have to do with Netflix's Ted Sarandos having this personal relationship with David Zaslav at Warner Brothers?
Good question.
That certainly does seem to be a factor here. Ted is very well liked in Hollywood, which is shocking considering the power that they have. Other people less so. I mean, it's not like Ellison is disliked, but there's certainly a little bit of a feeling that he was a bit of a newcomer to come over here and take up Paramount and then immediately try to buy Warner Brothers. People are used to working with Netflix. Certainly the idea of Netflix having control of these franchises and being able to grow them all around the world as they've so successfully done with original franchises is certainly appealing to some people. So I think that's part of the reason why Warner Brothers went with Netflix.
Now, speaking of people to watch, Jen, I'm going to ask you a dumb question. Does Brendan Carr, the current chair of the FCC, play a role in any of this, or does he not get involved because this is cable television assets?
He's not involved because it's not even cable television assets because Netflix
because that part of the deal is not part of it. Yep.
Yeah. So the FCC would not be involved. This would be, at least in the U.S., the Department of Justice. And like I said, probably some state attorneys general. We've already heard from California that they're concerned about this.
Chris, we're getting reports that this is not over yet, right? Paramount is now considering taking this deal straight to shareholders. Would you see that resulting in anything?
Probably not. So Paramount has offered 30, but it's Netflix is at 27 cash and stock. Plus, there's this extra value shareholders will get from the Warner Brothers cable channels when they're spun off. So Paramount might have to come out at an even higher offer. There's questions about their financing, even though they're backed by one of the richest men in the world. They've tapped some Middle Eastern funds and Netflix being able to borrow $50 billion seems like more of a sure thing. Paramount may certainly, try to go hostile here, not necessarily going to work.
Jen, what will you be watching for? What are the next steps? I mean, there are a lot of investors who bet on deals and whether they'll go through or not. And this one looks like it'll take a while to unfold.
I think so, and they expect it too. I mean, they're saying 12 to 18 months before closing, but their purchase agreement gives them time all the way through toward the end of 2027. So I'll just be watching, I think, a lot what the administration has to say, because in this day and age, we do have a Department of Justice that's really pushing the policy priorities of this administration when it looks at outcomes for deals, when it's reviewing deals. And that's going to play a big part here. You talked about relationships, and it was clear that President Trump favored Paramount as the buyer, and the White House has already come out to say that they have some reservations about Netflix as the buyer. I'll be watching that to see what happens, because that's really going to tell you what the DOJ is thinking as they go into it. But this is going to take a long time. The investigation is going to start, and things are very quiet during that time, because that's really just a time period where the companies are turning over data and documents to the Department of Justice, and we don't really hear very much.
So basically, sit back, relax, grab some popcorn, and watch this thing play out.
And they're going to turn this into an HBO special at some point.
At some point, they are. Jennifer Reed, Bloomberg Intelligence's senior analyst for antitrust litigation. Chris Palmieri there in L.A., Bloomberg senior editor and entertainment team leader. Thank you guys so much for putting it all in perspective for us. And just a quick recap of these stocks. Netflix down 2.5%. Perhaps no surprise there. Warner Brothers up better than 5%. As for the other players in this, Paramount, Skydance down more than 8%, and Comcast haven't been talking a lot about them.
No, it's like we forgot about it. They haven't come up and said anything like they're going to try to put in a bid, as far as we know right now. I mean,
right. And you know what? Their stock is up almost 1%. As for the overall market, we're higher, guys. The Dow Industrial's up 128, NASDAQ up 102. This is Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and SpaceX is telling investors it's aiming for a late 2026 IPO now. This, according to the information. Earlier, the Wall Street Journal reported that SpaceX was in talks to sell insider shares in a deal that would value Elon Musk's rocket and satellite maker at $800 billion. Again, developing story. Stay with Bloomberg for the very latest. Stocks paired gains after a dated reading of the Fed's preferred inflation gauge, with the S&P 500 index now climbing by 0.2%, up 15. 68.72 earlier today was flirting with records. Keep it locked into Bloomberg Radio to see how things shape out at the close. And of course, Bloomberg Television has got you covered at the closing bell as well. Dow Industrials up 155, up 0.3%, 48,006 on the Dow. Nasdaq Composite Index up 60. That is a gain of 0.3%. Bought on an update from much of the market. Russell 2000 Index of small cap shares lower now by 0.2%. The 10-year 4.13%. The 2-year 3.56%. Spot gold flat on the day, 42.06 the ounce, while West Texas Intermediate crude 60.01 a barrel. WTI right now up 0.6%, and a retreat for Bitcoin now down by 2.8%, 89,610 on Bitcoin. A deal we continue to talk about, a deal we are covering on Bloomberg Television and Radio, is Netflix agrees to buy Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. It is a $72 billion cash and stock deal. Netflix shares down 2.2%. Warner Brothers Discovery, WBD on the ticker, up by just about 5.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pelleton. Just to recap the breaking news that we got, a red headline crossing the Bloomberg terminal, Alexis, that SpaceX is telling investors that it is aiming for a IPO, an initial public offering, in the second half of next year. This is according to the information, which cites people familiar with the matter. And of course, SpaceX, if it were to go public, would be a massive company. It's already seen as one of the most valuable private companies out there.
Yeah, now valued at $800 billion, according to the Wall Street Journal, more than OpenAI. Pretty incredible when you think about it. We did want to see if Tesla was reacting at all, and it's actually not. It's not doing a lot of anything today.
Yeah, like you said earlier, Tesla shares are tired. They've had They're volatile year. But okay, of course, we will continue to keep you posted on any further headlines on this. In the meantime, when you look at the overall business environment, there are headwinds and tailwinds galore, right? You have a massive AI spending build out. You have deal making, as evidenced by today's bid from Netflix for Warner Brothers Discovery assets. You also have the prospect of lower interest rates from the Federal Reserve as early as next week. Softer job market as well, with a lot of concerns, especially from consumers, that they might not be able to spend it the way they had been because they're not feeling as confident about their employment outlook. And then, of course, there's tariffs, too, which threatens to keep prices, if not higher, then certainly elevated. So with all this in mind, let's bring in Dr. Rebecca Humkes. She is a lecturer at the London Business School, and she's at the faculty at Duke Corporate Executive Education. Dr. Rebecca Humkes is also author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. Dr. Humkes, thank you for speaking with us.
Thank you so much for having me. It's my pleasure.
So I guess the first point I want to tackle is this idea of AI, whether we're in an AI bubble. And of course, we won't know the answer until after the fact. But if AI and the excitement around it starts deflating, how much does that cast a pall over everything else that we have going on?
Yeah, the difficulty we have right now is that AI investment was the primary driver of U.S. GDP in Q2. It is the primary driver of all S&P earnings. And as you know very well, 10 companies in the S&P 500 are driving over 40% of the returns. You know, this is incredible concentration. So if a few of these big AI hyperscalers have a bit of a hiccup, we could see a lot of the other market taken down with them. The challenge with any bubble is it's not black and white, as you know very well, Scarlett. There are shades of gray. And that's what we're seeing right now. Every time we get a market earning, if it's great, we think, okay, well, this is just more a narrative that we're in an AI bubble. If it's bad, we think the bubble's starting to burst. So we're going to see this constant swinging over the next couple of quarters every single time we get one of these earnings reports for that reason.
You know, Rebecca, we've been talking a lot about this K-shaped economy, and you say when it comes to people in leadership positions, to executives, they should be leaning into that, right? Like playing into the K-shaped economy. What do you mean by that? What would that look like?
So we've now had several quarters of data and really a couple of years. We are very much into this K-shaped economy. There is a small percentage of customers, 10% of American consumers are driving half of spending. We've been saying this. We're actually already seeing this happen in the holiday shopping period. Now, this lower income consumer is still spending, right? We had some good data over Black Friday that they're still spending, but it's a different type of spending. It is very value-based. It is very purpose-driven. It is incredibly researched, right? So influencers and AI engines have a role to play, but we're seeing more research and purpose-driven than we have before. And it's now time for companies to say, okay, we're beyond the point that we can do more shrinkflation or one-off promotions or even worse, wait and see. And we're still seeing this reaction from some of the big players. So my guidance is step up and play, right? This lower income consumer wants real innovation. They want value. And it's time for companies to reinvest and think about what does innovation for this economy and for this consumer look like.
So for companies, does that mean the easy answer is to just make a play for the premium consumer?
There's no easy answers in a growth strategy, of course, and we are seeing some go that way. We're definitely seeing a very bifurcated economy and a bifurcated consumer. So if you have an offering for everybody, you essentially have an offering for nobody right now. This is really the time where we want companies to really think about who their ideal consumer is. Now, if it's in the luxury end, this is still a research-driven and purpose-based, but there is a lot more froth in that aspect of the market. So they could lean in there, but then we're leaving out a large proportion of the American consumer that wants innovation, right? They still want to spend, they still want to gift this holiday period. So that is a answer, but I definitely don't think it's the answer.
And as we are about to close out this year and look ahead to 2026, how should executives, Rebecca, be thinking about the new year in terms of expanding payroll, R&D, investing, et cetera, et cetera?
Yeah, the challenge is the macro data is very messy and it's very lagging. Given the government shutdown, we are really lacking that gold standard data we really need to make decisions. And we're going to see this reflected in the Fed meeting next week. Both aspects of their dual mandate are moving in the wrong way, but not so dramatically so, right? Inflation is high, but still within a tolerance level. The job market is cooling, but we're still roughly in that no fire, no hire narrative, though we might start to see some of those fires happening. And a lot of organizations, as CEOs are looking to make their growth strategies for next year, are facing this environment. The challenge that we have is we look at all of these data points to try to get a reading, is it good or bad? And that's not how we should be looking at data as executives. We should be looking at data for insights. What does this data tell me about what my growth insights are and leading on to those? We unfortunately look at uncertainty and tend to frame it as negative or bad. And when things look gray, we assume it's going to be a downturn and start planning that way. That's not the view we should take if we want to perform in this world. It's about seeing uncertainty for what it is, a series of future events which may or may not occur. And whether or not those events are good or bad depends on what that organization is trying to do and how they're set up. So I do think on a macro level, we're going to see a real more lean into an AI investment. Many companies are really just starting to go up the curve there. R&D and innovation are looking a little bit mixed across different sectors, depending on where you're set up right now. So I think we're going to see it next year, and that'll be interesting. We're going to start seeing it coming on through earnings from next summer as well.
So, Rebecca, what is the black swan, or what's the one thing that you really worry about that keeps you up at night that you think executives, would kind of freak out over if it were to happen?
Well, executives freak out over quite a lot of things, but I tend to be a pretty preliminary bull and try to reframe everything for what that possible insight would be. There's a couple things that we should be looking for, though. This AI investment bubble right now is very much built on anticipated demand. If we get a few industry leaders, non-tech, come out and make pretty firm statements that they're pulling back from AI investment, that would have real market implications. So, of course, we're looking for that. We're also in an environment of extreme political and geopolitical uncertainty. So any big changes to more trade policy or regulatory policy that really upends industries, that could shake a lot too. So kind of anything in the AI bubble, geopolitical uncertainty, and the extreme policy uncertainty. If we could get a